Good morning, Tyler Crowe.
Good afternoon, Jason Hall.
I love it when we do that. It's so much fun. Happy Friday, everybody watching, whether you're a Motley Fool member watching behind the paywall or you are a YouTuber watching on your YouTube app or on youtube.com on the stream there. It's awesome to have you with us. And I just want to say happy CoreWeave Day to all who celebrate. Tyler?
By the looks of the IPO, I don't think there's a lot of people celebrating the CoreWeave IPO today.
Yeah, so we're going to talk a little bit about CoreWeave's IPO. It's the IPO has happened, right? Today is the first official day of trading, I think is the main thing that's happening. We'll talk a little bit about that. We'll talk about other stuff, a little weekend review looking back. And we'll answer your questions too. Get your questions into us. Go to slido.com. The event code is Fool24. Get that code in Fool24. And whether you're a Motley Fool member or you're watching on YouTube, somebody that I encourage to maybe become a Motley Fool member at some point down the road, if we can create some value for you and share a little bit behind the glass of what's special about the Motley Fool here. All right. Just remember though, Tyler's going to give great answers. I'm going to give some long-winded, mediocre ones. But whatever our answers are, just remember we're not advising you what to do. We're not giving individual or personalized financial advice. For a whole lot of reasons, it just doesn't make sense for us to do that. We don't know anything about your situation on the other end. We're not allowed to. So we're not going to even consider doing that. So get those questions into us. All right, Tyler, where do you want to start?
You know, why don't we start with CoreWeave? Do you want to just get into CoreWeave already and get started? Because ProShop guy kind of set us off first thing in the morning with a nice little prompt here with so much for the AI hype bubble, allowing IPOs to start flooding the market. CoreWeave scaling back its IPO price before even opening shows the market is getting smart.
Yeah, I think that's good. If you could, Natasha, go ahead and release the screen share. And what I'm sharing here, this will be the bulk of my shilling today. Let me go ahead and get the shill over with. Breakfast news is something I encourage Motley Fool members to sign up for. It's just a morning update of the things that are going on. You can get it in your email. You can also, if you just go to your dashboard, this is my Fool One dashboard. If you log in the morning, it's going to be the first thing you're going to see over here under coverage. But so yeah, this is the nuts and bolts of CoreWeave's IPO. Like you just said, Tyler, they were looking to IPO closer to $50. Now it's 40. So CoreWeave's core business is launching, is providing basically like data service. It's like data. It's like a data center as a service sort of business, primarily focused on AI. And they've just got a few big customers and then a lot of not customers that they want to try to make customers, right?
Yeah. And that was actually kind of look, there's going to be a lot of reasons. There's the world's reasons, there's Motley Fool reasons, and then there's Tyler reasons why CoreWeave may not necessarily be the investment that people are looking for. But let's start with probably like the big market reasons. It wasn't that long ago before CoreWeave went public where, Microsoft kind of was like, hey, maybe we don't need to sign this massive $12 billion future revenue contract with CoreWeave because, you know what, we've got all these data centers. We're building data centers. We have our own hyperscaler platform. Maybe we don't need all of the extra capacity of, leasing space with another data center. So that news came out. People started looking a little tepid. There was the news, obviously OpenAI wanted to jump in and grab the compute where they could to take that. But, seeing Microsoft back out of it was a little nervous. The Financial Times has just been really on the spot here with kind of looking at some of the things that CoreWeave has been doing recently. This IPO was originally looking for over $4 billion to raise capital. It ended up being a $1.7 billion raise, so it went way down. Some of the things that Financial Times was mentioning was like refinancing some of CoreWeave's debt is going to be challenging, talking about some special dividends that the founders paid to themselves before going public. I mean, there's been a lot of kind of not just so much of the like chatter around this on social media or whatever is going to be like, oh, it must be the the AI bubble popping, as if like this is some sort of theme. Sometimes you have to look at the just the bones of the business itself. And just because it has the word AI attached to it doesn't necessarily make it a quality business or anything like that. And there were so many like non-AI related like business things that made this an unappetizing thing. Now, a little behind the glass pro shop guys saying, it's a debt ticking time bomb, but like, look, data centers have debt. That's not a thing. Like, they'll refinance. Most businesses eventually will find some sort, part of the reason of going public is not just raising equity, it's being able to get corporate debt that you can get rated by a credit rating agency and not having to go to private credit companies or private credit lenders who charge 12, 14, 16% interest rate. It's going to the corporate bond markets and being like, hey, we want to raise a senior note at 7% and cut our interest rates in half. So like,
that's
the
a key.
lot going on here.
Yeah, there is a lot, but I want to sit on that for just a second, because there is a path to getting public debt with still being a private company. Klarna, for example. I don't think Klarna has launched its IPO yet, but it's considering an IPO. It's been around for 20 years. You can go on Klarna's website. There's an investor relations section for this privately held company, and you can find their audited financials going back more than a decade, because Klarna has gone to the debt markets to raise debt because it's used that to fund its buy now, pay later and its credit business, right? It's needed it for that, in the same way that a CoreWeave might need to raise debt. But one thing you mentioned there, that convertible debt, if you're, that's a lot harder to do if you don't have a public float, if you're not a publicly traded company. So if you want to get some of the most attractive cost of capital debt, you need to be a publicly traded company too. So that's certainly part of it. Tyler, something that you've written about that I agree with, there's definitely some questions about corporate governance here as well. We're seeing, this is something that we've seen with Meta, and to some degree with Alphabet, and some other tech companies. You get these multiple share classes, where what seems to be the pattern with some of these is the percentage of economic interest is getting smaller, while the percentage of voting interest for the founder shares, the insider shares, gets larger and larger. I don't know the exact mix, but I know it's something like a quarter of the float is going to be owned by insiders, the actual economic interest, but those insiders will have something like 80% of the vote, I believe. So it's pretty substantial. So go ahead.
I want to be like that Norman Rockwell painting of the guy standing up in the church and making his declaration of like, hey, this doesn't make any sense. And so this is my soapbox. This is my profession, my preaching to the world in terms of investing. We're seeing that is more and more pervasive over the past 20 years is this concept of the dual class shares, where founders take these A shares that have voting control and give them super majority voting control, and then have a class B share that have little to no share, voting control whatsoever. And so they get to have their cake and eat it too, where they get to raise lots and lots of money from the public equity markets and from corporate debt and have all the benefits of being a publicly traded company without any of the downsides of like, hey, maybe you need to be held accountable by your shareholders, because your shareholders, when you go to the public markets, you now have, like bosses you need to report to. We as shareholders, we are the boss of the CEO. We are the boss of the company. We are the owners. At the end of the day, they report to us. That's why we have proxy statements. That's why we have annual meetings and votes, is because we own these companies. We own their businesses. These dual class shares, where in the case of CoreWeave, they have a class B share, which is what the founders have. And these have 10 votes compared to 1 vote for the class A shares. So, 25% of economic interest, almost 80% of the voting control in this entire business. They get to basically, they can issue all the class A stock they want. and it will have very, very little impact on like the control of the business. We can't, us as the investors, whether it be an activist investor, whether it just be like disgruntled investors being like, this is, you're kind of screwing us in like future deals.
Yeah.
We could have like literally no say in this whatsoever. And I find that very frustrating because we're not, it's like disrespectful. Like we are the owners.
So I want to put a couple of cases out there that we can that investors that are looking at CoreWeave should think about when it comes to this, because it gets like back to the like the ham sandwich CEO, the any idiot company, however you want to describe it. Peter Lynch, Warren Buffett, both have talked significantly about this, and that the business quality, it has to kind of start and end with the business quality, because you want a business that's so good, that has economic moats, that is in an industry where they can get really good returns, but like you've talked about, maybe not too good of returns, but really attractive, consistent returns that aren't going to draw competition, a really good niche where there's not a lot of room and there's a lot of barriers for competitive entry, like all the things that make the companies really good, that stay good for decades, right? So good that, a ham sandwich could be the CEO and it could perform. I think it was, in One Up on Wall Street that Peter Lynch wrote, you should own businesses that any idiot can run, because eventually any idiot will run it, right? So
I feel like that's the quote where there's like 17 famous investors who have said that in some form or the other, and they all get attributed to it. It's like that, it was what was the Mark Twain's like, sorry, I didn't have time for a short message, so I wrote a long one. But that was actually like
Blaise I'm sorry this letter is so long. I didn't have time to write a shorter one. Yeah.
Which was actually like attributed 100 years earlier to Blaise Pascal, and like the same thing. This ham sandwich quote is every famous investor ever.
Right, and Pascal probably wrote it after somebody wrote it to him. Right, so it's but I think the key is corporate governance certainly matters, but business quality matters first and last. I think we should focus on there. And I want to give some examples of where this particular area of corporate governance, the business quality has been the overarching creator of value. Look at Meta platforms, for example. We can look at Alphabet, for example. Alphabet was one of the early companies really large companies to have this dual class of shares and it's something that they converted to along the way. And the business has been so good, and they've had good CEOs running the business, from the founders to now the current CEO, that it's still delivered wonderful, wonderful returns. Meta platforms, again, you could say the same thing. Even as Mark Zuckerberg, founder, has remained CEO this entire time and has, a death grip on voting control of the company, even though his economic interest is far smaller than his voting interest. Here's the counter case: Under Armour, Kevin Plank, and this may have changed some. I honestly haven't looked at I don't think it has, but they created a dual class of shares probably close to a decade ago to allow Plank to begin to exit and monetize some of his stake while reduces economic interest while remaining his voting interest in the business. Under Armour has been a terrible investment for most of the past decade. It was a wonderful investment for 15 years. And then it hit a wall of competition and costs, and it lost relevance and spent a ton of money to try to go into digital and tech-driven things that eroded value and didn't create any value, and ended up to pretty substantial write-downs and weakened the business as a result. And there was no way for shareholders to check the business, the manager. There was no way for the board to check the manager because of his de facto control, even to the point that brought CEOs in, at least one CEO, I think two CEOs in to run the company. And these people had, less than a couple years to make any change before Plank was pushing them back out the door. So there are clear cases where if the business quality, and we know that athletic apparel is hyper competitive, the moats are almost inexistent today to come into that business. You can find a contract manufacturer. All you got to do is design a product and come up with a few $100,000, and you can get a contract manufacturer to manufacture it. And if you can get some traction on social with a few influencers, you can start a business, right? The moats are everything about how you market that product has completely changed. And as a result, Under Armour is now just an also ran, right? So it gets back to business quality. If you don't have the business quality and you don't have any ability as shareholders to leverage management, then you're making the mistake of investing in that business. So
Yeah.
CoreWeave, maybe it's going to be a great business. It's so early to tell. It's so early to tell.
Yeah. And, you know, kind of to that point too, is like, you know, if you are going to be the owner of these businesses for a long time, you don't want to, you know, there's not a lot of opportunities where you want to put yourself in a situation where, you know, you're just along for the ride. It's just been it's something that's been pervasive for like the past 20, 25 years now, that you've noticed it more and more and more as these companies going with the dual class share structure. But you know, while we're on this, ProShop guy asked a pretty interesting question about this too, because, you know, one of the companies we praise is Berkshire Hathaway, but as ProShop guy, but what about Ford and Berkshire Hathaway as dual class structure? Mentions Google and Facebook as well, or Alphabet, where they're dual class from the IPOs. You know, shareholders knowing what they're getting into. I'm gonna punt a little on Alphabet and Facebook for the simple fact that, like, I actually have my contentions with that, and we can get into that later. But let's start with, I want to start with Berkshire Hathaway, because this is one that, you know,
we can throw Hershey in this conversation too.
Yeah, you go to it and you say, well, what about this one? Because it, you know, they clearly have worked out. I think there's two very distinct differences between this. Number one, there is some difference between economic interest and voting interest in the Class A shares and the Class B shares. It's not like the Class B, you know, they're divided up, and the economic interest of a Class B share is considerably smaller than that of the Class A share. So there is some separation there. It's not equal to voting, but there is some separation. And number two, and this is, I think, the most important part, is that despite the dual class share, we have decades and upon decades of evidence of Berkshire Hathaway's management acting as stewards of all shareholders, not just, you know, the Class A shareholders. And I don't just mean, you know, stock went up and to the right. This is a company that has very, very much been thoughtful about per share value for both the A and B shares. And so, to be honest, I actually don't like Berkshire's dual class share. I would much, much rather, as an example, see Berkshire do a pretty sizable split of its Class A shares down to a more affordable price and let everybody participate.
Like a 10,000 for one.
I don't, yeah, 10,000 for something where it's like, you know, maybe get Berkshire share price down to like $500 or something like that for the A shares. That, look, but they did what they did, and I can't argue with it. It was like, well, I was in high school, I think, when they did it, or maybe even younger. So it's not like I had shares where I could have said, no, don't do this. But yeah, honestly, I would much rather see Berkshire have a single class share. I can't say I even like the way that they do it now, but they've been, you know, good enough stewards of shareholder capital for both share classes that I'm willing to overlook this one indiscretion of Berkshire. Ford, I mean, when was the last time Ford was a good investment? So, like, I don't know.
Yeah. Well, it gets back to the good company thing. And Tyler, this is coming from somebody that smashed my face on the breakers of the auto industry for years before coming to the conclusion that there are rare cases when the stocks are down a lot broadly because the industry's down, where you may be able to, I don't want to say time the market, but you can buy when there's just extreme opportunity broadly. And eventually, you know, within months to a couple of years, you can get some solid gains just on the market recovering. But broadly, it is such a brutal industry. Its margins are so tight. There's so much competition. Capital costs are so high. Hardly anybody over the past decade has created per share economic value. Hardly anybody, right? So it, like I said, first and last is business quality. You know, we're right back kind of where we started. I think one of the things that I get challenged with is when there's these dual share classes that are not accessible by retail investors at all. So Berkshire Hathaway, I think you can say that its A shares are not really accessible. They're $800 and $2,000 a share today. So it would take
you can't buy one, Jason? Come on.
I mean, that'd be about all, but it would take a 1,600 for one split to get to a $500 share price. And $500 is a little scary for a lot of retail investors to buy, just a few shares. So, at least I'll say with the Alphabets of the world, they're dual class shares, both are available, but even that, it's still so, the thumb is so heavily on the scale of the insiders that it makes it hard. And then at the same time, I own shares of businesses, Clearway Energy. I intentionally buy the non-voting shares. I buy CWEN.A, which is a non-voting share. CWEN has a vote, but again, you have two sponsors in Total Energies and Global Infrastructure that are the majority owners of the business, and they have de facto control, right? So that's a case where I know there's a little bit of a deal with the devil. And in my economic interest, because my vote, buying the voting shares really doesn't give me anything material and useful, I buy the non-voting shares because they're a lower cost, they're a lower price. And this is a yield play. They're always going to trade for a lower valuation because they don't have that voting interest. But I'm buying them for the yield and the dividend growth. So if I can buy at a better cost basis for the dividend, then I'm going to do that. But again, it comes back to the quality of the business. And I do know that there's economic alignment between the purpose of that entity to be the operating business and a co-investment vehicle with those parent companies that are looking to have ownership in and participate in development of renewable energy resources, right? So again, it's all about that case, the quality of the business, but also following the money, and where does your economic interest align with those that have de facto control over the business?
Yeah. I'm going to give one last point on dual class, especially the non-traded, and then we'll move on. What happens?
It's too early for this kind of stuff. I just want to say I'm still working on my second cup.
You have your coffee. I mean, my long rants, I should be having a glass of wine. I'll look a little tipsy over here, and it'll be great. I was
going to say, what's in that coffee cup, pal?
Well, not today. So this is my last point, especially on these like non-traded dual class shares. What happens when that founder gets hit by a bus?
Yeah.
I don't think a lot of people consider that. And so that's just my closing thought. Like, you are putting your hands in a founder who might not be around. And with these very, very complex dual class shares, it can get ugly when it's time for that founder to go away. So with that last said, I'm going to go really quick on this one as a kind of a comment.
On that positive note.
On that positive note, we're going to hit I need input kind of question about where I live, and then Van Doe about Berkshire. So I need input asked. Any good business on your side of the pond look very interesting to the long term? Well, my side of the pond is kind of like, it could be Europe, Middle East, North Africa. Like, there's a lot of places we could go. I'm to where I am specifically in the Republic of Georgia. There's a couple banks that are publicly traded on the London Exchange, Bank of Georgia and TBC Bank. No recommendation on them whatsoever. I don't want to, I'm just saying that they exist, publicly traded. No comment on them at all. I have sniffed at them, but I as a weak bank analyst, I stay away from them until I have learned my lesson and gotten slapped by banks around a few times before I actually do anything with it.
Tyler, let's talk about this later. You know where to find me.
I'll send you the financials and I'll let you know what you think. So let's go to Van Doe, because we were a little bit on Berkshire, the dual class share,
question too. It's so
and
relevant
Warren
to the
Buffett,
conversation.
Being at the helm. The Van Doe asks, thought experiment. What is the premium currently built into Berkshire's share price for Uncle Warren being at the helm? And to be honest, I don't know. I don't even know if there is one, because here are the two countervailing arguments for and against. If someone were to do let's say Elliott Management were to take a very large activist investor stake in Berkshire Hathaway, and Warren Buffett isn't there anymore to fight them off in a proxy. And Elliott gets a bunch of boards of directors, and they have this very comprehensive plan to break up Berkshire Hathaway from the conglomerate back into its respective parts, the utilities, the railroads, the retail, all of it. We're going to break it all up, and everything's going to be publicly traded again. And, we can kind of do that. I would say the lame sum of the parts analysis, because everyone likes to do some of the parts and compare it to the valuations of similar companies in those spaces. My guess is, based on the book value of everything that's on Berkshire's books and the amount of time so much of that has been on the books. We're talking about See's Candy being there since what, the 70s?
No, 80s.
80s?
Yeah.
Okay, Geico. How long's Geico been there? 40 years, right? Probably fully depreciated.
Well, when they fully acquired it, it was actually in the early 90s, so not quite that long, but 30 years.
You get what?
Yeah, but the
early 90s, only 30 years ago.
Is the carrying value of those assets on the books
is very, very small relative to what their market value would be. That's kind of the prevailing thought here, is that I would actually argue there is probably a sizable conglomerate discount built into Berkshire Hathaway if we were to just, send all of its respective operating subsidiaries out into the wilderness as publicly traded companies. Together, there's probably a conglomerate discount, but at the same time, there is a Warren Buffett premium. So yes, it's a conglomerate. It's probably discounted relative to its sum of its parts, but the existence of Warren Buffett is going to give it a little bit of lift, because there is I would say mostly an assumption in the market that Warren Buffett and everyone on his team are excellent capital allocators and will figure out how to do this well. And so I don't know which one is the more important component. Is the Warren Buffett premium greater than the conglomerate discount in Berkshire? I am somewhat of the opinion that it's a conglomerate discount, but I might be on my own in that regard.
I want to throw some numbers out there just for giggles on Berkshire Hathaway. So right now, the market capitalization is about $1.1 trillion. The most recent 13F, which is the quarterly filing that breaks out the equity positions in U.S. based equities. It's a requirement by the SEC, Securities and Exchange Commission, that they file this every quarter. It's about $267 billion, roughly. How much cash does Berkshire have on hand right now?
300 something billion.
Yeah. So let's call it.
Let's give it to you if you just keep talking.
Yeah. So okay. So there's that. Now I'm going to give some prices to some of the market peers out there. So Geico's a massive business. Progressive Corporation market cap's about $161 billion. Southern Company, the big utility, is $98 billion. Canadian National Railway, which I think is probably, in terms of scale and size, probably the best comp to BNSF, $62 billion.
Pacific.
Mate, you think Union Pacific? I know they're U.S. based, but in terms of like the routes and stuff.
Yep, because they're both the West Coast USA only.
Yeah. Okay. All right. You know what? Let's do that. I'll do Union Pacific instead of Canadian National. So Union Pacific's market cap is, yeah, $141 billion. Okay. So that actually supports my case even more. So let's say we've got $260 billion in stocks on the portfolio. We've got $300 billion in Union Pacific and Progressive. So that's, you know, BNSF and Geico. We've got another $100 billion in our utility business, Berkshire Hathaway Utilities. So what are we at right there? That's 3 and 3, 6, 7.
Plus 300 billion, 334 in cash.
Right. Call that $1 trillion. Right. That's pretty close to $1 trillion. And then we've got another 40 subsidiaries. You know,
Yeah. They're small, but they're there.
I mean, they're not all that small, you know, but again, they're not they're not the same scale of these kind of core businesses as well. So again, the part of the answer to that is the valuations of these analogs to the fully owned subsidiaries and the valuation of that $270 billion in publicly held stocks. Are those overvalued right now, or are they reasonably valued? Right. So you kind of have to think about that a little bit. So that's one way to think about it. It's like, you know what? It's probably roughly fairly valued with a little bit of a discount. The discount of all of the intrinsic value of all that other stuff. Right. I think that's where the conglomerate discount comes in. I want to share one more thing on the screen because this is something that to a certain extent maybe gives us a little bit of Uncle Warren's thinking. If you can release the screen share, please, Natasha. I've got, you know what, I can pull off the B shares because I don't think it's really going to matter very much. But you see, this is the past 10 years. The yellow line, is that yellow or orange? I don't know which it is.
We'll call it yellow.
The school bus color. This is Berkshire's shares outstanding, the A and B. It's the same. Over the past decade, it's down 12.5%. This blue line, the two blue lines, this is the price to book value. And if we notice, that has moved up substantially more recently. Now, if we go back a little bit, what I'm going to do is I want to show you, this is the past since the beginning of 2024. The share count has essentially stayed flat as we've seen the book value. Since the book value really started to move up, Berkshire has basically stopped repurchasing its own stock. So that's as the company has reduced its equity exposure and continued to accumulate cash. That screams that Buffett says the stock is too expensive right now because it's never had more cash to work with. And he's talked about how hard it is to find opportunities to move the needle for Berkshire investors. The cleanest way to move the needle is to buy back a couple $100 billion worth of stock, and you'd still have a ton of shares left over. But Berkshire's not buying its own stock. That tells you that Uncle Warren thinks that the stock is trading for a premium right now. I don't know. Maybe there's a secret letter somewhere that says, hey guys, let's just start keeping a bunch of cash. And then when I kick the bucket or tap dance out of here, buy a bunch of stock that next month. Maybe that's part of the plan. So Tyler, I'm going to be at Berkshire. I know you're going to try to be at Berkshire.
I'm working on it.
Yeah.
I'm pretty sure I'm going to be there.
Jeff Santoro, our colleague that comes on here in the evening is going to be there. So I'd love to see some other fools that are able to make it there. But I love the thought experiment. Thanks for giving us a chance to kind of think about that. All right, what's next?
Well, I'm going to give the floor to you for a minute because this is something we discussed a little bit yesterday. And if you have some follow-on thoughts, we had a couple questions about Kyndryl. and the short seller report. I see Rufus Grecus. Good morning, fools from remote Greece. I can assure you it's not the most remote place that people are calling in from right now.
Well, he did specify remote Greece. So
okay, so maybe a remote part of Greece. But thoughts on the short report yesterday from Kyndryl, thoughts, insight, as well as Jags asking, is there any update comments from, well, we can't say for the Fool because you and I are contributors and not exactly, we don't have any guidance on formal recommendations, and nor
so I will say this. Kyndryl is a recommendation in 5 different services. At least one of which I believe 2 of which are actual real money portfolios where the Motley Fool has bought shares of Kyndryl and also recommended it. And I think the other 3 are all idea services. We're just out there publishing best ideas on a regular basis. And these are all from late 2024, mostly early 2025. So go ahead.
Well, I actually just wanted to get if you had thoughts on this, because again, Kyndryl, I would say, is not necessarily my. It's not in my. If that pitch comes through, that's not one I'll be swinging at. That's probably in the weaker part of my swing zone as being a left-handed hitter. So, what is there anything that you have kind of maybe in a follow-up on Kyndryl based on the short report, based on some of the things that have happened since? Any changes to what you saw yesterday, or maybe just giving our 2 listeners or viewers here kind of a little bit of a update on what happened here?
So I know other fools yesterday talked about it. So Mike, Pro Shop Guy, if you don't mind throwing in our studio chat here, if there was a particular hour yesterday that you're aware of that might be good for anybody watching right now to go back and take a look at, because I know it got a lot of mentions yesterday, but I'm not sure about the level of depth. So I think the key, just to kind of circle back to what the allegations from Gotham City primarily were, is drawing connections between Kyndryl and IBM and the ongoing business relationship with the two, and making allegations essentially that Kyndryl is not properly or fully, I don't want to overstate what they're accusing, but essentially what they're saying is that they may not be fully describing or disclosing all of the costs that they're going to incur from their relationship with IBM, and that could be causing its free cash flow numbers to be greatly inflated, as the piper has to be paid for those things. I haven't cracked any filings to really dig in, but I do know other fools that I've talked to have said, look, Kyndryl's management has actually been pretty upfront with a lot of these things, and they've talked through on their earnings calls. So the general consensus from the people that I've talked about that know the company better than I do is that this is probably more hot air making steam than it is smoke from a fire. The stock closed down about 5% yesterday. So it's not, I know it's down a lot more than that at different points during the day. But it did kind of pick up some of those earlier losses. And the pre-market today, it's down a little bit. It's down about 1%. So, I think there's still just going to be lingering uncertainty from there. Mike does say here, so thank you for sharing this, Mike. It was discussed on almost every episode from the morning show through the 6 p.m. episode. So I would suggest go to the replay hub, and it might take it a day or two to fully filter through with transcripts and all that kind of thing. But you should be able to find some things on the Kyndryl ticker page on fool.com, and also as it kind of flows through. But I think the core here is, and Mike says the transcripts have been done. So again, click on the link for replay hub, and you should load the video library, video library. And you should be able to find an episode where somebody that really knows the company well talked about it. But I think generally with these, when we don't see a massive sell-off that's kind of persistent, it's probably more steam and less smoke from a fire. So I think we can just kind of leave it there.
So we're going to get nice and philosophical here because we talked about dual class shares and like I would say our obligations as investors to vote our shares and to be responsible owners of the companies that we own. ProShop guy asked if around 80% of the market is owned by institutions and ETFs, do retail investors have a viable voice in directing company management? I would say to this, there is a cynical voice inside everyone's head that says no, and that it doesn't matter, and that, all that matters is that the stock goes up and to the right. And it's very much I think there's a lot of management consultants that would tell you that. There's probably a lot of, I don't want to say it's been a train of thought for a very long time. It's just like, you know what, just let the market take care of it. Just let management take care of it. The market knows best. Daddy knows best, as Jason Zweig used to put it. I don't ascribe to that. I really don't. I think that we, as investors, have an obligation. If we own businesses and we do truly intend to own them for a long time, we should vote our shares. We should voice our concerns. We should voice our, vote with our, vote on your shares and read your proxy statements. And if you don't agree with something that management is doing, vote no. Even if management is saying yes or the board is saying yes, maybe this is just me shouting at clouds or tilting at windmills or any reference you want to make. But to me, there is a world where what we do and what we say and how we vote our shares as investors matters. It might not show up in the first year, but I think with enough thought and practice and maybe enough rabble rousing from investors like us who are sick of these dual class shares and getting kind of mowed over by management teams, that, management teams and boards of directors will change their voice. The reason that companies get away with a lot of this stuff is because we just keep buying them. And
well, it's more than that, Tyler. It's not just that we keep buying them. I mean, I'll be honest. Let's be honest here. I would go as far as to say that most individual stock investors, or at least a plurality, spend more time trying to decide which knockoff brand toilet paper pack to buy on Amazon than they do reading proxy statements, right? And understanding how the management of the companies that they invest in are being compensated. Yeah. I would go so far as to say that most of us don't spend enough time fully understanding where we're putting, hundreds, thousands, tens of thousands of our actual dollar. And we spend it on other things that have far less material impact on our financial health over the long term. So I would say that it's, and once you start doing those things and you start reading, you're like, wow, they're going to get 150% bonus on that layup thing. And that layup thing doesn't actually do anything. It's basically a participation trophy, and you're putting them on the top of the pedestal, and it doesn't create any value for me as a shareholder. What? Yeah,
exactly.
It's stunning what you find. It is absolutely stunning what you find. Yeah.
And in this maybe this idealized world where nobody lives anymore but me, I hope there's a world where these, corporate shenanigans that, diminish our role as voters, as owners of these businesses go away, because we as investors stop investing in those types of businesses as a vote of protest to say, if you're not going to if you're not going to give us an equal voice at the table, it may be a small voice, but it's an equal voice. I don't want to be any part of you. And maybe it takes voting with our wallets. Maybe it takes, voicing your concerns to your ETF provider of like how they are voting for you as a owner of that ETF. But there is this, I don't know, we'll call it like what's the term I'm looking for? It's not like ground up grassroots, like some grassroots campaign where, we all rise up again as minority shareholders and take back our rights.
What's the movie about the news station? I'm mad as hell and I'm not going to take it anymore. Everybody lets up the window, and you got to remind Mike, you got to remind me. I know you know what I'm talking about here. You got to remind me in the studio chat here. All right, Tyler, get off your soapbox. You've said
I've been up there. You know what? I'm actually kind of dizzy because I've been up in the altitude so long on my soapbox.
Pretty high. So I do want to respond to Matt's question here. Matt, if we don't have Matt's asked Tyler, I want to answer this. You've been up there too long. I'm pushing you off. If we don't have enough time to read the proxy statement, does such mean we shouldn't be foolish investors? So there's a lot of ways to invest, but I want to say when it comes to things like the proxy statement and annual report, if you can't find 12 hours a year, Network. Thank you, Mike. Network. That was the movie. Thank you. I'm mad as hell and I'm not going to take it anymore. But Matt, and again, I'm speaking broadly here, not just to you, Matt, but I want everybody to hear this, internalize it. If you can't find 12 hours a year to read the proxy statements and annual reports for the companies that you own, and as you find new companies, go back and read their most recent annual report, or two, even better, and you're trying to pick individual stocks on your own, and you're not leveraging stock advisor, rule breakers, the services that are the real money portfolios, where there are analysts that are doing those things, that are pre-vetting those ideas, then I do think you're making a mistake broadly as an investor, because you're going into investments uninformed of the most fundamentally valuable documents that disclose risks and things that companies can't gloss over like they do in their marketing documents, which are the investor presentations and the quarterly filings or the quarterly releases that they give. Those things are presentations and they're marketing documents. They're marketing to the capital markets. It's a lot harder to do that in your proxy statement and your annual report. Sure, the letter, you can gloss that up and make it sound good, but then you get into the business section and the risks and the operating statements and the other financial statements. That's where you learn about the businesses that you own. Find the time to do it. Or at the very least, start with a pre-vetted list from the analysts of the services that you subscribe to with the Motley Fool. Okay. Got a lot of people jumping in here. Larryville, Jeff M, all weighing in, reminding me that it's network. Thank you. Thank you very much for that. Where's it at here? So Lulu, Ed asked about Lululemon. I want to weigh in this. I haven't looked deeply at Lulu's earnings, but I've looked at their earnings reports every quarter for about 3 years now. So it's on my list to read. Lululemon down 13% after earnings. What is so special about a company that is a copycat in a crowded field? Ed, everybody's copying Lululemon. Let's start there first. It is not the copycat. It is the brand. They've had some issues in the past with quality years ago. And a loudmouth founder CEO who badmouthed a lot of people and is no longer involved in the company. But this is the brand that there's a lot of copycats with lower price goods that has made a lot of people a lot of money by selling those, making those copycat items. But in terms of the quality of the product and the loyalty of their core customer, this is one of the most valuable brands in apparel. They're fully integrated from design all the way through retailing, e-commerce, marketing the product. They have a lot more control over their brand and where the product's sold than anybody. Look at Nike's struggles over the past, several years. A lot of it is they tried to take a lot of control over the customer relationship, and they damaged their relationship with a lot of resellers. And that's one of the reasons that the business has struggled. Under Armour is still growing. Their guide for growth and the impact. This is one of the first companies in the apparel industry and retail that's really being clear that, look, and it's not because they're a Canadian company. It's because they manufacture largely, like most apparel companies, they manufacture in China and they have some manufacturing in Mexico too. They're saying, look, we're going to see some impact from tariffs, and it's kind of built into the guide that they're talking about how it could affect their margins. I see you're
So I
about to say
just
something,
thought
Tyler.
I was going to say, you said Under Armour. I'm pretty sure you want to say Lululemon, just so
Sorry,
everybody's clear
Lululemon.
here.
Yeah. Yeah. I don't know why I said Under Armour. So again, Under Armour has struggled from some of the same things. They tried to hyper focus on control of their own retail in the same way that Nike did, but it was the loss of Sports Authority, Sports Chalet, and some of the other retail outlets that really started to kind of undermine their business. So, but yeah, Lululemon, not Under Armour. Sorry about that. But valuable brands are rare, and Lululemon has an extremely valuable brand that they protect. They maximize their product. They're just going through a little bit of a cyclical, challenging environment right now. I think over the long term, the business is going to do well. They're starting to figure out how to leverage AI to help their operations, improve customer outreach, create better marketing for their customers. So I think Lululemon is going to return to its winning ways. It is a proven winner. It is a crowded market, but it has the value of that brand and the quality of its product that creates a tremendous amount of loyalty. Sure, there's customers on the margins that they're not going to be able to retain because of price, but they're not trying to fight for customers on the margins. Go ahead, Tyler.
I'll give 10 seconds on it. And I'm also going to give you a moment to think about small investors question here, because I feel like that's our, I can feel the crescendo of the grand finale coming up with stock recommendations at the end. But to your point on the, marketing and the designs and all of these things, this is the ultimate challenge when it comes to apparel and retail, is that you can never let off the rope when it comes to these sort of things.
Absolutely.
And that is the most challenging part when it comes to apparel retail, is that you have to be front and center all the time. The minute that you back off or let off the rope in terms of being relevant and front and center with your customers and delivering something that they want and desire and will come back for more, you're going to lose the thread very quickly. We've seen it happen with Nike. We saw it happen with Under Armour. These are, and they're, like you were saying too, it is easy to spin up a athleisure athletic apparel brand these days with a contract manufacturer in Bangladesh, and buying 5 social media influencers. The startup capital that it used to take to do this is less. It is going to be a knife fight for the Lululemons of the world, and they have shown that they can do it, but it doesn't mean that they can do it forever. And so you, as the investor, will need to stay on top of that. And those are my thoughts on Lululemon. And now we can hear the background music. It's coming up. We've just spent being existentialists for a long time, probably at Voltaire's on our bookshelves and talking about Nietzsche and all of these other existentialists and philosophy, because we're talking about dual class shares and our obligations as investors. But let's get down to bare bones, because people want stock recommendations. So let's hit small investors question here.
Yes.
What dividend stocks potentially offer growth as well do you recommend? So Jason, do you want to go first? Do you want me to go first?
So you go first, but I want to say this first of all, we're not recommending you, small investor, go buy these stocks. I always want to be clear when we answer these kind of questions. These are stocks that we love. Broadly, we recommend. Everybody, we just spent 30 minutes talking about doing your own due diligence. Don't forget that when we answer your question, people. That's what I want to say. All right, you go ahead, Tyler.
All right. So we're going to dive into my world of obscurity once again, where we often venture. We go off into the wild woods with Tyler Crowe on these recommendations or thoughts or great companies. Federal Agricultural Mortgage Corporation, also known as Farmer Mac.
Farmer Mac, right.
So if you've never heard of Farmer Mac before, hey, that Mac part at the end, does that sound really familiar? Like Freddie Mac, Fannie Mae, those sort of government service entities that have been around for decades to service mortgage markets. Guess what? Farmer Mac's the same thing. It's just for the rural America mortgage.
And it didn't blow up 16 years ago.
Nope, didn't blow up 16 years. Has it been 16 years? It's been so long now.
Yeah.
So Farmer Mac, same idea. Farm and ranch loans, FDA loans, rural electrification, rural infrastructure projects. Also looking at rural renewable energy projects. Basically, Farmer Mac is kind of the rural development secondary mortgage market maker, very much like Fannie Mae and Freddie Mac were over a long time. It's been part of the farm credit system for a long time, which has been one of these things of that the US has been working on for decades to figure out, like, how do we make the farm credit system robust enough that farmers have loans and there's enough liquidity and ways that we can bring down interest rates enough to make it to help our farmers and the rural America thrive. Farmer Mac is one of those businesses. If you look at this business, it is, I think, spectacular. It doesn't look great on paper because it's just a mortgage holder. It holds mortgages, it services mortgages, it bundles mortgages and sells them as agricultural mortgage-backed securities, all that stuff. But here's the best thing: incredible underwriting, very conservative on their loans. And this is a business that's grown its dividend by 25% annually over the past decade. Their, total loan losses since inception is like less than $50 million, despite having multiple $billion in the books. I think this is a spectacular business if you're looking for dividends and growth. 3%, 3.09, so 3.1% dividend yield today.
All right,
and I leave you 4 minutes, Jason.
Okay. I there's like 30 that I wanted to do. I thought about doing Starbucks, but I'm like, you know what? I like it and I own it, and it's more of a turnaround play. So there's some execution risk there. I thought about doing Care Trust REIT, which is starting to get really attractive to me again. Dividend growth looks compelling.
Let me pause you because I screwed up.
Farmer Mac ticker.
AGM.
Okay, there you go. AGM. So, all right. So thought about doing those two. Care Trust is really starting to get more and more compelling as the stock price has gotten a little bit more attractive, has pushed the yield up. Good dividend growth story there. But I'm going to go with Texas Instruments here. Texas Instruments, ticker TXN. It's kind of been left behind by the AI semiconductor run. Even though the analog semiconductors that it makes, and it also does some integrated semiconductor work, and it's a giant in analog semiconductors, because as much as analog semiconductors are important for like power management and radio signal and all the other things that they unlock, which means that multiples of them get sold for every digital semiconductor, every logic chip, every memory chip that gets sold, because you got to get power into stuff and you got to get signal out of it. But the rest of its business, besides anything tied to AI, which is minimal for it, has not been great for multiple years. At the same time, it's also, if you look at its cash flow, free cash flow is way down because it's making some massive capital spend right now to build out its manufacturing, grow its manufacturing capacity, and also shift the bulk of its manufacturing to a larger form factor that's going to significantly reduce its cost of goods sold, because it's going to be able to make it each pressing of each chip, it's going to be able to make like 40% more chips, 30 to 40% more chips at a time. So that's going to really drive its costs down. The question is that going to help drive its margins up? Because we've seen China invest a lot in this area. I think its fully integrated business is going to really, really shine, and it's going to continue to create value. The dividend yield's about 3% now, which is on the very much higher end of its range over the past decade. It is a wonderful dividend growth story. It is a truly necessary David Gardner snap test business. You snap your fingers and Texas Instruments is gone. The world comes to a halt, right? It would be massively industrial machinery, cars with so many more semiconductors, analog semiconductors connecting different parts of the car together. Just massively, massively important business. And the valuation to me right now, where they are, as the cycle starts to improve and get better over the next few years, and the investments they've made to lower their costs, I'll say Texas Instruments. And investors that do some diligence here and know what the risks are and the volatility through the down part of the cycle will probably continue to be really happy to buy and hold that as a dividend growth stock.
Jason, I'm so happy you left me like 30 seconds for a follow-up with Texas Instruments. Automotive tariffs. Big problem, little problem, maybe in the middle problem.
So their manufacturing is largely in the US. They do have some international manufacturing. So So their products not necessarily being directly tariffed in the U.S., retaliatory tariffs, maybe. But again, this is a timeless business that has operated through these sorts of cycles for decades, and it's built with the financial strength to operate fine. Could be some near-term risk. I'm not going to argue that at all. But again, this is a business that you buy to own for what it does in 5 years and not what it does in 5 months.
And I think that brings us to the top of the hour with our grand finale, stocks we love sort of business. So we're going to hand it over to the Jims for a much more intelligent conversation, perhaps a less existentialist than we had in the first hour here, but I'm sure it'll be a lot of fun.
Oh, we can go there. I went to Gonzaga University in Spokane, Washington. The Bulldogs. Too bad they went out early in the dance. But that's a Jesuit school, and Jesuits are real good on philosophy.
So. That is very true. Well, we'll leave you to it for this fabulous Friday, guys. Have a great day.
All right.
Enjoy, guys.
Thanks, guys. Good morning, everyone. As my cat walks across my computer screen, and Jim falls out of his chair laughing. I'm Jim Mueller, joined
I can get my dog to walk across the screen if you want.
You can see that my working situation slightly better. This is my piano. It finally arrived. It's right here, right over my screen, my shoulder. I'm Jim Mueller, joined on Fridays by Jim Gillies, and we're going to get Jason Moser as soon as he finishes rebooting his computer, which I also had to do this morning, but luckily not at the last second before the show started. Good morning, Jim. How are you? How's Guelph treating you these days?
It's going to be a miserable weekend. There is a 3-day freezing rain or rain with freezing rain buildup later in the day. It looks pretty miserable. So I'm going to celebrate this weekend by staying in, and except for Sunday when my daughter plays competitive ringette, which is like hockey, but slightly different. There's a ring instead of a puck and no blade in the stick. And it's the annual parents versus players game. So I'm going to be doing that on Sunday, which is loads of
suiting
fun.
up. Putting on the skates.
I grew up playing both hockey and ringette, so I am looking forward to this. Last year I had a lot of fun with it, and I expect no different. If I don't get body checked, which is illegal in ringette, if I don't get body checked by half the team, I will be very disappointed.
So this is a strange question, but do you remember the Monty Python movie Meaning of Life?
Of course.
Do the adults behave as badly as the teachers do in the teacher versus student rugby game?
No. And for anyone who hasn't seen that movie, the teachers pummel the poor students.
Yeah.
Literally. Anyway, morning, JMO.
Good morning,
hey,
Jason. How are you?
All doing? All good here. Got a lovely morning here in Northern Virginia. Weather's warming up a little bit, and
go away. Sorry, was that out loud?
I actually might have to mow the yard this weekend. It's a distinct possibility I might have to mow the yard.
Oh my.
I know.
There is no possibility I will have to mow the yard.
Yeah, one of the reasons I actually found myself liking living in a condo when I lived in Northern Virginia was that all the yard work was taken care of.
I certainly understand that. Now,
of course, it costs us several $100s a month, but
I will say the way I've always viewed it is, for me, it's just forced exercise for the most part. And I would say 9 months out of the year. I mean, I'm doing yard work.
So by exercise, do you mean sitting on a mower and cranking the wheel, or do you mean actually pushing the mower?
So I push the mower. I don't have a riding mower. I that was my Christmas gift this year, was a brand new lawnmower, believe it or not. Just a really, I got a nice battery powered, lawnmower that's just state of the art, good stuff. But we have a fairly big yard at our house. So when I mow our yard in totality, after I get done with everything, and I've used my phone to measure this before, I actually walk almost 5 miles.
Wow.
And so I thought, well, wait, that's forced exercise. And my doctor confirmed that, by the way, Jim. I will say, I went in for, when I turned 50, and I went in for that 50 checkup, be like, guys, is everything okay? They were like, well, what do you do for exercise? And I was like, well, the yard work, I think. And when I play golf, I like to walk. whenever I can. But they're like, yeah, walking like that is just a great way to get it done. So I'm gonna keep doing it as long as I can. My wife tried to talk me into paying for yard service, and I was like, that's insane. It's $300 a month. I'm not lighting money on fire. That's just bonkers.
All right. Welcome to the Yard Work Hour. We will continue it shortly.
I can give you some good tips.
Yeah, there we go. Okay, everyone. So
it's good.
So let's actually talk about stuff we're actually supposed to talk about.
There you go.
So on the breakfast news, the leadoff story was CoreWeave listing offers AI bellwether, and there I don't want to talk about CoreWeave. I want to talk about something that was mentioned in that. It is let's see. The price, the IPO price is going to be below the anticipated range, which is what it is. But something that that showed up in the article kind of stood out to me. Quote, more than 75% of last year's 2024 revenue was generated by just 2 customers, one being Microsoft.
Wow.
Ruh-roh.
75% from 2 customers. Do you guys take that into account when you look into companies and whether to invest in them? Customer concentration.
Sure do.
I certainly do.
Why,
Yeah.
and I'll tell you why.
Sure.
I'll give you 2 examples, or at least one. There was I'll give you 2. 75 from 2 customers, one of which is Microsoft. Did they break out what the second one was and is Microsoft 73 of that 75, or is it 37 and a half?
I don't know. I was just reading from the article. You'd have to look at the S1 for that.
Yeah, and they might even disclose it there. Okay, 75% from 2.
I think I think US GAAP requires
you have to say it's over 10, but I don't know that you need to name. I don't know that you need to name and shame. Usually, you'll see it. Customer 1, 2, and 3.
Yeah, you might not have to name it, but you do have to identify that you have them.
Yes, exactly. Okay, so I'll give you 2 examples. The first is a company called Aimia, which reported earnings last night, which is irrelevant to this story. Aimia was the former parent company of Aeroplan, which is the loyalty plan for Air Canada, Canada's national carrier, and the least offensive of Canada's national airlines, which I never thought I'd ever say that. WestJet, if you're listening, do better. Anyway, they were basically, they had a few other loyalty programs and other airlines, and they had a few other irons in the fire, but like 75% of revenue was Air Canada. Okay. And it was actually spun off from Air Canada when Air Canada went through, airlines like to go through bankruptcy proceedings every couple of decades just for fun. And so as part of the emergence from bankruptcy in 2004, 2005, Aimia got spun off holding the loyalty program. And they did a bunch of stuff that I agree with and don't agree with, blah, blah, blah. Come to about 2016, 2017. Air Canada said to Aimia, hey, you know what? We know we're 75% of your revenue, but we're going to go develop our own loyalty program. We don't need you anymore. So once our contract expires, you're done. And you can probably imagine what that did to the stock price on that day. Hint, it was down about 70%. And miraculously, I know you're going to find this difficult to believe, miraculously, after the dust sort of settled about a year and a half later, Air Canada came back and said, building your own loyalty program is hard. How about we just buy it from you? And they it has no value unless it's attached to Air Canada, right? So they had to sell it at fire sale. It's one of the great ruthless bloodlettings of corporate Canada, I suppose. And so, that's exhibit 1. Exhibit 2 is a little company called Payfare, which is basically developed a means by which gig workers, so Door Dashers, Uber Eats, Uber drivers, Lyft, that sort of thing, they could get paid almost instantly, essentially. And their largest customer was DoorDash. And stop me if you've heard this one before. But DoorDash, I think in October of last year, it was like a 10 o'clock p.m. press release, or not DoorDash, a Payfare at about 10 p.m. one night. I was watching a hockey game and everyone else was in bed.
Do you have an alert set on your phone when the SEC?
I do. No, I for various, for companies I follow, yes, I do have alerts set up. Yes. And I got an alert at 10 o'clock at night. DoorDash was dropping, or Payfare was losing their DoorDash contract to Fiserv, if you know them. And Same thing happens. Stock gets whaled 75% the next day, basically trades for the value of cash on the hand. And again, miraculously, because none of these things are ever deliberate corporate strategy or anything, miraculously, 4 months later, Payfair comes along and offers to, or Fiserv, the company that took the contract, comes along and offers to buy the rest of Payfair for like $4 a share, which if you bought it at like we had it about $7.50, it still sucks, but what can you do? They suck the knife in. So one of the giant risks of customer concentration like this is that you know it, and so does everybody else. And you start getting these kind of corporate strategic bloodletting moments. It's no guarantee it ever happens. But if and when it happens, if Microsoft ever decides to play hardball with these guys, or customer number 2 ever decides to play hardball with these guys, you are going to wake up to a 50% share price drop and extreme weeping and gnashing of teeth among the shareholder class of that particular company. So something to be aware of. Everything's got a price. I'm willing to pay lower down for it, but it's not. It's a known risk, and it's not a small risk. So that's why I wouldn't be watching this very closely.
Yeah, customer concentration. The Fool in its early history had a customer concentration problem. Back when they were being paid by advertisers and clicks, paid for clicks and eyeballs and all that stuff back in the internet day. So when you only have a few customers, if the situation changes, and remember the .com crash, that kind of dried up paying for clicks and eyeballs. The Fool got into experienced a bit of difficulty, shall we say, in being able to survive, and is one reason why they expanded to a membership business, because the customer concentration was too high. And when those customers start not buying your stuff, you are in trouble.
Mm-hmm.
You are in trouble. All right. Good morning, everyone. Thanks for checking in. Stefan from MUC. I saw Berlin Simon checked in too, but his comment's gone. Borzu, enjoying my Tim Hortons coffee this morning. So is Jim, I think. Berlin Simon. Oh, there he is. Berlin Simon.
Coffee here. Oh.
Happy Cat Day. Savet Safria, Van Doe, Happy Fool. Maybe not. More likely, maybe not about the playing a tune. You're not the only one who mentioned that, though. Hogfather comes at, hopefully Jim has to be Gillies, comes at us elbows up with some rants today. We'll see. Jeff, Ray in Pennsylvania, Zach's a Fool from Catterday Eve, Guessing Fool, Mark the Train Operator, Random Lake, Jeff, Tarshiva 8, Cena, Jimmy G, good morning, Jimmy, Matt. Let's see. Are the three of you generally pessimistic about the long-term business prospects of the Toro company, about lawnmowers? We might be able to get to that. JP was also indulging in exercise, out shoveling some snow that they're getting in the spring out where JP lives. Larry the Left Stock talks yard work. I love it. Let's see. Random Lake, Eddie Z. Get a nice riding lawnmower that the kids want to mow the lawn. Oh, here comes the cat again.
My kids are in college. They're not even here.
Kim Whistler. There goes the cat. Sorry, guys. Besties, Jenny Slipper, Kim, HFM. Good morning, everyone. Thanks for checking in. Thanks for saying hi. Yeah, don't expect any tunes. So,
yeah.
Something else on the morning news I wanted to touch on, and that was the fourth story, I think. Yes, Robinhood, ticker HOOD, says that they are going to be getting into traditional savings accounts and banking to go after the big banks. Co-founder Vlad Tenev, I'm reading from the article, wants to make the company a one-stop destination for people to manage their wealth with a particular focus on the wealthy and their stock portfolios. As a stock, it's done really well over the past year, up almost 120% versus 9% for the NASDAQ, and it was rounding up slightly. But I think Robinhood here is not being very, how shall I put it, is not being very innovative in this, because brokers are already doing the bank thing. I mean, Charles Schwab is ticker SCHW, is also a bank. In fact, that's how it's organized. It's a bank with a brokerage attached. And Robinhood is also getting into the predictions market. Interactive Brokers, IBKR, also has a prediction market that they launched. So I think Robinhood is doing more about trying to catch up and play the same game everyone else is than anything innovative. But Jason, you had an interesting comment about PayPal. Why didn't you share that?
Yeah, it just real quickly on the Robinhood story. I don't know if you saw in the Robinhood announcement there. The one thing that really stood out to me in what they're trying to do. Did you see the part about offering cash delivery? Like they're actually
What,
saying,
you mean like shipping
trucks?
Yeah.
So Gillies says. Gillies wakes up one morning and says, "You know what, man? I looked at my wallet and I need $200 in cash and I don't have it, and I don't want to go to the ATM because
Why not?
of whatever reason. Either it's inconvenient or I'm afraid of crime or whatever it may be. You know what I'm going to do? I'm going to have Robinhood deliver that $200 cash to me."
Oh,
And
my
so
word.
that was just, and of course it's going to come at a nominal fee. And
of course,
you're gonna,
what?
of course you're going to have to
5%?
tip. Yeah, you're going to have to tip. So, your $200, it might cost you $15 or something to get delivered to you. But they're actually in this mindset of delivering. Now, I don't know about you. Number one, I don't really ever feel like I need cash like that. But man, I would not want to be the delivery guy.
Yeah, I was just thinking that because if anyone can figure out, yep.
Word gets out that you're the cash delivery guy, and that's he's gonna put a target on your back.
That is very true.
Work, but
my son works for the local currency house here in town. He's doing his co-op job there, but he's also working part-time when he's not in official full-time co-op mode. And they have a small little, it's one of those little Fiat cars that looks like it could fit in the back of my SUV. It's a car you don't drive so much as wear.
It's like the little, like the Mini in the Caper. What was that Caper movie? That they remade?
The Thomas Crown Affair.
No, the three Mini cars, Mini Coopers that they put all the gold bricks in.
Well, this is not. It's not that. Well, actually, it might be that small, but it's not a Mini Cooper. It's a Fiat, and it had a wrap on it that was advertising the business. And I guess yeah. And my son has driven that because he goes to the various other locations as well. He'll drive it, and I guess I noticed they took the wrap off the car a while ago because
there's a reason
they had a. And even though, it's just a car to travel, like you're not transporting any money at all, whatever he's got in his pocket, I suppose. But like there was an incident where the car was penned in and the driver wasn't my son at the time, but the driver was accosted. Let's put it that way. No damage was done but was accosted probably because, you're driving a car that's advertising money exchange and people think, oh,
yeah, so, there's a reason
I would not want to drive
are
here.
Brinks trucks, right?
Yeah. I don't know how long. I don't know how well that'll do. I mean, it just doesn't seem like the demand is really there for something like that. But
but it's also the concept of why does every fintech company seemingly want to get into banking? I think it's a terrible business.
I don't know.
It's a boring business. Like you're not going to make much more. Like it's just like.
Okay, so you make the spread on the interest, right?
If you're lucky, ask Silicon Valley Bank how that went.
Yeah.
I mean, okay, that's not entirely fair because, of course, that was in a bunch of mortgage. It was in a bunch of mortgage securities that they locked up.
But that points out. So that's what led to the financial crash back in 2007. Is that it's a boring business, doesn't make a lot of money. How can we juice things to get a bit more profit?
But that required, I'm going to say that required, because I have recently rewatched The Big Short. That required almost, societal level. We're all going to agree to go along with juicing this. And I have some thoughts.
Well, we all trust our banks, right?
Well,
and so what the banks want to do should be.
The problem is when society as a whole doesn't decide that everything is worth ridiculous. And look, as a society, we do this about 7 or 8 years. You've already mentioned the tech bubble, the global financial crisis. COVID says hi, and how is crypto doing nowadays? We're constantly all deciding to lose our minds about something or another. But if you don't have that broad societal losing of the mind, if it's just 1 or 2 companies that decide to go into banking, so there is no existential giant crisis. It's just, why do you want to go into banking? Like, you are on the cutting edge of fintech. Like, you're changing the world, and now you want to go into stodgy, boring old banking? What, you want to pay an 8% dividend yield and trade for 7 times earnings? Like, like, why?
Yeah, Berlin Simon, thanks for identifying the movie for me, The Italian Job.
There you go.
The one I'm thinking of was a remake, actually, of the original.
Mike on our chat says, as Pro Shop guy says, doesn't banking provide leverage? Yep. See Buffett and Munger's comments on leverage sometime.
Yeah.
Well, I think in line with this conversation, Jim, you had mentioned the PayPal news, and I think it's interesting to think about that. PayPal had announced recently they just surpassed $30 billion in loans to small businesses through their PayPal Working Capital and PayPal Business Loan programs, and I think that's something that's akin to what Square, aka Block, aka XYZ, XWTF. I don't know what they're doing. But
WTF, I like that one.
I think it's important to note that in this case, right, PayPal's not trying to be a bank. They're doing this through a banking partner. In this case, it's WebBank, which is an FDIC insured bank and national issuer of consumer and small business credit products. So, I think when fintech, I think with fintechs, we're trying to find new ways to make money, and that makes perfect sense to me. A question we always kind of bandy about is, would PayPal be wise to try to become a bank? What are the pros and cons? And I've always thought, well, no. I mean, I just think there's no reason to do that. You're more nimble, not being a bank and just partnering up with banks, right? Mm-hmm. You just get to scrape a little bit off the top, and you keep on doing what you're doing, and it creates relationships with your merchant consumers that kind of keep them in your universe because you're establishing these lending relationships, and that's fine. I mean, it's the risk for them isn't really that significant, and they have a lot of data on those relationships, so they can make They can make good loans. I mean, the underwriting there, I would assume, is generally pretty sound, but. I just thought it was interesting to see they had gotten past that $30 billion. They did note that both businesses, the PayPal Working Capital and the PayPal Business Loan, they have net promoter scores of 76 and 85. And for net promoter scores, anything above a 70 is considered excellent. So they're being received well by their customers. So yeah, I just thought that was interesting news. I think it just sort of solidifies their role sort of in this value chain. It gives them a little bit more. I think it has the opportunity to really sort of stretch these relationships out and make them more meaningful over time.
I like Random Legs' comment. Why banks? That's where the money is, according to John Dillinger.
That's John Dillinger's comment, but they cited it. Okay.
They cited it.
Yeah. Well. Now the money is just that's not where the money is, because money is just all a bunch of ones and zeros. So
yeah, exactly.
What you need to do is you need to develop your hacking skills, fools.
This is where the money is, guys. Come on, that's where my money is.
Fulio, my next job is following the Robin Hood driver around and providing security detail.
I mean, that's not bad, actually. Make sure you're body armored and tasered up.
Yeah, and Fulio does mention Axon too, another opportunity for them.
I think
maybe.
I should be reading Slido. Apparently, don't usually go to Slido till we're done the planned portions of the show. So, okay.
All right, Jim, you wanted to talk a little bit. I know the guys in the previous hour touched on Lululemon earnings, but Jim, you might have some thoughts to throw in.
Sure,
as well.
I'll hit it. I'll hit on Lulu because today is the day after my Lulu, her birthday. So yesterday was her birthday. She got all the gifts that a 53-year-old woman would like to receive, including Lego comic books and more comic books. Well, Jim, you were there when we.
And I'm sure she's grateful for you.
And I know we went to the bookstore downtown, and
she got more. And
oh,
action
you,
figures.
oh, you went back?
No, well, I got a couple more. So, but no, the kids got her action figures too. So yeah, so it's just a very we laugh. You've seen the room, you understand the reference.
Yeah, and I regret not taking pictures.
We'll send you some pictures. It's insane. Anyway, not to be confused with my Lululemon, ticker symbol Lulu, reported earnings last night. The stock is getting waffled in the pre-market. Looks like it's down to about $300. It's down about 11-12% from where it closed yesterday. Getting closer to a 52-week low rather than a 52-week high. It was a fine report. It's a fine report. They did Q4 has an extra week in it because the way retailers schedule their fiscal years, occasionally they get an extra week. So if you exclude that, revenue was up about 8%. Which is, basically America's sales were flat, whereas international comps were up about 22%. Gross margin was up marginally, no pun intended, as was operating margin. They opened up about 18 stores in the quarter. They opened up, I think, about 56 stores or 56 net stores for the year. And again, looking at the full year numbers, revenue of 10.6 billion, that's up 11%, but you strip out the 53rd week again, it's actually up about 8, where again, North American sales, it kind of went nowhere. I think they're up 1%. It's really international driving the bus here. That's maybe an area to be concerned. Has Lulu peaked or at least slowed enough in North America? And what valuation does that justify? And I will also point out that the 10.6 billion in revenue for the quarter underperformed the full year guidance given a year ago. They made a lot of cash for the year. They made about $1.6 billion in cash. It's a company with a $2 billion cash stronghold on their balance sheet, zero debt. We like that. And they managing their balance sheet well. Their cash conversion cycle actually fell. Cash conversion cycle is basically how long it takes to turn raw cash into sales, inventory, sales, and collections of your payables and back into cash. It's been over 100 days for the last couple of years. Anything lower is better with a cash conversion cycle, fools. They dropped below 100. I think last year was about 105 days. They got down to about 97 days in this most recent year. It's good balance sheet management. Like I said, there's no leverage here. 1.6 billion in free cash generation. They used all of that cash essentially to buy back their own stock. They seem to have one idea for returning capital to shareholders.
And this is beyond dilution control.
Oh yeah. Their share count dropped about 4% for the year. But there's very much dilution control is a portion of it here. And also, if you want to get really pedantic about when you should be doing buybacks versus when you shouldn't. I previously talked about how Winmark is really good on this front. Medpace is another one that's really good on this front. They only buy back when their valuation models say they should, or their own assessment of their own value says they should, whereas a lot of companies just buy back constantly and otherwise perfectly good companies, Lululemon, Apple, eBay, good companies all, but they are not paying attention, or they don't put any weight on what price and valuation they might be paying. They're just returning capital to shareholders. Might not be the best way to do it, but anyway. The quarter looked good. The quarter looked fine, but it's down 11% in the pre-market. So what is that all about? And that is going to basically be summarized in their guidance. And for that, basically they're saying if you exclude the 53rd week from fiscal 24, again, you're expecting only about 7 to 8% growth. And for a company that's had, kind of the history of growth that Lululemon has had, this may be the market kind of coming to terms with the high growth story is over, or at least it may appear to be over for now. I'm really quickly going to pull up some growth numbers. In 2023, top line growth was almost 30%. In 2024 was over 40%. In 2021, which was of course marred by the pandemic, it was 11%. Last year it was 10. Next year they're expecting between 7 and 8. Their 5-year growth rate has been over 21. It's almost 22%. This may simply be, and they're citing, uncertainty due to the, we'll call it presidential administration induced uncertainty. And that can maybe be a catch-all phrase. Because people are uncertain about a great many things right now economically. What do? They pull back on spending. Where do you usually pull back on your spending? It's going to be on discretionary and luxury items, which is basically what Lululemon sells. I've said before, but I think it's a great company with great products, and I think I've had some beaten into me. I've had some really, I think, valuable insight about how their target customer looks at them. I've mentioned before, I had in the very dimly lit past, I had a girlfriend who said to me, like, when I commented on, it was during remember the see-through yoga pants scandal? Was that
Yes.
2012 or 2013?
Yeah.
Right.
We had a couple of market fooleries on that.
Well, but I remember I was talking with her about it, right? And
we lost Jim's voice.
Oh, I'm here. I'm just gonna. Can you see me?
I hear you and see you.
And
Okay. Am I heard and seen? Well, that's good to be heard and seen. No, she was a fitness instructor, so she had a lot of there was a lot of Lululemon in her world. And when I was commenting about the scandal that was going on, her thing was, what you need to understand, Jim, is that Lululemon makes products that make women feel good about themselves. And I'm like, that is incredibly insightful, and I would not have gotten there on my own. And I was just like, because I was like, this is a disaster, and you can't even make your signature core product properly, blah 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 blah. And she says, no, you're wrong, and here's why. And I'm like, cool.
Yeah, I think. Sorry about my comments. I muted for some reason. I muted the stream, and so I couldn't hear you. So that was me.
You should mute me. More people want to mute me.
It's interesting that your Lulu was pointed. That was your.
No, it was one of the ladies between marriages.
But that's an interesting point, in that she was the one who identified that, and once she said that, you said, "Oh, of course."
Yeah.
But
that's why I said I would not have gotten there on my own.
Exactly, and I wonder if that's just because you're a guy and she's a girl, and if that made any difference.
And she worked in the industry, and
that helped.
Yeah. But no, I think it's always really good to take, like I've said this before, and I'll say it again. David Gardner and my stock picking style, very, very different, right? Obviously. But I think David Gardner is probably one of the fools I've learned the most from, and I think we could all probably say that. But no, it's like, because I know value investing already. If I'm hanging out with someone who's another value investor, we're just self-reinforcing each other. We're not really learning anything. We're just having confirmation bias festival. And, that could be nice and all, but we're not really doing anything to better ourselves or to better outcomes for members. Whereas if I am going out and getting disparate opinions and I'm seeking out opinions or ways of doing things that are not just different from mine, but that may in some cases be like completely diametrically opposed to mine, I'm going to say that's over time, hopefully going to filter into my process as well, and ideally make me a better investor, and ideally make me a better advisor for services that I participate in. So I some people think that being wrong must be avoided and pushed and fought. No, I want to be wrong as often as possible. Please tell me why I'm wrong. Well, I'm gonna. That should be unstated, but I guess you're right. I should state it. I want to be wrong as often as possible, so I can grow and so I can add to my process and learn.
Ted has options comments on Thinkorswim. He's saying that Lulu traded all night, and then writes a nice comment. Oh, great! New ways to make bad decisions. Trading all night long. Yeah. All right, let's hit some questions, folks, if you have them. Bestie's asked me, how's Schrodinger doing? How's their drug business doing? Do they work with Chinese molecules? I don't know if they work with Chinese molecules, but at the moment last time I looked...
didn't know molecules could have.
Yeah, I didn't know.
nationalities.
I didn't know that. I mean, maybe they mean Chinese drug companies and their molecules. Okay. But Schrodinger's right now in a bit of a holding pattern. We're waiting for phase 1 report out of their first own molecule in trials. I think that's I couldn't find my notes, so I'm going from memory. I think that happens later this year. At least they're going to do a preliminary report out on that at one of the big science conventions in April, May, sometime along that line. And that should provide information about that. Schrodinger is in the slow part of drug discovery, which is the clinical trials. I mean, what they do, their software speeds up the molecule discovery process, which can be very long because it's all in silico on the computer rather than in vitro in the lab. Actually making the molecules and testing them, they do that all on the computer. So that speeds that up and saves drug companies, pharmaceutical companies, a lot of time and energy and money, the last one being very important. But once you get into clinical trials, that's the slow process, and that's going to take a few years. So they are still in a holding pattern for that, but we should get some data later this year. That's where they stand. And while I was talking, did you guys have a chance to look and maybe grab a question or two you wanted to answer? And if you didn't, why not?
Got going on here.
Let's see.
Now look.
Who asked about
here? Go Habs Go says, "Morning, gents. Missing Alicia. Any update?"
That's what I was looking for.
Cheer to my Fridays. Yes. While Herr Mueller was up visiting me in the early parts of March, we were in downtown Toronto letting Lulu go on her book run. And we officially got word that she welcomed a beautiful baby daughter on March 1st. We've had conversations since. Mother and baby are doing fine. Father might be a little frazzled. Chris might be a little frazzled, but that's okay. No, everything has gone well. And I was speaking with her yesterday, texting via text yesterday, but everything continues to go well, and baby looks very healthy, and I can confirm the baby has an excellent set of lungs. So yeah, it's all good, and I think her mat leave goes to June.
Yeah, she has.
It makes sense, something like that.
I think it's something like 4 months.
Yeah, okay, maybe July, but she
I'm
will
sorry,
be back.
guys. You're stuck with me for now. I apologize, but
man. Come on, Alicia. Come on.
I work here. How can I help?
Well, Jason, don't worry. If you have another baby, we will also be excited. But
I am I'm aiming to avoid that. But by the same token, I went and met Matt Greer the other day for lunch here in Fairfax, and there we just a local pizza joint. There was a couple of grandparents sitting there with their little granddaughter. She couldn't have been more than 6 months old, maybe 8 months, but in that 6 to 8 months old, and just the most adorable thing. I mean, and she was just like looking at me and smiling the whole time, and I was having fun making faces at her and whatnot, and it was just such a good reminder of how I just really, really enjoyed that phase of life with my daughters, and it was something that I miss it, but dang it, man, I'll tell you, you had to set that coffee maker on stun. It is hard work. It is hard work.
How strong do you want your coffee, sir? I want it to show up on a drug test.
Exactly.
Let's go.
Exactly.
Getting back to Schrodinger Filio comments, I commonly work with Scottish and Irish molecules, usually after hours. Nice. And Irritable asks me, have I used any of the Schrodinger software suite for drug discovery specifically, especially for biologics? I've never used it. That was not what my research was in. My research was in DNA repair. So I was not in drug discovery, and I have long since left that behind. So no, I've never used it. Go Habs Go. I wish Lulu would ramp up menswear a little faster. Ray Alicia, congrats. I did not know. Let's see.
I've got a question if you want me to throw one out?
Go ahead.
Besties asks, Jim G, why and how have you changed Academy Sports and Outdoors price targets? $80, $70? How do you determine that? Well, I use what's called a discounted cash flow model. And as I like to say before, anytime I talk about DCFs, every single DCF you, I, Jim Mueller, Jason Moser, anyone else ever does.
And all of Wall Street.
And all of Wall Street, every single DCF is and will be wrong. Period. The end. And that is because when you're building a DCF, various tools, you come up with your explicit forecast and then your long run kind of terminal forecast. And your forecast might be, these guys do a 5% free cash flow margin, so I'm going to assume revenue at 10% for the next decade and 5% margin. Or you might forecast every little jot and tittle of the income statement, and you might forecast the balance sheet, and with a cash conversion cycle, you can do all those things. That just gives you more opportunity to be wrong.
Yep.
But being wrong is a feature, not a bug. And what I like to say about DCFs is they are precisely wrong, but they might be roughly right. They might be directionally right. And so, and you also want to, so what you do is you make your forecast, you forecast your cash flows, you discount them back to the present at an appropriate discount rate. A lot of people don't listen to that part. At an appropriate discount rate, add any net debt or delete any net cash, make adjustment for stock-based compensation or outstanding options and warrants if there are any, which is what I do. I treat them as contingent liabilities like a debt. Take that off, divide by the number of shares outstanding. That gets you your target price. So besties, if I say changed one aspect of growth, and that flows through the spreadsheet, and what was previously saying at 80 might drop to 70, could also go to 90, could drop to 75, move to 74, can be but directionally, what I need to be asking myself is the explicit forecast over, say, the next 10 years, is my explicit forecast period, does that make sense? And by that, I mean, let's say it's a company that's done 5% revenue growth for the last decade. And then my explicit forecast is for 15% revenue growth for the next decade. Does that make sense? When a company's only been able to do 5, and I would be sitting here going like, well, why is it doing 15? Why do I think? But if I build it using 15, and by the way, this is actually something that I saw in a pre-IPO company. Was coming public, and it had done 5%, but the roadshow from the company saying, oh, we're going to do 15% going forward. And my response was, I'm going to short this company into the Stone Age when it goes public, because that's nonsense. But when you change a slight aspect of growth, when you change perhaps the margin, you're trying to make, again, you always want to be asking yourself, does this, my assumption, does this make sense? And you flow through the spreadsheet. And so, besties, I can tell you right now, if you want, I can give you any number you want out of a DCF. Okay. The stock's trading, I think, 48, 49 or whatever today, somewhere around there. If my spreadsheet comes out that it's worth 80 or worth 70, I think the last one I had was 75 or 76. All three of those numbers lead me to the same conclusion. At 48, this is a buy, particularly because what do they do with their capital they generate? They pay a modest dividend, which they've just raised. They cover all of their expansion growth, and the rest of the money goes and buys back their own stock. And unlike Lululemon perhaps last year with fading growth prospects, Academy Sports and Outdoor, no one's buying them for a growth story. Academy Sports and Outdoor, what they're doing is they're using all of their generated cash to buy back their own stock. And when they do that, the remaining pile of shares or pool of shares that you spread future cash flows over shrinks. You own a larger proportion of share of the business. But I wouldn't get hung up on specific numbers, because I'll tell you flat out before, and it does not just Academy, it's any company, anywhere, any valuation. The target price is wrong. Has to be, because the world will unfold differently than your forecast in every situation, particularly if it's a detailed forecast. It's more DCF talk than anyone ever needed.
Well, I'm going to extend that because
here we go. JMO's fully checked out now. He's like, no, I'm out of here, man. You guys are idiots. Go ahead.
a DCF model, despite being wrong from the get-go, is very important to do because it forces you to think about how the company makes money and how it generates cash flow and profits. Okay, and it gives and that leads you to the 2 or 3 levers that the company can actually manage to pull and generate growth for itself. I remember building one for Netflix years ago, and I updated it routinely. But you could change a lot of assumptions on that, but the ones that made the most difference to the final share price that the model kicked out was subscriber growth.
Yep.
I mean, bar none. I mean, you change subscriber growth by 1% or 2%, and the share price went woof or whoosh. I mean, it was quite impressive. You change free cash flow margins, you change operating margin. That has some effect, but it was the subscriber growth that really changed that for that company. And you can see that with other companies. I mean, restaurants. A big part of that is higher foot traffic, higher basket size, that is how much people buy per transaction, and store growth, right? Those are
and
probably
you might want to watch labor costs too.
Yeah. That would eat it. That would eat it.
Particularly in the last couple of years.
Yeah, on the downside. So, so it forces you to think about that. I once went to a class sponsored by this, run by the CFA Society of Washington, on how to model banks. Okay. And it was a 2-day class, and bring your computer, and you better be good at Excel because we're going to be using Excel. And it was basically build the financial statements for the next 10 years, the 3 of them. The income statement, the balance sheet, and the statement of cash flows. And the number of assumptions that went into that, because, I mean, every single line of those statements, okay, every single one had assumptions about growth. And the more assumptions you have, the worse your estimate's going to be, because the more, as Jim said, the more chances you have of being wrong. So every assumption you make increases your chances of being wrong. So I like to keep my DCFs simpler and with fewer moving parts, because I know I'm going to be wrong right off the bat. But
I think it just shows value in making sure that you're just directionally correct in the fundamentals and the quality of the business. I mean, I think you both said it all very well there. I mean, building models, whether it's an earnings model or a cash flow model, whatever it may be, it's less about the output, and it's more about understanding the levers that make the biggest impact, right? And that to me was always that's what's to me is so enlightening. But yeah, they're all forecasts, and you know what? They're going to be wrong. And you know what? There's going to be a recession or an election or a crisis or something, and it's going to knock everything on its
tail,
on its backside. And so then where are you? So there's not much you can do about that. And I think that, I mean, honestly, it just speaks to why we invest the way that we do, right? I mean, in just focusing on being directionally correct with the qualitative aspects of the business, and then saying, I don't mind hanging on to this business for literally the next 10 years and not worrying about things. Everybody wants to get rich quick. I get it. It just doesn't work that way.
I mean, the share price responds to Wall Street. Oh, they changed their price target, okay, and then they moved it down by $5 or 2%, and the stock price plummets. I mean, that is giving too much value to the precision of the price that that the analyst is putting out. Okay, I think it's worth $55. Okay, and if it reaches 58, I'm going to sell because it's overvalued. No, it's
no.
A model should kick out a range of prices. I like to think of the intrinsic value of a company is a fuzzy target. It's somewhere in this region. Okay, it could be a little higher, it could be a little lower, but I don't know precisely. I think it's somewhere in that region. I mean, and if it's way up here, then yeah, it's overpriced and you might want to sell. And if it's way down here, ooh, maybe that's a good buying opportunity. But if it's somewhere in this range, come on. And Wall Street moves the price target, boom, still within that range, but the market responds so happily when it goes up and not so happily when it goes down. And that's relying too much on the precision of those models when they're not precise models, when they're not precise at all. They're more like shotguns rather than rifles. If you want to think of it that way, a shotgun blast versus a rifle. Sorry for the violent image.
There was an interesting question I saw here. Jimmy G.
It's not me.
Jimmy G asked, what happens when a company reaches peak store growth? Is that possible? And will that put them in a new growth phase? I mean, I would say yes, it absolutely is possible. I mean, you can only open so many stores before you become saturated. Now, depending on your concept, I guess that really will dictate how many stores. Like I mean, it wasn't that long ago we were talking about Starbucks as being opened up within Starbucks, right? You know, there's a new Starbucks inside the Starbucks bathroom with all those jokes. And now they're still talking about opening up more stores. So there is something there with Starbucks where they feel like they can open up more stores. But I think maybe it was last week we were talking about Costco, Gillies, and sort
Probably.
of the very slow growing, store count, right?
But
I mean,
once
I
they
don't
have
know.
a store, they have a store.
Yeah, I don't know how many more stores they're going to open. I mean, but those stores are material, man. I mean, they are real endeavors. And you think of like a Home Depot or something like that, same kind of deal. So then once they get to a saturation, once they've opened up as many stores as they can open up, what do they do next? How do they continue to grow? Or do they just enter a new phase of life, right? Is it less about growth and it's
Turn into a
more
cash cow.
about profitability and returning value to shareholders? And I mean, I think that's kind of where you see a lot of those companies go. You turn those companies into, like you said, Jim, cash cows, and you make the most.
Well, Home Depot is a fantastic example of this, actually.
Yeah.
Like Home Depot, about 2007. I don't have my sheet open, so I'm just going to make it up. Reasonably make it up. 2007-ish, they realized, every American and I think every Canadian lived within, 15-minute drive of a Home Depot, right? And so, they kind of said, hey, we're kind of saturated. And so if you have access to like a Capital IQ or want to go through the SEC filings, you can feel free to do it yourself. But like anything that an aggregator of like many years of data, you can go back and see that their CapEx basically fell by like 75%. Their new store openings fell off a cliff. But they still had this giant installed base of Home Depots, within 15-minute drive of every American and every Canadian. So what do you do with that? Turn to cash cow mode. Their dividend their dividend's gone from, I think it was under $1 for the year. I think it was like 90 cents a year in 2007, something like that. And now it's something like, they pay like $2.50 or something every quarter. Like the dividend is up tenfold plus, I believe. At the same time, the rest of their cash, they largely use it to buy back their own shares. So their share count went from, I think it's down to 60% or something. And that worked really, really well. The stock went from pre global financial crisis, I think it was in the 30s or 40s. It fell as low as 19 during the credit crisis. Today, it's what, 350, 400, somewhere in there.
Yep.
And yeah, okay, that's pretty good. Like it has been a spectacular story because they said, hey, we've hit saturation. We are now a cash cow. And only recently have they decided, they seem to be going down we're going to try to grow through acquisition. So we're going to we're at saturated on the store levels, but we're going to kind of go sideways into more services and, professional services maybe, and fulfillment centers. And that's, that is as yet to be seen, right? And I'm a little skeptical of that because they really did have a really good thing going.
But, what was it? SLS? They just acquired the distribution network. Yeah.
Yeah,
I mean, that's it. You figure out ways to
cash flow.
own more of your value chain, right? I mean,
exactly.
And maybe that works, maybe it doesn't. I mean, I think you look at a company like Amazon. I mean, Amazon certainly made those investments through the years, worked out well for them, but it doesn't always work out. So, I mean, I think that's when it boils down to like execution. But I think that's a good exercise to kind of look at the business and then think about the value chain. Think about everybody that participates in what makes that business work, because it's not all about just that business. I mean, Home Depot is a business, but they get their stuff from somewhere, right? And they get that stuff delivered to them somehow. And so you think about all those players in that value chain. Those can represent additional growth opportunities potentially. And it certainly could also be something that they shouldn't really try to mess with a good thing. But yeah, then you look at the business and say, well, listen, we're going to take what we've got here, and we're really gonna make it hum. And I mean, if you've held on to Home Depot shares over the last 10 years, you're feeling pretty good about yourself. I mean, the stock's up. Total return price on that stock's 300%. I mean, it's killing the market over the course of the last decade, and that's the kind of stock Home Depot is, right? I mean, that's the kind of stock that you just sort of set it and forget it and check in every once in a while to make sure they're not blowing things up. But yeah, it's a good exercise to think about how companies, when they get to that saturation point, because they will eventually, what's their next act? What are they going to do next? And there are a few different ways they can look at that.
Want to hit a couple of questions. Happy Fool asks, is that a discounted cash flow model or a reverse DCF? And is there an example somewhere? So a DCF is where you're predicting, making the assumptions on what the growth will be, and the model spits out a share price, and you compare that to the current share price. And reverse is you make the adjustments so that what the model spits out is the current share price, and that kind of tells you what the market is pricing in, what it's assuming. And then you can ask, and Mobison is the one who introduced me to this idea.
The book is called Expectations Investing Fools.
Right. It's a good book. You can then ask, does this make sense? Is the market thinking about this correctly? Might they be missing something else? But that can be a bit tricky because it might kick out a number, 0% growth or negative growth. That's what the market's pricing in. And you really should find out why your model has those numbers in it, and not necessarily trust or say, oh, negative growth. Well, it's never going to grow negative. I'm going to buy shares. And so the market, I think, as you Gillies like to say, the market is mostly right.
It's mostly efficient. It's not.
That's the word I want. Efficient. Yeah. Mostly efficient. So there's a lot of people investing, a lot of people making buy and sell decisions, and that tends to be correct a lot of the time. So if you have a reverse DCF model saying negative growth for the next 10 years, do a little digging and see, is my model wrong or is the market wrong? And it's probably your model, more likely. So, and then right above that, Bessie's asked if I would ever rebuy or Netflix. Given what has happened with the share price, I regret selling. Yes. But I'm given what the management has decided to share with investors, I think it's a more difficult proposition today to buy Netflix than before, because they have decided not to share their subscriber growth numbers anymore or their subscriber counts. And they've decided, and they're not yet required to reveal how much revenue they're getting from advertising, because they haven't hit that 10% critical threshold that US GAAP requires to break out as a separate line item. So it's still mostly a subscriber growth company, and the company's not sharing the data anymore, and that makes it more difficult for me to buy the shares.
You can just buy it by an index fund. You get everything else too.
Yeah. All right, a couple of last minutes. Any final thoughts? Any final questions you want to hit?
The 909 condo for Canada. Okay, says Gus Kelly, AirCap CEO, was paid $50 million last year. Comments? I'd want to see the source. I've got the 20F, which is the annual report up. Says he was paid $5 million, which was $0.9 million in salary, annual bonus of $3 million and $0.2 million in contributions to pension plan, $0.7 million to other benefits. I imagine you're probably referring to a stock grant. If it is truly 50 million, I'd want to find it. I wasn't able to find the full proxy statement in the 30 seconds I've had here. But find me a CEO at a better year last year than Gus Kelly. I mean, it's nice to get $5 million salary. I would, Tom and David, if you're listening, we would all be very happy with that. But we're not the CEO, obviously, and CEOs. It can be. You can lose sight of what you want a company to do. We'll put it that way by focusing on compensation. I'm usually one who argues with high compensation levels, but I'm also reminded of the old saying: if you pay peanuts, you probably get monkeys. Gus Kelly, again, I think is probably the best. I think Gus Kelly is the best guy in the business, and he's proven it through long tenure in the business and making very good and strategic capital allocation decisions. He's very good at the be greedy when others are fearful and fearful when others are greedy style that we espouse for investing. He's really good at that running a business, and so I'd want to see the 50 million if it's some sort of a restricted stock grant or options. Okay, but that's probably not repeatable every year. But the thing that's in the 20F filing, which is basically $5 million last year, I have no problem with that.
Yep. All right, we've reached the top of the hour. My clock says 7 o'clock on the West Coast. So I guess that means it's time to hand it over. Thank you so much for joining us for the past hour. Hopefully we've provided some value and some laughs, and we even got a lesson from Gillies instead of a rant. Maybe he can oblige us next time.
Sure.
I hope you have a wonderful rest of your day. A fantastic weekend, everyone. Don't forget to get outside. It's spring. Flowers, the daffodils.
Miserable here. I'm not going outside.
It's spring. Try to get outside, even with in the rain and stuff. Bring an umbrella. Have a fantastic weekend. We'll see you next week.
Cheers.
Thanks, guys. Jim, by the way, you didn't go far enough with AirCap. I mean, I have it on good authority that Gus Kelly gets a phone call before Boeing or Airbus even thinks about designing a new plane. That's how important he is to the aerospace industry. So, yeah.
That's pretty good.
I don't know. I was searching the same thing, and I couldn't find anything other. So maybe if yeah, I don't know. So anyway. Be it. Have a great day, guys.
Cheers. Bye-bye.
Yeah. Jose, how you doing?
Pretty good, Lou. How about yourself?
Sorry, I had to defend AirCap. I just can't help myself, right? Jim, go away. All right, on that note, we are, Lou and Jose, we are, I don't know what we're doing. Nobody knows what we're doing, but we are here to take your questions, fools. Slido Fool 24 is the way to get them in. As always, as it says on the scroll, we are here to give our opinions. We are here for educational purposes. We are not here to provide individualized advice. Jose, what you watching today? What's going on out there?
Nothing too crucial, but I think the only thing I'm watching today is CoreWeave is IPOing. I'm not sure if it went public already, or I think usually it happens during noon times when we start to get the company going public. But this is a player in the AI infrastructure space. They're trying to compete against kind of like your Google Cloud, your Amazon AWS, or your Microsoft Azure, and it's one of those companies that AI infrastructure, Lou, is super expensive. So while you do have massive revenue growth, I think their last revenue growth was over 700%, and the year before that was like 1,700%. They're still at a net loss. And last night, Mike is reminding me they reduced their IPO price just a few hours, like 24 hours before going public. Originally was going to go, I think, at a valuation of roughly $32 billion. Now with the reduced price, is going to be $23 billion. And I think, Lou, I think that's crazy how in just a matter of a day, you can kind of change. You know what? Our valuation was maybe about 33% off. So we have to reduce it by that much 24 hours ahead of it. So I think that it just kind of shows the way that the market doesn't know how to value AI right now, and it's just kind of just throwing numbers out there.
Yeah. Yeah, it's tough because so much of an IPO is what's going on with the company, but also what's going on with the market. And so it's easy to kind of write the headline if it goes out, and yeah, they reduced the price last night. This is sort of how the process works. If you're an investment banker, kind of just the 2 seconds on an IPO is you get the job to go out and sell this company. You work on all of the details, you get all the paperwork right, and then you do an old-fashioned roadshow. You go meet with the big investors and you try and get a sense of like what the appetite is and at what cost, and you do all that and you do an estimated guess based on on what you can get, because what you want isn't oversubscribed. You want more demand than there is supply. So if I'm the investment bankers here, and not to defend investment bankers because they're doing just fine on their own without me, but the last few months and everything that we have known about AI, you're probably getting a lot of hype and a lot of interest, say in January or pre DeepSeek, and then now maybe it's pulled back a bit after DeepSeek, but you're still probably feeling pretty good about yourself. And then in the last few weeks, we have seen things, just the uncertainty build. And so suddenly you've worked for months, like kind of with a model of what you think you can get. Suddenly that's not as sure. The responsible thing to do is you only give a range until the very last moment, or maybe you put something in there as a placeholder, but you always price the thing the night before based on your most recent data. I don't think, and I mean, I'm not, Jose is a much better person to tell you whether or not you should think about buying CoreWeave or not. I'm not saying that this is, investing advice, but I would not, given what's going on in the world and given kind of how this process works, I wouldn't think it would be a reflection on CoreWeave if they've lowered their price and it doesn't go out. I think it's a reflection of just investor sentiment, market sentiment, and just kind of the convoluted process of how IPOs are done. I mean, Jose, obviously you're, this area better and the strengths and weaknesses of the company, but IPOs are tough. And that's why we see so few IPOs in this environment, because everybody wants something of a surge. The first day, you may not want too much of a surge because that means you'll have a ton of money on the table. But it really is, the markets work on supply and demand. Every stock price on the market right now is just a function of how many people want to sell at what price and how many people want to buy at what price. And as that balance changes, the price moves up and down. That is hard to get right moment to moment in a public market with a ton of participants. When it's basically you, your cell phone, and a Bloomberg terminal trying to gauge people's interests and asking people to predict the future, it is much harder to do. So yeah, I don't know. I wouldn't panic about this company's prospects if it doesn't go out at what the headlines might have said it would go out at a week ago.
Yeah, and one thing, Lou, they did also kind of reduce the amount of shares. So it's like you mentioned, they don't want to leave money on the table, but they also want to kind of stay oversubscribed in kind of this process. So I'm guessing to help out with with the market sentiment, like you mentioned, there's a lot of things happening with AI right now. They reduced that price of what was expected based on the new data that they have, but they also reduced the amount of shares that they were going to let go initially. So Yeah, I mean, CoreWeave, interesting. There's definitely a lot of bullish reasons to be excited about the company. Also, a lot of bearish, just like any company in general. So, if any fools wants to learn more about it, feel free to ask a question on it. But Lou, I actually want to take about 52 minutes ago. Jeff had a question. Would it make sense for Microsoft to buy CoreWeave? Microsoft is the number one customer of CoreWeave, and CoreWeave, in their last report, I forget, it was 62 or 63, something around 60% of total revenue came from Microsoft for 2024. So it's like, hey, Microsoft, if you're just kind of being their main customer, why not just purchase this? I think CoreWeave, Microsoft is already investing a lot in AI infrastructure. This is kind of just their, you know what, let's be safe and let's see if we need extra capacity, but let's not pay that full price of handling the infrastructure, because building data centers is still more expensive. It's still super expensive. So I think this is kind of like their small hedge where it allows Microsoft to have a little bit more capacity if needed without really building that data center themselves and worrying about all that infrastructure that maybe in the future might not be worth as much as it is now. So Microsoft already is investing a lot in AI infrastructure, in data centers. I think CoreWeave is more of just like a small hedge to, if they need more capacity, they're able to turn it on. If they don't need more capacity, then okay, they just paid maybe a smaller fee than they would have if they would have overbuilt on data centers.
This is interesting because, to some extent, just the process I just talked about, if Microsoft was interested, it probably came up, right? And I don't know what CoreWeave had in mind if they're just not open to a sale, but part of the IPO process is, again, you're doing all this and you tend to at least solicit offers, even if it's very informally, because again, you're trying to set a price. And if I'm a banker on this, and again, AI is everything right now, to go to their biggest customer, which has a huge, huge pile of cash it's sitting on, and say, hey, what would you pay for a company like this? As a way to try to up, and then I could informally, without saying it, but then I go to you and say, Jose, I know you think this valuation I'm talking about is crazy, but I have it on good authority. Microsoft would pay it, So this is how this, and what that tends to do, and some of a lot of times you do see acquisitions happen. Sometimes it can kind of plant a seed for an acquirer. So not to say, like, I'm not trying to break news here or say that Microsoft definitely considered this, but usually if they got to this point, it would imply to me that the obvious buyers, at the very least, don't want to think about that now. Who knows, right? But almost certainly that sort of thought came up in the discussions, and either it was dismissed or laughed at, or they said, well, antitrust, that's not going to happen, or what, we'd rather just be a vendor to this company. It's so hard to deal make in a vacuum, but this is not really a vacuum. Like I say, I almost guarantee the bankers spent a ton of time talking to the company's biggest customer about how they value that company in the lead up to an IPO. So who knows? Maybe in 2 years, right? Yeah. All right. We're playing matchmaker left and right. How close a relationship does it have with NVIDIA? Jeff wants to know.
From what I know, NVIDIA is an investor of the company pre-public. Based on the numbers that I saw online, Lou, I didn't really look at the S1, but based on the numbers online, they say it's about a 5% ownership of this company. And NVIDIA kind of puts CoreWeave almost on the top of the line to kind of receive some of the latest GPUs before other players. I think CoreWeave was actually the first AI cloud to have the GB200 available for public instance. So that could be one, getting the products first, or at least one of the first players, but also kind of talks a little bit about maybe their engineering talent, that they're able to build up these data centers a lot faster than maybe some of the tech giants themselves. The other thing, Lou, is NVIDIA actually rents, I don't know if you've heard, Lou, but NVIDIA is kind of like a beast in the software space. And one of the reasons they're a beast...
Yeah.
one of the reasons they're a beast in the software space, Lou, is because they actually have a supercomputer that they use, and their software engineers are always working on it and always kind of progressing. Not many companies do that, where they rent out or have these massive infrastructures to test out their products. And one of the supercomputers is called EOS, and CoreWeave actually owns it, and NVIDIA rents it out from them. So there's definitely a bit of a relationship there with getting some top of the line GPUs, maybe on the top line, maybe not first, but at least probably one of the top 10 to get it, or the first 10 to get it. And then there also is NVIDIA uses their infrastructure for improving their software solutions.
Mm-hmm. All right, good. So, a question here about a company that I think is near and dear to both of our hearts, or kind of a bit of overlap, but I can take it. Matt was asking, Lou, the thing you previously explained about the secular shift from metal benders to brains behind them in the defense industry apply to General Dynamics, ticker GD. And yet, just a little context here is that, like with most things, defense has gone digital. It's great. We've transitioned from an analog to a digital world. For most of the time, from World War II almost up until the 90s, the value in these companies, the competitive moat, was their ability to just build these massive things, whether they're ships, tanks, and and it was just barrier to entries to be a new tank maker. Increasingly, though, the brains inside these systems is where the value is, and the metal has become commoditized. So and Huntington Ingalls is always the one I talk about here, and that is near and dear to Matt's heart, I know. And just as a big ship maker who is just spending a decade building out these big metal hulls, only to have other contractors come in and wire them and triple the margins on the project. General Dynamics is both a victim and a winner in this trend. General Dynamics is much more diversified, which is what you want in these defense contractors. They do have a boat business. Electric Boat up in Connecticut makes some of the nuclear submarines, some of the other boats. They also have that. They are the land systems vendor to the Pentagon, basically. They are the ones that make the tanks and those. But they also, GDIT, General Dynamics Information Technology, is basically up there, the second largest of the Beltway bandits, even though we don't think of it as that because they are a prime contractor. But they do a ton of electronics and integration work through that. They also have their missile business that tends to get into space and has a lot of electronics then. I think that this is more a best of all worlds for a defense for these primes, where you're not reliant on the metal bending, but you have that in your portfolio, and you have these huge platforms that can drive revenue over time and provide predictability. But you also are sort of future-proofed with the digital. General Dynamics, interesting, Jose, is the only one of the big primes that are still in this business. Lockheed Martin, Northrop, they all divested the IT. GD doubled down on it, and they bought a couple of companies to grow bigger. It is a scale business. Lockheed, Northrop basically made the call that we want to allocate our resources elsewhere. General Dynamics said we want to allocate our resources there. But I actually think there's a couple of things that are that kind of separate out General Dynamics that make them either more resilient or a laggard, depending on the market. This IT business is one of them, and also the fact they own Gulfstream and have a big commercial business with that. High margin when it works, but not a high volume business. But General Dynamics is unique in the IT and unique in the Gulfstream. When business jets are selling, that's a good thing. When we go through a decade, like we did in the last decade, where coming out of the great financial crisis, nobody bought corporate jets, it made General Dynamics a laggard. So I hope that answers that. Yeah. What else do we have? A lot of NVIDIA coming in, Jose. I know.
There's a question that came in 7 minutes ago by Besties. Jose didn't agree with your concerns with Broadcom, ASIC versus GPU. Many use cases would suit ASICs that GPUs won't. The contention with InfiniBand may be more the question. So yesterday, Lou, I did kind of the prediction show, and I predicted that maybe Broadcom was going to lose out a few kind of customers on mass production because NVIDIA was innovating too quickly. And the thing is, so there's two types of AI chips right now. There's kind of your third party GPUs or AI GPUs, which third party either being NVIDIA or AMD create. And these GPUs are great for a boatload of workloads. Big tech is kind of designing their own chips now, Lou, to kind of maybe help reduce the dependency of some of these third-party vendors. And these are kind of called ASIC solutions, which are usually meant for a specific workload that tend to do really well. And I think ASICs are really good in the market when technology is not evolving as quickly. We actually see it really good in the CPU space, Lou. The CPU is a market that every generation, you're only seeing maybe like a 10% boost. So like a 1.1x boost versus the last generation. And when you see minimal gains like that, it's okay for a player to kind of develop their own chip, because even if they miss out, if they're not as at the best of the best, it's not like a huge margin, a huge difference or gap between the leads. So even if you provide maybe a weaker chip, most of the consumers of the world won't know. But in the GPU market, NVIDIA with the Hopper and the Blackwell, it was about a 40 times, not 40%, 40 times better. I think right now in the ASIC market, you can't really compete with those types of returns or those types of gains. And right now in data center, Lou, you are very power constrained, power limited. So you have to choose what's the better chip. And if it is a huge margin between the previous chip or the other competitor's chip, you can't say, oh, I'm just going to choose this one because it's cheaper. Let's say Microsoft or let's say Google decides to just build their own AI chips, but NVIDIA chips are 50, 60 times better. Google's going to lose so much market share in the clouding space to the other giants that decide to get NVIDIA's chips. So I think right now, as GPUs are evolving at such rapid levels, I think that the need for ASICs are going to decrease a bit. They're not going to go away. I think eventually, just like we see in any technology, the rate of innovation starts to slow down. Maybe we find we get some form of limit. Once we get to that form of limit, I think that's when we start to see these custom AI accelerators and AI and ASIC solutions become a more crucial component.
I'm always power limited, but I have teenagers in the house, so I do understand. Yeah. All right. Here's one for both of us, but I don't know if the answer will be satisfying. The Cyber Mike, he said, "Good morning, Lou and Jose. Tips on when to add or trim positions from current to target allocation." I'm curious what you say here, Jose. I will. Full disclosure, I don't really have target allocations like specifics in mind. I generally organize my portfolio as I have like a bunch of stocks that are pretty sizable positions that are just kind of my hopefully set it and forget it. And then I have a lot of little speculative stocks that, are less certain bets. Alphabet's other bets portfolio, right? And I target allocations in terms of like whether or not I see something as ballast and I want to grow it large, or if it's just kind of experiment. As far as adding and trimming there, I will say this, and I know this is unpopular around here. I am very happy right now with this, hindsight capital management being what it is. I believe it's okay to sell at least part of big winners. And all last fall, I had stocks that were up 100% plus, a couple of them up 400% in a short amount of time. I sold some of that. And to me, it's the best of both worlds. You bank something, and also you keep the upside because you only sold some. So I know it's let your winners win, and I get that. But this is sort of just a modified version of this, because I'm not saying just try and time to market and sell, but trimming for me is always sort of hopefully a sign of success or payoff. I like having cash. I'm at a point in my life where I just don't want to let it all ride for 20 years. In terms of add to an allocation or target, I respect people who buy in thirds and all that, and I get the thing behind it. And if it works for you, it works. For me, every time I buy a stock, I bought 2 stocks yesterday. Every time I buy it, I really want to have almost a kind of cage match wrestling between everything I'm thinking of and just whatever I deem to be the best buy at this moment. And whether or not I had written down 2 months ago, I want to buy this in third, so I will buy it again in late March. Things change. Or, maybe things change with that company, but maybe just something else is on sale or there's something else, or I'm in a different mood. I think that every stock purchase and sale decision should be an independent event based on the data and your thoughts at that moment. You can use kind of what you've done or what you've thought about in the past as a guideline, and hopefully you're not just kind of, you don't want to be too sporadic where it's just like literally whatever is getting in a moment. But I don't tend to worry too much about, I want to get this to X percent of my portfolio, or I want to get this to X amount of money. I just kind of go with what makes the most sense in the moment.
Yeah, and Lou, I mean, I agree here. I mean, I don't. Let me see. When starting a position, though, it's a little bit different. For me, for starting a position, I just have like a value set. I don't even know if it's a percentage, a value set that if I want to buy this company, I need to buy at least this value of it. The reason I do that, Lou, is not just is not for it's not because I need to have a certain percentage off the bat, but it kind of prevents me from just, hey, am I really willing to spend this much money on a company? It kind of it's that last gate of entry for me. It's like, if I'm saying I'm willing to spend this much money on this entry position, and I'm still okay with it, then that gives me the final that I've done my due diligence, I've done my research, I believe in my thesis. If I say, maybe I don't want to buy that much of it, it kind of stops me from going into that entry. It's kind of like that final law that allows me. So when I enter a position, it has, it's just, it is based on the number, but it is based on, I guess, how the market is doing. But I do have some form of value that I use to kind of be that final guard. I do agree trimming. I think trimming is great. I would never kind of sell my winners all at the full position, but selling like, hey, 10% of it. I still have the ability for it to grow, and I still say, hey, look, I have the ability to get some rewards right now. And it's also very dependent on how my portfolio structure might be. Is it just becoming such a big position in my overall portfolio? So allocation is more where that impacts a lot as well. And I try to look at my portfolio in various ways, Lou, and I'm pretty sure investors do this, not just individual company allocation, but market allocation as well. I do have a lot of AI stocks. So if I see my AI exposure grow bigger and bigger than I want it to be, I start to trim some of those players to maybe have a better sleep number, as is said, right? So it's all on the flow, and I have an entry position level. And then from there on, if I want to buy more and more, it's just, depending on the market, do I see this as a great opportunity? I know it's in my portfolio now. Let me add on to it. But I don't really do much thirds or fourth when looking into a stock. It's more go with the flow.
Yeah. And I would say the one thing on that is as part of my other bets or whatever, that because I am involved in so many industrials and I think I kind of understand the business cycles. I mean, that's very arrogant of me and I get it wrong, but I will just try to ride the waves with some industries. We're like, okay, I know this business cycle is very predictable. This is beaten down. I'm going to own this hopefully for about a year to 18 months and just ride the wave of the cycle. With those, I tend to be much more just cognizant of where things are, and I will sell out entirely. I only talk about my successes. About this time last year, I bought an aerospace company called Triumph Group, TGI, just because I thought they were finally had their stuff together, and got taken out at a premium of like 74% of what I paid for it, or 70-something%. So, with that, but that's sort of almost too small to worry about. I mostly am focused on my top 20 positions, and those are the ones that will affect what I'm doing in retirement at this point. Cyber Monkey says, or Cyber Mikey, not Monkey. Wow, that's terrible. Sorry, Mikey. Same cage match approach. I think, look, that works for me. Anytime you are going to invest real money into a company, it shouldn't be based on what someone else said. It shouldn't be based on what you thought 6 months, a year ago, or even 2 days ago. It should be based on the best information you have right now. And that to me is like, that's just common sense. So yeah, I think that works. But look, if frameworks and sort of the more programmatic ideas, if that kind of keeps you from straying, then definitely do that, because that makes sense too. You don't want to be making things without rational. So Bestie's kind of fired back at you, Jose, right? Do you want to let's get this on? I like, speaking of cage matches. No.
No, I like this, right? Because Bestie's mentioned that it really does depend a lot on the ASICs. They have like power advantages for different. So it's not all about processing power. And Bestie's, I do agree with you there. And for a lot of internal solutions, maybe a lot of these companies use it for internal solutions. There's always the opportunity for ASICs to be there. So I believe ASICs will always have an opportunity, but I think right now the market is getting a little bit smaller for them. But there's always going to be a need for them. And it doesn't always have to be AI accelerators, right? You can have ASICs for all types of things. Like I mentioned, GPUs for networking solutions. A lot of these players kind of create, Amazon creates kind of like their Nitro card, I believe it's called, which is kind of like their DPU version. And that's an ASIC for them. So it doesn't always have to be an AI accelerator. And for various things, there's also different types of ASIC solutions. Now, in forms of GPU, I'm going to just make a one final example. Amazon has their chip called the Trainium. And the Trainium supposedly is kind of selling at 1/3 the price of Hopper in forms of GPU rentals. And many people see that as a bullish thing. But if you're barely making any money out of a chip that you make, wouldn't it make more sense to kind of buy a chip that can make you more money because you're power limited? So right now, it is cliche to kind of quote Jensen here, but before he used to say, the more you buy, the more you save. So previously, the premise of data centers was to become more power efficient and to kind of have the best TCO product available for you. Now he kind of changed it where, and this is Jensen math, so take it with a grain of salt, but it's the more you buy, the more you save, but also the more you make. So now kind of in this TCO approach for the data center market, at least kind of in the data center cloud computing market, it's not only about you're saving the most amount of energy, but which chip is going to allow you to be able to sell it for more and be able to make more revenue and better margins. And with a market that's power limited, you really do have to kind of have that part in your equation. It's not only about saving. It's cheaper to make this chip, but which one is going to make you more money in the long term of things. Besties, I agree, right? ASIC has a place in all big tech players. It doesn't always have to be in AI accelerators, like I mentioned, GPUs, CPUs, DPUs, and all types of PUs that are out there.
That works. All right. We have some great questions coming in, fools. Really appreciate it. Slido Fool 24, get him in. To Jose, he's wrong. That's fine. Tell me I'm wrong. I like that, actually. Lou has a question, and I'm just drawn to that. But Lou said, would you feel comfortable buying Ford F or GM, General Motors GM right now, or would you prefer to wait until after April 2nd? Yeah, I said, do you have plans with the family for Liberation Day, the big tariff day, which I guess is a holiday now? That is April 2nd. So this is a really hard question to ask, because the first question to ask myself is, do you really want to own the automakers? This has historically been a really, really tough business to, other than that one company, to make market-beating returns. I don't anticipate that changing for the better anytime soon with tariffs, whether you wait till now or not. I'd note, though, that you're not getting arguably a bargain right now. I believe Ford is still green for the year after all this drama, which really surprised me when I saw, barely. And GM is maybe only down 10%. Look, tariffs are going to make their lives miserable, period, for GM and Ford. I would be surprised if, unless things are really different than what we know, if the stocks have an oversized reaction next week, just because this is pretty well telegraphed and in part done. So I don't I think the question isn't about the next 2 weeks and trying to time things. The question for me would be, do you really want to own these over the next 5 years plus? If you do, then I don't think you really should stress about buying now or buying on Tuesday or buying whenever, because hopefully, whether or not you save 30 cents a share whenever now, you're looking at much more upside over time or not. Just really, really think about the market dynamics that these companies are facing in terms of, do you want to own them for 5-10 years, I think is the answer. And I'm sorry, it's not a very good answer, but again, it's really hard to think in day-to-day movement, especially right now with the volatility, but it is just so much easier to evaluate stocks over what you think they can do for the next 5 or 10. And so I would stick to that personally. All right. We have a ton of aerospace coming in, but what do you got, Jose? I love this, but
I don't. Let's see.
I can get another if you want. I just don't want to help you out. Tim, and this one, I love this because I love talking market manipulation. But said Rocket Lab, RKLB, got a $6 billion contract and is up 2%. Market manipulation. So, Tim, let's talk about this, because was it Lee Corso who always said, not so fast, my friend, right? I think what Rocket Lab got was Rocket Lab was added to the NSSL Phase 3 Lane 1, which is a government speak ishy way of saying, so it's a national security space launch. Lane 1 means they are now a preferred vendor for the government to launch things into space. Right now, there are 3 incumbents on that program: SpaceX, Blue Origin, which is Jeff Bezos, and United Launch Alliance, which is a 50-50 joint venture between Boeing and Lockheed Martin. The government has added 2 new partners, Rocket Lab and Stoke Space Technology, that are basically get to be in on its primary launch vehicle. The ceiling value on this contract is $5.8 billion or so. Rocket Lab is not getting a $6 billion contract. Rocket Lab is getting the right to compete with 4 other people on a launch-by-launch basis for launches that have total payment options of up to about $6 billion. Look, it's a big deal and it's very important. It is not only a kind of the seal of excellence that the government is bringing you in, it helps with your credibility with others, and it provides steady business, which all of these companies need revenue, right? There's 30 plus missions, I think, through 2029 planned through the NSSL vehicle. And I think, and usually it's extended. I can't think of the extension, but so this is a very good incremental step forward. But I mean, Jose, we're talking about stocks to sell bits of. I sold a ton of Rocket Lab late last year when it went up 500% in a couple of months, and the business didn't change by 500%. It's given about half of it up, so you can say I'm smart, or you can say I'm still missing out because it's still up big. Rocket Lab, the stock, tends to be very volatile. I think 2% is actually probably an appropriate move, because one thing I really, really like about this business and this management team is that they are very long-term driven, incremental progress. We have a plan. We're just going to stay on this course, and not so much to the moon and back, pardon the pun, with the industry. And if anything, for me, I would like to see the stock become more rational. And if it's only up a couple of percentage points on them getting a very good incremental positive, but not a $6 billion contract, I actually think that's probably a sign of the shareholder base kind of growing into the stock and being more in line with management and not less. So I'm okay with that. Fun stock, though. Fun stock.
So, Lou, I have 2 things here I can take. First,
Sure.
Bestie's got me again. She's like, nothing against Jensen, but you shouldn't only listen to him, especially about GPUs. Bestie's 100% agree with there. I don't listen to just Jensen, right? Obviously, he's probably the easiest to go, as he's one of the most popular in the AI space. But there's a lot of information online based on kind of, and the way I'm discussing it is more kind of like third-party clouding solutions, which is kind of your external customers. It's very hard to kind of dictate internal use cases, as a lot of these companies kind of keep all that private. But there's a lot of information out there on kind of like the pricing trend of not just the GPUs, but ASIC solutions out there as well. And all of them kind of seem to be in a negative direction. So I agree, right? There's a lot of information. Obviously, don't listen to the ones selling the GPUs about the GPUs. Listen to what he says and then try to find the information out there to see if there is anything that correlates or kind of is against some of the points that one is trying to make. So agree. And the second question here is one from Let It Ride, Lou, about 21 minutes ago. Could you be the next, you being Unity software, be the next NVIDIA, start in gaming and where did I lose it? Start in gaming and expanding to real world applications, a multi-bagger perhaps with a few less bags. So I do believe Unity has the opportunity to grow. I don't know if it's kind of like the next NVIDIA. The next NVIDIA is one of the things is they just are a leader in a lot of spaces. Unity is kind of a leader with their game engine in the mobile space. They also hit the advertisement market, but they're far from the leader there. They also hit kind of like the industrial space with 3D creation, far the leader in that space as well. They do have competitors in other industries. So Unity, I don't know if I would say it's the next NVIDIA, but I could potentially seeing it if with this new CEO, with things improving in their advertisement market, with things moving in into augmented reality, virtual reality. There's various growth stories for Unity, but there is some things that need to be fixed, and competition, the ad space right now still being a little bit weak for them, are some things that the management shifts. We saw a huge shift in management from new CEOs, from new CFO, from new kind of just people on the board. So all that needs to kind of create a final synergy to be able to move the stock further.
Yeah. So just there was a question, was the other company other than Rocket Lab? I assume on that contract, it's a privately held company. You can't buy Stoke Space Technologies, I believe it's called. It's interesting. Of the five, Stoke, SpaceX, Blue Origin, none of those are available for public markets. Rocket Lab is, and United Launch is, but through Boeing and Lockheed, who are 50-50 joint ventures. So there isn't a lot of investing opportunities on the NSSL, but Stoke is the other one. It tends to be, it's kind of how what the government uses that to support the industry as much as anything, while also fulfilling a need that they have. All right, Besties had a question about kind of that brain versus bending metal, which is a good question. What about Howmet in there, HWM? So Howmet is bending metal, but the component suppliers are a little different because that is needed. This is more a big play theme on the primes, the companies that are actually the platform companies that are doing the contracts, and where the value goes in those contracts. With suppliers, what you want to look at more is how commoditizable it is. Is that a word? How easily it can be commoditized, how easily it is for someone to set up a competing production facility in a lower cost environment and just drive you to oblivion on price. Howmet is pretty well insulated there. But that is more the factor I look at with them. You don't necessarily have like the same like government allocation questions. Another half of that question, yeah, this is an interesting channel. Another aeronautical note, advances in materials, any business opportunities in that area. Yeah, part of kind of the push towards, and this is especially on the commercial side, but the military cares about this too, is greening the industry, trying to be more fuel efficient. A lot of that is getting the weight out of aircrafts, right? Because metal is expensive, but you don't want planes made out of, I don't know, paper mache. Yes. So a solution there is the carbon fiber, which is carbon fiber, people can write in and tell, but very, very fancy plastic. So it's lightweight, but it's stronger in a lot of cases than these metals. You also have specialty metal blends, mixing titanium and stuff like that. The two public companies to look at for that is, one's called Hexcel, HXL is the ticker, and the other used to be Allegheny Technologies. I think they now just go by ATI, which is their ticker, ATI. Both of them are in the carbon fiber composite materials. I will note that that's sort of a limited market for now. It's still a market with great potential. Those always seem kind of fairly valued to me, and so they aren't my favorite investments, but they are. It's definitely part of a long-term trend is to get more and more carbon composites. The 787 Dreamliner, which has now been out 10, 15 years, they were the first ones to really, really go all in on this, and it's worked out pretty well so far. We have long enough to know real world environmental testing, and there's a certain logic to it, definitely.
Thank you, Lou. I have this question from Matt that came in almost 30 minutes ago. Jose, do Microsoft's reliance on OpenAI when it comes to artificial intelligence and its failure to capitalize on high demand suggest any operational missteps by the tech titan? So I think Microsoft was a pretty early on investor of OpenAI since 2019, and before this kind of company jumped in valuation. So I think Microsoft actually made a very smart move in the OpenAI investment. It was able to secure a nice amount of ownership in OpenAI at a time when AI was still pretty cheap and no one knew where it was going to go. So I think that was a great move by Microsoft, right? So owning a good portion of it, I feel like now that dependency is kind of just like an investor, I don't see it much different from Google and DeepMind. Maybe DeepMind is owned 100% by Google, so maybe that's the main difference there. But I think it's kind of within that same ballpark. So I don't think it failed when it came with OpenAI. Now, what Microsoft is trying to do is like, hey, look, we have this investor or investee on OpenAI where we own a certain percentage of their IP and their AI solutions. At the same time, we're working now in the back end because we're not behind anymore. We're in the front run. OpenAI, you can say, is one of the leaders in the space. It allows Microsoft now the opportunity to take its time to develop its own internal AI solutions. I think it's called Phi, whatever large language model they're working, but now they don't have to rush it, right? Unlike some of the other players, if you want to be in the AI space, you have to rush it. You have to build as much infrastructure as quickly as possible. You need to do as much training. So Microsoft, I think, did a good step there. The only maybe real criticism I would do with Microsoft is with the recent announcement that they might not give OpenAI as much capacity as they kind of intended to do, and it's letting Stargate or Oracle and SoftBank kind of handle that. I see that as Microsoft, in my opinion, did it for one reason. They wanted to make sure they don't overbuild. So they are de-riskifying themselves by not building massive AI infrastructures. Unfortunately, when you kind of eliminate some risk, you're also eliminating some growth potential. And obviously that growth potential, if the demand is going to grow for OpenAI, they're going to miss out on that revenue. I personally believe the AI market is still going to be pretty strong. So while I agree why they did it, I think it's the smart thing for right, you're de-risking it. You still have a little bit of growth opportunities, but you kind of cap your risk. I'm not a fan of that. I understand why they did it, but I wish Microsoft would have been a little bit more aggressive. I don't think it's a misstep. I just think they were more conservative, and when they had the ability to be more aggressive.
Makes sense. Makes sense. Rose asked, kind of, I guess, a follow up what I was saying before. Lou, do you buy and hold industrials? Keep them for a cycle? What industrials have you held the longest? I definitely do. I mean, there's some. I am firmly of the belief that, you know, Jose, you don't have to just do things Jose's way. Although, because part of it is I'm not as good at what Jose does as he is, so I have to find other things. But there are massive market beaters in every sector of the market. There are just management teams that are better. There are companies that have competitive advantages that you can generate market beating returns all over the place. And I do that in industrials. Some of the ones that I've held the longest that Anyone who has watched me before, they're not going to be surprised by the names. TransDigm, TDG, I have held for over a decade. XPO Logistics, and now it's all of its parts, I have held, over a decade. What else? I mean, Berkshire Hathaway, if you want to call it, I've owned that forever. Some of the defense contractors, I've probably held Lockheed Martin for about that long, and Leidos Holdings and L3 Harris through Harris over the time. So I do think that, or I hope that there are companies that just over time are just better run than others, or have natural advantages that will allow them to be market beaters. The nice thing about these too is a lot of them, you can do a total return thing where there are dividends and there are multiple ways to win. At the end of the day, for these companies, these big titans, I don't expect them to grow the way NVIDIA has, but I do expect them on a total return basis to over time beat the market. So that to me is over time averaging low double digits return. And they're not going to do it every year. They're not going to do it as spectacularly as some of the tech firms do, but hopefully they're going to be less volatile over time too. The cycle stuff is much more on the other side of the portfolio, where it's just, making much smaller bets on arguably lesser quality companies, but just ones that will benefit from market dynamics or changes inside the company. And that's sort of just a hobby. Like, it's not going to decide whether or not I eat in retirement. But yeah, I do think you can own industrials for the long run. You just have to pick the right companies.
Thank you, Lou. I'll take this next question, which just came in from Cyber Mikey. Jose, do you think Perplexity will eventually go IPO? I'm a pro customer and use it daily. Where does this fall in the pick and shovel AI play? So Cyber Mikey, I'm happy to see another pro customer here. I also use Perplexity daily. It's really weird to say. I think it's very limited to how many AI solutions people use, and Perplexity is probably on the bottom of the line. But Perplexity, most of the time, has eliminated a lot of my Google use cases. Sometimes I'm not saying it's over for Google, but there's definitely a great opportunity here for Perplexity. Based on the last information that I know, Mikey, is they are thinking about having another kind of investment round happening here in March, in either this month or next month. I don't know if it happened, but they were kind of looking into that. Will they IPO? I think there's a potential for it. I wouldn't see why not. But I'm going to guess this is another company that's going to be very similar, where it's spending a lot of money. It has a nice growth in revenue, but it's not making much money or earnings at the moment. It's most likely going to be at a loss. I do know there are a lot of big players that kind of back this or have some form of investment through the various types of rounds that they've done in the private sector. And where does it fall in the AI play? I think it doesn't really fall much, Cyber, in the pick and shovel play. It's pretty much in the bottom line, where it uses AI models, right? So it uses all these AI models for its own solutions. But I think it would be let's say there's a chip company. The bottom line of the chip company, it ends up in a laptop or something like that. I feel like the AI models are like the chips, and Perplexity is kind of like that laptop. It's kind of like that last product that goes straight to the consumer. So I really wouldn't put it in the pick and shovel AI play.
Makes sense. All right, I wanted to get to one because I'm not going to be around much next week, so I'm fools, you're welcome. But there was one before the big purge in the Slido questions. I think, Bestie, it was you, and if so, you're around, but if not, I apologize to it was. But it was asking me directly about Manhattan Associates, MANH. They are a the kind of inventory management software company that does a lot of work with warehouses, retailers, things like that. Stock is down big after kind of some disappointing quarters, a CEO change. And the issue with it now is, I am a holder that's kind of holding on. the issue with this company is there just aren't a lot of catalysts for now, because a lot of their core business is to customers who are tied up in what's going on with tariffs, tied up with falling consumer confidence. So there isn't a lot of investment from their core customers right now. Their customers are in retrenchment mode. I still think it's a long-term winner, but it's just not a good environment for them to succeed. And what will the catalyst be? I think it's down 40% year to date or something the other day. I don't know where they are now, but people are slowly coming back to them thinking, all right, maybe it's oversold, but I do think there's time to wait this one out. Their annual meeting is right here in Atlanta. If anyone's going, I think I will be there. It's in mid-May, so look me up if you're going to be here. I think it's a good company, but it's a good company in back to cycles, a bad cycle with a lot of uncertainty over a CEO change. So I think this is one that if it's going to work out for me, I just really need to be patient with right now. And it bums me out, but hopefully over time, it'll be the quality that I think it is. All right, what else
Lou,
you got?
I don't have one at the moment. If you have one that you wouldn't mind taking.
All right. Well, I just want to tell lovely Lily good morning. No, so I will say that, we talked about there was a question about Ford and GM earlier with the Liberation Day next week. The one thing that I'm really, really going to look for there, and again, this isn't investment advice because I do think it's really tough right now until we get some certainty on these tariffs. The tariffs seem to be designed to spur capital investment in the U.S. It is really, really hard to make that happen if you are also at the same time, because of tariffs, driving up the cost of capital for these companies, which, lower stock prices, higher barriers of entry. And there's all these reports that the government will be watching closely for signs that the companies are passing on the tariffs to consumers, which is kind of painting them in a corner. I would just be very careful getting into automakers right now until we have real clarity here. I mean, I don't ever want to say anything is uninvestable, Jose, because there are always opportunities. But I look at the world right now with that, and I would just, until I've said this before, good management teams can basically play by any set of rules and figure out how to win over time. But if management teams don't know the rules, or the rules keep changing, it is really hard for even a good management team to succeed. There are parts of the economy right now that I would just stay away from until the dust settles, and hopefully maybe April 2nd is the first step in the dust settling, and we can sort of figure out rules and move on from there. At that point, we'll decide. But just be careful out there right now with these really, really exposed names to tariffs, because we don't know, they don't know, and it's really hard to be a successful business person and run a successful business when you don't know the rules. Right.
So, Lou, I have a question here that came in about a day ago from SB. VRT, Vertiv, so ticker VRT, has had quite a sharp drop recently due to AI on the wind. Now at 25.4 PE with low double-digit growth expected, is this a good buying opportunity? So obviously no personal advice here, but just kind of sharing my overall thoughts. So first, Lou, Vertiv is a company that helps build the infrastructure for data centers. They help a lot with kind of like the power solutions, the cooling solutions. And right now with data centers becoming such a huge craze, in January of 2020, January of this year, the stock was sitting at $153. Now from that peak, Lou, the stock is down roughly 50% in a matter of 4 months, and is sitting at around $74 at the moment. So one of the main concerns, well, obviously first, there could have just been valuation or a huge stretch in valuation and growth potential for the company. But now you're kind of seeing a little bit more risk of, recently we've heard more concerns about slowing AI demand. You have kind of like the Alibaba chairman mentioned that there's an AI bubble going on. You have reports that Microsoft might be canceling some leases. And again, just the overall fear right now is coming out of AI demand overbuilt. Obviously a highly volatile stock. Now, looking at ratios right now, Lou, I'm on the Y charts real quick. Forward PE ratio is actually 20.5 at the moment, which is the end of this current fiscal year, and forward 1 year is 16.6. And this is a company, I mean, it doesn't look like it's that bubble anymore, that crazy valuation. I think these valuations are a little bit more attractive. This is a company that's expected to grow roughly 15 to 20% on an annual basis. But this is also kind of a company that deals in the construction phase, Lou. So when it comes to the construction market, there could be hiccups that can kind of show the market maybe seeing a bit of a slowdown, where it might have just been a delay in maybe some of the licensing or some of the regulations that needed to be approved before going forward. So this is going to be a stock that's going to be very volatile. I think looking at revenue might not be the best approach for a company like this. It's most important to look at things like backlog, which can kind of create a better picture of it. But at the end of the day, it's more like in the construction phase. You're not going to see crazy revenue growth like a chip player, because you can only build so many data centers at once. You can only ship so many cooling and infrastructure solutions at once. You can only get probably so many licenses and regulatory approvals at once. So I think now the price is kind of looking at those types of risk, and it's looking more attractive. I wouldn't buy it. I'm not into that market, but I definitely see the growth opportunities now.
Good deal. Well, we are right up on 11. Rose, sorry I didn't have time to get to your question. The short answer is yes. All these truckers are sort of dealing with the same thing. But hey, I'm on for 3 hours tomorrow morning, 8 to 11. So please come on back. We can talk trucking for at least 45 minutes. I think definitely that's good TV. And Cyber Mikey, hope to see you at that Manhattan Associates event. So yeah, but we have time to figure that out. All right, Jose, this was fun. Happy Friday. We now turn it to two men with very, very good-looking gray tops on, which, you know, it's good you guys coordinated.
Yeah, we spent a lot of time going through the color palette for this show, so
that's good. I
the most
did that
important part, of course.
exactly.
It's the attention to details that make you all great. So, Travis, Will, have a great show.
Thank you.
You.
Will, how are you doing today? We got a down market.
Well, we do have a down market. That's true. I'm doing well despite that, though.
I know I've been joking for years on these shows that I don't look at the market all that often. I'm truly a long-term investor, and just peeked this morning, and I was like, oh, I wonder what's going on. Must be some tariff-related news or something. So
yeah, tariff-related news. We had an inflation report this morning, so yeah, there was a lot going on, and it wasn't positive for the most part. So
a little something for everybody. Well, what's our topic for today? Do you want to lead us in here?
Autonomous vehicles, as I understand it.
Yeah, go ahead.
Yeah, so we've autonomous vehicles have gotten a lot of attention between Tesla and then the Waymo Uber partnership. Well, both companies are going to be launching autonomous vehicles in Austin, Texas later this year. Uber's also going to go into Atlanta. So it's been quite interesting. I guess we're really going to see what happens here. I was looking at the map for Uber. It's going to be primarily in the center part of Austin. So unless you're just live your life in that area, you probably wouldn't be taking a fully autonomous trip from point A to point B. But it's a good little area. Very lot of traffic there. So it'll be a good test to see how these vehicles ultimately perform.
Are you talking about Uber or Tesla?
Oh,
because I think Uber is operating Waymo's vehicles.
That's correct.
In a
Yes.
couple of cities. So yeah, let's let's maybe take a step back and start with sort of who the players are here and what the pieces that are being put together. Because I think this is one of the things that's always really confusing is there's the technology piece.
Yeah.
There's the auto manufacturing piece. There's owning the vehicles. And then there's the ride sharing network, which I think is kind of what everybody thinks we're going to head towards eventually. So there are two companies and only two companies that can actually do fully autonomous rides in the US today. That is Waymo and May Mobility. Everybody else has a safety driver or something like that, including Tesla. Tesla is a level 2 autonomy system. So let's just kind of put that out there. There's tests going on in level 3, level 4, but those are really the only two companies that are commercially operating today. Anything you wanted to add there?
Yeah, I just well, I had a point. I forgot it. I guess Friday is having a Friday moment, I guess, for lack of a better way to put it. Yeah.
The interesting thing with the tech side, if we can just take it to the next step, which is sort of the OEMs, is that there's basically two ways that you could go about this. You could vertically integrate. That's basically what Tesla's doing, and to a certain extent, it's what General Motors is doing as well. Ford is doing some of their own stuff themselves. Waymo is vertically integrated in that they own the ride sharing piece and the technology piece. They are not an automaker, so they're going to be, outsourcing that piece. They had a deal with Geely, if I'm remembering the names right. But as a Chinese automaker, 100% tariffs on those vehicles coming into the U.S. not going to really be palatable. So the next step is for them to launch these vehicles with Hyundai, which is basically the Hyundai Ioniq 5 is going to come off the production line, and then they're going to stick their Waymo stuff on top of it. So that's sort of the manufacturers kind of have different strategies and different priorities. The other company to bring into that from an auto manufacturer standpoint is Mobileye. I'm going to talk about them in just a second. I'll go through a couple of announcements. But Mobileye would be the horizontal services provider or the modular company, if you want to think of it that way, in autonomous driving. So they are the company that if you have like smart cruise control or lane assist on your vehicle today, so like they call it ADAS or advanced driver assist systems, that would be like a level 1 autonomy. That most likely comes from Mobileye. It's just a single camera. They got some software and a chip behind it. They generate about $50 to $100 worth of revenue per vehicle that has that. But they're moving up the stack to level 2, level 3, and then ultimately level 4 vehicles. So that's the one thing that I kind of want to talk about today is the different business models that are going to be going into this. The other piece would be the ride sharing piece. So you have Lyft and Uber who are going to be involved in ride sharing. They have their own strategies. They have basically similar strategies in getting to autonomous driving, kind of trying to commoditize the supply, if you will, and bring more supply onto the market, potentially even lower costs. So that's kind of their piece in the market. And then the other way to build this out would be to build your own ride sharing network. Can Tesla do that? First of all, can Tesla answer the technology piece? But then they would also have to answer the ride sharing piece. They would have to build a ride sharing network, scale that before all these other companies get to having tens of thousands of vehicles on the road. And then Waymo is kind of in the middle going, we have our own ride sharing. Also, we're on Uber. So we'll see kind of how that plays out. But that's sort of the lay of the land, just to kind of give an overview of where we're at. But what are your thoughts there?
Yeah, I actually wanted to invest in Waymo. However, you look at Alphabet, their parent company. Waymo doesn't even get mentioned really in their earnings report. It's the Google/Alphabet earnings report is primarily advertising in the cloud with little mention of Waymo and Verily Life Sciences and all these other dozens of companies they happen to own. I actually decided that the best way to invest in Waymo was to invest in Uber since they're partnering with them. However, you kind of have to ask, okay, Uber doesn't own its own car, so why would people turn to Uber for autonomous driving. After all, Waymo is connected to Alphabet. Alphabet is one of the biggest networks out there on the internet. So you would think maybe they could just cut out Uber and do it on their own. However, Uber offers that network of its rideshare customers for one thing, and I think it could offer they can offer more right now because we're going to be transitioning into autonomous. It's not going to just come on. I mean, what they're launching now is just one small part of Austin, so we're still, I think, some time away from going fully autonomous if we ever do. So Uber can combine the customers that want to do a rideshare via a human driver versus autonomous, or mix it up. Uber can also offer fleet management services, which Waymo Waymo's again connected to Alphabet. That's more of a software type company. So whereas Uber's had more experience with the fleet, since they also happen to do freight and delivery. They're kind of all things transportation. Plus they're doing it in 70 countries now to one degree or another. So that's kind of how I've approached the sector. But I think it's very fascinating. We're going to see how these autonomous tests go. But I think it does look promising. Of course you have to. There's a lot of testing that has to go through this, and of course because it's driving, it needs the best technology. So this is going to be a very iterative process. But like I said, I'm excited to see how this goes, and obviously investors will take things from there.
Yeah, let's let me pull up my screen here, and we can talk about kind of an update on where things are today. If you want to share that, Natasha. So Waymo offers about 200,000 rides per week right now. 200,000. So this is a big service in the San Francisco area. They actually have about the same market share as Lyft does. I could pull that up, but they have like a pretty significant market share. I'll get to their map in just a second. But what Waymo has done is build out, basically solidify the technology in the San Francisco area. Arguably the hardest place to test autonomous driving. I mean, if you want like an easy situation, you go to Phoenix, or even Austin. All the hills, all the traffic, everything that's going on in San Francisco. I still think it's incredible that they were basically proving themselves there. But they are now moving to a whole bunch of cities. They call these, they say they're doing these stops in different cities where they're just going to kind of go in. And the way that I'm understanding it or reading into this is they know that they need to scale the business. And so the next step is, how do you go into a new city that you've never been in before? And what's the process for going from, okay, we're going to go to Washington, D.C. to we're going to have 1,000 vehicles on the road? What they do is they go in and they map the city. So they basically just drive the car around and collect data for the map so that the vehicle sort of knows where it is and there's reference points. And then once that map is created, then they start to slowly roll out services usually to internal people, and then to, kind of a wait list, and then to the broader audience. So that's what they've done in a handful of cities, is basically test this out. So you can see here, just a few of the places. They're going to Japan. But the big thing here, if I can go to San Francisco, they have really expanded quickly to most of the Bay Area. They actually recently announced that they're going to expand to Cupertino, Mountain View, and then actually parts of San Jose as well. So kind of basically that whole area on the peninsula. And over a course of years, I forget when they first got their commercial license, but it was, maybe 2020, maybe even before that. But they could only operate at night or during the day. I think it was at night because there was fewer vehicles on the road. And then you expand the number of hours. And then they recently expanded to highways. So they've been slowly taking steps forward. And this is, kind of built that trust in that community. I haven't been to the Bay Area in a while, but my understanding is these are kind of everywhere. And even Zoox which is owned by Amazon, is operating in the peninsula. So if we go to some of their other operating areas, and this is just on the Waymo site, you could see their map. This is something I try to keep track of at least periodically, because they have been operating in Phoenix for quite a while. And you can see this is a pretty significant part of the Phoenix metro area. It's not everywhere you would want to go, but it's pretty close as far as the metro area goes. So they've been expanding at 315 square miles. So big space that they're operating there. A couple other cities. Los Angeles and then Austin as well. So Los Angeles, they've been expanding there as well. This map just keeps slowly getting bigger and bigger. Obviously, they could probably 10x the size of this map, and they still wouldn't have the entire LA area covered. But that's sort of their strategy, is just piece by piece, adding different sections so that they can operate a bigger and bigger portion of these cities. So this is, think back to Uber. If you go way back to when Uber launched, when you had individual apps for each city. I was in the Minneapolis area, and basically, if you weren't in downtown or uptown, there was no Uber. There was like a geofence around Uber, but slowly but surely, it just sort of expanded. Everything became one app, and then it became ubiquitous. I think eventually, if Waymo was the only competitor, we would see Waymo do exactly that. And one of the ways that they're going to market is with Uber, like you said. The way that I'm reading this with Uber is they don't want to be the company that has to charge vehicles and hire tens of thousands of people to like clean out cars and do maintenance on vehicles and stuff like that. So they're going, who are we going to partner with? We can partner with a company like Uber that will take that on and have the ride sharing network ready to go. So we can just be the tech company. And so we'll see if that's how it plays out long term. They're basically testing different business models in different markets, but that's what they're doing in Atlanta and Austin. They're going to be. I think it's Austin was the second one. Atlanta for sure. Uber is going to be running the entire network. So Waymo is not. You're not going to be able to get a Waymo on the Waymo app.
Yeah, and also, go ahead. I'm sorry.
No. Go ahead.
I was like, Uber is also kind of looking to be kind of a super app as well. They were actually proposing, acquiring a travel company, so it can kind of combine all these services into one. So it'll be interesting to see how this goes over time. But there's but when you combine all that with autonomous driving, obviously there's tremendous potential for growth over the next few years.
Yeah, and Uber has no interest in being captive to Waymo. I think that's the other thing that, if you listen to their CEO talk, you look at their presentations, they are very aware that they want Waymo to be one of many suppliers. And that's where their vision is in the market. They want to commoditize supply, just like they've commoditized supply with individual drivers. No individual driver has a whole lot of power over Uber. They want to be in the same situation once we get to autonomy. They want to have a whole bunch of different fleet owners. They want a whole bunch of different manufacturers, a whole bunch of different technology providers. And so that, no one of those providers has a lot of power over the network that Uber has built. Let's talk about a couple of the other companies involved here. Tesla is the one that I think gets a lot of attention. They still say that they're launching in June. This is one thing I think everybody should just track is how this is crowdsourced data on the number of disengagements that they have on FSD vehicles, and this has by the FSD version. Tesla, Elon Musk has, by the way, has tweeted out this data before, so it should be at least directionally accurate. Tesla doesn't give specific data on their safety metrics, but if you go to this main dashboard view, which provides some interesting context for how many miles you have before a disengagement with the Tesla, on average 38 city miles. On a highway, 45 city miles. So is that going to be safe enough to launch a autonomous vehicle in June in Austin? Tesla is still sticking to that. Everything that I've seen, I mean, even Waymo's former CEO said there's a lot of ways to, his quote was, there's a lot of ways to fake an autonomous vehicle. It sounds like Tesla's already building out, having kind of like remote operators available at a moment's notice. So we'll see how that goes. But they're the other company obviously gets a lot of attention, but they are still a level 2+ system. Let's go to Rivian. They announced some interesting autonomy stuff. and they have a pretty high valuation. So I think they're at least worth mentioning, because a lot of their valuation is based on future growth and software that they could be selling to companies like Volkswagen, where they have a partnership for their ECUs and other pieces of software. That does not appear to be something that's going to make its way to autonomy. And I'll get to that a little bit more in just a second, but they are starting to roll out, and they have the sensors in these newer vehicles to roll out basically a level 2 plus, maybe potentially level 3. And the distinction between level 2 and level 3 is where the liability lies. If there's an accident and it's level 2, this is why Tesla is level 2, you are at fault as the driver, because you should have been paying attention. If it's level 3, now the automaker takes the liability and they have the responsibility to make sure that there's no accidents. So that's the big bridge to cross between those two. But they are at least rolling some stuff out. The reason I think they're interesting is they have that partnership with Volkswagen. But Volkswagen just announced that they're going to be using Mobileye sensors for their level 2 plus autonomy in what they call their MQB vehicles. This is kind of the platform that, like the Volkswagen Atlas and the Tiguan and a whole bunch of their other vehicles, even not under the Volkswagen brand, are built on. Spans ICE vehicles and electric vehicles. So they're leaning on Mobileye. Again, this is the biggest automaker in the world, makes about 9 million vehicles a year under all their brands, and they're using Mobileye. So that's, another player that you may not think about in this market, but maybe you should. I'll leave it there for just a second to get your thoughts, Will.
Yeah, there's so many of these competing platforms out there, because NVIDIA is developing autonomous. Qualcomm is. I'm a shareholder in Qualcomm, so I've been kind of following that. I think the revenue is up more than 60% in automotive, and right, it's a very small segment of the company right now, but it's also the fastest growing. So I'm kind of wondering how that's going to play out over time as autonomous grows, and I think there's probably going to be, there has to be some consolidation at some point, but
well, and it'll be interesting to see, like, NVIDIA is building pieces that are a little bit like what they do with artificial intelligence, where they're going, we're not actually building AI, but we're going to build all the tools that help you build AI. So they have a chipset that automakers can buy. GM just said that they were going to be using that chipset. You have simulations that you can do, but ultimately building the software then still falls on the automaker, whoever that supplier is. So I think that's interesting, in part because one of the critiques, and I own shares of Mobileye, so this is one that I follow, and they're really interesting to listen to, because they will talk very honestly about what the state of the industry is. And their critique is, hey, you can buy our entire system for the cost of the NVIDIA chip, just the chip, before you even build the software or buy any of the other sensors. In a vehicle, spending $2,000 on a chip is pretty prohibitive for most vehicles. So that will be interesting to see. I don't think there's any question that NVIDIA can be the chipset and help sort of build what they've called their operating system for autonomous driving. The question is, what's that cost structure going to look like? Is it going to be a good business for them? I don't know the answer to that. So they're a player absolutely to watch. Companies like Mobileye are buying their chips to help train their stuff, but they are also building. They're also designing their own custom-made chips that's specifically for autonomous driving. So different strategies coming into play there.
Yeah, and also you have to keep in mind the natural deflation in the semiconductor industry. As this technology becomes more prevalent, the costs are going to fall. So that may help NVIDIA in the end. But yeah, right now they're commanding such premium prices for those AI accelerators. This kind of seems small potatoes in comparison.
Yeah, small potatoes and potentially small margins compared to the what is it, 80% margins that they're getting for AI chips. So I think the same thing is going to be true in robotics too. They get a lot of attention for their ability to build chips in robotics, but are they going to be able to command a high price for a robot that people are going to try to sell for $20,000? I think that's pretty tough. But I think those are a lot of the big players from a public investment standpoint. You mentioned that Alphabet owns Waymo. Technically, Waymo is its own subsidiary and has its own capital structure. So just pointing that out. They don't own 100%. I don't think we even know exactly what the ownership stake is, but like employees have stock options in Waymo, not necessarily in Alphabet, as I understand it, anyways. So I would say they're a vast majority owner. I think it's still a compelling. I mean, they're eventually going to have to spin Waymo out because it doesn't make any sense to have that under that umbrella. I think their last capital raise was at over a $50 billion valuation. Today, I mean, what would this be worth? $200 billion. That's still pretty sizable for Alphabet.
They were saying it was worth something in that neighborhood a few years ago. Then they dramatically cut the valuation after the 2022 bear market. It's hard to really know, but it's kind of frustrating as an investor because, as Travis alluded to, as a standalone stock, it'd be probably a great investment, but because it's part of the behemoth Alphabet, it doesn't really stand out, which is a shame in my opinion. I kind of personally wish they'd break up Alphabet for that reason. Probably not going to happen, but hopefully Waymo will be spun off at some point.
Yeah, if we just look at like Aurora Innovations, $11.8 billion market cap, they're essentially pre-revenue, aren't they? Let me look that up quick so I'm not misquoting. They don't have a lot of, no revenue last year. So $11.8 billion for the promise of autonomous technology someday in the future. The company that actually has vehicles on the road, I don't know, you would think would be worth more than that. But yeah, I think very, very fascinating space. And if you look at, if you follow NVIDIA, if you follow any of these tech companies, it's pretty clear that this technology is moving forward extremely quickly. That's why I think the thing that investors have to ask is what's the right business model for the future? Because I don't think that it's going to be impossible for multiple companies, potentially a dozen companies or more, to answer autonomous driving safely enough to scale it. The question is going to be, how are you going to make money on that? Is this just going to become a commodity that everybody has to offer? Just like ADAS, right? Like you don't go into a dealership and go, hey, do you have smart cruise control? You just sort of assume if you're buying a new vehicle, you have that stuff. Is that where we're going to be in 10 years? What do you think? Let's start there. What do you think that this is going to be a commodity when you go buy a vehicle that you're just going to be, hey, I assume that I can fall asleep for 20 minutes if I want to, or look at my phone?
Maybe eventually, but I think we're a very long way from achieving that point.
What do you think what's your very? What is a very long way?
Certainly over 10 years.
Okay, I will absolutely take the under on that. But.
Yeah, until you becomes commoditized anyway, because you have to, especially even when they master the United States, there's still the rest of the world too. So I mean, maybe it depends on where you are. Maybe the U.S. comes along a little bit faster than that, but depending on where you are, it could certainly take longer than that.
I think what you're saying makes sense. I want to put this into a little bit of context though. Okay. Uber was founded in 2009. In 2019, they had $13 billion in revenue and bookings of $65 billion. So they had $65 billion of people ordering a ride or food on their phones. Uber went from not existing to $65 billion in ride sharing over the course of 10 years. This is what I think is always so mind-bending about technology, is that we sit here today and we go, that seems like it's a long way off. And then suddenly it's like, boom, 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 boom. The announcement with, we didn't go through it in full detail, but the announcement with Volkswagen is that Mobileye is going to be providing what they call level 2+ autonomy. Basically think about that as what Tesla has today. Because it's not going to be taking over driving. It's not going to be hands off, eyes off, as they call it. It's going to be hands off. And you can maybe like 2+ would be like, you can look down at your phone. You don't have to have your eyes specifically on the road. But that's going to be, and there may be limitations. This is available in this. Most of the traditional automakers have done this where, okay, on these roads, the car will take over. On these roads, that we haven't mapped before or we're not familiar with, you got to actually be paying attention. but that's coming in vehicles in 2027, I want to say. I don't know if that's in this release, but it's coming quickly.
Well, and I think another factor people may not be thinking about is the trust factor. Like I touched on this a few minutes ago, talking about Uber. A lot of people just aren't going to trust the technology. So I mean, it may take years or even decades to get to where people fully trust it. So Uber probably isn't a good place there, because if you want the human driver, you can have it. If you want the autonomous driver, you can also have it.
That's an interesting point, because I would actually take once you hit a certain bar of safety with autonomy, I think the opposite is true. Like I have a wife and kids. I feel fine taking an Uber by myself. Obviously my kids can't, but I might put them in a autonomous vehicle where if I have a a video camera on them or something like that, when they're 12 years old or something, that's potentially compelling. And I'd feel way more comfortable doing that than I would, putting them in a random person's vehicle. So I think that's interesting. Same thing with, I think my wife feels very differently riding in some of these ride sharing vehicles, and Lyft even has a program for, if you want to have a female driver, you can choose to have a female driver. Autonomy takes that out of the question. So I hear what you're saying, but again, we go back to Uber. It was a weird idea in 2009 to go get in a random person's vehicle and have them drive you around, and here we are. Same thing with Airbnb. That trust factor seems to be built a lot more quickly than a lot of people think. But anyways, that's one of the reasons I'm so excited about the technology. I think it's moving so quickly, and it's just a matter of who's going to win, if you will, and what is that going to look like. Because I think we're all in the agreement that it's a huge potential market, but what in the world does it look like? I am in no way thinking that this is a winner take all market. Right. And I think that was the conventional wisdom even 12 or 24 months ago.
Yeah, and you have some people talking about Tesla being the winner take all. So I'm not really quite sure I agree with that. Although Tesla is compelling in that sense, because they actually make the vehicles, unlike these other companies.
Well, they will. So that's the other thing I should mention. So Mobileye specifically is building their vehicles to be what they call lift ready. So that will be in the future. That will be once they get to level 4 autonomy. They have some vehicles that they're testing in Austin. Actually, there's some ID Buzz vehicles that are fully autonomous. They are. I should have. There's a site that you can see of known autonomous vehicle operators in Austin, Texas. Volkswagen is one of them through a subsidiary that's using Mobileye's technology. Interestingly, Tesla, not a known autonomous vehicle operator in the city of Texas, at least as of last night. So, I think often in this industry, and specifically, the conventional wisdom is probably not really what's going on. You got to dig a lot deeper, and there's a lot of private companies too that are, like I said, May Mobility. We don't really know a lot about them because they're still VC funded. So if you have any questions about that, I'd be happy to talk about it. But let's move on to a few questions. Have you looked at Tom Morris asks about Wing and Kava? Are those two that you follow?
Somewhat. I think I favor Wingstop at this level. It's a bit more established, and it's growing fairly quickly. I need to look at the numbers. I haven't looked at the financials and the valuation metrics in a while, but I mean, when I looked at this about a month ago, Wingstop looked like probably the one I would go with here. Primarily it's because it's more established, and I think the valuation was a bit lower. I'm looking that up right now.
Yeah, I'll just cover the valuation. So Kava, currently $10.2 billion market cap. Price earnings multiple is 79. Enterprise value to sales is about 11. If you go over to Wingstop, $6.6 billion market cap, enterprise value to sales is 12. So similar from an enterprise value to sales. Price earnings multiple is 60. I believe that Wingstop is Kava, is, I guess the 3-year growth rate of Kava is 24%. Wingstop, it's actually 30%. So Wingstop is growing faster. These are two companies that I have like on a watch list and just haven't, especially with Kava, the price got so crazy that it was just sort of off until these stocks, even these high growth companies, start to come down to a multiple where you can go, okay, that's pretty compelling. I just kind of generally stay away. People have nothing but good things to say about Kava. So I've never been to one. So that would be the first step if I was going to buy shares, is to find one. I don't even know if we have one around here. Wingstop, I know we have, but yeah, they fall kind of in the same boat to me, with high growth and from their valuation.
Yeah, I think they're both great restaurant stocks. I think chicken wings is a bit more established than Mediterranean food, for one. So I think it's more of a proven concept in terms of what Americans like. Although with all the focus on health, Mediterranean is becoming more popular. So and it may get there. But it's not as tested as a concept, and given that it's more expensive, I would probably go with Wingstop here over Kava until the dynamics change significantly.
Interesting comment from Jeff M. I have a BMW iX M60. Congratulations, those look really cool. I have a decade-old BMW, and after driving some of the new ones, I was like, I'm going to keep this one that doesn't have a whole bunch of electronics for a little while. Stay old school. But I can't take my hands off the wheel for more than 10 seconds without bells and whistles going off. Yeah, that I think is going to be the case, at least for a little while, for some of these companies, especially companies that aren't kind of leaning into autonomy first. I would say one of the leaders from the kind of level 2 where we are today with what BMW would be offering would be GM with their Cruise Super Cruise product. So they're going to be adding that to more and more vehicles. I don't know if you probably run into the same problem. I know a lot of them have like eye sensors too, to make sure that you have your eyes on the road. We are moving to a world pretty quickly where it's going to be eyes off and hands off. And you will need to be in the vehicle. So that would be like level 3 autonomy, where you will need to be in the level 3 autonomy, at least the way that some of these technology companies have explained it themselves, is you have to be in the vehicle, you have to be in the driver's seat, you have to be available to take over. But if you get into a situation where, okay, the car doesn't know what to do, it will alert you, and then there will be like a 10-second or 15-second time frame where if you don't take over, they're going to do a safety maneuver and just pull over to the side of the road. So that's level 4. You start to get to the point where like there doesn't need to be a steering wheel. But that's going to be the first step on for vehicles. The other question I have with some of these as these things get more advanced, the equipment is pretty expensive. I know that Mobileye has some of their chauffeur products going out with Audi and Porsche. I don't think that's an extra cost for them, but we're talking about vehicles that are probably selling for, $70,000, $80,000, $90,000 to start with, and then probably up from there. It'll be interesting to see if they try to, GM I know is trying to squeeze out subscriptions. I don't know if that's going to work for autonomy in the future, but that'll be the other question.
Yeah, so Indy Farm D had a question on ASML. Any thoughts on why ASML's stock price continues to fall? That's a good question. I think the uncertainty in the economy and the industry itself is probably the reason. Intel is becoming one of its big customers. However, Intel's had some turmoil with the recent CEO change. They went to 2 interim CEOs for a while. They finally picked a CEO, so we'll see if their investment in fabs picks up. And they delayed those fabs in Ohio, so I think that hurt them. And I think there's also maybe some competitive concerns that some of the competitors may be starting to catch up with ASML technically. I still think ASML is a leader, but but you know, for until recently anyway, ASML was the unquestioned leader in EUV. So if people start to question that, that could hurt them. But you know, you look at the PE ratio. The PE ratio now is about 33, and I think that's historically cheap for that stock. Let me see where it has been.
Yeah, the other, just to put some numbers behind the EUV comment, in 2013 EUV revenue was 9.1 billion. Last year it fell to 8.3 billion. So when you have a company that I don't think the PE ratio, I mean 34, but the shares have come down significantly from their high anyways. When you have a company that's priced for perfection, if you don't deliver perfection, the stock's going to drop. I think that's.
Yeah, but look at the PE. It was almost 60 in the middle of 2024. Now we're looking at 33, so almost half. So yeah, I think it's kind of a near a almost a multi-year low. So I think it's getting to where you might want to accumulate shares if you're looking at this company. I haven't really taken an interest in this part of the semiconductor industry personally, but you know, it is still a very powerful company within the industry. So it could do well long term, but I think it's just going through some of these concerns. The big problem with it, I think, is it just has so few clients.
Yeah, it's a weird. This is one of the companies I think the snap test really makes a lot of sense. If ASML disappeared, then a lot of the chips that we are probably using right now to record this probably aren't getting made. But that said, that doesn't necessarily mean that a very, very high valuation is justified. I'm just looking at the 3-year compound annual growth rate is 15%. That's good.
Yeah.
But is that worth 60 times earnings? Probably not. So yeah, eventually there will be a point in ASML's price where I'll go, that's really compelling. But even at 34 times earnings, I'm just sort of sitting on the sidelines waiting until there's kind of more of a no-brainer price. And that I think holds true for a lot of the semiconductor companies who I think are riding a lot of hype now, and we'll see if things kind of come back to earth a little bit.
Yeah, not a no-brainer price certainly, but it's getting to where it's
absolutely absolutely much more compelling than it was a year ago or so.
Yeah.
Harry asks an interesting question about diversification. Says, new to investing, I read some Fool articles about diversification. I'm curious as to why there's a very large percentage of stock picks are all in the tech industry. I don't have insights from the premium side of things on exactly why that kind of tends towards technology, but I think one thing that holds true generally in investing, in the style of investing of something like Stock Advisor or Rule Breakers, where you're looking for these opportunities that are 10x, 100x, 1000x, those typically fall in technology spaces where you invest money once and you can make money on that over and over and over again at a very high margin for a long period of time. So I think that's probably why both those of us who are covering things for Fool.com or on the premium side are trending towards technology. That's where also a lot of the innovation and new products are coming from. If you just think about what are the other opportunities, is it oil and gas? You can maybe make some money in oil and gas, but it's a tough business. Same thing with like minerals, healthcare is kind of the same thing. So I think that's why things probably tilt towards technology, is just that's where the biggest opportunities are in the market.
Yeah, that's where most of the game-changing innovations come from, it seems like. Now, although I say that, but there are some stocks that have performed well in history that aren't tech. Tyler Crowe likes to talk about that. So next time you see him on, maybe ask him. But I just think back to Home Depot. It had a very small number of stores when it launched its IPO. That's one of the better returning stocks in history. If you invested in it when it only had a handful of stores in Metro Atlanta and then expanded across the country. But that expansion really made a lot of investors wealthy if they held on through the decades.
Yeah, but that's a good example. I mean, there's a bunch of, Costco's another example of that. But if you're
Yeah.
looking at a company that IPOs today, I don't think there's going to be any good retailers. It's going to be an e-commerce company, like a shop,
Yeah.
a Shopify or something. So it's the opportunities of the 80s and 90s are now in technology. And so I just think that's where everything kind of.
Even if it is retail, it's going to have a tech component in it. And then you're probably not going to know, even if you see a retail stock IPO and it's operates only in a small corner of the country, it's kind of hard to predict that that's going to be the next nationwide sensation too. So
right.
That's kind of, I think to get into Home Depot, you've had probably live in Metro Atlanta in the late 70s, early 80s, and be a homeowner and say, "Oh, this is a great company. Maybe I should invest." But someone out in LA wouldn't have picked up on it until a few years later. So, I think it's a combination of luck and opportunity with those.
Yeah. T Stock asks, maybe we can just kind of riff on what our favorite total return stocks are. I mean, I'm always thinking about total return. I don't know if you had any in mind. I'll just stick with the theme here today of autonomous driving. I think the best risk reward in that entire space right now is Lyft. It's trading for a price to earnings or price to sales multiple of about 0.7 or 0.8, depending on the day, which is about a quarter of where Uber trades. Their price to earnings multiple on a forward basis is like 11. And yet I think they're very well positioned. This is a supply driven market. Ride sharing is a supply driven market. If you have more supply in a city than the other company, you're going to attract demand. And the interesting thing about that for Lyft is that as we go to autonomous driving, they could flood the zone in any specific market with autonomous vehicles. And Uber is going to have a much more delicate dance to keep the market share that they have. If you think about, I'll just use Minneapolis as an example where I live. If I open up the Lyft app, there's maybe 4 or 5 drivers within a couple of miles of me. If you open up the Uber app, there's going to be significantly more than that. So if you're Uber and you're going to autonomous driving, how do you do that dance of like bringing Waymos or May Mobility vehicles or whatever it is to this market and then still having the support for those human drivers? Lyft could just say, you know what, we're cutting human drivers. our business isn't that big here anyways, so we're going to go all in on autonomy. And now we're going to have 50 vehicles. We're going to 10x the number of vehicles, and we're just going to own the market. It's easier to burn the boats when you're the second place player and not getting a lot of valuation. But that's where I think there's upside and value. So that's one of my favorites right now.
Well, you could be right there. Yeah, I think it was.
And I could be wrong. Yes, absolutely. I could absolutely be completely wrong.
I think you might be missing the international component with Uber. Uber just isn't just the U.S. unlike Lyft. So I think there. I kind of disagree with him slightly, although he could turn out to be right. We'll just have to see how it plays out. Talking about historical gains, I guess Home Depot is one I like to go back to. I don't own any. It's a mature company. You're not going to. It's more of a keep you rich stock nowadays than a get you rich. But it's good to study the history of it to tell you what a stock can do if you get it in at the right place at the right time. In terms of ones I own, I'm kind of looking at actually C Limited as a favorite. For those of you who don't know C Limited, it's basically the Amazon or Mercado Libre of Southeast Asia. It does e-commerce, fintech, and gaming. And people overlook Southeast Asia because combined it's about 600 to 700 million people, which is about the population of Latin America. And that's huge, but it gets overshadowed by China and India, which are each 1.4 billion people. So I think this is kind of an underappreciated market. C Limited did make a lot of mistakes early in the decade by going into markets they had no business going into. They pulled out of most of those markets right now. They're refocused on Southeast Asia. I think that's going to serve them well over time. I think it's going to do better as more investors appreciate its value proposition.
Couple of questions come in about stocks that I don't know much about. Healthcare industry. And then there's one from Hong Kong. It looks like. So I'm gonna leave those for someone who may be a better to answer them later. Do you have thoughts on Dutch Bros? No, that's one we get a lot of questions about.
I've been following it. I'm hitting myself because I didn't buy it when it was down to the 20s or 30s. At 60, I think it's still a bit overvalued, but it is one I think you should keep on your watch list, because now I think now that it's coming back down a bit, it's starting to look more compelling again. But regional to national growth stories like that usually are winners for investors, especially as quickly as Dutch Brothers is growing. Well, the forward PE is still above 100, so it is a very expensive stock right now. Let's see, price to sales ratio.
Yeah, not turning that revenue into much in the way of even operating income. Operating income is about 10% margin right now.
Yeah, they're heavily focused on their nationwide expansion, which is happening very quickly. They started off in Grants Pass, Oregon. They've already expanded all the way to Florida, so they're kind of beyond regional at this point. But they're not. I think they're only in 20 or so states, if I remember correctly. Although that changes all the time too. So, but yeah, it's still quite a bit more expensive than Starbucks in terms of price to sales. Starbucks has about 3.1 price to sales ratio. You're looking at about 5.0 for Dutch Brothers. I mean, if it continues to pull back, if it gets toward that price to sales ratio, or even within 20% of it, I definitely favor Dutch Brothers over Starbucks here. As for which one I favor now, I think it depends on what type of investor you are. If you like a more mature company, a little bit more stable, you want that dividend, then go Starbucks. But Dutch Brothers is still compelling. I think it's still going to grow very rapidly for the next few years.
My stomach hurts looking at these drinks that they have. Is this candy? These seasonal drinks? Is this candy in this drink?
I don't know. I've had to cut back on sugar, so I can't really.
Dutch Bro is not your place, apparently.
Well, but that's all those companies though. Starbucks, Dunkin', doesn't really matter. They all have their very sugary drinks.
That's very true.
Let's see. It's thoughts on Mixu. I think that's the Hong Kong one, right?
Yeah, I've never even heard of that one, so I will leave that one for later.
It came out yesterday, and people have been asking about it, but it's on the Hong Kong exchange. U.S. investors are legally barred from buying Chinese stocks directly. Even when you buy an Alibaba, it's really through a Cayman Islands-based holding company. In Alibaba's case, you don't really have shares of the company in that case. And if Mixu offers a American depository receipt or an ADR like Alibaba, then you can invest indirectly. But I don't think you can really capitalize on it right now.
Yeah, that's a good point.
See what else. I did see a question on Murphy USA. It was for Jim, but I'll take it for Bestie's asked 2 hours ago. Any comment on Murphy USA, MUSA? It's become more interesting. It used to be just the gas station for Walmart, basically, but lately it's been expanding more into convenience stores on its own, and gas stations that are separate from Walmart. It was trading it in a PE ratio in the high teens right now, where it was down to like 10 a few years ago. I think it's fairly valued here. If the PE gets back to 10, I might be interested, but it's a very stable, slow growth business. If that's your thing, maybe you might consider it, but I'm not. Even if I was looking at those kind of stocks, I'd probably hold out for a lower valuation personally.
There's a question here that I'll pop in so Natasha can pull it up, but about does Microsoft's reliance on OpenAI when it comes to AI, is that a failure to capitalize on high demand? Reflect on any operational missteps. I think this is going to be an interesting thing to think about for over the next few years, whether it's Microsoft or so many of these other companies, because AI is changing so quickly. But I think, Microsoft or OpenAI raised its last round, just a few months ago, and they're apparently talking about raising another $40 billion. Microsoft didn't participate in that last round. And I think that's really interesting. You can look at their relationship sort of deteriorating even in Microsoft's conference calls. They, at one point in 2022, 2023, were talking about hey, this partnership with OpenAI is great. We're going to be so integrated. We're going to be optimized to run OpenAI's models. Now you're looking at a situation where Microsoft has basically said, hey, we'll put any model on our platform because the models have essentially become a commodity. So it's interesting that the challenge that I think Microsoft has today is, are their current products suited for the AI environment? And are they going to be the preferred platform to build in the cloud? And I think those two things should be maybe questioned a lot more than they were, over the last couple of years. Microsoft was one of the bigger beneficiaries, at least from a market cap growth standpoint, from artificial intelligence. But right now, they don't have any proprietary models. They don't really have, they have somewhat exclusive access to OpenAI, but their models and equivalent models are getting better. So there's not necessarily a differentiation there. Then you have Alphabet, I think, is the most interesting one in the AI space today because they have arguably the best models, arguably the best points of distribution, and they have the cloud infrastructure. If you're just looking at a cloud provider, I would say that Alphabet's probably better positioned than Microsoft with Azure. And that's because they're doing all these things internally. I think you'd be thinking about Microsoft very differently if they owned OpenAI and they owned that, that customer interface and the infrastructure, and they were kind of vertically integrated. But as it is, and we're kind of getting more modular, I don't know that they have great products for AI today. I mean, so many of their customers are corporate customers, and my friends who are working in, in the corporate world are not going, what I use all the time is Copilot. Like it's just not, I don't think it's being used all that much in Microsoft's own products. And so that's a real challenge. So is it a lost opportunity? Probably, but I don't know that anybody would have thought that at the moment ChatGPT came out, because I think Microsoft was seen as being a clear leader, and it just played out so differently than I think a lot of people thought maybe 2 years ago.
Yeah, I would agree here. I mean, but Microsoft's a very diverse company. It's in a lot of things. It's going to do some things better than others, and like Travis said, partnering with OpenAI looked good 2 years ago. Is it looking so good now? I don't know. So Microsoft has a history of making some great calls and some not so great calls. They had, looking historically, they dominated PC operating systems, but then missed out on the smartphone operating system, or by the time they tried to get in, it was pretty much too late. So maybe some of history repeating with this, but I wouldn't necessarily count out Microsoft for that reason. But yeah, will it be a leader? Yeah, maybe not, and maybe it was a misstep.
All right, question for you, Will. OpenAI is raising $40 billion at a $300 billion valuation. Are you a buyer? If that was a public company doing a $40 million raise at a $300 billion valuation, I'm going to see if I can pull their revenue numbers here. I want to say it's expected to be about $12 billion this year, but they're expected to lose, I don't know, 5 or 6 billion. What do you think?
I'd have to look at the financials to make that call. I'm not that big on buying it stock as at the time of its IPO personally. Once it was out for a while, I would look at it, but I probably wouldn't go into it right now, personally speaking.
It's so crazy because the money that's flowing around from some of these investors is just, like SoftBank just putting in $7.5 billion initially with an additional $2.5 billion. Just throwing $10 billion around on a company that's still burning money like crazy. And I think is after their AI or their image generator announcement, what was that, a couple of days ago now, probably burning even more money, because I don't think there's any way that Sam Altman said that their GPUs were melting. They had so much demand. Having demand is great, but that also means that they're going to be losing more money, because the people even who are paying $20 a month for ChatGPT probably costing the company more than that.
So this means you're a no too, then?
I'm absolutely a no. I think we are still in very much like a mid to late 90s phase in artificial intelligence, where we're throwing a whole bunch of things at the wall and somebody's going to emerge, but it's going to be somebody who, all those companies that came out, except for Amazon I don't think was profitable from the start, but like Google, I think raised $50 million before they went public, and they probably didn't even need to raise that much. They were profitable almost from go.
Mhm.
Most of these businesses that end up becoming really phenomenal, huge, world changing businesses are not starting as we're going to burn billions and billions and billions and billions of dollars for a decade plus, and then something money machine turns on. So I historically, we don't see these kinds of companies that are burning through cash, don't have a clear profitable business model, becoming suddenly massive money makers. And you see OpenAI sort of losing their lead in, I think they make better products than Alphabet for sure. I don't think their artificial intelligence is better. So that's problematic because Alphabet has so many places they can just put, I always use, my wife as an example. She's using AI and has never used ChatGPT, but she's using it because like Alphabet's just putting it in Google search responses, and, Gemini will pop up every once in a while. It doesn't even realize what's going, like that's an AI model. And so I wonder if they're going to ever live up to it. They could become a great consumer brand company. I just haven't seen them be able to figure out a business model that works. I think subscriptions would be really rough for them.
Yeah.
They got to be an advertising company at the end of the day. And Sam Altman said recently that they're not going to be an advertising company. So there you go. Alphabet already has the ad business. They're ready to go.
And Meta and Amazon
and Meta and Amazon. Yep, all these other big companies.
Or Mercado Libre if you're talking Latin America. So
yeah. So it'll be very interesting to see.
So we got less than a minute left. Should I try this question? I'll just knock it out quickly. Bessie's 2 hours ago asked, what is your view of Broadcom AVGO and how it competes with NVIDIA? What are your expectations for Broadcom in the next 5 years? I expect it to beat the market. I don't know if it's going to outperform NVIDIA necessarily. NVIDIA, as we know, is making so much money off those AI accelerators. Broadcom works off relationships with other businesses primarily. So I think they'll make some compelling stuff for those businesses. We don't have as much visibility as to what they do in general for that reason. But they've been successful with that model. They've integrated software, which has been very fortuitous. I expect it to do well, but I don't know if it's going to outperform NVIDIA or not.
All right, well, that's our hour. That went pretty quick.
Yes.
We're gonna welcome in. I think Jason and Corey are up next.
No, I'm actually on with Jason next.
You're on with Jason next.
Yes.
All right.
Yeah, we're gonna keep Corey behind the glass back there moderating and keeping us reined in. Travis,
I will. I'll hand it off to you guys. Have fun.
Okay, see you, Travis.
We'll on.
Good afternoon, Will.
How are you, Jason?
I'm good. Well, it might not be afternoon where you are. It might still be morning.
Yeah, it is. I'm in Central Time. It's 11 a.m. here, so yeah, I guess it is technically still morning.
Well, happy Friday. I can wish you a happy Friday for certain. It's good to see you, and it's nice to have you here on News versus Noise.
Yeah,
so go ahead.
A lot of news today, to say the least, between the tariffs and the inflation report and CoreWeave coming out. So
yeah, there is, and so here's the idea. So News versus Noise is something we try to do for an hour once a week, typically on Fridays. And the idea is to make this a thought exercise. So we take something that's in the news, something that's topical, and we try to figure out on some, almost think about like a bell curve here of whether it's news. So think about news as like signal. Is this something that I can take, this piece of information? Is there something that is useful and actionable that then I can take it as an investor and I can use that information to deliver better investing outcomes? It can help inform a decision that I'm considering, give me more clarity about a company. Or is it noise? Is it interesting but useless? And again, it's not binary, right? Well, we've talked through this before. So I think about it like if it's like a 1, let's say 1 to 10. I keep saying 0 to 10, but 1 to 10 I think makes more sense. If it's a 1, it's useless for investing. Maybe it's good to be aware of, but like I can't take it today and do anything useful with it. If it's a 10, it's clear signal, something that is materially important that I can use to move forward as an investor. And again, things are going to kind of fall on that range in between, right? So for example, we got some macro stuff today. Macro stuff is interesting, but we can almost never take it and apply it to an individual stock and use it to say, okay, this makes this business better, or this makes this business worse as a long-term investment. So that's the basic idea, Will. So we'll try to apply that framework to as many questions as we can and try to give the best answers we can. So everybody watching, just a reminder, if you haven't before and you're not familiar with us, we're going to answer questions. We're going to answer your questions, but we're never telling you what to do. When we answer your questions, we're not providing anybody with personalized or individual financial advice. Just remember that. We're just getting your question. We don't know enough to tell you what the right thing for you to do is. So we're just doing our best to give the best answers that we can. Slido.com. The event code is Fool24. If you're watching on the YouTube stream, it's so awesome to have you on here. You're joining Motley Fool members, being able to watch something. Hopefully we can create some value. Maybe encourage you to consider joining one of the Motley Fool services along the way. So, all right, Will, I've been talking for about a minute and a half straight here. You see a question or a topic that you want to put through this news versus noise framework, or just weigh in on with a good answer for any of the people submitting questions?
Yeah, that's a good question. Yeah, because we've had, we had that inflation news this morning for one thing. It came in pretty close to expectations. I think it's like a 0.1% hotter than everyone was expecting. That kind of spooked the market. And then we're going through the tariffs as well. So I haven't checked the market since I started my last show. So I don't know I don't know what the market's done over the last hour, but it seemed pretty spooked by that.
Yeah, markets are down pretty sharply today. The Dow down about 1.3%, S&P is down almost 1.6%, and the Nasdaq and Russell 2000 are both down even more. Russell 2000 down almost 2%. Wow. The Nasdaq's down more than 2%, about 2.2%. So markets definitely not liking the consumer sentiment and the macro stuff.
Yeah.
Well, so let me ask you this. So thinking about that, so consumer sentiment data, GDP data, all is indicating a deterioration, maybe a little bit of a deterioration of the economy, but certainly a deterioration of consumer sentiment that may be pointing towards a continued further deterioration of the economy, from an economy that's been okay, right? It's been fine. It's not bad, right? Most people are making more money than inflation's raising prices. The job situation's pretty solid overall, right? Most people that want a job can get a job. It is taking longer for people that are out of work to find work, though. Inflation has been persistent, and we do know, based on the concerns that most consumers are weighing that are being surveyed, is that the macro position is certainly concerning. Costs could go up, that it could be harder to find a job. People are a little less comfortable that the job they have is they're going to be able to hold on to it. So my question, we know all of that stuff. All this is an uncertainty with the backdrop of a market that's still well down from the highs, and after today's down even more. So my question for you, taking that macro backdrop as an investor, again, thinking about that 1 to 10, now we have a little more information, a little more data to kind of tell us how the consumers are feeling and how the consumers are doing. How do you think about that as being 1 being not useful at all as an investor versus 10 being absolutely useful?
It's hard. Well, I rate it pretty low in terms of usefulness, because you hear about tariffs. Well, what does that mean? Well, I guess today the focus is an automobile tariff, so that's right. Only one small part of it. But that's not the only tariff controversy we've been dealing with. over the last couple of months. So I don't really, you say things are pretty good. I still think they're pretty good, but I think there's just a lot more uncertainty right now in terms of where consumer spending is going to go. Do I want to spend money on this, or am I going to be able to buy this because of the this or that because of the tariff? And people don't know, so I think they're being a little bit more cautious here. As an investor, you really don't know, because right now, whether we're talking news or noise, most of it's just noise, because we don't really know what's going to happen yet. So I just think the mood is very cautious right now. Like you said, things aren't really bad, but we could have a self-fulfilling prophecy if this goes on. So
yeah, no, I think that says a lot right there. So just one example. This is from the, I think this is from the University of Michigan survey. Which, when did that come out? I don't know if we just got the update of that one, but this is an interesting thing from that. We saw inflation was, relatively high, and it's been a little bit sticky. But respondents to the UMich survey, at the end of the year, were expecting inflation around 2.8%, which is kind of directionally where inflation had been at the time that they were surveyed, right? So, but that's human recency bias. It's not uncommon that happens. But from this survey, this most recent survey are expecting prices to rise 5% this year over the next year, versus 2.8% in the previous survey. So clearly, the perception is there among consumers, and the sentiment is there, and and also consumers are expecting inflation to, over the long term, to be higher. So kind of instead of higher for longer for interest rates, now higher for longer for inflation. So to your point, the self-fulfilling prophecy, right? Maybe that's what happens because consumers start to pull back now to make sure they have bolstered savings for this summer and in the fall, when prices could be even higher. And that could be the catalyst that actually weakens the economy, right? Yeah. So it's funny how that happens. So here's how I think about it. In terms of telling me what the market is going to do, telling me what stocks are going to do in the near term, it's a solid 1. It's absolutely useless. But what it does do a little bit is inform me, as someone who is regularly contributing money to investment accounts and retirement accounts. I'm still working, generating income, saving for retirement, future financial goals. It does tend to tell me, one of the things that I do during these periods of uncertainty is think about being mindful about spreading out my investments. Not trying to, okay, now's the time to buy. Sentiments is worse than we've seen it in 3 years, right? Time to go buy. I used to be that investor. So what it does is, from a mindset perspective, it tells me, hey, instead of taking your 10% of your portfolio in cash and going and spending it all right now just because the market is down and sentiment's the worst we've seen it, slow your process down a little bit. Maybe find that one opportunistic stock that you're ready to add to, and add to that, but don't do 3, right? Slow your process down and deploy that excess capital over time, instead of trying to time a bottom and get it when everybody feels the worst. Because we hear all the famous investors through times, when there's blood in the street, even in your own, this time to be greedy when others are fearful. All of those quotes, right, that we know, that we have tattooed on our investing shoulders. We don't want to take them too literally, right? We want to be mindful about our long-term goals and be thoughtful about having a process. So it does give me like a 3 or a 4 in terms of just like that actionable reminder to be a patient investor. And patient investors are the ones that succeed over the long term, because they don't make short-term, too quick moves that are mistakes. What say you?
Yeah, I mean, I may approach it slightly differently. I agree that the tariff information, that's clearly a 1, and yeah, I might be a little bit more mindful of what you mentioned, in terms of looking for stocks. But when I'm actually buying an individual stock, I look at the individual stock and I look at that industry. I don't really look at the overall economy necessarily. So if I see something I think is a good deal, I'm probably going to be adding shares regardless of what the economy is doing. That's me personally speaking. But I don't.
That's fantastic. You know, when you do that, but the key, and this is my follow-up question for you on this, is when you buy a stock, do you tend to start a position and this is as much of that stock as you want to own, or are you building out that position over time?
Well, I used to be the former, but yet nowadays, as I've become smarter, I tend to buy in small lots and then see what happens. I don't because I as a much younger investor, I was like, oh, I want the stock, and I would just put all my money that I was going to allocate to that stock, and more times than not, that was not the right decision to make. So
you built a process over time that allows you to still be opportunistic. That's fantastic.
Yeah, you know, I keep some cash just because you never know what's going to happen.
That's right. That's exactly right. No,
you look at the Shiller PE ratio, which has been a historic market indicator. It's not quite at all-time at multi-year highs, but it's pretty close. So I'm not saying the market's going to crash necessarily because of that, but it does increase the possibility of such an occurrence. So if that happens, I want to have some cash I can deploy to take advantage rather than panicking because all my money's in the market and that now I've lost 20, 30, 40%, and I have no money to work with. I always want to have some optionality in that regard.
Yeah, that makes sense. I want to take Quentin submitted a question about 6 months. Listen to me, 6 minutes ago. That would be very prescient of Quentin to 6 months ago having submitted a question about the short report on Kyndryl that just came out yesterday. So the question is, Jason, do you think that the scathing short sell report on Kyndryl, ticker KD, was news or noise? So again, putting it on that kind of on that range, I think it's probably I would say, I don't know why I'm trying to share the question in here for our producers, and it keeps putting in a link. So I don't know what's going on there, but thank you for sharing that on the screen. So this is one where now, in full hindsight, I haven't read the full report. Okay. So my answer is going to be a little bit based on conversations that I've had with other people that follow the business closely, and that have read the report. But I would say that this is probably a 5 or maybe a 6. So that's partly going to be tied to, what's your take on whether or not there's any signal there in the report itself? So my take is that it's a pretty typical short report, and that it's taking some things that are a little bit more obscure and a little more opaque with companies' financial results, and the difference between their cash flows and their operating results and their recognized results. Because again, according to GAAP, recognized revenue, recognized earnings is not cash flow. So they're using that difference in cash flows and GAAP accounting to make something that there could be a little bit of a signal there, maybe seem like it's worse than it really is. Kyndryl has been pretty open and honest about its continued relationship with IBM. And the short report is generally saying, Will, and feel free to weigh in here if you have some thoughts on this too, is generally saying that Kyndryl might not be completely showing the full cash impact of its relationship, of its ongoing dealings with IBM on the costs side of its business. And that could mean that the true free cash flow is substantially lower than what the company has been able to show so far. And as such, the stock should be valued substantially lower. Now, I want to show the stock price, because I do think when it comes to things like short reports with high beta, highly volatile stocks like this that have done extremely well, the market to some extent will kind of give you an idea how much signal and noise there is there. So Natasha, I just sent the screen share over, so if you can release it when you get a moment to. So this is Kyndryl's stock price since the 25th. So the short report actually came out. Was it after the market closed on Tuesday, Will?
I think so. I like you, I haven't been able to dig into the report yet. So
again, this is the market at the open on Wednesday. Okay. So down about 7%. It's down even more for the full week. But then if we just look at today, it's down about 2%. And again, let's look at the NASDAQ 100. So we'll just look at the NASDAQ 100. Again, it's going to be, look at that. So it's basically tracking with the market a couple of days later. So when stocks that are a target of a short report like this, they give up a little bit initially, not a lot, but a little bit. This isn't like a 20% sell-off after it came out. They give up a little bit, and then they start kind of tracking with the market after that. That means a lot of really smart people that have done their homework don't buy it. Okay. Right. So I think that's kind of my take, is that there's a lot more noise there than there is news. Now, the interesting thing sometimes is if you're a little bit counterintuitive, thinking about it a little bit counterintuitively, if you believe that management is right and what the company is reporting is more right, and what is listed in the short report is more wrong, then this could be an opportunity, right? This could be an opportunity. But with that said, shares of Kyndryl are still up, 150% from the spin out. The stock has done exceedingly well, and is down from the highs. It's down about 27%. But there's plenty of tech stocks that are down that much or more over essentially the same period of time. So you have to start breaking away performing with the market on sentiment versus the impact of the short report. And I think generally the market is starting to weigh in and saying, we don't really see what Gotham City is reporting. Any other context to add there, Will?
Well, entities release short reports usually because they're short the stock. So there's always a lot of self-interest, or at least there's usually a lot of self-interest in these reports. So you have to always take it with a grain of salt.
Of course, yeah, absolutely.
I would have said it was a 10, quite frankly, but the stock did fall a little bit. So maybe I'd put it at a 7 to 8 personally. But yeah, I would, like Jason said, I always take these with a grain of salt, just because of the self-interest factor. Now, you did have Super Micro a few months ago, actually last year, where there was a short report, and then some of the behavior of the stock kind of led you to believe that maybe what they were saying was true, and that caused the stock to tank and kind of undermine the confidence in the stock to a great extent. But then you see other short reports. I don't remember what this company was, but there was a few years ago, there was a short report released. The stock went down and then recovered quickly. But then you look a month later, the short report isn't even there. So sometimes these can appear almost fraudulent, to be quite frank with you. So I'm probably at a 7 to 8 here until I hear more information. If it's another case like Super Micro and Kyndryl behaves in a way that leads you to believe the information could be true, then I'd have to change that rating. But that's where I am right now.
Yeah, no, I think that's fair. All right, let's see here. What's coming in next?
I saw one from Besties I wanted to tackle from 17 hours ago regarding NVIDIA. It was for Danny, but I'll take it anyway.
Well, Danny's not here. You should take it.
Exactly. So the question asked, will you predict that NVIDIA will get cut off by 50% in the next 18 months? Well, I will say, when the DeepSeek news came out in January, I was concerned about NVIDIA stock. I was saying in the short term, yeah, maybe you want to trim your position. I've since changed my mind about that. We're 2 months into this now. We're getting some of the fallout and seeing how it affects the market. And I think NVIDIA fell by a third at one point. It's still down approximately.
It's still down. It's down about 27% still, roughly.
Yeah.
Yeah.
So I mean, so maybe even if you talk about 50% down from the 52-week high, I'm kind of inclined to say no. I might have said maybe 2 months ago, but I'd be very, at this point, I'd be very surprised if it fell below 100. So I'm going to say no. I do not expect a 50% retrenchment here. Although I will say there's been 50% retrenchments in NVIDIA since 2018. So you can't count out that possibility. It will probably
and neither of those were during the pandemic, right?
That's correct. Yeah.
So that's right. So they're totally independent of the crash that we saw in 2020.
Well, the second one was kind of post-pandemic because the 2022 bear market. But
yeah, right.
But yeah,
right.
You're right that they weren't actually deep in the thick of the pandemic for sure.
Right. So the sell-off back in 2019, that was tied to crypto, right? I think that was because prior to this run up with this massive explosion of, hundreds of billions of dollars being spent on artificial intelligence infrastructure, NVIDIA's most important business was GPUs that were being used to mine crypto. So much so that they couldn't keep inventory of gaming graphics cards on retailer shelves. So they actually built a line of their GPUs that were specifically for mining that stripped out some of the other things. They were still getting good, probably better margins on them, but so that their gaming customers could still get GPUs. And then the crypto market just hit a wall and crypto crashed as it does. And I think NVIDIA stock bottomed out at like 58 or 59% from the high in 2018. And it didn't fully recover until I think it was 2020 before it fully recovered from that prior high. So that's the business cycles that do happen, because when that happened, it really affected NVIDIA's business. We're going to see another one of those. Well, with the spending cycle for AI is going to go from this massive acceleration to building out the infrastructure. The industry is going to pause at some point and reevaluate, and it probably is going to overbuild, right? Because we always see that through these cycles. They're going to overbuild. They always do. And the cycle is going to turn negative for a period of time while the industry resets. Now, what we don't know about NVIDIA's business is the upgrade cycle is going to kick in there at some point too, where all of those hoppers that have been installed over the past 2 years are going to need to be upgraded to probably whatever the next generation of Blackwell is, right? We're going to start seeing that trend of the upgrade cycle kicking in. And what we don't know for NVIDIA is how is its business going to be impacted when we go from that transition from the infrastructure buildup to the upgrade cycle to upgrade and maintain the existing infrastructure. But at some point that's going to happen. And I do think, Will, this is probably too early. Even as much as we're hearing the Satya Nadellas and the others across the industry set, and we know that they've pulled back a little bit on some of their commitments to data center capacity. And we're seeing more executives kind of say, hey guys, we're not going to keep running like this forever. At some point, things are going to slow down. I think they're trying to cool off sentiment, and they're not necessarily like telegraphing what their moves are going to be this year. But at some point, we're going to see a pullback. I just don't know that we're necessarily there right now. And what I want to caution besties and other investors asking these sorts of questions to consider, again, thinking from signal or noise, it's so easy to look for signal, to look for clear things to tell us what's going on with these cycles that we mistake. We get noise and we think we're going to time the market perfectly. And we end up getting off the rocket ship too early, so to speak. And we lose track of the long-term potential of these businesses in our drive to try to get it perfect, to time it just right. We're never going to get the tops just right. We're never going to get the bottoms just right. I want to share that NVIDIA chart because, again, I think it's so informative to the whole idea of news versus noise. If you can share that, please, Natasha. So this is the past decade for NVIDIA stock. It's what these, you see, it's flat across the top here. These are the previous all-time highs, right? Previous all-time highs. And every time the stock has fallen from that previous all-time high. And like Will said, since 2018, we've seen two 50% sell-offs, 50+% sell-offs for the stock, and a handful of 25% plus sell-offs here more recent, like in the pandemic, and then what we're going through now. But what I want to do is I want to normalize this, and it's so hard to see it because it's been such a good performer. Let's just look at it over the past 5 years. I guess I guess we do have to go back to like 2018,
Yeah.
to really see. But you see, this looks brutal because and living through these is brutal. It's hard to hold through these, but every time the stock recovers, again, with the exception of it took a while to recover during the 2022 bear market, but all of those prior recoveries, you go down and then you reset again higher up before the next cycle turn happens. You reset the business gets stronger, and then you go through a cycle and it emerges and it's stronger than it was before the top of the prior cycle. And then it goes through that period and then it's stronger than it was before the top of the cycle before that. So that's the key thing that you have to remember, is that it's not zero sum, and trying to get out before the cycle turns. Yeah, I get it. If it's been a huge winter and you're going to need money in the near term, but if you continue to see the business's long-term 10, 20 plus year potential, and you're investing for wealth you're going to need in 10, 20 years, often the mistake that we make is selling to try to get out too soon, with the idea that we're just going to get back in, right? And it's not zero sum. That's why the stock has gone up, 22-fold, just since the beginning of 2018.
Yeah.
So just remember that.
Also, NVIDIA is now a $2.7 trillion company. So you are running into some issues with a law of large numbers. Not to say its growth is going to stop, but it is slowing down. Unfortunately, investors tend to punish stocks with slowing growth. I think they were predicting 58% revenue growth for the next quarter or something like that. That's still phenomenal, but it's not the triple-digit growth of some recent quarters. So it's possible that the stock will get punished somewhat for that reason. However, the PE ratio right now has also gotten pretty low. In terms of PE, in terms of price to sales ratio, we're talking 21, which is not low, but not certainly not where it has been. The PE is only like 37 right now, so it's kind of in a weird place valuation wise. Like I said, I don't expect it to fall off a cliff, and I don't think the growth is going to slow down quickly, but it is slowing, and the market may put some pressure on the stock for that reason.
Yeah, no, I think that's exactly right. Okay, what's next here?
What's next? Do you follow UPS closely?
Yeah, I do. I'm a shareholder.
There's one question. It's about Target and UPS. And I follow Target, but I don't follow UPS so much. So I guess we can answer this together. Ed asked about 18 hours ago, what is a better long-term buy at today's prices, Target or UPS? Which dividend is safer? I will say Target's dividend is a little bit above 4% right now. I do think it's safe despite the troubles Target is having. Its sales have become sluggish amid the economy being uncertain and some other factors. But its price to earnings ratio right now, I think it was just 12 right now. So historically speaking, I think that's a very, very low price for the stock. And like I said, you're getting a dividend yield above 4%. That's not a record for the stock, but it is pretty close to high. So I would say that's a good buy right now. I'm not quite sure how it compares to UPS, since I don't follow that stock quite as closely. But
I can weigh in because the interesting thing about both is both look relatively cheap. Their stocks, and the dividend yields are certainly attractive compared to like the long-term average that you've gotten. Both businesses are also going through a little bit of a turnaround period. So for Target, there's a little bit of some operational missteps that it has gone through. Going back to post-pandemic 2022, they had some inventory struggles. They basically had a lot of the wrong inventory, but there were a lot of companies that had too much apparel. Walmart had some of the same problem, but it seems like those things were compounded for Target, and Target actually went through a period where they were struggling a little bit with traffic at the same time that we saw Walmart doing exceptionally well, and other kind of some of the more upper echelon retailers like Williams Sonoma was reporting better comps than its peers. So the difference, I guess, is that Target, kind of their core customer, was spending less time in the stores, and it looked like they had lost some of their marginal customers to the Walmarts of the world. People that were trying to save a little bit of money were moving away from Target, which has kind of marketed itself as kind of the upper middle class big box retailer. But at the same time, the business has remained completely fine and solid. It's not like they screwed things up. They just haven't executed quite as well as some of their peers. Plus, just some of the trends, the macro trends have been unfavorable for their product mix and kind of where they focus. So that's happened. For UPS, it's less about operational missteps versus more of just looking at their relationship with their biggest customer, Amazon, and realizing we got to do something. This is a big business. This residential delivery is great. It's very, very large, but it's low margin. And it ain't like Amazon is going to want to continue to do business with anybody. They're clearly growing their internal distribution business, and we're going to lose that business eventually anyway. So let's move on our own terms and start focusing on the things that are going to be value additive, where maybe they're smaller businesses, but they're far more profitable, and they fall right within where we're logistically already the best. So things like moving into more like healthcare related stuff. They've actually built, and they're near their Louisville hub, they have a facility for medical testing. So for labs, so to be able to turn around labs quickly, that's high value. You get better margin for that sort of thing. So they're actually going through a situation where over the next couple of years, they need to shrink before they can really fully grow. So both businesses are going through a little bit of a turnaround. So I think, number one, investors in either one of these should acknowledge that when you have turnarounds, you have execution risk that's higher because you're trying to fix or redirect parts of your business in a new direction towards new things, trying to recover customers you've lost in the case of Target, in the case of UPS, trying to cultivate customers that you haven't done a lot of business for in the past. So those are hard things to do. They're very, very difficult things to do. But neither one, I think, is onerous for either of these business over the long term. I think they're both built to be able to do fine. And thinking about their dividends, I think both the dividends are reasonably safe. Maybe Target more so than UPS in terms of a percentage of its cash flows, because UPS is going to have to deploy some capital going forward. Its free cash flow has already started to come down. Likely could continue to see pressure. But the good thing for UPS is it has $6 or $7 billion in unleveraged cash on its balance sheet. It has debt it has to service, but it has a lot of cash available. That's a pretty good margin of safety. So even if we do see its cash flows get a little bit squeezed, it's got plenty of margin of safety to support the dividend at current levels. I would say if anything happened to the dividend, it may be that they just suspend any future increases over the next few years. Most probable outcome to these, probably they just lower the rate of growth to maintain as much capital discipline as they can, while still trying to deliver some sort of a promise for some growth to investors. With both, I think you look 5 years from now, you look back and the dividends are higher than they were. They probably get raised a little bit every year, most every year. And whether they beat the market or not, I think either one, you're going to get solid 7 to 10% returns, maybe even better from these prices. That's certainly better than you'd get on cash savings or something like that. So I think the risk reward is pretty compelling. I mean, there's a case for both that they end up doing even better, right, than that and beat the market. But I think to me, the floor case for both is probably 7 to 10% in annualized total returns over the next 5 years.
Yeah, well, I've been doing some research while you talk while you've been talking. UPS's dividend yields up to 5.9%.
Yeah.
I haven't dug in enough to know whether they can pay that, but it's the dividend's gone up, I think, for the last, say, I think 18 years now. So
yeah, that's about right. Yeah, that's about right. So you look, here's the thing, like you look at the cash flows over the past, let me do free cash flow here. I'm going to just look it up. Total dividends paid over the past 4 quarters, paid $5.4 billion in dividends, generated $6.2 billion in free cash flow. So that's, an $800 million gap of excess free cash flow above the dividend. That's pretty good. But again, if we see continued weight on that free cash flow, because they're having to deploy more of it, or if we go through an economic environment where shipping volumes go down, and they have a pretty high fixed cost structure because you've got jets, you have pilots you have to employ, you have their whole delivery fleet, those massive distribution centers. You can only lever down those costs so much, right? And they try to be as optimized as they can. So I mean, there is some near-term risk that they're in the middle of trying to shrink before they can grow, and we go through a bad economic period. Like it could be just terrible timing. But again, I think they have enough cash on their balance sheet, and the business is strong enough that it should be okay.
So about 6 minutes ago, Harry S. asked, I know long-term investing, but if you clearly see a spike, should you sell and rebuy once it drops? Any advice there? Well, I've tried this in the past. I've usually screwed it up.
Yeah.
For example, last year I sold Palantir too early. I got in near the bottom, but then I sold it in the 40s, right before the election, right before it basically tripled in value. I do think, in fairness, I do think Palantir is in bubble territory, at least in my opinion. So, so that does make it a very tempting sell. I'm not gonna lie, but not only do you have to sell at the right time, but you have to rebuy. And I made that mistake years and years ago with booking holdings of the forward price line, which again I got it at the bottom, which was, I think I paid a little less than $20 a share. I tripled my money quickly, sold it. Well, I think it's like 4,500 a share now. So, I at the very least should have paid attention to it after I sold it and look for a point to rebuy. But if you're going to go into that, you have to time it right. Then you have to have the discipline to rebuy, which I have unfortunately screwed that up in my own case. And
I mean, let's be honest, right? That's the mistake that most investors make, is selling too soon.
Yeah.
And often on near-term valuation concerns. And again, I agree with you. A company like Palantir, I've yet to be able to wrap my head around the valuation for that business. The reason I haven't opened a position. So to my answer, Harry, and the way that I think about this, and the way I wish more investors would think about it, is the concept of rebalancing. So this isn't necessarily a great individual stock process, but when it comes to asset allocation across a portfolio, here's what we know. We know that stocks, we think about our portfolio as a toolbox. We know that stocks are the best category of tools for us to use to build wealth over the long term, right? 5+ years. I think you hear 3 to 5 years. I think 3 years is too short. I think 5+ years is the way you think about stocks. So if your financial goals are 5+ years, then the majority of one's assets, and again, Harry, we're not telling you what to do. We're laying this out broadly. Then if your goals are 5+ years out, the majority of your investments for those goals should probably be in stocks. There's some gray area there where bonds can kind of come into play as a way to get better yielding cash and taking on a little bit of risk, the debt risk at the individual company level, but you're in front of most every other party in line to recoup value in a worst case scenario with a business that defaults on its debt. So bonds kind of fit in there too and overlap more into kind of that near term. And then when you're thinking, the next few years, you should have cash. Plus, in other words, if you need money in 3 years, you probably shouldn't have stocks with that wealth today. That's the way that I think about it. Luckily, as somebody that's still in my late 40s, most of my financial goals are much further out than that. So Then the next portion is how much cash do you need to have in your portfolio to keep your brain under control, right? Because we typically, the optimal portfolio, Will, is you should just be fully invested all the time, but our brains are not optimal. So we have to decide what works for each of us as individuals. And for me, I learned that it's probably more cash than the average investor should have. So what I do now as part of my process is I do rebalance my portfolio a few times a year, where I go back and look at the percentage. What's the percentage in cash? What's the percentage in the bond funds that I use as my bond exposure? What's the percentage of my portfolio that's in stocks? And then rebalance to get it close to the amount of cash that I want to hold, close to the amount of bonds that I want to hold. And what I find is that when the market's roaring, then that does mean that I need to start looking through my stock portfolio and figuring out if there are places that I do need to sell. I typically start by trying to find weeds to trim. What are the businesses that I own that haven't done well, and now the stocks have underperformed? And I look through those, and do I ever have any intention to adding more to these businesses? If the answer is no, why am I continuing to hold them? And if I don't have a valid reason, then that's a weed, and it's time to pull that weed. But then I also will move further up the portfolio too. And sometimes you might have those huge winners that at some point you do have substantial exposure to. And from a rebalancing exercise, or from the perspective of, holy cow, this is 20% of my net worth. And I'm, if you're 35, 25% of your net worth is very different than when you're 50 or 55 or 60 or 65 in terms of the downside implications. But at some point, the downside implications, when you become so exposed to individual companies, rebalancing just makes sense. Even if you believe that there's a legitimate chance that that stock is going to continue to outperform the market, you become so concentrated in your risk to that company that the concentration to the upside is maybe not worth that risk. So maybe that's where you rebalance a little bit. So I think trying to time the market on individual stocks is a terrible idea for almost everybody. But rebalancing your portfolio a few times a year can help optimize for returns, give you more cash and liquidity to use when the market is down. Because when the market's down, if you're rebalancing when the market's down, guess what? Your percentage of cash has moved up, your percentage of bonds has moved up, and your percentage of stocks has moved down, right? Because stocks are the thing that go down when we go through these downturns. Time to buy more stocks with that cash, or maybe even some of the bonds if you want to reduce your bond exposure. So that's how I think about it. If you're looking at it on an individual stock level, it's a one. It's like it's all noise, right? It's all noise almost every time. Maybe I'm being a little too over the top. Not every time, almost every time. But if you're thinking about it as part of your asset allocation process, market up, market down. I think it's more like a 7 if you have a process that you're diligent about using multiple times a year. All right, what's next here, Will?
What is next? Well, I'm a trade desk owner, so I think I'm going to take on this one about the trade desk lawsuit from Red Cliffs about 11 minutes ago. And so Red Cliffs asked, concerning the upcoming class action lawsuit against the trade desk symbol TTD, what effect do you see on the stock price short term and long term?
It's the Dewey Cheatham and Howes, right?
Something like that. There, yes. Yeah. The trade desk. If you follow the trade desk, they reported their fourth quarter earnings in early February. They missed their own revenue number, which you never want to do. It's quite embarrassing. But
yeah, they were 33-0 with beating their revenue number before that quarter. It's the first and only time so far the company's actually missed its own revenue guidance.
Yeah, and so the stock is down about 60% over the span of 6 weeks. Now it hit its high before the report, so it'd been on its way down at that point. But
right,
investors just really hammered it, and so I actually bought more of the stock. I doubled down a couple of weeks ago on the trade desk because I thought it came down too far too fast, and so the lawsuit pertains to that. I think a lot of investors feel misled from some of the things that the company said in earlier quarters. Then you had this February quarter where the stock got hit. when you turn to lawsuits, I think that's kind of the last resort. That's kind of the loser solution, in my personal opinion. That's what you do when you're upset or you have no recourse. That's not to say all lawsuits are illegitimate, but a lot of them are. I kind of, I think they're trying to punish the stock over, the natural ebbs and flows of the stock price. Like I said, I was in trade desks somewhat before this period. I think I bought in 2022. But yeah, I doubled my money. Then all that got wiped out and then some over that 5-week drop. So I doubled down. So I'm optimistic about it in the short term. I'm optimistic in the long term. I think this lawsuit will ultimately be noise, in my opinion.
Yeah. So I will say that in the history of forever, if a company stock falls a lot, there will be a class of law firms that target those things that will flood the ticker pages on the Yahoo Finance and Google Finance, et cetera, with press releases of, and generally they'll start with exploring a class action, and then they'll say, notifying shareholders of a potential class action, and it's a land grab amongst this class of law firms that are trying to sign up enough clients to be the lead attorney in a class action lawsuit that may or may not even materialize. And often they don't materialize because they launch all of this push to the press to build a class before there's any evidence of anything fraudulent or otherwise that they would attempt to build the case on. This is the MO of the industry. That doesn't mean that there isn't anything fraudulent with the trade desk. I don't believe that it is, but again, it's the MO of this entire cohorts of the legal industry that this is their business. They do the same thing when stocks go up a lot, when an acquisition has been announced, that they will try to put together a class claiming that shareholders are not getting enough, right? So I've got attorneys in my family. The legal industry is incredibly valuable and important, and it's the core. It is a core part of what makes capitalism in a society of laws work. Part of the cost of that is frivolous nonsense that doesn't create value and costs everybody money and has negative implications for society. And I think writ large, a lot of what we see around these sorts of things is just that. It is very much noise. It's almost certainly not going to be material for the trade desk. Yeah, it could be somewhat material because if they have a legal team that's already looking into this right now, like literally looking into this right now. They probably started looking into it, a week before when management said, hey guys, we're going to miss our guidance. We're going to lower our guidance for the next year. Our stock's going to get hit. And their key legal counsel said, okay, we're going to go ahead and start going through every filing over the past 5 years so we can be ready to respond when Dewey, Cheatham, and Howe publishes something out there. So they've already invested resources, I'm sure, to prepare for some eventual possible case. But it's a cost of doing business at this point, I think, is the thing. And I don't think it's going to hinder the trade desk's ability to deliver on their goals, to move their customers from Solimar over to Kokai, continue to build the best AI platform for the buy side of programmatic advertising, continue to take steps to get more involvement into the sell side, and build multiple platforms across programmatic ad that are going to remain the gold standard. I believe they're going to be able to continue to do that. I could be wrong. I could be wrong that there is something that somebody finds that costs the company and its shareholders money, right? So that's what you have to remember. If the company does have to pay, that's money that takes away from all of the existing shareholders as well. So that is a reality. So yeah, I definitely think this is more on like the 1 to 2 side of zero, like the 1 to 2 side of being noise. But if it's not noise, it could be like a 7, right? So
Yeah.
could be binary, but I think the probability of that's very low, right, Will?
Yeah, you never know what's in someone's internal financials. I mean, even in a 10K, you don't see everything. You just kind of see a very generalized balance sheet, income statement, statement of cash flows. You never truly know what a company is hiding behind that. And if they are doing something nefarious, they are breaking the law. But it does occasionally happen. So maybe you give it a 2 for that reason. But in all probability, this is almost all noise. And objectively speaking, this was not a bad report they filed either. It just they missed their revenue number, and that's
Well, they missed the revenue number, and then the guidance was like for the first quarter is like mid to high teens versus the 26% they delivered last year. So yep.
Not a bad report, but not what investors were expecting. So, but it was an overvalued stock too, in fairness, I think, when it was trading in the 130, 140 per share range. Now I think the valuation looks a little bit more fair given their growth rate. So I like I said, I'm optimistic in both the short term and the long term.
Yeah, I exactly the same. Exactly the same. Yep.
So about 31 minutes ago, STG asked, do anything related to chips or semiconductor components or production move tariff-free either internationally or to the U.S.? I was reading up on this while Jason was talking. It looks like that they're going to aim towards 25% tariffs on semiconductors, similar to some other projects, it seems like. I was also hearing some talk about maybe they reduce or eliminate the tariffs for certain classes of semiconductors, because of course unfortunately we don't make the top semiconductors here in the U.S. The Biden administration was aware of that. The Trump administration is aware of that now. So you see TSMC looking to expand their fab capacity here, and then Intel is also building more advanced fabs here. But those will take years to get built. So in the meantime, you could see some tariffs with that. But I think over time we're going to have more of the production here, be it TSMC or Samsung or Intel or some other company. So yeah, I think in the near term, I think it could have some impact. But I think if over the long term, I think they'll adjust.
Yeah, I think so. And I mean, I think one of the challenges right now is that for the companies that do have strong domestic semiconductor manufacturing, which is almost exclusively on the analog side, right? Intel does a lot of domestic manufacturing, but then they ship that stuff overseas for packaging internationally. So all of a sudden it becomes potentially exposed to tariffs because of, once it actually gets integrated into the packaging, the rules change again, and now it's being imported again. We're going to be dealing with retaliatory tariffs, the second order effects of impact on end markets where there are tariffs in place. So it's really messy right now. And to me, it's more noisy than signaling, because again, there's nothing that's like a clear, like, how can I pivot as an investor to profit or benefit? We just have to invest through this reality in the cycle, I think.
Yeah.
That's the reality. Quentin dropped in a comment here that I think is important as we get into our last 5 minutes here. The trade desk potential class action is really different from, pointed out, the Celsius Holdings one, as it was clear that information was not shared regarding the sales numbers. True, but not sharing every single piece of information doesn't necessarily cross the threshold to fraud, right?
Yeah.
I think that's the important thing. Managements can screw up and not break any laws and not be subject to being accused of anything that's law breaking. So I think that's the important thing to remember, is that, there's the case to be made to crib from somebody much smarter than me that works for Bloomberg and writes a great blog called Money Stuff. Everything is securities fraud. That you could draw a line from lots of different behaviors and say that that's breaking, committing securities fraud. But at the end of the day, the recourse for managements that just mismanage a business is you fire them, and the board replaces them with somebody that we hope can execute better. So I think it's important to remember that, again, fraud claims up to interpretation, but we do know the Chancery courts are, when it comes to those sorts of things, are pretty clear about using prior judgments to make their decisions. So again, still just feels more noisy than signally at this point.
And who's to say if they had published that information, the stock wouldn't have done the same thing too? We don't really know that. So
right.
Like I said, before this news, this was a very highly valued stock. So I think just the high valuation it had played a part in the severity of the drop recently.
Yeah, no, that's right.
And you can't really pin it on one piece of information like that, at least not with any certainty.
All right, let's see here. We got a couple more minutes here before we hand it over to Toby and AC. Andy Cross is going to be joining Toby the next hour. What do you see that you want to grab next here?
That's a good question. There's a question about the CoreWeave, its relationship with NVIDIA. Unfortunately, I haven't really dove into CoreWeave. They just IPO today. I don't know if the stock is officially launched yet, as I've been on for a couple of hours. Is that one you followed, or?
So I think the key is that CoreWeave uses, I think they still exclusively use NVIDIA GPUs in their data centers. I think that's the key. And NVIDIA is a pre-IPO investor in CoreWeave. I believe invested in multiple rounds of CoreWeave. But beyond that, I don't know very much. But here's the thing: if you're building data centers for AI, guess whose GPUs you're buying?
Yeah,
there's one name. There's one name at this point that you're buying. So that's I think that's the key thing to remember there.
Yeah. So, and then I've got 2 minutes left. Bessie's asked 3 hours ago, directionally correct. Why not flip a coin? Well, I think there's a lot of investors that operate that way, to be quite honest with you. In the short term, especially, you don't really know what the market's going to do. There's that theory that you put all the stocks that are listed, throw darts at them and buy the ones that dart hits. Some people in the distant past, when there were newspapers, tried that, and I mean, who's to say? Maybe you get lucky and pick the right one, or not. But the thing with the market is I think it's a little bit easier to predict in the medium or the long term than it is the short term, because literally anything can happen in the short term. You don't really know, but if a stock is consistently growing its earnings, especially over a number of years, you can safely assume that stock is probably going to rise. You won't know exactly when or how much that stock rises, but I think things are a little bit easier to predict when you have more information and more time to deal with.
So I don't think CoreWeave shares have actually begun trading yet. I was looking on Yahoo Finance earlier to see if they were showing anything, and it was still showing unchanged. I just went on I'm on CNBC's website right now. I looked on my brokerage. I use Fidelity. I looked there, and it does look like the stock is halted. Is not begun trading yet so far. So at least from anything that I've seen on any of the common websites out there, including through my brokerage as well. So, all right, we're out of time, Lou. We are done. We're out of signal, and we're just getting noisy. So we're gonna hand it over to Toby and Andy, and we'll call it a day for you and me. What do you say?
I think that's a good idea. So, fool on, everyone.
Thanks, Jason. Thanks, Will. Hey, Toby. Hi, fools. Welcome to the Motley Fool. Fool 24. Andy Cross, Toby Bordelon, both part of the Stock Advisor team on Team Rule Breakers. Thank you for joining us here. We haven't titled as Ask Us Anything, so ask us anything. But Toby, maybe just start off quickly. Let's give 30 to 60 seconds. The markets are down today. We're seeing more and more conversations about the markets. Give maybe 30 or 60 seconds on the markets, and then we'll get to some of the questions.
Yeah, Andy, I'm not even sure what to think, quite honestly. I've been on vacation for the past week or so, and I'm trying to get my head back into the mindset of up, down, as seems to be the case right now. I think it's just stay the course, right? I think this is one of those periods of higher volatility, one of those periods of market pessimism for a lot of reasons. But we know, what do we know, right? We know it's going to turn around at some point. We don't know when that's going to be, but we know it's going to turn around. We know that it turned around during COVID, which was a terrible, terrible dark time in March of 2020 for the markets. We know it turned around after the great financial crisis, which was is the world ending financially situation for a lot of people. And that ended up just fine. So we know we're going to be fine, right? We just don't know the timing of when we're going to be fine. And I think that makes it challenging.
Well, that's certainly true. So if you just, for those who may not be as familiar with the market cycles, Toby, as we talk about, so about every 11 months, if you go back 50 years, the S&P 500 falls about 10%, about every 11 months, 11 to 12 months, right? 15% every couple of years, 20% or more every 4 years. And then you get the even worse performers every decade or so. And so if you go back to the great financial crisis, you go back to COVID, we're down now 10-ish% from the market, down even more. And what we've talked about, Toby, before is that's just the market averages. We know the individual stocks tend to be far more volatile. So we feel the individual movers in our portfolio more so than we feel the averages. So that 10% drawdown, the average, we may be looking at many of our stocks in the portfolio other than maybe Berkshire Hathaway that's up and say, gosh, I'm feeling a little bit more because my stock and my portfolios are a little bit more volatile. If you look at the great performers in the stock advisor history or at the Motley Fool, they tend to be a little bit more of the volatile stocks, the Netflixes, the Amazons, the Chipotles of the world, right, Toby? So we feel that, and we have to be mindful of that. Even if we've been investing for many, many years, we have to be mindful of that because we don't want the emotions to really get in the way and interrupt looking ahead over the next 3 to 5 years. The markets may not return 15% or more like they've done the past 5 years, but certainly they will return something because the markets, I believe, and again, history tells us that over 5-10 year periods, there are very few periods where the market actually loses money and a diversified basket of stocks actually loses money.
Yeah, that's right, Andy. And I personally remain very confident in about, over the next 5-6 years that we're going to see a 7 to 8% over inflation return for the market. I think that's probably about right. That's historically what we see. But hey, if you're used to this post-COVID, as you said, 15-20% a year thing, maybe that feels a little light, right? That's historically fine, right? And you can do very, very well over time with those returns. But I think there's an element of adjusting your expectations based on the recent short-term performance that we need to kind of get into. And I think for some people, not everyone, but for some people who may have been looking at that saying, hey, 20% a year is great. I can retire in 5 years if this keeps up. That may not happen, right? And if you reset your expectations to like a 10 or 11% return on average, with volatility in there, of course, maybe some of those midterm plans become longer term plans, and that's fine. But there's a period of adjustment, I think, that's going to have to occur for that. And I think that's part of what a lot of people are feeling right now.
And yeah, Toby, and this is one reason why we really guide. And if you're just joining us here on Fool 24, whether you're streaming on YouTube or really just a brand new member watching it for the first time, or for maybe early on in your career as an investor, having that 3 to 5 year cash cushion, the stocks that the money that you're going to need in the next 3 to 5 years, we really advocate having out of stocks, certainly volatile stocks. I could see an argument for maybe dividend stocks, which tend to be less volatile in down markets, Toby. But I just gave the numbers, right? Every year or so, the markets are falling 10%. Every 2 years, they're falling 15%. So, and that's from their highs, by the way. So, it's not guaranteed that. So if you really, I think if an investor really needs money, we advocate having that money out of the market if you need it for the next 3 to 5 years. So I think that's still important, and that is advice through any market condition, I think, Toby.
Yeah, that is important advice. I know for me specifically, Andy, I've got my oldest child is 13, turning 14 in June. So what does that mean for me? It means I need to look at her college account, like probably by the end of 2025, and say, okay, maybe 20-25% of this needs to come out.
Yeah.
And sit in either in cash or in something like maybe a bond fund or something that I have a high degree of confidence that 4 years from now the principal will be there.
Yes.
Write that first check, which is going to be painful, but a lot less painful to write if the value of that account isn't down 50%.
That's right. That's right. That's right. And of course, we're not here for giving personalized advice, as we say across our bar there, more for educational, but Toby just shared a little bit more of his situation so everyone can adapt as they see fit, of course. But I think that is, if you just keep that in mind, I think, because, 25% of the time markets fall 10%, Toby, they go on to fall 20%. Or 15 or 20%, right? So it's not every single time. A lot of times they rebound and the markets tend to be closer to their highs than their lows because the markets over time march higher, even though we said those drawdowns, they march higher, but 25% after a 10% pullback, they go on to fall even further. So it's good guidance for thinking about as from a portfolio allocation perspective, capital for the next cash that you're going to need in the next 3 to 5 years tends to be a little bit more either in cash investments or much more safer alternatives away from growth stocks. Toby, and then we'll get to some questions.
I think a good opportunity if you want to take your mind off your specific stocks that are falling right now, because who doesn't want to take their mind off that? Use this downturn as an opportunity to say, all right, let me look at my plans for the next 5 years. Yeah. What's happening in my life? What's going on? And let me adjust based on that, whatever that might be.
That's right.
For you, right? But for me, a downturn is always a gut check, always a time to kind of look at my mid-range plans and say, does it work? Am I where I need to be for this? If not, what changes do I need to make sure that what happens in 3 to 5 years, I'm going to be cool with, right? That's going to be fine for me, right?
That's great. Yeah, I think and I think just even doing that once a year through all markets, I think is good guidance from that gut check perspective. Call it the Toby Bordelon gut check approach. Just making sure that your positions are where you want them to be. A few questions, Toby. Let's get right into it. Rose has asked, how do you rank ODFL, XPO, and JBHT and other peers? Those are shipping and logistics companies. Are they dealing with the same issues as Manhattan Associates is, tariffs and falling consumer confidence? Rose, this is from 2 hours ago, but I'm going to take it now. They're actually different situations. What's happening with Manhattan Associates, which is a warehouse logistics management software provider, is and what's happening with like the likes of ODFL or XPO or some of those logistics shippers, those are much more cyclical positions. Those trucking companies, those shipping companies, Toby, ODFL is one of the best. They are the cream of the crop when it comes to like trucking companies. They do LTL, so less than truckload shipping. That's their specialty. Very high returns on capital. One I also follow is Landstar, which is also very slightly different, but also very good in that. But that's a volume game. And the volumes, I think both those companies have reflected, or certainly is that we've been in this kind of trucking winter period post-COVID, where volumes have slid, pricing has slid, and it's just kind of like month to month it ebbs and flows on what the spot market pricing is and demand for those shipping. And so that is impacting those businesses. A lot of money went into that business because you can spin up a trucking company very quickly, but to do it long-term well through cycles is very difficult. And so now we're seeing a lot of money come out of that part of the market. And now we're seeing some of the impacts of those tariffs, as Rose points out. But that's a little different than what's happening with Manhattan Associates, which is seeing some of their professional services slow down as clients are saying, I just may not need that professional services. And the stock's gotten very reasonably priced. And one reason why now, after a very nice run, the stock dropped, we think the prospects are better for Manhattan. But those are two different positions. Those are two different situations in my mind. And I think all of those, certainly ODFL I can speak to, and Manhattan I think I can speak to are in lower points. But I look out 3 to 5 years, and I think those businesses are going to be larger and more meaningful.
Yeah, Old Dominion looks somewhat compelling right now, actually.
And we talk about this. We talk kind of through on the stock advisor side, Toby. In fact, like you and I personally talk a lot about just just like at what point does ODFL look attractive? Sometimes it gets a little bit, a little bit pricier for a company, even if it's quality. But there's, as I was saying with some of the housing stocks yesterday or the earlier, there's just there are very few good threads out there and good narratives about trucking and logistics companies.
Yeah.
And that often is a time to look for the highest quality companies like ODFL.
Yeah. And it's especially this one, Andy. This is one where you wouldn't think it. You wouldn't think that it gets overvalued or bid up, right? In a sleepy industry like trucking. But it has a reputation for being such a great performer, right? Such a great executor in the business with a fantastic management team. That does happen over time, right? Because people start to expect the greatness of what they deliver over time. And, it's not like throwing out 20% returns every year, right? But it's just, hey, you're doing a great job. You're doing a better job than everyone else. You deserve a little bit of a premium. And it's rare that you get an opportunity to go into a company like that and say, maybe that premium is gone because the whole industry is just being hit hard, right? So it's time like these, you can take a look at that and say, am I getting a good value here? Maybe I am, right? So that is one that, at least for me, it tends to come up a lot right now when we're going through our monthly rankings and whatnot. And I always give it a look because it's like, maybe this is a chance to get it without that normal better than everyone else premium that you tend to see.
By the way, Toby, I think a lot of firms could take a page out of the Old Dominion Freight Line transition plans on their CEO level. 2 years ago, gosh, maybe 2020, let's see, 20. Yeah, about 18 months ago or so, Greg Gant handed the reins over to his Mr. Freeman. What was his first? Kevin Freeman. Kevin Freeman, who has been at Old Dominion for many years. It was a very seamless transition. It had the support of the board of directors. It almost went kind of like nonplussed. And I think there's lots of ways to do with transitions. But that one to me, Toby, was just one that just said, Old Dominion is run almost like a family firm in so many ways, been around for so many years. That transition was just is one that I think investors can learn from and companies can learn from as well. And that's one reason why I continue to think Old Dominion, again, it's a cyclical natured business, but they are really cream of the crop when it comes to trucking, U.S. trucking and logistics, which right now, again, admittedly is going through a little bit more of a difficult time in the cycle.
I heard this question from Matt real quick. He asked me if I just returned from a Viking mover cruise and what new stocks have I added to the portfolio in the last 2 weeks. I did not. I was actually not on a cruise. We were in Costa Rica for the kids' spring break, which was quite a good time. And surprisingly, I did not add any stocks. I think, as I recall, I made one options trade as a rolling transaction ahead of expiration, which happened while I was there. I thought I might buy some stocks, Andy, because I was going to be, silent for that week or so.
Yes.
And I just, Costa Rica was too pretty. I just didn't take the time to sit down and look at that. So I'm still where I was before, guys. But
Toby, do you go on cruises? Do you go on cruises?
No. We are going on one this Christmas.
Okay.
With the kids, but the last cruise I've been on, I was a kid. Like I was in.
Okay, great. So
tell you how long ago it was, Andy. This was the Disney cruise before Disney Cruise Line existed.
Oh my gosh. Okay.
This was back with a big red boat. If anybody remembers that, if you're of a certain age, Disney's first foray into cruising before they had it was a partnership with a now defunct cruise line. So it's been a while. It's been a hot minute. So we're looking forward to that one, and I'll give you guys a report when I get back.
They're investing so much capital into the cruise business. I think they're buying. Is it another 4 or 8 ships or something like that? Building those out, just continuing to.
It's 7, I think, with one of them coming by the end of this year.
And what was the Disney catalyst? Why a Disney cruise versus something else?
It just looked very family friendly.
Okay.
So I think that was kind of what attracted us. And my wife was hesitant, so I had to do a shorter one, and just kind of looking for one that we could. So we're in Reno, right? There's no port, so it's where can I get to easily? I don't actually want to fly all the way to Florida because that's expensive.
Right.
So we're actually going out of Texas, but I wanted to try to somewhere I could get to without a connection, that sort of thing, right?
Okay, got it.
And so yeah, it looks like it'll be fun. It looks like a very family friendly, good stuff for kids oriented thing, and we'll see how that goes. And hopefully, this will be in December, so hopefully my portfolio will still have a little bit of cash in it, Andy. To get
yeah, I hope so too, Toby. I hope so too. So, Toby, there's a question on Target and UPS from Sandy. Hi, Sandy. Hello. Thoughts on Target and UPS for long term? Thank you. Sandy, both these stocks have really not performed well and underperformed. Target facing a lots of. I liked how they were positioned. My family is very active Target shoppers, and so tied to some investments with my kids, we choose stocks and that kind of thing. And Target was one of those ones that we kind of narrowed into at one point, but it's not performed very well. Running into lots of different challenges, but the slight concern I have with Target is that Walmart continues, maybe with the exception of just recently, but it just continues to really excel, especially in grocery. So I haven't added more to a Target position in a long time, and just kind of sat there. UPS is a little bit slightly different. They changed their policy with taking the Amazon packages, which are fine. It's going to drastically cut the volumes, Toby, but increase hopefully the profitability. The concern around some of the UPS dividend, I think, is the thing that we have to watch a little bit with UPS. But again, UPS certainly tied to the cycle, and we're seeing what's going on with shipping volumes, FedEx. Where I get a little bit more interested in that is because the narratives are so negative. But as of right now, they don't jump to the top of my list as buys.
Yeah, my one of my kids owns UPS in his account. I'm sort of intrigued by it because of the Amazon related drop. I think that was perhaps overdone, but that interest is more of a short to medium term interest, right? Versus a long term market beating winner. It's a solid company, right? But it's just, it's not one historically, and maybe the Amazon, the easing of the Amazon relationship will change this, but historically they've been more of a price taker with respect to their big shipping partners. They haven't had much pricing power vis-a-vis like Amazon,
right?
Which of course you understand, right? Which hits their margins a little bit. Good on the labor side though, very good employee relations. Lot of long-term loyalty among the employees at UPS. It's one of those jobs you talk to the drivers, people who work there, like, yeah, I got a UPS job and that's it for me. Like, I'm not going anywhere else. That's positive, right? In terms of long-term culture, the success of the business, but not a long-term huge market beater. I don't think so. It strikes me as a company that maybe you want to have if you're looking for some steadiness, a little bit of a dividend, that type of thing. But it's hard to get super excited about it as a long-term winner, personally speaking.
Yeah, my concern, just the payout ratio. So if you look at their earnings versus the dividends they pay out, and UPS pays that nice dividend, it just has crept up. And so, Toby, for those who may not be as familiar, a dividend payout ratio is looking at the dividends a company pays versus their income. Now, it's not necessarily cash flow, so it's sometimes a little bit different, but let's just say it's defined as net income. So, hey, a company makes profits, and they pay some of those profits out to shareholders in a form of a dividend. That's the payout ratio. And that payout ratio for UPS is now north of 90%, and it's just kind of steadily crept higher and higher. And the reason that gets a little concerning is for two reasons. A, they may not have the flexibility to increase the dividend. And you like to I think many of us like to invest in companies that can increase that dividend. So if the payout ratio is elevated, any income growth it only can max out at what the net income is going to grow at, unless you're borrowing to pay out that dividend, and so which we don't necessarily always support either. So that's one concern. And then the worst is that they may cut the dividend because they're concerned about, if the net income gets a little bit worse and doesn't grow, the stock they could cut the dividend. So two reasons why a higher payout ratio starts to get a little nervous. And I think we're seeing that in UPS. And I think that's some of the concern that investors are feeling right now. So that's another reason adding more to UPS.
Yep.
Defense stocks are ARE, high R, asked about defense stocks. What do you think about defense stocks? Toby, we don't, I've recommended and still support Saab, which is a European defense stock. Traded, you can buy it on the pink sheets, but SAB, which I think most of us think about it as a car company, but it's now a defense company, having gotten rid of the car, separating the car business out, and using it has always really been focused on defense and engineering, and they had a car component, and now that's all done. So it's all really around defense spending, and of course with what is happening over in Europe, and the fact that Europeans are going to have to spend more on defense spending, and then spend it locally, even though Saab has contracts with the U.S. military, that has been a good for Saab. But in general, so many defense companies tend to be very large platform companies. They're tied into the political morass. So they don't jump to the top of at least of my list from a buying component, other than maybe Saab, and even then it's just smaller positions. Toby, yeah. I don't know if you have any thoughts on that.
No, I'm not even sure. Do we have any in Stock Advisor?
There are interesting things like, again, not in Stock Advisor, but like Axon Enterprises has some kind of like little defense component, and all those companies, cybersecurity companies have some defense, angle. And then of course, we're not quite sure what's going to happen with defense spending under the new administration and how it might change or be cut and those kinds of things. But so in Stock Advisor, we don't have a lot of them. I think a part of it is because of those like the Lockheed Martins, those big, large platforms. Things like the F-35 or the submarines or those kinds of things. They just are very, very complex.
It tends to be, in terms of the construction aspect, a very capital intensive business.
Yeah.
Which creates a moat of some degree.
Yeah.
Right. For some of these companies.
Yeah.
For sure. In terms of defense stuff, I don't know if this be straight up defense. The consulting angle is a little more attractive, like Booz Allen Hamilton. Now, not just defense, there's other stuff there, but a big government contractor that they do a lot of work in the defense space, right? A little higher margin for that. But I think that's, stuff like that is maybe a little more interesting right now.
They've just been gutted. Booz Allen, 90% of Booz Allen is tied to the federal government, or tied to government government contracts. And they are just, they have a bullseye on their back right now. So those are, and we looked at BAH, but we ended up not recommending it in Stock Advisor. And I think for some of those reasons. Now the stock has come down dramatically.
Yeah, it's about a 30% down.
30% from maybe last fall or something like that. So it might get more interesting, but I think there's still going to be some other shoes to fall in that space, Toby.
Yeah, it's this is one that had a massive run up, right, through kind of like late 2024. So in terms of price, it's certainly looking more intriguing.
Yeah.
A lot of headwinds in front of it, as you say, but potentially interesting there.
Let It Ride asks about Airbnb and Booking Holdings. I heard Tom Gardner say that Booking is a better business, but Airbnb seems to be more recommended. Is this because of valuation? I think they're different, and we like both of them. Booking is an absolute profitable financial machine that they've honed, light assets, profitable, decent returns on capital, buyback stock, rinse and repeat. They have those properties, booking.com, obviously a big one, Priceline. They have Open Table. They are using more and more AI tied through, and so-called agentic software or agents that eventually will help you make and plan things. So they're making those investments. Very large company, and very well used and very tied to global travel. Airbnb is just a different platform. They're obviously both tied to consumer travel, Toby, but Airbnb is a slightly different, while it can generate a lot of cash, it's not. I don't think it doesn't have the financial stability and proven model like Booking does. I think that's what Tom, without hearing Tom say this, I'm guessing he was kind of referring to that.
Yeah. I think there's probably more potential on Airbnb from here, in my opinion. Booking has a lot more going on, but they're a lot more mature in what they're doing. I think Airbnb in part wants to become more of what Booking is. Although really, I think you could look at Expedia to what they're trying to be in terms of expanding beyond their core business and adding some new services. Interestingly, Andy, so
that's right.
I did use Airbnb on this past trip. Now we were on an organized tour, but we did have some time before and after that we wanted to do some things, right? So I looked at Airbnb, the experiences, to say, all right, there's something I want to do? Do they have something that would be interesting? And there was a bunch of cool stuff on there, right? But I was not able to book through their platform because we had the nuance of I want you to come pick us up at our hotel, right? And that was a little more complicated. So when I reached out to the company Airbnb, they said, you're going to have to go to our own website and like put in your hotel so we can generate a transportation quote for you right there, right? So in order, I think for Airbnb, so for straight up experiences, like I'm in the city, meet me at this point, we'll do a walking tour, or come here to our offices and we'll drive you wherever. I think it works fine. To be a complete full service travel company with all of these experiences, it seems like it's going to require some more robust tech going on there for them to be able to really integrate everything that needs to be integrated for multiple use cases like that, so that they can keep people on the platform and not have to send you off platform to the company's individual website to process kind of more of those edge cases like that. So that experience, I think, showed me the potential here. But it's not just flipping a switch, right? There's a lot that needs to be done, I think, to get to where they need to be in that aspect of the business. So we'll see if they can do that. And they say they're going to start to roll out the first of these this summer, May-ish, I think. So we'll look at that. But there are certainly some back-end challenges, I think, that they need to overcome to deliver what I think is very compelling for a lot of travelers, like a full service platform. Go here, you get everything, and you don't have to think about it, right? But that's going to take some time to get there.
The question around valuation, the valuations have actually started to condense as Airbnb's valuation has come down. Bookings has gone up. At one point, we were paying less than 20 times earnings for Booking, pretty consistently around that, and we were still championing it. And now the multiple has gone up, so they're starting to come a little bit more together.
Yeah.
And Airbnb generates, they do have the potential to generate so much of that cash, but it's so it's just, I see them as I own both, and at different allocation levels. Booking's a higher allocation than Airbnb for the reasons of just a little bit more of the stability I like and the way that financial model works. But Airbnb, as you said, they have a lot more flexibility, I think, on how they are innovating across their different platforms, and obviously founder led and a lot of involvement from Brian Chesky and his team.
And Booking does have more exposure to Europe overall from their revenue.
100%.
Which could be very nice for someone who's investing in the travel industry. You want to be careful about regional diversification as well within that. You don't want to put all your eggs in one region or one country, as it were, because consumer downturns can hit at different times in different parts of the world. I mean, it's all that's coming out of COVID, Andy, right? The U.S. recovered quickly. Booking lagged. Why? Because they had that higher European exposure, which was slower to come out of the travel restrictions. Once they did, you started seeing Booking do very, very well as the U.S.-based travel companies were kind of lapping their awesome post-COVID comps, right?
Yeah,
so,
and
that can be a good thing for investors if you're looking to kind of spread out your risk a little bit more globally when you're looking at travel.
Yeah, and Booking specializes in hotels, especially boutique hotels, and which are very prevalent for any of those of us who have traveled, into Europe. Interesting for Booking is on how this is something I was talking to some other fools about, Toby, which is how does the changing search landscape with generative AI start to impact businesses that are reliant on search engine optimization to be able to drive business. Now Booking has mastered. I mean, they are as efficient on the marketing side and continuing to tweak and think about how they're spending their dollars and whether it's, the booking.yeah, is it booking? Yeah, booking.com, booking.yeah, advertisements on television and all these spots and the relationships they have with so many of those different hotels. But it will be very interesting to see how the changing landscape around search impacts clients, advertising clients who are reliant on SEO, search engine optimization efforts.
Yeah. There's going to be a big change, Andy, I think, with generative AI and AI search in a lot of places. And this is certainly going to be one of them.
Yeah. That's something I'm thinking a lot about, not just around the battle between, I'm certainly thinking about it for Alphabet, Toby, but it's just even the clients on how so many clients rely, including like the Motley Fool, rely on SEO, the landscape of SEO, and how is that all going to change? And, maybe minimal, it could be significant. How does Gen AI, which, is going to be, when I say generative AI, open AI and Perplexity, those businesses, subscription model is probably not going to be the lasting business model. So an advertising model probably has to play in there somewhere. How does that play in when you're getting more answers and less links and fewer links?
Yeah.
Do you want to take the question on the ranking, Let It Ride's question on Meta, Tesla, DoorDash, the Trade Desk, and Google/Alphabet?
That's
really good ones, and I think we'll probably disagree a little bit on some of those. But
all right. So for rank the following for more than 5 years. So 5 years plus returns. We got 1, 2, 3, 5 companies here, and I'm going to rank them in order of highest return. My highest expected returns are lower.
Yeah, and we're not talking risk adjusted, so these are just nominal,
flat out the
overall return
to do better return the next 5 years. Let me go.
I'm just writing mine down here.
Trade Desk number 1.
Yeah, I have Trade Desk number 1 too. And just 30 seconds on why that is, Toby.
30 seconds. That number 1 ranking is based in large part on the crash that the stock has suffered over the last couple of months. I think it's a solid business. I think it's a very good business. Yeah. I think they will recover, and I think you're getting a good opportunity at current levels. So
I would echo that. I said this week again that I wasn't excited to really add more Trade Desks soon after, but now that it's continued to pull back, thinking through that new COO on who I think has a lot to prove, and so hopefully Jeff Green can get him on board. But and they are thinking through both the demand side, the supply side of the programmatic advertising market, and how that is shifting and changing. And hopefully they will, and the valuation has come down pretty dramatically. So I'll put Trade Desk number 1 as well too. TTD of these 5.
Yeah, of these 5. Number 2, I go Meta. I think I go Meta too. And as between Meta, so there's a couple of reasons as I put Meta higher than Alphabet, for instance, but I'll get to that in a second. With Meta, I think Zuckerberg is still a visionary leader. I think he really is. And I think Meta is going to surprise us in AI. I think they're still going to surprise us in metaverse stuff, even though that's kind of fallen off the radar and no one's really interested in that anymore because generative AI is the big thing. But I feel like if you were paying attention to what they were trying to do with metaverse and some of their headsets and whatnot, AI had to be a big part of that in order for that to work. And I think maybe we're getting to the point where you can kind of see how some of that might work out. But I still think there's a lot of potential there. And I think people kind of sleep on them a little bit, but they still have, Facebook, Instagram, massive numbers of users, massive ad generation possibility for there. A lot of cash they can throw off as they explore Zuckerberg's kind of higher shoot for the moon type projects here. So I like that one. I'm gonna go number 2 with Meta.
I think I was between Meta and one other, but a Meta jump. I was actually thinking Meta, maybe even for the first one, but I put Meta as number 2 as well too. Okay, so we agree on the first 2.
The first 2. So now's where it gets tricky here. Between these 2, I struggle with. I'm going to probably say DoorDash number 3.
Oh, see, now we're going to agree on all of them. I just know that.
Oh,
So I have DoorDash. I think we are. I think I have DoorDash, Alphabet, and Tesla. And the reason why I have, I mean, I think Tesla obviously has so much going around it. Besides, it's just its core EV business, and then tied to all the other businesses, robotics, AI, FSD tied to its battery business doing well. But there's just right now, Tesla is just this. It has so many narratives around it. I just wouldn't put that one as my. I know Tom still likes it very much, but I would not put that one around it. DoorDash, I think, has some really interesting tied to the advertising business. They have clear market leadership in restaurant delivery, still working through the economics of that business. I still think they have some ability to pull some levers in there. We had a great conversation with the Serve Robotics CEO yesterday. Serve Robotics does these very relatively small robot delivery vehicles on 4 wheels, designed to deliver food within about 1.5 miles. And they're testing it out and rolling this out. They have a partnership with Uber, pushing out towards 2,000 different robots. Fools can find that on our video, our platform, the interview we did with Serve Robotics. So there's lots of competition out there, but DoorDash has that. I think they have that leadership space that I think that's why I put those number 3 in Alphabet. For just some of the reasons I had talked about. I just continue to study and think through, but we obviously own it.
And Alphabet for me, Andy, is in a situation where a lot of what they're doing with AI, generative AI, and all this stuff is really to kind of hold serve, as it were. Like they're trying to hold their dominant position in search and as an extension in online advertising like that. And so I think the ceiling for them is a lot lower because they're kind of like, if you're already number 1, what can you do much more besides hold that spot? And suddenly AI gives everyone else the opportunity to very quickly catch up potentially. And so I don't think, it's not like I think they're doing poorly, but I think just given with their positioning, they have a whole lot more to lose, and they have to spend what they're spending in large part just to stay where they are against this new competitive threat of AI. And I don't know how that's going to shake out.
Well, Toby, what I said is I really think some of their new AI specific for consumer initiatives and then obviously tied to what they're doing with GCP, their cloud business, which is continues to do very well. Like they were behind the curve. They have now caught up with that. I would maybe not fully caught up, but they have made up a lot of ground with that. And they have loads of experience of making this type of interactive platform profitable with their advertising model. However, as we pointed out earlier, that advertising model is shifting under our feet right now. And so just thinking through the impact of that, if their search dominance goes from what used to be 90% down to sub 50%, based on some estimates you see, like it just but the others haven't necessarily proven in a successful, lasting, thriving business model tied to generative AI necessarily. Again, I'm thinking out long-term over the next 5 years. So there's still lots of question marks out there. Hopefully Google can take advantage of some of those, have the successful business model and build that out tied to. So, and plus there's lots of regulatory issues. We saw that just more and more arrows getting fired at them from the EU. So I put that kind of, but those last 3 kind of started jumbled together for me.
Yeah. AI powered search, especially within these generative AI models, is very, very good. It's awesome for consumers, for the searcher of information. It seems to be so far a lot less awesome for the company that is trying to sell you something. Right. Because one thing it lets you do, Andy, is it lets you cut through all the crap to get to exactly what you want without having to see these inputs from elsewhere.
It's and you can source them. I mean, like there's yes, exactly. It's not, you're not getting links, you're getting the answers more. So when you're using all these tools, and so you're not crawling through different sites and seeing different searches. There was a great article in the Wall Street Journal this week talking about this, and the near the end, it was like, listen, Google still does a lot of things really well, and sometimes you want different access to different sites and all this, but a lot of times consumers don't, and so that is starting to have that impact. So, but the thing going for them is they have history of being able to make these platforms very, very profitable on different sides of the equation, and that's what they still do well. That's one reason why they also are under the regulatory microscope, too. But so I give them a leg up in being able to make this profitable. The others don't necessarily have that, Toby.
Yeah.
Jags asked Toby, just on market conditions, what it means when they say retailers are shaken out.
That's a good question. I don't know what that just means, that you're kind of going through some tough times, and the cream is rising to the top there, and it's revealing some weaknesses.
I think so.
Some other models, yeah.
Well, I think the retail is very difficult in general. Also depends on how you define retail. Like, is Decker's Outdoor, which I think is actually getting very attractive, is that retail, or is that more? I mean, they're kind of part retail. Is Nike retail? Nike's really struggled. So I guess it depends on what you think about
right?
retail. But like, just take Lululemon down 15% today on a very good quarter, Toby.
Mm-hmm.
But the guidance was half of what they did last quarter on the sales side, or roughly. So, I think as Jags is saying, maybe that's what when people talk about a shakeout, it's kind of like, gosh, we're seeing consumers start to slow down some of their discretionary purchases. How is that impacting these companies? The best companies through the cycles can survive through that, but the worst can't.
Do you need a pair of Lululemon leggings, Andy? Right? Probably not. You need pants, but do you have to pay higher margin for those?
Yeah. Well, I think also that's I think as we've talked and looked through,
that is what is happening here. That you look at some of these higher margin retailers, and the idea, the fear, I think, from even, and you're hearing that from their management saying, we may not get the consumer dollar right now because
that's right. Well, the marginal dollar, I think, for Lululemon, because if the core customer who would typically allocate dollars to Lululemon is no longer allocating the dollars, that's where it starts to really hurt, as opposed to someone wide-based like Walmart, which is more mass market kind of. So I think we're starting to, and this is what I think some of the concern is with what you're seeing in the short term with Lululemon. But, Toby, I still think that this just gets me more excited. Painful for those who own Lululemon, but for those who are even looking to build positions out over looking out the next 3 to 5 years, like, while retail is very competitive, Gavin McDonald at Lululemon, they have a long history of being able to deliver, and when the stock gets more reasonable and starts to get at or below a market multiple, Toby, for that kind of quality company, maybe some doubts that they can't grow at 18% a year on the earnings side, but if they can grow at 10 to 12% or 13% over the next 3 to 5 years per year, paying 18, 19 times earnings, starts to look very attractive.
Yeah.
Hey, Besties asked, the MF considered buying when the sentiment in the market is against. In the case of Tesla, since you are all against it, would it be a good time to consider a position? Well, there are those who still like and support Tesla. I still own it, right? And so there's just different opinions here. And for all the reasons that I think we outlined, Tom Gardner, for one, still thinks very highly of it. And they clearly have some intellectual property that is in a leadership position in the market. So there's still a lot to like with Tesla. For me, just looking at these 5, I was just kind of balancing the opportunities among the Trade Desk, Meta, DoorDash, Google, and Tesla. And I saw just what the narrative around Tesla right now is just one that I wouldn't, because I just think it's going to be exceptionally choppy. And that could open up massive opportunities to be a great buying chance to get it to, from where is it, maybe a $800 billion company up to a, 1 point something billion dollar company. But I just saying, I think the other ones are ones that I would add to before adding to Tesla. So that's just to clarify a little bit of that thinking.
And for me, Andy, like my avoidance of Tesla right now, to be clear, has nothing to do with any of the political situation around Elon Musk, right? It's just that I look at Tesla, and given where they are, it seems like they have to have basically everything go right for them in a short amount of time with some of these new initiatives, with the AI, with the robotics and whatnot, to kind of justify a higher stock price. And it looks to me like a very high risk, high reward business, which can be great to invest in. But I think it's still not considering the potential downside there, right? I think the price is too optimistic, given the likelihood that all these things happen in a short time frame for them. So at some point, I become very interested in it, right? And I think it gets to where it really does become high risk, high reward, appropriately priced risk. I'm just not seeing that right now.
Oh, that's interesting. I think the risk is that because they had talked, Elon Musk had talked last fall about 20 to 30% deliveries after last year being basically flattish on the car delivery, the EV car delivery. And I think that just might be a little bit under pressure to be able to hit that kind of number. And some expectations are still going to fall. The other side of it, which is really long-term value, and why someone would be an owner of Tesla long-term, I think. And one of the reasons I think, among the reasons Tom is still excited about Tesla is because of those longer-term initiatives. The AI initiative, what they're doing on the FSD side, cyber cabs, robotics, which they've been, Tesla's or Elon Musk has been very open about that. Like, robotics is going to be a bigger and bigger part of the Tesla story. Their battery position is really strong. So that's more of the longer term thing. I'm just thinking like that, just that near term pressure on the deliveries.
That's right. I think that's what you had to be believing in it to buy it. I just think it's too pricey for me.
Yeah.
Even so, I would love for this to be like, it's a weird company because you have a very easy to value automotive business with a lot of optionality.
Yeah.
That's very, very tricky.
Yeah.
And they're squished together.
Yeah.
Right?
Yeah.
You would almost rather have the car business be separate and the AI and all that stuff be on its own thing. And then you would have you would know what to do with it a little bit more.
Yeah. Right. And even that EV business, like the margins are maybe a little bit tight, cutting some of the prices to drive demand, all of those things, and what's happening kind of, globally. And, they had some unfortunate fires that have impacted various things as well, too. By the way, Toby, Jag says, sorry, I meant retail investors are shaking out of the market in a downtrend. Sorry, Jags. Thank you. Thank you for clarifying that. So, what's interesting about this, I think, Toby, as we come up on our hour and 50 minutes, we got about 11 minutes left, Toby, is, so much of the market is driven by institutional money, but parts of the market are driven much more by consumers and by retail investors. And I think you do start to see some of these retail investors in the market like this start to get a little bit nervous and concerned because they don't really understand. Well, first of all, no one likes losing money, even over the short term, but they start to anchor too much on that and lose the perspective of that long-term graph of the S&P, of stocks in general. And they get spooked out of the market. And as Peter Lynch has said, the worst thing an individual investor can do is get spooked out of the market because you interrupt that long-term compounding effect.
Yeah, you don't want to be selling right now, I don't think. And that's not individualized advice. That's general advice to every investor that exists. Downturns are not when you should be selling.
Yeah.
But you can only do that if you've done the things we talked about earlier, Andy, right? Like you've got.
That's exactly right. And that's why the Toby Bordelon yearly check-in, I think, is very healthy because the gut check, because it allows you to do that through good markets too.
And I think, Jag, that's one of the reasons you do see a lot of individual investors shaken out and like maybe panic selling at times like this, because they realize, oh, wait, I need this money next year, right? Or that sort of thing. They haven't appropriately taken an assessment of their situation, of their midterm, of their long-term situation, and set themselves up for success in market cycles. And so you get that panic selling, right? You get that nervousness. I don't know if I'm going to be able to survive this, right? Whereas if you've done that, right, if you've really committed capital that you know you don't need for 5+ years, say, in your individual stocks, you can look at that and say, I'm okay, I'm fine, I don't need to sell because it's, I have confidence in the market cycles that are going to work for me over the long term.
I think that's where I think I am just not built to be a trader.
Yeah.
The trading mentality, thinking about returns in short amount of time periods, I just think that's very difficult. Now, I might anchor a little. I mean, I very rarely sell, so I might anchor a little bit too much on that per se. Just thinking again about just self-reflection, which I think is always good. But the trading mentality, I think, is very difficult for me personally. Very difficult to do because of the risk and the volatility in the markets over let alone a year, Toby, let alone a year, thinking about it in short-term time periods.
Yeah.
T-Stock says, considering dividends, what stocks are your favorite for total returns right now? Toby, any dividend payers? Now, if I go over to the Stock Advisor scorecard and we just start thinking about, I'm not going to share it just from IP protection, but just thinking about some of our stocks in our stock. Of course, we also have our Dividend Investor Service, specializing in dividend stocks. I do love some dividend growth in my portfolio. I've been a long owner of Home Depot, Toby.
Yeah, Home Depot's steady increases over time and steady stock buybacks over time, right? Which take their kind of, in the grand scheme of things, anemic growth in the business because they're kind of dominant, right?
Yeah.
And they that juices it a couple percentage points between that dividend and the stock buybacks. And that's all you really need if you're looking for just a steady compounder over a couple of decades, right?
Yeah.
That's been a great one.
Yeah. We still don't, I mean, some of the ones, Toby, are not, let me get back to my camera here. Thank you for that. We're still, the yields still for some of those dividend grows haven't, like Progressive is just one of the best dividend kind of growing companies out there. Very solid large cap insurance company, but the yield is 1.8%. So that's healthy, but it's not like super high, but they have the chance to, build that over time. Williams-Sonoma, I think, is one that I've talked about many times before. Stock was down after the earnings. They're going to face some of the headwinds with some of the consumer appetite. They've been able to navigate these markets for many, many years, and Laura Alber and that team, I think, are very good and underappreciated managers to be able to manage that business. But especially the retail footprint, balancing between retail and online, and they've been using online to drive more, and that's WSM. But it is, it's just that the appetite for spending a lot of money on different home goods is not certainly high. So I think, we might get a better buying opportunity for a company, like that. But
one I like, Andy, on our scorecard is Garmin.
Oh yes.
Yeah. Nice dividend, steady growth in that dividend, history of share buybacks, solid performance in the business. Looks like the stock's doubled since we recommended it, about 3 years ago?
Yeah, so this is such a great case study, Toby. Thank you. So Garmin, GRMN, the maker, I think on the consumer side, really known for their watches, but they also have a very solid aviation business, a boating business, lots to tie into navigation, those kinds of things. And that's one, Toby, where we bought when there was a lot of pessimism, getting back to pessimism around the business and getting totally disrupted by the likes of Apple, as Apple was coming out with its watches, and oh my gosh, they're going to put Garmin out of business. Was, okay, maybe I'm being a little bit hyperbolic there, but that seemed like the narrative, and we thought, well, wait a second, there's a lot to like here, and I believe we were buying that business at 17 to 18, 19 times earnings.
Yeah,
it's not there now. It's a little bit higher. I think it's north of 25 times or so.
And we saw that narrative with Garmin before, like years and years ago, right? This idea that, oh no, cell phones are going to put Garmin out of business because no one's going to have the Garmin units in their cars anymore.
Right.
Well, it didn't. And as it turns out, the auto OEM business is actually quite solid right now.
Oh, the auto business, right? Exactly.
Yeah. It's much more than like the the GPS, right? They do a lot of behind the scenes stuff with that.
100%. And even the GPS side, Toby, has really. I was talking to a running friend of mine the other day, or 2 weeks ago, and it just has real brand strength that I think again was underappreciated. Will they be do they have to go and discount a bunch of their watches, and do they have the strength to be able to compete against the likes of, it's Apple, and they clearly did. And so I think Garmin's a very solid one, but that is one that where the multiple I think has gotten a little bit because the stock has performed well, as the business has performed well.
Yeah.
So, Jags, appreciate the time to answer and reassuring. Well, thanks, Jags. Thanks for the question. That's what we're trying to do here is both be honest, reassuring. And continuing to advocate the message of a long-term investing mindset and perspective, because in our history over, almost 30 years of investing at the Motley Fool, but 22 or 3 plus in Stock Advisor, investing on a regular schedule as much as possible, if that's the appetite that investors take, as we do in Stock Advisor, because we're coming out with recommendations every month. And being able to do that through good markets and bad markets, and taking the ups and the downs. And not all of our stocks, if you're batting more than 50 or 60%, meaning that 5 or 6 stocks out of 10 that a person buys, do well and beat the market or make money, that's pretty good. And if you're holding for a long period of time and you're investing in some of the best performers, those best performers tend to have the biggest impacts on your portfolio. And you want to continue to invest into those and not get scared out of the markets. And that's what we're trying to do here at Stock Advisor. Bestie's asked about Arista Networks, Toby, ANET, fascinating. I think to think about Arista these days, it's high-tech data center switching technology. It's extensible operating system, competes with the likes of Cisco and trying to help move data around different data centers. And they have some other businesses, but that's kind of at a very, very high level where they specialize in. And for years they've done this, and they've have an exceptional pedigree. They have products that were in demand, and as the data center growth over the last 2 to 3 years started to really pick up on the AI side, they started to benefit from that. They really benefited from that. They have their 2 large clients, likely Microsoft and Meta, continue to rely on that technology. But there are other players in there, even NVIDIA, which they're a frenemy with. They both partner and also compete with in some regard. And so I think you just saw the multiple for Arista get really elevated, and that has now since come down pretty dramatically, Toby.
It has. This is one I think where context is important, not even long term, just kind of longer than a month. Like the stock's down about 14% over the past month, Andy, but it's still up almost 10% over the past 12 months, right? Which is a good performance for a business. Things up 560% in the past 5 years, right? And so this is, I think, when some individual investors look at like, oh yeah, it's down a lot from its very recent high. But you don't have to go back pretty far to see some very good returns here. And I think it helps just to think that, yes, we've seen a lot of stuff down very recently, but that's because we've seen some fairly massive run-ups in a very short period of time. And this is to be expected in part, as people don't even necessarily have to get pessimistic. They just have to maybe have a reality check. And you kind of see some of the pullbacks we've seen. It's part of the cycle. It's just natural.
Arista has always been very profitable. And I'm very profitable. Operating margins, real operating, GAAP operating margins, very profitable, generate a lot of free cash flow, healthy growth rates. They have a whole founding led culture. Jayshree Uel, the CEO, has been there for many, many years, owns a lot of stock. So they have all the pedigrees that we love to see. They just have that concentration in some of those key customers. They have some other competitive threats, and the valuation just got a little bit elevated. That has reversed now. And I think Arista still looks attractive long term. It will go as a data center, at least in the near term. It'll kind of go as a data center. You know, you saw this. We may have seen some of the continued stories or news outlets or analysts conversations about Microsoft pulling back on some of its data center, changing some of its leases, all those kinds of things. Arista is going to go a little bit in the near term with that, but I think they're in a pretty strong competitive position, Toby, going forward.
Yeah, for sure.
Toby, thanks. That was a great hour. Thank you, fools, for joining us for the Ask Us Anything as Toby and I tied in a little bit of stock advisor investing, and now we're going to turn it over to Jason and Rachel to go on for the next hour. Team.
All right, fools. Have a great
Thanks,
rest of your
guys.
Friday.
Have a great rest of your Friday. Thanks, y'all.
Take care. Hey, Rachel.
Hey, Jason. How's it going?
It's incredible. Things are going wonderful. It is sunny outside. It is actually in the low 60s. I might be exaggerating a little bit. That might be an adjusted temperature, not a gap temperature, but it's close enough for our purposes. I believe we're doing an Ask Us Anything hour here on Motley Fool 24. Right? Did I get that right?
Yes.
Yeah,
Our
that's
theme is just ask us anything. We will do our best to answer those questions.
We've got, and the questions are starting to come in. There's a few leftovers from last hour.
Yeah.
Let it ride. Yeah, finally, CoreWeave stocks finally debuted. We've been waiting and waiting and waiting. It's finally debuted. It looks like it's down a little bit. That might not last. I promise I will be monitoring it during the hour just because it's fun to watch highly anticipated stocks when they debut on the exchange. So we'll talk about that. We want to answer your questions, though. Get those to us at slido.com. The event code FOOL24, all one word, FOOL24. Get that into us. Whether you're watching us as a Motley Fool member through your membership behind the paywall, or you're watching on YouTube on the live stream, definitely get those questions into us. And remember, Rachel, we always like to remind everybody, we will answer your questions, but we are not advising you what to do. We're not providing anybody with individualized or personalized financial advice. Just remember that. We don't know you. We don't know your situation. We're smart. We know stuff, but it may or may not apply to you. So you just got to remember that when we provide the answers. So I want to start with Let It Ride's question and it's topical, right? So CoreWeave just opened at $39. I'm reading the question in the comments. So I don't know. I haven't verified that. It has been trading around that price. How do you value a brand new IPO? I love this question because depending on the IPO, and this is one that, I mean, this was the open for every news outlet today. CNBC, this was their open this morning. CoreWeave rang the bell. It's been getting a lot of focus. It's attached to NVIDIA, right? NVIDIA was an early investor in CoreWeave, seed investor. I believe they invested in a couple of other rounds as well. And CoreWeave in their data centers uses NVIDIA's technology, right? So very much associated with NVIDIA. Artificial intelligence is its bread and butter. So that's the thing with CoreWeave. So of course the question is, how do you value a brand new IPO? As a starting point, I tend to not try too hard to value new IPOs because it's very rare for me to buy on the debut, right? It's very rare for me to buy on the debut because debuts can be super noisy periods, the first few days afterwards. And then you'll have a lockup period for insiders that goes a number of months before those lockups start to allow insiders to begin to sell their shares into the secondary market. And that's something that can put downward pressure on stock prices. And a lot of times just the mania of the markets can take over. And I prefer to let that kind of settle out a little bit. I kind of like to see, how do managements of these companies, how do they operate in this new environment? Moving from being privately held, venture capital backed, where you have close relationships with your VC investors. You're talking to them all the time. They know what's going on with your business. They're not chasing some quarterly results. To them being under the pressure cooker of the quarter and your guide, and did you hit guidance? Did you beat? Did you raise your outlook for your coming quarters? Like all of that pressure from management teams that are often head down, really focused on their business. Sometimes they start to shift a little bit to managing the message and perception of analysts and of the public markets, and don't focus as much on their business. So to me, that's one of the other reasons that I wait to see is how does management's focus on the business change based on moving into the public markets. So I tend to not really put a tremendous amount of time trying to value a brand new IPO. In a lot of cases too, when companies, particularly in technology, Rachel, are going public, they're not, they're still losing money, right? They're still burning cash in a lot of cases. And generally, if they're venture capital backed, they're going public to raise cash so that they can build their balance sheet. They're selling part of the business to new investors. They want to raise cash to continue to spend on the business, to scale up, right? To take more market share, to get to a level of scale, to get to where those unit economics kick in and the business gets profitable, right? So they're trying to get to that point. So so that can make it a little bit harder to value IPOs, particularly in technology, when those IPOs are venture capital backed. Not always. Some companies are going private, and they're generating positive operating cash flow or maybe even GAAP profitability. Then I'm using those traditional cash flow and earnings based multiples, but also thinking about where's the business in its stage of growth. For CoreWeave wants to get a lot bigger, right? That's part of their goal is to be a lot bigger. So you'd start looking at revenue growth rates to start extrapolating to a future size where the business is, if it's growing at a fast enough, high enough rate, then you would pay a higher kind of a future multiple. You're doing basically a discounted cash flow, right? Where you're thinking about future cash flows that the business can generate and trying to determine if today's price within some directional margin of safety can get you to a future result that can be profitable, even if the multiple that you're looking at is substantially lower, right? 20 times cash flows versus 30 times cash flows that you might hope for, or whatever, right? So being mindful about that. But generally, I like to let things kind of settle out a little bit with the businesses before I invest in the IPOs.
Yeah. I have some thoughts on this one, and I'll also give a little bit of a kind of update and background in terms of the IPO and how it's been performing. And yes, the stock did open at $39 a share. Last I checked, it was sort of dipping just above and below the $41 a share mark. And I think broadly speaking, I agree with Jason. That is often as well my approach. I don't really tend to put cash into newly public companies. I like to let things settle a bit and really watch their performance as publicly traded companies and see how the business is doing as we get more and more, financial information. We obviously have some recent, details in terms of CoreWeave's financial performance, and the company is still quite deeply unprofitable. But just broadly speaking, valuing a new IPO, you can look at things like financial performance depending on how much data and how far back that goes. We think of a company like Klarna that is not yet public, but is about to go public. And they have quite a few years of financial results that are actually publicly accessible on their website. That can give you a little bit more insight into some of these companies. And also looking at the industry in which the company operates, their growth potential. These are also factors that can play into your thesis for the business. One of the reasons why this has been, I think, an IPO that has garnered such attention, besides the fact that it has been, one that has caught the attention of so many investors and is arguably one of the biggest IPOs we've seen in the last few years, is this is the first pure play AI company to go public. We've seen the private markets ascribe quite high valuations to still private businesses like OpenAI, Anthropic are a couple examples. But this is also an IPO that could, and I think a lot of analysts are commenting on this particular one, sort of ascribe what the trajectory of the future looks like for pure play AI businesses that may in fact go public. You know, they make money by, in CoreWeave's case, by providing clients with access to data centers, which are used to develop AI models. They're building out AI data centers to offer, you know, AI related computing power. They're a major buyer of NVIDIA's AI chips, and essentially all of their revenue comes from cloud rentals of AI servers that use NVIDIA's chips. There was, some news that was right around the IPO in terms of last night. It came out that they were going to sell shares at $40 each, when originally they had been targeting a higher figure for those shares.
Yeah, the midpoint was about $50 of the range. $51 or $52
Right.
is what they were initially expecting. So coming down to 40 was a pretty big, and it's more than 20% less than the expectations had been.
Right. And I mean, so far from what we see, you know, the CoreWeave raised $1.5 billion in its share sale. That makes it the biggest tech IPO in the US since 2021. So that's another reason, you know, we're seeing, I think, a lot of excitement around this. One of the biggest concerns I've had with this business in particular is the fact that they are, and a lot of people have pointed this out, that their revenue is so highly concentrated among a few customers. There's two customers that make up 77% of the company's entire revenue. 62% of that total is entirely attributable to Microsoft. That is their biggest customer. And of course, they do run out access, to hundreds of thousands of NVIDIA graphics processing units to other large tech and AI companies like Meta, like IBM. And they're also facing competition, you know, even from their own clients like Microsoft. Some of their stiffest competition is from the client that comprises, the lion's share of their revenue. They grew their revenue 737% in 2024. They reported a net loss of $863 million in the 12-month period. They have a lot of debt that's been raised, much that allocated for GPUs that go inside their leased facilities in the US and abroad. And as you noted, Jason, they had initially set their price target for their market debut between $47 and $55 a share. And then last night I was scrolling through the webs and saw the news that came out that they were, bumping that down to 40. It's also been an environment in which we've seen very few tech companies that have entered the public markets on US exchanges in recent years. There was actually data that came out in an article on CNBC saying there were just 13 venture-backed tech IPOs in 22, 23, and 24 combined. 13, compared with 77 in the record year of the IPO, which of course was 2021. It's been a very, very sluggish few years for new entrants to the public markets, but particularly as it pertains to the tech space. And CoreWeave is a relatively new business. They were founded in 2017 as a company called Atlantic Crypto. They operated in the crypto industry at the time. They were focused on crypto mining infrastructure using GPUs. And then in 2019, they pivoted and began offering these extensive GPU resources to companies working in the AI space. So today their main business is really providing that AI infrastructure to these AI companies. So it's kind of an interesting business to look at. It's certainly monumental in terms of market debuts based on what we've seen the last few years. And then, of course, certainly within the tech space, because as I noted, that has been a very, very sluggish environment since 2021.
Yeah. Well, in fairness, I think it's worth pointing out, too, that 2021 was unique, that a lot of companies' IPOs got pulled forward. A business that
Right.
I'm a big fan of. Oh, goodness gracious. And the name has fallen right out of my head. I'm going to have to come back to it. But there's a company in data streaming. I've been studying this industry so closely over the past year, and I've kind of doubled down on looking at the competitors that I've now I can't remember the name of my favorite company in this space. But if you look at the dilution that they're showing from stock-based compensation, there is a substantial amount of it that's happening because of stock grants that were based on how you would award equity to a pre-IPO business. So one of the things that these companies do is they start approaching being ready to go public is they start making changes to how employees are compensated, because once a company's public, typically it's at a level of stability and cash flows that it can afford to pay more cash and salary. And companies that are, or employees that are joining the company when it's still VC funded, part of the risk they're taking on is lower salary, more equity compensation based on the upside when the company does go public, right? So that can create a tremendous amount of tailwind. And there's multiple companies that we've talked a lot about their stock-based compensation that did IPO around that period that probably would normally, if we hadn't have gone through the pandemic and seen the market rush up in 2020 and 2021 to those extreme highs where it was obvious to VC, we need to take some of these companies public while there's tremendous amount of value that we can realize. We would see, instead of it being, 4 or 5 dozen companies that went public during that period, it would have been a normal amount. And we would have seen over the past few years, more of those companies having gone public more recently. So I don't think it's as much just the IPO market for tech has dried up. The wave crashed on the beach back in 2021, right? And that was all of the water. There just hasn't been any more companies that were mature enough to bring in. So we're starting to see more of that starting to maybe materialize over the next few years. And certainly the acceleration of AI build and needing to have cloud infrastructure to build AI is the reason why CoreWeave is going public now. It's a really compelling business and story to follow. But I am curious what happens going forward, particularly around AI and funding, or if this is just I think this is more like just a kind of a pebble tossed in a puddle. The ripples, I don't think these are big waves of ripples that we see. Just to keep us on track here. Shares are still trading about $40. They jumped up to about 41 for just a hot minute, right around.
I know. I was watching like it go up and down.
We're like a couple day traders here. What are we even doing, people?
We're like watching that resistance. Yeah.
I want to take David in Oregon's question. Thoughts on CareTrust at these levels? So CareTrust is a business that I've owned since not very long after it was spun out of I believe Anthem was the. No, it's not Anthem. Ensign. Sorry, Ensign is an operator of long-term care facilities and seniors facilities, and they spun most of their real estate out into CareTrust, which is a real estate investment trust that focuses on skilled nursing, seniors, and rehab facilities. They also have recently, a few years ago, they went into addiction treatment facilities as well, substance abuse treatment facilities. So first of all, the background of the business, it's a tough industry. There have been a few big winners over the past few decades, Welltower and a few others that are big winners from the beginning because they were the ones that have largely been kind of the corporate institutions in that industry that have built and opened a lot of facilities and done a little bit of mergers and acquisitions over the years to get to this large scale that they're at. But it is a tough industry overall because the customers, the operators, it's a tough industry to operate. It's highly regulated. It's hard to find labor. You have thin margins. It's just tough. It's just tough. So because of that, I've tried to, and the tailwinds are attractive. You think about the aging of America's population, growing the cohort of Americans that are 65 and older, and the cohort of Americans that are 80 and older. Both of those populations from 2010 to 2030 will have doubled. There'll be 80 plus million Americans that are over 65 years of age here in, with less than 5 years from now. That is a substantial population that also consumes a substantial portion of healthcare in the U.S. and most countries as well. So when it comes to skilled nursing and rehab facilities and that sort of thing, a lot of that's the tailwind, right? That's driving that. To profit in this industry, you need to have really good operating partners that run that are good operators, that run the facilities well, that take care of their patients well, manage their finances really, really well. It doesn't matter how high quality the property is in your portfolio if you're not renting it to tenants that can pay the bills, right? So the things that CareTrust has done really well, that spin out of Ensign was its largest customer, and I believe it's still its largest customer, but has become a much smaller percentage of the mix. They come from a legacy of operators, so they know what good operators look like. Ensign is a very good operator, so they know what that looks like, and they've really focused on partnering with good operators as they build out their property portfolio. Now, the way that they build out their property portfolio is by making sure that the balance sheet is very, very strong, because real estate investments trusts do use a lot of debt or equity offerings, secondary offerings of stock to raise the capital to acquire properties. So cost of capital is really important. You got to be smart about what you pay a reasonable multiple on the property you buy, and then you've got to partner with a good operator to do it. The good thing is that it's an industry that there is still a tremendous amount of room to continue to consolidate. The vast majority of these properties are owned by an owner that owns 10 or less. So there's generally small operators. For CareTrust, which has less than 300 properties, that means that making small acquisitions of an operator that only, or a real estate owner that only has a few properties, can move the needle if you do that over a full year's period. So they've been good at making small accumulations of property and growing the business larger over time. And they've consistently prioritized keeping the balance sheet strong. It puts them in a position to be able to move quickly because they have liquidity and make deals happen very, very fast. And again, because of their size, they've been able to do that. I've actually mentioned CareTrust a few times recently as one of my favorite dividend growth stocks. The growth rate of the dividend has been relatively slow during the pandemic. This is one of the industries that was hit the very hardest. A lot of their peers had to cut payouts. CareTrust was actually able to get through the toughest period and has been able to increase its dividend since then. Strong balance sheet, partner with good operators, right? It's just right there. It's so baked into the DNA of this business that they consistently do that. The valuation looks really attractive right now. I need to verify the yield. I know it's consistently been above 4% recently. Let me just look it up and just make sure I speak the truth. So the yield right now, up to minute, 4%. It's about 4%. The stock price is actually up a little bit this year, but to put that 4% in context, that's about the average of what we've seen for most of the past year. And it's well above where it was back in 2022 and 2023. Stock price kind of went on a little bit of a runner, got a little bit ahead of itself, I think, but the stock has kind of come back down a little bit, and I think represents really good long-term value. So I like CareTrust. Again, have the right expectations. If you're looking for 15+% a year, this ain't your dog. You got to go find another dog to hunt with. But if you're just looking for good returns, a high floor with that 4% yield, the probability that the dividend is going to grow over the long term should grow at or above inflation. And the stock is going to compound because they're smart buyers and they're going to create more value over time. You should be able to get, I think a good floor here to think about is, if around 8 to 10% a year over the long term, I think is a reasonable floor to expect for this business. And it could get, to 12, 13% a year if they can accelerate growth. And if we see interest rates fall, which I think the long term is they probably do come down a little bit over the next few years, that could push the valuation up a little bit. So a little bit of a valuation bump could boost the returns even better from these prices right here. But I think even if you don't factor that in, I think, a solid 8 to 10% in returns, which, I mean, that's not beating the market over the long term. But if you want to lock in real value and income and growth in your income, that's better than you could get from bonds, and you can hold, so you're not necessarily worrying about some volatility with the price of the stock during downturns, then I think it has a place in a lot of income investors' portfolios. All right, what's next here?
There was a question from Ed about Chewy. I've spent quite a bit of time talking with them this week, so I'm happy to dive into this one. It's also a company I follow pretty closely. But Ed was saying, is Chewy fully valued? Won't it be difficult to grow the business with new customers, stiff competition? What about the vet clinics? Is the best over? A lot of different thoughts to share there. I think that something that Chewy underscored in this most recent report was that while active customer growth had slowed in recent quarters, this is far from a business that is anywhere close to stagnation. They delivered active customer growth of 2% year over year in their recent report after having seen some declines or just sort of the same reports in terms of their active customer count quarter after quarter. While active customer growth has not been what it was a few years ago, which again, they had this really significant uptick in customer growth during the pandemic, a time when
I think it really pulled forward a lot of customers that might have been a little slower to accumulate to the platform.
Yeah, there was a time when, pet ownership accelerated. And something that I think we saw with a lot of businesses, and Chewy, of course, is one of them, is they were companies that experienced growth rates in a very short period of time that probably, if not for the pandemic and all the very unique factors that were present in that era, would have otherwise experienced that growth over a much more prolonged period of years. And so I think, for example, with Chewy's customer base, this was a part of the business that matured on a much faster trajectory than perhaps it otherwise would have. While their growth up until this most recent report had slowed in that area, this is still a business that has been successively growing their profitability, their revenue, and continuing to expand, into new business lines. The company, I think, is obviously known for their flagship e-commerce platform where they sell everything from, pet toys to pet supplies, pet food. But over the years, they have expanded to other areas. They have their own compounding pharmacy. They have their pet telehealth service where pet owners can access a licensed vet on demand if their pet is sick. They introduced their own line of pet supplements, although they still sell an extensive collection of third-party brands on their platform. They launched this is also a part of their business I've been paying close attention to. They launched their sponsored ad program, which is essentially a way for pet-centric brands to advertise to shoppers on Chewy's platform. That business totaled about 1% of the company's net sales last year, and they just launched it in 2024. And then, of course, the biggest development for the business has been their decision to open vet clinics. This was a decision that definitely at first took me by surprise. It's a development for the business that I've been watching very, very closely in each of their recent earnings reports and calls. But I actually think if you take a step back and you look at the trajectory of this business, it makes sense. Chewy is a company that for a long time has partnered with veterinary locations, providing integrative software that made it also really, really easy for customers. They go to the vet and then they decide, let me place an order for whatever the medication or item they need is from Chewy. And it was helping vets facilitate their own business growth. I think this is something that is already, while in its very early stages, proving to be a smart move for Chewy. They had targeted that they would have up to 8 new vet clinics opened by the end of 2024. They reached the top end of that goal. They had 8 open by the end of the year. But something that management has noted consistently in the last few earnings calls, including this most recent one, was that these clinics are correlating to be a really excellent and consistent sales funnel to their flagship business, their e-commerce platform, where customers go in, whether for a routine appointment or because their pet needs urgent care or even surgery, whatever the case may be, and then they're very likely to go and place an order for a range of products on Chewy.com. The other thing that I think is worth noting about Chewy's business is, even though we've seen some slowdown in active customer acquisition up until this most recent fiscal period, this is a company that continues to derive most of their net sales on a recurring basis. Their auto ship program, which is where pet owners can pay to have recurring deliveries of their favorite products to their door, has continued to grow at an exponential rate. As of the end of the year, their AutoShip program represented almost 81% of all of their net sales. And growth in AutoShip customer sales has actually outpaced overall top-line growth. So Q4 net sales rose 15% year over year. Growth in AutoShip customer sales increased 21% year over year in Q4 and 11% for the full year 2024. Then, as mentioned, they accelerated their customer base. It was their first year over year growth on that metric in 8 quarters. And they ended the period with 20.5 million active customers. Something that I think is also worth noting is they've converted approximately 80% of their adjusted EBITDA last year to free cash flow. They recorded $452.5 million in free cash flow in fiscal 2024. And then there's these newer business lines like their sponsored ads business, which they don't think that that's going to comprise more than 3% of their total enterprise net sales over time. Now it comprises about 1%. However, they said that sponsored ads business was the single largest contributor to their gross margin improvement last year. And that continues to be a trend that they expect moving forward. And then they're looking in fiscal 2025 for their vet clinic business to open 8 to 10 new clinics. Again, they think this is a total addressable market of about $25 billion that they are opening themselves up to by expanding into the vet services market. I do not think that Chewy has come anywhere close to maximizing their growth. I think that this is a business that has shown its ability to evolve. It's been going through a period the last few years that while profitability has consistently improved, the net sales have been growing. They've been investing into all of these different areas of their business. And even though we've seen actual customer count slow, net sales per active customer has risen consistently, and so has their free cash flow and profitability. And as they're seeing these really strong correlations between the growth in their vet clinics going back and flowing back to their e-commerce platform, I think that bodes really well for the company. And also just the fact that most of their sales are recurring. And they've noted that somewhere over 75% of net sales tend to come from non-discretionary pet purchases like consumables and healthcare, which I think shows that, while consumers are more wallet conscious, there are certain expenditures that they are not going to cut back on, even if, finances are a bit tighter than usual. In terms of competition, I think Chewy has done a really good job of outpacing the growth of the competition. Actually, yesterday, I was doing a bit of a side-by-side comparison of Chewy and Petco, which is a much older business in this space. And, Chewy started out as an online-only business, has expanded from there. Petco was known and is still known for its brick and mortar locations, has built out an omni-channel presence, but that is a business that has seen an absolute stagnation in growth with revenue.
Well, it's shrinking. They're actively closing and decreasing their footprint.
Yeah, the revenue is down, profits are down. As Jason said, they're decreasing their footprint. I think players like Chewy are dominating this space, will continue to do so. It's also a fragmented market. There is room for more than one player. But I think this type of a model that we see from Chewy is how businesses in this space will succeed. And Chewy is definitely one of the most, I think, prominent examples of a success story in this space. So I think that there's a lot of growth still ahead for them. I think this vet clinic business is an exciting area that I've been skeptical on, but as I'm watching the execution in these early days, I'm kind of intrigued by. And then, their sponsored ad business as well, seeing how that's a small part of the business, but a huge contributor and expected to be to gross margin improvement. There's a lot of really good things happening with this business. And there's a lot more, I think, to pay attention to than just the customer growth. That's huge and that's part of the business, but there's a lot of other factors at play as well.
Here's what I think. Chewy's doing. I think they're trying to build like a Costco / Amazon Prime sort of business here. And you start from the clean sheet of launching Chewy. It's obvious that the opportunity is to start from distribution in the internet, right? You build that first. You build the e-commerce business. you get lucky that something catastrophic happens that's really good for your business with the pandemic, because it accelerates the onboarding of people. And that means your cash flows start to come in right now. And it puts them in a position where it's like, okay, we've built out the e-commerce footprint largely. We have our logistics. We're going to continue to expand it as we scale up, but we can kind of leverage that now for operating leverage. Where can we build things across the ecosystem of the value chain of pet care that can create value for customers, that we can truly lock them in, And one of the things that the Petcos, et cetera, of the world have tried to do is having things like grooming facilities and things like that in their locations. And those things have provided some moats, but they're not really truly like durable competitive advantages as we've learned.
Yeah.
But you start acquiring vet clinics and you start building your Chewy branded pet care. And again, they've got 11 total locations now. They opened 10 last year, like you said. There's like 35,000 vet clinics in the US. Chewy has relationships with like 17,000 of them. Maybe it's probably 18,000 now that they're partnered with the things that you were talking about, right? The vast majority of those, just like I was talking about with Care Trust, are, it's an owner operator that has a location or 2 or 5, right, that they've built over time. And a lot of those owner operators they're going to want to retire at some point. They're going to want to turn that investment into, whatever's funding the rest of their life. They're going to want to liquidate. They're going to move on. Having those relationships, there's companies, there's real estate investment trusts in the storage, like public storage properties, that do the same thing. They have like a software that you can run your public storage building properties on, that they provide to the industry. That's basically like, it's like a shopping list for them for future acquisitions. So Chewy has done a little bit of that same thing by establishing those relationships that over time could help them consolidate that part of the industry. And as they try to build out things like what do they call it? They're the Chewy Care. I can't remember exactly what they call it, but like, you know what I'm talking about. It's this service.
Their telehealth business? No.
Well, it's what do they call it? I gotta look it up.
Connect now. Is it Connect with a Vet? No, because that's what that's called. But
I gotta look it up. This is gonna make me mad if I say the wrong name. Care Plus. So Care Plus is their insurance wellness, right? So they want to be able to sell more of that, scale it up, because you scale that sort of thing up and it becomes more profitable. It becomes more sticky. Your customers become stickier and they want to do more business with you because it's more convenient more broadly. Mm-hmm. So I think they're trying to build a more fully integrated business. And as much as it can be very profitable to own and operate vet clinics, it's a very, very profitable business. I think they want to use that for profitability, but also to continue to be top of the funnel and a way to build a deeper relationship that becomes more and more sticky. So that's what I think they're trying to do. Right now, they are facing a tough, customer acquisition. 2% customer growth is minimal, that's not much. That's not much. But as they scale up these other parts of the business, I do think the operating leverage is going to kick in and help drive profits higher. So that's a lot on Chewy.
A lot on Chewy.
All right, Ed dropped a comment in earlier that this is just warms the cockles of my beating heart here, Ed. I had 2 GTC, which is good to close, good till close orders hit today. Phillips 66, ticker PSX, and LGIH, which is LGI Homes. Hopefully it works out. These are 2 of my holdings, 2 of my favorite businesses. And the one so what good till close means is Ed put in these long-term orders, buy orders, at a price that Ed wanted to pay. And Ed apparently got those prices today. So that's fantastic. And these 2 businesses, I think the prices that the market's selling them for today, Ed, I do think it's going to work out. I've talked about that before. So here's a recent thing that I want to share that I loved reading this today. This came from, and I've sent the screen share over, Natasha, if you can release it. Phillips 66 has been dealing with Elliott Management, which is a large investment management activist investor that made a pretty big investment in Phillips 66 quite some time ago, and they've been agitating for change. Tyler Crowe and I have argued back and forth about whether the things they're agitated for make sense. Here's where things take a little bit of a twist. So Bob Pease, a longtime energy industry executive, spent a lot of years in the refining industry. Phillips 66 directors appointed Bob Pease to the board a little over a year ago at the agitating of Elliott Management. Apparently, if you read the letter from Bob Pease that was published today, Bob Pease has said, I found this group to be welcoming. And usually if you're the guy that comes to the board or the lady that comes to the board from the activist investor, the existing directors tend to have a little bit of animus with you, right? So what Pease essentially says is that I was encouraged to get involved and debate and offer ideas to how can we improve our business from the beginning. And now apparently Elliott is going to be proposing 4 other directors and not support Pease staying on the business, staying on with the board. So activist investors don't always get what they want. And sometimes they agitate for change, and the change that happens that's best for the business. In some cases, the person that they suggest to get on board as a director comes to the conclusion that, hey, this is a really well-run business that has some competitive advantages as it's structured. And the directors here get it, and they're working hard in the best interest of shareholders. And in the case of Phillips 66, what makes it unique are the things that I like about it, and that it's not a pure play refiner, and that it has infrastructure operations and the pipelines for moving refined products and moving oil and moving natural gas that gives it those steady cash flows across the cycle. It has a pretty good petrochemicals manufacturing business in a joint venture with Chevron. That's a great value additive business that's tied to cheap U.S. natural gas. And it has one of the best refining businesses in the world. And those that have argued that Phillips 66 should sell off everything but the refining and just be a refiner, sure, there's a case that if it did that on paper, its margins would be better. Maybe there'd be steadier revenues. But from a countercyclical perspective, selling off other really, really good businesses when you have a bit of a strategic advantage because you're built differently than all of the other integrated majors makes you a unique, better business. And I think that's the case for Phillips 66. So Ed, as a fellow investor, I'm hoping it works out as well. LGI Homes, ticker LGIH, I want to say this could be a tough year. It really could. I think they're in a good position with active communities. They've spent the past year and a half really rebuilding their land inventory and getting land prepped to try to start getting more communities, active selling communities open. And they've done that. They just reported it, and they're planning, I believe they're going to end the year with more active communities than they started with. Now, what happens between now and the end of the year remains to be seen. It could be a rough ride. It could be a tough year. I'm sure you've heard me talk about that, Ed, and anybody else that's listened to me ramble on and on and on about home builders over the past few months. This is a very front of mind topic for me because I do think we're getting into a really attractive time to be accumulating those companies. Not because of what's going to happen this year, but what's going to happen over the next 5+ years. We're so underbuilt in the markets that builders like LGI builds in Texas, the Southeast, that's where the growing demand is for affordable houses, condos, townhomes. That's where they kind of focus. That I really do think that LGI is going to really, really deliver. The market is very much undersold this business. It's gotten really cheap. Doesn't mean it can't get cheaper. Like I said, this is going to be a tough year for home builders, but I think we're going to look back in 5+ years and be pretty happy with that. So if I'm wrong, Ed, I'm wrong in my portfolio along with you and everybody else is buying these shares. So again, no individual advice being offered here, but yeah, I like those buys. All right, what's next, friend?
Okay, so there was a question for Besties I wanted to hit. What do you think of LRN, which is the ticker for Stride Inc.? This is a learning company. And how would it be affected by the Department of Education cut? It's interesting. This was not a business that I knew until about a month or two ago, and I started getting a lot of questions on it and found myself interested as I dug deeper into the business. Stride, the stock is up about 100% or more actually over the last year. But what they do is they basically offer comprehensive school as a service offerings, integrated packages of curriculum, technology, instruction, and support services. The majority of their revenue comes from providing these comprehensive online learning solutions, school as a service, if you will, to school districts and other educational institutions. And so that's where the question of how could potential, federal funding cuts impact the business. So it's important to note that in the US, the majority of funding for school districts does come from a combination of state and local sources. Local property taxes are a significant contributor. State governments provide a substantial portion of school funding, often through formulas that distribute the funds among districts, and then local governments, primarily through property taxes, contribute to school district budgets. The federal government does provide a portion of K through 12 education funding, but it is a much smaller amount, typically around 8 to 13%. It's kind of important to note that the U.S. Department of Education, they fund a wide range of initiatives, but it is not, broadly speaking, the biggest needle mover for the local districts. It's often targeted towards specific needs, supporting students with disabilities or those from low-income families. So as it pertains to the question of how it would impact school districts, which are the biggest client for Stride, in fact, most of that funding comes from the state and local level, where they would be less affected by some of these cuts because the Department of Education is, broadly speaking, that money goes towards things like special education programs, funding for students with disabilities, and other similar areas. Now, Stride's revenue, as I mentioned, most of it comes from the school as a service business they have, providing really comprehensive solutions to school districts. And this includes curriculum development, technology platforms, instructional materials. Their agreements with school districts typically extend for more than 5 years, and there's often automatic renewals built into these agreements unless customers opt out. And they operate through two primary business units, which is general education, focusing on virtual instruction for K through 12 students, and then career learning, which is a smaller part of the business, but is providing things like job training, skill enhancement services. And their business model has proven to be highly scalable over time, really allowing an increase in enrollments to significantly boost the company's profit margins and earnings. And they aim to expand their reach by leveraging these multiple models that I've mentioned and expand capacity within existing states as well as new markets. And they continue to do so in a very profitable way. The most recent financial results we have for them are from the second quarter of the company's fiscal 2025. They reported revenue of about $587 million in the 3-month period, up from $505 million a year ago. Net income of about $96 million in Q2, compared to about $67 million a year ago. And then, broken down by general education and career learning. So of their total revenue of $587 million in their most recent quarter, about $354.3 million of that came from their general education business, which broadly is that school as a service, those packages I mentioned that they provide to school districts through long-term, often automatically renewed agreements. And then career learning comprised about $233 million of their total revenue base. So interesting business. They've been seeing enrollments grow in the double digits, even though revenue per enrollment has been more on a decelerated growth trajectory recently. They are still, very profitable, high cash producing business. It's an interesting company. I don't often find myself interested in the education technology space. And I think one of the things that I have found more intriguing about this business as I've gotten to know it more, just given that we've had quite a few questions on it in the last couple months, is the fact that they do have a pretty resilient model baked in because of the clients and customers they serve. Working with school districts, but also with private schools. They also number companies as well as some government agencies among their clients for their career development services. But they really work with a wide range of school clients, which again, that's the biggest source of their revenue, ranging from private institutions to local school districts, which again, a lot of their funding comes from the state and local level. So interesting business, perhaps not as prone to being impacted by some of these cuts as one might think, before digging a little deeper. It's an interesting business. It's one I've definitely been watching a bit more closely recently.
So David in Oregon sent me a thank you for the follow up on Care Trust. You're welcome. Good to hear that there's some other fools out there that are also interested in keeping up with that company. So thank you for that. We've got a little over 8 minutes left here. I could very easily take every one of those plus half of the next show answering Kent's question.
I just knew you were going to say that.
I'm not gonna though. So Kent asks, Jason, which stock do you like the most? And lists 3 of the Brookfield stocks. So Brookfield Asset Management, ticker BAM, Brookfield Renewable, ticker BEP, and Brookfield Infrastructure, BIP. So Kent, you left out the one that is owning all 3 of them, and that's Brookfield Corporation, ticker BN. I think we should throw that one in there as well. But I'm going to answer the question in kind of a backwards way. If you look at my economic interests, the one that I own the most of directly is Brookfield Infrastructure, ticker BIP, and then Brookfield Infrastructure Corporation's ticker BIPC. So we can work that one into the mix as well. But if you factor in options that I have some calls that I've bought to hopefully acquire more, then my potential economic interest and exposure the most would be to Brookfield Renewable if I'm able to call in the shares at the price, because my plan with those calls is to take shares and not just make the premium and the profit on the options trade. So how's that for a mixed answer, pal? I will say this: the one that I think is the most compelling at recent prices continues to be Brookfield Renewable, BEP, and BEPC is the corporate equivalent stock, because I think it's the one that the market is the most down on right now. And I think it's the one that maybe the market misunderstands the most. Obviously, it has a substantial amount of exposure to the U.S. and the Trump administration's stance on energy, I think, has been a little bit mixed. President Trump has been very negative on wind, which is a pretty sizable part of Brookfield Renewables business, and has been very pro oil and gas. And that, I think that kind of gives the perception that it's going to be a tough time for businesses like this. And Brookfield Renewable has a pretty large and growing solar portfolio, distributed solar on top of like parking decks and large businesses, factories, and big box stores and that kind of thing. And they have a large utility scale solar presence as well. They also have a pretty big hydroelectric business, and the majority of the business is outside of the U.S. too. So there's a lot of optionality that Brookfield has about where they can deploy capital going forward. And wind and solar have gotten very, very affordable and competitive with hydrocarbons in terms of sources of power, and energy storage costs have come down so much that it's getting really compelling to have renewables paired with solar. And on a price perspective can be competitive in different markets with hydrocarbons. So I think that's an important thing to remember, is that the economics are still super favorable. Some big advantages in terms of cost of capital because of the relationship with Brookfield Asset Management, where you have a lot of cash that's investments from very high net wealth individuals and pension funds and sovereign wealth funds that are looking to take that cash and invest it in something that can get yield and capital appreciation. So you're not competing against a lot of the competition out there is having to take on debt to fund this stuff. And Brookfield Renewable does use debt at its own level to take stakes, but generally it's taking minority stakes in these interests, and the majority stakes are being invested in by Brookfield Asset Management in a lot of cases, and they're deploying cash, so they can get better returns, and they can be more competitive when they're acquiring assets than other peers can, because of the difference in cost of capital for its entire corporate capital stack. So I really like Brookfield Renewable a lot right here. The thing I like about Brookfield Corporation is it is a good way to get exposure to infrastructure, to renewable energy, to private equity, to insurance, the fees on the asset management business, all in one bundle. So Brookfield Corporation is compelling, but right now Brookfield Renewable is the one that's the most compelling to me. Hey, look, I left you 3.5 minutes.
Well, there we go. There was actually a question that was targeted towards both of us that might be interesting. Cyber Mikey was saying, "Hi, Rachel, Jason. I asked earlier on Fool 24, but do you prefer going all in on a position cage match
I love that.
or slow build based on the thesis? For example, adding as your thesis on the business rises." This is a really interesting question. I think for myself, I would say that it depends on the business.
Yeah.
There are companies I have bought for which my thesis was and remains extremely strong, that I bought a larger position in, and therefore it represented a more significant part of my portfolio pretty early on. And depending on, what other companies I'm interested in at a given point in time, or what my risk tolerance is in a given point in time, I may or may not build on that because it's already a significant, position in my portfolio. Slow building based on a thesis rising would generally be an approach I would probably take for a company that I looked at as a higher risk investment in my portfolio. Maybe a company that is, still working towards profitability, or which I'm a little unsure about over the long term, but I still think it's a good investment and want to have it in my portfolio, but don't want to over concentrate. So for me, it really, really depends on the actual stock and business. I have found that sort of a combination of these two approaches has been something that I've liked in my own personal portfolio. I do like the idea of gradually adding to positions over time. I think that can be really great, because sometimes, and this has been especially true, as a newer investor starting about 5 years ago, particularly when I was starting out, although I did invest in a wide range of really well-known, large, mega cap companies, which I've talked about many times, there were certainly businesses that, I was really fine-tuning my own research processes for buying stock, understanding how to value a stock for my own portfolio. And I found it helpful to be much more cautious with my approach to adding in that period of time. So for me, it really depends on the business. If there's a stock that I am not comfortable having too much exposure in, at a particular moment in time, I might be more inclined to add gradually, versus one where my thesis is really, really strong over the next, 5-10 years as I'm looking forward. I feel confident in that. I might be a little bit more inclined to take a bigger position.
Yeah, Confluent. You see how my brain works? Confluent.
It came to you, Jason.
That's the data streaming company. Boom, just poof, just like that. I'm surprised it wasn't 2 a.m. and I just woke up and thought about it. So generally, I'm very much a build out the position over time investor. I love to average up, because that means the market's healthy, the businesses are doing good, and the stock is going up because the business is growing in earnings. So I'm paying a higher price for the stock over time, but a lot of times I can get a little bit maybe better valuation over time as the business matures. Now I especially do that with companies that are more on the speculative end of things. So the younger tech companies that aren't profitable yet that I've bought, I start small, and as the business wins, whether the stock price is up or down, as long as the valuation is so directionally I'm pleased with it and the business is doing well, then I'll add to those, and I'll add more, I'll add more often, and I will, but maybe in smaller amounts as I'm building out that position. On the other end of the spectrum, the Brookfields of the world, the Phillips 66s of the world, the Care Trusts, even those, I still build out the position over time, but typically I'm making a little bit bigger buys when I do it, and to get to that, whatever that full cost basis that I want to invest in the company is, I will have made fewer buys, and they're a little bit bigger, and probably over a shorter period of time, because it's not, you don't run into an NVIDIA or a Trex or a Mercado Libre where the business is so wonderful that, 14 or 15 years after you bought your first position, you're still like, there's still a lot going on here, and I can still buy more of this stock. And even though, I'm paying 30 times more per share than I did the first time I bought it, still very happy to be adding to that position. So definitely. And here's the other thing too. I mean, I anticipate between now and the time that I'm no longer earning an income, hopefully my wife and I, my spouse and I, we will have contributed a 6-figure amount of money, right? So the old saying, sometimes the best stock to buy is one you already own. So thinking about that and not being unwilling to add more money to existing positions, I think is a really important mindset thing to remember. Hopefully that's a useful answer.
Awesome. Well, thanks, Jason.
Who's on with Brian? Are you on with Brian next hour?
I am. Yes,
All right.
I'm sticking around. I'm actually here a couple more hours.
So we've actually got two people that understand healthcare, different parts of it, but two people that understand healthcare. Well, that's fantastic. So I'm going to disappear, and we can bring Dr. Brian Orelli, PhD, onto the stage.
There we go.
Hey guys.
Hey, Brian, how are you?
Good. We're talking valuation for the next hour.
We are. Yeah, fools, get us your questions about valuation. If there's any companies in particular that you want to ask either Brian or myself about, go ahead and get your questions in the Slido. The event code for that is Fool24. I see that we had a few questions as well that we're going to try to go back through from the prior couple hours. This one that came in, Novo Nordisk or Zoetis, which one do you guys like better and why? I'm sure we both have thoughts on this, Brian. I'll defer to you to share your initial thoughts there.
Yeah, maybe I can share my screen and we can look at some data. But just while I'm doing that, just to be clear, I mean, probably most people know what Novo Nordisk is. They're the pharmaceutical company out of
Denmark.
Denmark, thank you. That has obesity drugs and a lot of diabetes drugs. They also sell drugs for the blood, when your blood won't clot.
Anticoagulants, right?
Yeah. Yes. I don't know why the disease is
There's so many. Well, and Zoetis is a little different, right? This is was a spinoff from Pfizer, but they're a top animal health company. So they make money from vaccines, medicines, diagnostics, another tech for pets and livestock. So two different businesses, both very interesting though.
Yes. So if we let's see. Okay, so we got the screen up there. Let's do this. So we can look at revenue. Well, that didn't work. Oh, I guess this is what I want to do. So we can see Novo Nordisk is obviously growing much faster than Zoetis, but 17% growth over 3 years is not bad. I think it's probably the 5-year chart. It isn't quite 5 years, but even so, if we look at the max chart, so this is when Zoetis got spun off of Pfizer. It's still 46% growth. Obviously Novo Nordisk is growing much faster. And if we look at some valuation metrics, we can see that Novo Nordisk was pretty high valuation in much of last year as it was growing quickly. It's had some stumbles in terms of potential sales growth in the future and has come back down, and so now the price to sales ratio is actually lower than Zoetis's. I don't know that I would expect that the revenue growth for Zoetis and for Novo Nordisk would be the same in the next couple of years. So, I mean, I think on this basis alone, I think Novo Nordisk looks like a better valuation. If we look at PE with the trailing 12 months, again, Novo Nordisk, was higher, but now is substantially lower. So, I think if I think Novo Nordisk is guiding for 20% growth in 2025. So I think if they hit 2025 growth of 20% and are trading at 21 PE of 21, I think that's a pretty good valuation, and probably better than Zoetis's. And if we look at the forward PE, this is obviously based on analyst expectations, and who knows what the analysts are expecting. But you can see that again, Novo Nordisk was higher and then has come back down. And so, I mean, I think the valuation of Novo Nordisk right now is pretty good. I mean, obviously, this big drop right here is because they had data. I guess this must be earnings data, and then let's do the price.
And the CagriSema trial, which I want to talk about that a little bit too, because there was some additional updates from management today on that in a conference that was interesting.
Yeah. So you want to talk about?
Yeah. So for anyone that has not been following this, so Novo Nordisk, they're known for Ozempic and Wegovy, which before the blockbuster success of these drugs, they were a pretty slow-growing insulin-centric business, and then these drugs have essentially completely revolutionized their growth story, and they are working on what is going to be their next generation, as they call it, GLP-1 drug, and that is CagriSema. And similarly to the results from the prior redefined trial, when results for this candidate came out, there was tepid response in the market, but particularly so when it came to this most recent set of results. So CagriSema, it's met its primary endpoint in the phase 3 redefined 2 trial. It demonstrated a statistically significant superior weight loss compared to placebo in adults with obesity or who were overweight and had type 2 diabetes. Patients receiving CagriSema achieved a superior weight loss of 15.7% after 68 weeks compared to 3.1% in the placebo group. And when applying a broader treatment policy analysis, weight loss was 13.7% with CagriSema versus 3.4% with the placebo. And again, there was with the Redefine 1 trial that also met its primary endpoint with weight loss of 22.7% with CagriSema compared to 11.8% with cagrilintide or 16.1% with semaglutide. But previously, management had indicated that they thought that CagriSema would achieve basically a lowering of weight by up to 25%. So that 22.7% figure was something that seemingly analysts and some investors were not happy with. There was actually a story that was published today. There was the firm Novo Nordisk's annual general meeting took place today in Copenhagen, Denmark. And management said that they are very confident about CagriSema. And CagriSema is a combination of cagrilintide, which is this form of a weight loss treatment known as an amylin analog, and then semaglutide, the active ingredient in Wegovy. And essentially, at this annual general meeting, they really were, defending their trial results for this drug candidate, which has been, significantly hyped. The CEO said acknowledged the really sharp share price reaction after 2 consecutive late-stage trials, both of which I just talked about, showed, what was seen by many as sort of underwhelming weight reduction versus the company's own targets, even though they still met their primary endpoints. But he said, they remain encouraged by the drug's weight loss profile and that they're very confident about it, and they think it's going to be, a very, very important product for them. And the results from these 2 late-stage trials I talked about, they're redefined studies, and the response to them have wiped a lot of value from Novo Nordisk's share price. And we've also been seeing, I think, some volatility, just broadly speaking, in this space. And they faced some pushback again on Thursday. Shareholders were urging the board for clearer and tactically sound trials and targets in a bid to promote less dramatic share price moves, according to this article. And he said, okay, 22.7%, it's not 25%. Some people were disappointed about that, but they believe there's continued potential for developing CagriSema further. So it's interesting to actually, see some comments from management about that. When the most recent trial results came out, I personally felt that the market was overreacting a bit. I know that they, were not happy with some of the numbers that came out compared to what management had been forecasting, but it still seemed overall like pretty solid results. But it's been a volatile time in the time since for the stock.
Yeah, I mean, I thought the results were, okay. I mean, they weren't great. I mean, the Zepbound is the leader here from Eli Lilly, and I think
Right.
they're, just over 20%, if I'm remembering correctly. So 22% is not bad. Then I don't know. Usually you would look not necessarily just at the total, but the placebo adjusted result, right? So I don't know what exactly the placebo adjusted result is for the two of them. And then the difference in the trial, I think, was the second trial allowed for patients to stop and go down a dose if they didn't like the tolerability of the dose that was as they were ramping up, if they got to a dose that they didn't like the tolerability of, then they would go down one dose. And so that's those two set of figures you gave where like everybody that was on the highest dose, how did they do? And then overall, how did they do? And they were expecting the results would be lower because obviously some of the patients are taking the lower dose and not forcing themselves to stay on the drug. But some of those would have probably dropped out, and then they potentially would have, assuming you could follow them, would have resulted in them not being having even worse results because if they drop out of the trial, especially early on, and aren't willing to take the highest dose, then they're presumably going to not lose weight because they're not going to be taking any other drugs, and so that that's a problem. So I like the way that they ran the two different clinical trials, and I don't think that they're horrible results. They're certainly approvable results, right? It's just that I think that there's less likelihood of it competing and in a huge gain over Zepbound. There didn't seem to be any major increases in weight loss that should get you to take Novo Nordisk's new combination drug over Zepbound, and the safety didn't seem like. I think the hope was that the safety would be better, and I don't know that we've gotten that data on a very granular level. I think we probably need to wait for the clinical trials to be published or presented at a medical meeting before we can actually figure that part of the story out. But that's probably as equally as important.
Yeah. And the trial allowed patients, as you said, to modify their dose throughout. By week 68, 61.9% of patients were on the highest dose. So they did break that out a bit. But there obviously would have been some.
So that's that's pretty similar to, I think, what you would expect in real world for Zepbound, where a lot of patients aren't are dropping off of it in the first, that was 72 weeks, so that's a little over a year, right? So almost a year and a half. And so I think that the in a year and a half, you've probably got somewhere in the 50% range to 60% range that are no longer on the drug, or are still on the drug. So somewhere they're probably in the ballpark. They might be a little bit better, but that still doesn't tell you exactly why people were dropping out and or dropping down to the lower dose.
Yeah. And the other thing that's interesting as well is they're planning to launch another redefined trial with a longer duration and focusing on dose escalation and re-escalation. That's set to launch in the next few months, I think. And they are planning to file for the first regulatory approval of CagriSema in Q1 2026. And there's some estimates out there that if approved, by the end of 2027, CagriSema could bring in as much as $2 billion. That figure is estimated to rise to as much as $10 billion annually, by the end of 2030. So, it's broadly expected to be a major boom for the company. We'll obviously have to see how this actually shakes out in the end. But I think it's fair to say a lot of the hope of the business for their future growth and sustaining the growth trajectory they've seen the last few years does hinge a lot around CagriSema.
Yeah, I'm kind of surprised that they're taking that long to launch to file for the drug, the thing. Is there a third clinical trial that they're waiting for? Because that seems like that would be a long time. It's basically a year to file, which you wouldn't expect them to take that long to file. At least I wouldn't. I would think they would be able to do it in 6 months. So
yeah, they're doing this new Redefine 11 trial, and it's going to have the high dose, which will be tested for longer than the 68 weeks that Redefine 1 ran, and is quote supposed to further explore the potential of CagriSema. So that has either just started or is about to start. They had announced plans for it in February.
Well, so that won't read out by the first quarter of 2026. So that still doesn't explain why it's taking them a year to get all. I mean, obviously it does take time, right? It's not like you can just like you have the results, the top line results, and you're ready to file. There's a lot of data that the FDA needs. So 3 months is super quick, and 6 months is sort of average. So I'm sort of surprised that they're taking that long but maybe they want to get further into that third trial so that they can have that data. That data would then read out about the same time that the FDA approval would happen. And so maybe that sort of boosts the launch of the drug. Maybe that's the thought process. I don't really understand why it would take so long for them to file if they've got all the data they need right now to file. But
yeah, it's an interesting one to watch for sure.
Yeah. And then maybe just to finish off with Novo Nordisk before we move on to something else. Today they licensed a new drug, a new obesity drug. It has a completely different mechanism of action. It's an ACSL5 inhibitor. The drug is from Lexicon Pharmaceuticals. The ticker is LXRX. It's a pretty small biotech company. I've never heard of them, so I'm definitely not endorsing them here. Even though they're getting $75 million up front for a drug that hasn't even gone into the clinic yet, and they have there's potential for $1 billion in upfront and milestone regulatory and sales milestone payments, and then Lexicon will also get a tiered royalty on sales of the drug. So I mean, the drug is really early stage. So 75 billion, I think, is reasonable. It was a reasonable bet for Novo Nordisk to make. It's they're not spending that. That's really not that much for a licensing deal, and it's early stage, so that makes sense. And then they'll only pay out that $1 billion. They'll pay it out in chunks. Some of it may come as the drug gets developed. I mean, they do say they're just development milestone payments. So obviously some of the milestone payments are going to come as maybe as a successful phase 2 or a successful phase 3 or something like that. And there's a regulatory milestone payment when it gets approved by different regulatory agencies. But presumably most of that $1 billion in milestone payments it would be for the sales milestones. They would only come if the drug is actually, very successful. So my guess would be it's probably, 10% in the development, maybe another 10% in regulatory, and the other 80% of the milestone payments are probably in the sales milestone. So, Novo Nordisk isn't putting themselves that much on the hook, except obviously they're going to be paying for the clinical trial. So they'll have that expense in addition to the potential milestone payments for the regulatory and regulatory milestone payments before they actually start getting paid for selling the drug.
Awesome. There was a question that came in from Cyber Mikey about a company I talk about a lot, Vertex Pharmaceuticals. I think you also follow this one.
Yeah, I think it's my largest independent holding.
Yeah, I love this business. Cyber Mikey was saying, Vertex, what milestones will confirm successful diversification beyond cystic fibrosis in 2025, given suzetrigine setbacks? Well, it's now being marketed as Journavax, I think, and Cascovy's reimbursement hurdles. I mean, I still tend to think, and this is my opinion, but that Jurnivax is one of the most kind of exciting developments that we've seen for the business. I mean, this is a company that has built a very profitable business around its cystic fibrosis drug franchise, because they've been, for a long time now, the only company with approved drugs that target the underlying genetic root causes of cystic fibrosis. And then they have their new triple combination therapy. I think it's called AlphaTrack, which essentially contains the key elements of several of its most well-known drugs, notably from Trikafta, which has been its long time blockbuster drug. You've got vanzacaftor and tezacaftor, which are two of the main elements that they bind to different sites on the CFTR protein, which is faulty in patients with cystic fibrosis, and then work together to help the CFTR protein reach the surface of the cells. And then the third element, dudivacaftor, helps the proteins work better together once they're there. But I've been really watching the story with Jurnivax, I think, most closely. Their new non-opioid pain treatment. It's the first in a new class of pain medication that has been approved in over 20 years. Right now, it's approved for treating moderate to severe acute pain in adults. They're obviously also studying it for patients with ailments like diabetic peripheral neuropathy, but it targets a signaling pathway in the peripheral nervous system, preventing pain sensations from reaching the brain. It offers what seems to be a very promising alternative to opioids, and of course, not having the addictive properties of opioids either. And this was just approved at the end of January, and they are still seeking approval in many of their other core target markets, including in Europe and in the UK. I know they said in their earnings call that in the institutional setting, they're engaging with roughly 2,000 high-volume hospitals, about 150 related health systems, as they're working to scale out the launch of Jurnivax. And again, of course, we're still waiting for approval in some of its other core target markets. But even just in the US alone, there's roughly 80 million patients dealing with acute pain ailments that they think that Jurnivax could be well designed to target. And they've also been saying they've been securing broad stocking agreements at national retail pharmacies and regional chains to ensure the availability of Jurnivax for patients across the country. So I tend to think that this, along with their new triple combination cystic fibrosis therapy, will be the two greatest accelerators of growth in the next few years. Casgevy is really interesting because this is by its nature a therapy that, given how administration of it works, uptake of it is very, very slow. I mean, they had, at the end of 2024, they'd activated about 50 authorized treatment centers globally. More than 50 patients had initiated cell collection, because of course, before receiving it, patients undergo a process to collect their own blood stem cells. These are modified in a laboratory. Then shortly before the stem cell transplant, patients receive a conditioning medicine. Then they receive their modified stem cells infused back into them. And then patients stay at a treatment center after the infusion to be monitored. But it is a multi-week, very in-depth process. And so it's a very kind of long road ahead in terms of, I think, seeing any real financial impact from Casgevy. I'm curious to hear your thoughts on these, Brian. I know you follow these closely.
Yeah, and Cyber Mikey says it's also his or her just largest holding, Vertex is. So, and mine has not necessarily grown because I've added to it. It's mostly grown organically. I mean, I bought a fairly large position to start off with because it was at that point it was already a large pharmaceutical company, and so I bought. I was comfortable buying a larger position than I would with a small biotech company, and then it's just grown like gangbusters. I'm not as bullish on the pain drug as you are, because and not as bullish as the market is. So let me share my screen, but you can see like let's just look at what the year to date looks like. It's a little shocking to me. I was not expecting the market to react as strongly to the to the so this is
Oh
where
yeah.
this is where the approval happened, right? I mean, you can see it pretty obvious. It's just up and to the right here, where the thing. So and then the valuation is just really on the high side for me. Like look at the price of sales, especially historically.
Yeah,
I mean,
no, it's high.
it's certainly traded way down here. In the prices of sale. Let me get the price off of here. So you can see, I mean, and a few years ago it was trading in the 9s, and now it's all the way up in 11. And it was at the very beginning, right before the approval, it had dropped down a little bit, but it's still trading at a substantial premium to at least historically. The triple combination, I don't think is going to result in that much more sales because they basically have the entire market to themselves, right? So I don't think that they're really going to add that. It's basically just going to cannibalize the old sales for they have older medications. Patients are going to switch from the older cystic fibrosis medications to the new cystic fibrosis medication. I think there might be a slight premium in the price because it's a slightly better medication, but it's not like 20, 30, 50% better, right? So there'd be a slight increase just from the switches because it's priced higher. But in terms of actual sales, I don't think they're going to get that many extra sales with the new medication because it treats basically the same number of patients. Now that said, it also extends the patent life of the most recent combination, right? That combination is better for patients and also has a longer patent life. So it's better for patients, but also better for Vertex in terms of it's being able to, continue sales without generic competition. So that's certainly a huge benefit to Vertex, but I don't think it's really going to drive sales. So the question is, for the immediate future, will the pain drug drive sales? And I'm just not convinced that doctors are necessarily going to prescribe it for acute settings. So this is patients that are taking it for like maybe 7, 10 days, maybe 14 days after surgery, and then they're stopping, right? That's not necessarily an issue with addiction, right? Addiction is more when you have a long-term pain and you just keep taking them even though you stop your pain, right? Where the pain is going to go away. And so, I'm not sure about the addiction thing. It may be that insurers decide that that's a preferred, that they're worried about addiction, and that whatever small percentage of people become addicted to opioids, that cost for the insurance company justifies the higher cost of Vertex's pain drug, because of course most of the opioid pain drugs are generic, so they're cents versus dollar, multiple dollars per pill for Vertex. So the difference in cost is actually, fairly substantial. Now it's only a 7, 10, 12, 14 days, supply. So maybe the insurance companies don't really care that much, and patients are probably not going to care that much because it's only going to be the difference between a generic copay and a branded copay. So maybe it depends on your insurance, but it could be 10 for one and 20 or 30 for the other. It could be 20 for one and 50 for the other. So it sort of depends a little bit on how much the insurance is, but at that point you've already got the prescription. You're just going to go fill it because you want the pain to go away. So it's more probably on the doctors and whether they're going to prescribe it, whether they think the data didn't really look that much better, right? Then it's not like it's a better drug. It's just the main argument is that it doesn't have the addictive qualities, right? So I think that's the main question, and whether insurance companies might try to push it. You could imagine that, but I'm not 100% sure if that's going to happen. And then the other option is that doctors just decide that they don't, they want to stay away from opioids and they don't care about the difference in cost because they're not paying for it, which I guess could happen. But I don't know. I'm not as convinced with it. And again, I'm a shareholder, so I'll be happy if I'm wrong. But it's actually one of it's already on I'm already on record of saying that it's not going to be a good seller, at least in 2025. It's one of my bold predictions for the bold prediction show, the 7:00 show, was that Casgevy, or that the new pain drug would not hit a certain threshold, and I can't remember what I said. I think I might have said 200 million, but I might have said 100 million. I can't remember, but it was a fairly low number, at least for 2025. I can't predict beyond that. I don't know exactly what it'll look like, but I think it's going to be a slow launch. But we'll have to wait and see. And then with Casgevy, I think it's just beyond the slow ramp that you mentioned, just because of the way the drug is delivered, there's also this issue of getting insurers to pay for it. That there's there's a huge one-time upfront payment because it's a cure essentially, but the insurance company doesn't get the benefit of patients not having the crisis that happens in sickle. Let's focus on sickle cell, though it's also approved for beta thalassemia. But I think the argument for getting it for sickle cell makes a lot more sense because you're going and getting transfusions for beta thalassemia is not that. I mean, it's work, and you got to go to the infusion center every so often, but it's not that bad. Where sickle cell, you either have sickle cell and you can potentially die from it, or you don't, right? And so obviously not having sickle cell because you're cured of your sickle cell is a huge benefit. And there's obviously a whole bunch of costs associated with patients every time they go into the hospital with the sickle cell crisis. But the problem is that the insurance company doesn't necessarily gain all that benefit from the lifelong benefits of the sickle cell, not having sickle cell, not having to pay for the sickle cell crises, because the patient isn't necessarily going to be on that insurance for the rest of their lives. So they have to make this one-time upfront payment that's hundreds of millions of dollars, I guess, right? And then
I think was it 2.5 million a treatment? Am I remembering that right? I think that's what they priced it out initially.
Remember, but
it's a hefty chunk of change,
right? So they have to pay this up front, but they don't necessarily. I think over the lifetime of the patient, the patient's going to save the healthcare, market, a lot of money, but it's not necessarily going to be this insurance company. So there's some issues there. A lot of patients maybe are spending down their money so that then they can qualify for Medicaid, and then they can go on Medicaid and therefore and get it paid for that way. And I don't know, that sort of works out okay because it's good for society, and so the government paying for it is not necessarily the worst thing in the world, in my opinion.
Yeah, that one's been a complicated one to watch. I mean, the approvals really came in very quickly, but for the reasons you mentioned and that I talked about earlier, it is a very slow process in terms of actually getting the therapy administered and to patients and getting patients, approved to even receive it in the first place. Let's see. I had a question about Novocure and VCR. Go Bolts was saying Novocure's been on a wild ride over the years. What are your current thoughts? Could this be the ultimate bargain? So maybe I'll talk a little bit about some of the things that have been going on with the business recently, and part of why the stock itself has been on such a wild ride. So Novocure, they're known primarily for their tumor treating fields therapy, including devices like the Optune Geo and Optune Lua for treating various cancers, but primarily glioblastoma, non-small cell lung cancer. And so their real focus of the business is developing and commercializing their tumor treating fields therapy. They've also been expanding into new indications. I think malignant pleural mesothelioma is another one. And they've been growing revenue. They're working, getting more patients, being administered their therapies, and they've been focusing on expanding their platform. But there's been some challenges in the last year or so, especially. There was the phase 3 study evaluating their tumor treating fields therapy in treating platinum resistant ovarian cancer that failed to meet the primary endpoint. There were those with the other clinical trial results that had raised some concerns. There was also a study, I think, that's ongoing with locally advanced patients with locally advanced pancreatic cancer. That's a key catalyst for the business. And, despite some very promising, I think, FDA approvals over the years for their tumor treating fields therapy, they've faced some challenges in gaining market traction due to the very high costs involved and sometimes mixed results in terms of survival benefits. The glioblastoma market, which is where their Optune devices are used, is quite mature, and there's been a slower adoption of new indications, and they've struggled with profitability and cash flow as a result. Although they are seeing some headway that has been made there. There have been positive developments, the FDA approval of their new head flexible electrode transducer arrays for use with the Optune Geo for treating, I think it's a glioblastoma multiforme. And then they're also, of course, pursuing regulatory approvals for the Optune Lua outside of the US and new indications like pancreatic cancer. It's an interesting business. It's been a tough couple years, though, for the company for a lot of the reasons I've mentioned. This is not a stock I own, but it's one I've been following. Curious what your take is on it, Brian.
Yeah, I own it. Unfortunately, I was definitely a bull in 2024 when I thought that the lung cancer trial would read out successfully, and it did. I mean, technically, it read out successfully, and they've gained. I think they've gained approval for the lung cancer. Yeah, because they're launching it right now. But obviously, it's been a wild ride as the questioner said. If we can pull up the chart, I'll show you how wild it's been. So obviously this was sort of like the biotech's going to cure the world, where valuations were extremely high. So I don't think that necessarily this was a good valuation. This was probably a good valuation, and I was sort of a bull right here this is when they said that the clinical trial the lung cancer clinical trial was successful. And then this is where they read out the lung cancer clinical trial and said, well, yes, it was successful, but it was successful against a first line treatment that doesn't exist anymore. So previous to when they started the clinical trial, patients got chemotherapy as their first line in treatment. And so the patients were given chemotherapy plus tumor treating fields or chemotherapy alone. And if you look at that clinical trial, it was successful. But now everybody gets immune checkpoint inhibitors. Lung cancer patients, at least in the US, get immune checkpoint inhibitors as their primary thing because they were approved since the clinical trial started. And so they have less data on that, but it does seem like it's helping patients. So the valuation is pretty low right now. There's obviously no sales right now of lung cancer. So we're just looking at glioblastoma, and you can see that the valuation pretty much tracks the share price tracks the price of sales because glioblastoma, as you said, is a pretty mature market. So the revenue hasn't been growing that much. So if the revenue is growing, right, then the price to sales would even go down even further compared to the share price. But it hasn't been because it's been sort of flat. They haven't actually maxed out the market. There's just a percentage that's something like 40% or 30% of patients just don't use the tumor treating fields, even though it's clear that chemotherapy plus tumor treating fields works so much better than chemotherapy alone. And I'm not really sure how much of that is doctors aren't pushing it hard enough, or if it's that patients just don't want to wear around a cap to like basically, I mean, it's sort of obvious. Okay, I have a medical problem if I'm wearing around a medical device all day, right? But that's what you have to do if you want to use the tumor treating fields. And it's a terminal disease, right? So while it does extend survival, and it clearly does extend survival, it's not a cure. So, some patients may just decide, okay, well, is it worth having a few extra months of life to have to wear around a cap all day. And, so I think that's probably some of it, but I think they could definitely do some more pushing, and they have had some changes in the executive suite that could, maybe these new executives could push it a little bit more. But right now, I mean, I'm a shareholder. I wrote it all the way down. I actually think it's not a bad valuation right now. There's basically nothing in the lung that is built into the stock price, but the lung is approved. So, there's more upside to the lung, in my opinion, than downside. The worst comes to worst, they don't get any sales in lung, and I don't think the valuation changes that much. Best case scenario, they get some lung cancer sales. Maybe best case scenario, they get as much sales of lung cancer as they do for glioblastoma, even though the market for lung cancer is much, much bigger than glioblastoma. So, that would still be considered a failure in terms of the launch, but it would, it's a reasonable, goal, I guess, at this point, based on the data that they have. And then the pancreatic cancer trial read out positive in December. So they'll be applying for that, and presumably next year gain approval for that. So there's that potential for additional sales. So I kind of like the valuation here. I haven't added to my position, and I probably won't, just because I try not to add when stocks are down in the biotech sector, especially unless there's like a clear reason why the rest of the world thinks that it's a bad choice and I don't, right? Then like I added to my Twist Biosciences after there was a short report, and I didn't really agree with the short report, and the stock had gone down from the short report and then just kept going down and down and down. So then I added while it was down, because I didn't think that the thesis had changed. My thesis has clearly changed here. I thought lung cancer was going to be positive, and so I was very bullish on the stock. And so, and I was bullish on ovarian and pancreatic, and only pancreatic hit. Ovarian, what didn't hit, which, I wasn't necessarily thinking, they had like in 2023, they had like 6 or 5 phase 3 clinical trials that were going to read out over the next few years. So we obviously had ovarian that didn't hit, pancreatic that was positive, lung that was, iffy, it was positive, but not really. And then there's metastatic glioblastoma. So you have brain cancer, and then the brain the tumor cells from the brain end up getting lodged in the lung, and so that one still hasn't read out, I don't think. I mean, I don't know. I like the valuation here. I think I would feel comfortable starting a position maybe. It's not the same exciting story that I think it was 2 years ago, but I'm not going to sell my shares either.
Yeah, so I was kind of looking at some of the recent updates. So the Optune Lua received FDA approval for metastatic non-small cell lung cancer. Commercial rollout was underway in the U.S. as of the time of their 2024 and Q4 report. They said that their phase 3 PANOVA-3 trial met its primary endpoint, which was statistically significant improvement in overall survival for patients with unresectable, locally advanced pancreatic cancer. They brought in net revenue of about $605 million last year, Q4 net revenues of $161 million. And the CEO of Novocure said that their kind of 3 main objectives this last year was growing their core business for glioblastoma, which we've talked about. That's a slower but quite mature market. Their launch in non-small cell lung cancer, and then delivering on the promise of their clinical pipeline. They said 2025 is a defining year for the business. We're entering a new era with a multi-indication platform propelled by positive phase 3 data in 3 indications, 1 FDA approved, 2 advancing towards regulatory submission. So a lot to follow for the business. I mean, their Q4 revenues were up 21% year over year. So there was some solid growth there. They delivered a gross margin of around 79%. Obviously, they're still unprofitable under GAAP. So interesting business.
They've got plenty of cash, so they're not going to,
they do.
Even though they're losing money, they're not going to run out of cash anytime in the near future. So that's one thing you don't have to worry about as a shareholder.
Oh yeah, 960 million as of the end of the year. So they've got a nice amount of cash on hand.
Yeah.
Cyber Mikey was also saying, I like health related stocks such as, I think that's Veritiv is the ticker, VRTV, Gilead, and Viva Systems.
Yeah, it could be also that it was a typo and it meant Vertex VRTX.
Yeah, I'm thinking maybe that might be the case. But are there any companies within the pick and shovel healthcare approach outside of these ones? One that comes to mind, at least for me, and I'm sure you have some thoughts, Brian, is Thermo Fisher Scientific, ticker TMO. For anyone who doesn't know this business, they basically make a wide range of scientific instruments, reagents, software, services, and consumables that they sell to researchers, laboratories, life sciences, and pharmaceutical clients. So they make instruments, equipment, software, and services for molecular biology applications, cell biology, genomics, proteomics research, as well as for drug discovery and development. They offer solutions for testing and then diagnosing diseases, including reagents. They also sell software for hospitals, labs, and research institutions to use. They're a major supplier of analytical instruments for chemical analysis and environmental testing. So they really have a wide-ranging business, and they have a history of being quite acquisitive, which has really helped them expand their product portfolio and just the reach of the business itself. The stock has not been a great performer, although the business is still doing pretty well. Their 2024 revenue was about 43 billion. That was flat year over year, but their GAAP diluted EPS grew 7% year over year. Revenue grew 5% year over year. In Q4 2024, they saw a 14% increase in GAAP diluted earnings per share. It is definitely, I think, a business that you could say is a pick and shovels play in the space. They have a really solid history as well of increasing their quarterly dividend over time, even though the yield is on the low end compared to the average S&P 500 dividend stock. So that's one business off the top of my head that comes to mind of the ones I study and follow in this space.
Yeah, I mean, I think one that I really like is Twist Biosciences. It's a pick and shovel. So that, so just to define pick and shovel, that's sort of companies that have biotechs as their customers. So they'll presumably make money whether the biotech is successful or not, the same way the people who sold picks and shovels to the gold miners were successful, whether the gold miners found success and found gold or not, right? So that's the idea here. So there's a lot of clinical research organizations, both ones that do preclinical discovery work all the way through clinical trial work. I would call Viva Systems, I would call that a pick and shovel because they're selling to the biotech industry. They've got basically SaaS products that allow the companies to either track their sales force, to help their sales force track the sales of their drugs, or even for companies that don't have drugs on the market, they help track preclinical work data and as well as clinical data, and help them get the clinical data into the right format for the FDA and EMA submissions. So they have that I would definitely call that a pick and shovel. So my suggestion was for Twist Biosciences. What they do is they sell DNA to companies, both companies and to researchers. And so what their claim to fame is that they can make DNA very cheaply, so much much cheaper, 10% the cost of all their competitors, and they do this by making it on a silicon chip, and they therefore can make a very small amount. And as it turns out, the researchers just don't need that much DNA. The current people that make DNA, they do it in a volume, in a solution, and you end up with thousands of times the amount of DNA that you actually need to do your experiment. So I've told this multiple times on full 24. But when I finished my PhD, I just went into the freezer and just dumped out boxes upon boxes of DNA that I used a couple of times for an experiment and then never needed again. And nobody else in the lab is going to use it because it was, just my experiment. And so, there was probably enough to do, 1,000 reactions, and I only did 2 or 3 and then moved on to the next thing that I needed to do for my thesis. And so I had all this extra DNA that in solutions that I had saved in case I needed to go back to it, but I didn't need it to complete my thesis. So I just I just ended up dumping them all into the, they all got autoclaved and thrown away. And so the moral of the story here is that they can make DNA that's much, much cheaper. And so it's not super fast. So if you need DNA fast, you got to pay the more expensive rates to get the DNA. But you can get DNA is literally overnight. If you order in the morning, you can get it by the next afternoon from some of these companies. But again, you're paying 10 times as much for the thing. So if you need to do a large experiment, it makes sense to wait, a week, a month, however long it takes for Twist Biosciences to make your DNA, because your overall cost for the entire experiment makes a lot of sense to be able to reduce it by 10%. And then they also partner with biotechs directly because they can make cheap DNA. They can make basically every possible antibody that you could think of. And they make a library of that, and then they can screen that library for the biotech companies. Biotech company says, I want an antibody that binds to this protein target of interest that causes the disease I'm interested in. And then they go and screen the library and then just hand the antibody back, and they don't do anything else with it except collect milestone payments and royalties on the sales of those drugs. So they get an upfront fee that covers the cost of them screening the library. And then there's a whole bunch of potential drugs out there, like 100 of them, where they've screened their library and given it back to a biotech company, and they're in different phases of the clinical trial, preclinical and clinical trial process. And so they're, not all of those are going to be successful, but even if only 10 of them are successful and they're, milestone payments of, a few $100 million, that's still a substantial upside without any downside risk, because they're not paying anything for that service. And then finally, they could potentially they have this idea that because they can make DNA really cheaply, they want to be able to store data as DNA, because DNA is very stable, a lot more stable than magnetic tapes, which is how long-term storage of data right now happens, other than just having boxes and reams of paper. If you want to digitize it and then save it, you have to put it on magnetic tapes, because that's the cheapest way to save it right now. But then those magnetic tapes degrade over time, and so there's a business where all they're doing is just copying magnetic tape to new magnetic tape, so that they, and then throwing away the old magnetic tape. Well, DNA is a lot more stable than this. And then if you ever did need so this is for data that, nobody's probably ever going to look at, right? I mean, obviously, if you have magnetic tape, you got to go get the magnetic tape, put it on the machine, read it. It takes a while, right? It's not something you're going to look up on the internet. You're going to have to order the data, right? But there's companies that have to archive all this data, even though they don't think they're ever going to need it. But just in case they do need it, they need to have it around. So this sort of data here. They could synthesize the DNA to store the data. Data is just zeros and ones, and there's 4 different bases. So you can just change the 2-bit 0 and 1 into 4-bit, and then you can synthesize the DNA. And then if you ever do actually need the data, then you just go read the sequence, the DNA, and then you go and then you just change the 4-bit back into the 2-bit, and then give them the actual data. So I don't know. I like Twist Biosciences a lot.
Yeah, one I thought of, but I don't think that this is a compelling buy right now, is Recursion Pharmaceuticals, right? Their platform, they use, they say they use AI and machine learning to, accelerate drug discovery and development. They've tried to identify themselves as a tech bio company. leveraging AI and machine learning to identify what would be promising drug candidates and accelerate, the drug development process. They do have a very large proprietary biological and chemical data set, and they analyze that using one of the most powerful supercomputers in the world. And they do have an interesting pipeline. And they recently unveiled something called LOW, which is an acronym. It's an LLM-based software that's capable of performing complex drug discovery tasks. But there's, I think, been some skepticism about the effectiveness of their approach and whether it can really, revolutionize the industry. And despite their platform, one of their lead candidates that they've been developing since I think 2013 at this point, which is called REC 994, it hasn't really shown strong evidence of benefit in reducing the size of cerebral lesions in its phase 2 study, and there's still no plans for a phase 3 study. They acquired a company called Exentia, I'm not quite sure how to say it, and their lead candidate was acquired from that purchase of Exentia, not something that their own AI platform helped them select. And that lead candidate is a small molecule CDK7 inhibitor that's being developed for numerous advanced solid tumor indications. But this is an example of a business that sort of has a pick and shovels element. But I feel like I'm still a bit skeptical of their ability to demonstrate the longevity of the business over the coming years.
Yeah, I mean, I think this is it's basically it's a biotech that also has sort of a pick and shovel in that they
Right.
they do some work for other biotechs and pharmaceutical companies to help them develop their drugs, and they take a cut, they'll just hand them off, and they don't have any other expenses, and they don't have any other, but they do have upside, so it's much like that part of Twist Biosciences, obviously completely different. One's screening a library, one's using AI to develop the best drug. I think that the company has shown that basically just by looking at their pipeline and looking at how long they've been doing this, that they can develop drugs very quickly, that they can figure out the pocket of the most small molecule drugs, and that's what they're developing are there's a protein, and you want to put something into the active site of the protein, usually to block it, but sometimes to activate it. And so they've figured out that they've shown that they can find molecules that bind to that active site. What they haven't shown yet is whether that and they've shown that they can do that much faster than the average company has been able to do in the past. What they haven't shown is whether those drugs are any better, right? And so, let's say they can. The average time from I have a target to I have a drug ready to go into preclinical development is probably like 2 years. Some happen faster, some happen slower, but the average time is probably 2 years. Maybe they're cutting off a year, maybe they're cutting off 18 months, maybe they can do it in 6 months, but they're of the total time that it takes for a drug to get developed is probably a decade or more, right? So
Right.
they're only taking off a very small amount of the very beginning. Also, when the drug is the least the development is the least costly. So we're not really saving that much time. We're saving little time, but we're also saving even littler percentage of the money that's going to be spent over the course of the development, because obviously like later stage phase 3 clinical trials cost a heck of a lot more than preclinical and discovery does. And so but if they can show that not only are the drugs getting developed faster but also better, then that would be a huge move that would justify their valuation right now. But I don't think they've done that yet, and so we'll have to wait and
Yeah.
see. But I like the company, and they certainly have shown that they can discover drugs quickly. But that doesn't necessarily mean that they're better. And if they're not better, then I don't know that they're really they're offering something of benefit to the biotechs and the pharmaceutical companies.
Yeah, I think
They're their clients, but they're not offering enough to justify their valuation, in my opinion.
Yeah, well, and I agree. And I know they're working with companies like Roche, and it's just interesting to me that one of their lead candidates is one they acquired, not one that their platform identified. And then one of the lead ones their platform identified a long time ago. It's just been a very sluggish clinical development process. So a lot to watch with that one. Cyber Mikey said, "Yeah, I meant Vertex instead of VRTV." And then Cyber Mikey had also said, "Yeah, that Vertex is their largest holding too." Interesting business. With that, looks like we're to the end of the hour. This was a fun one. It was sort of like a healthcare valuation hour.
Yeah.
I'm sticking around for one more hour here before I take a break. I'm waiting for Jeremy to be ushered here into the studio for our upcoming earnings related hour.
Yeah,
Hey, Jeremy.
I think I'm. Hey, how are you doing?
Doing good. Thanks, Brian.
All right. Have fun, guys. I'll be back on with Rachel in a few more hours.
Sounds good.
At what, 6, 7? That's 6.
6
o'clock.
Yes.
6 o'clock. 6 o'clock Eastern time.
Yes.
So we will see you then.
See you then. All right, fools. It's an earnings hour, although we're really at the end of earnings season, right, Jeremy? At least for a couple weeks.
Yeah, it's definitely a bit of a dry spell if you love earnings reports like we do here at Full 24. It's a bit of a tough time of year and a tough time in the quarter, but there were a few companies out there we can talk about.
Yeah, I guess it's a kind of a fun time to also look back a bit at the last few months, because there have been some really interesting ones that have reported, even at sort of the end of earnings season. We have businesses like Lululemon and Chewy this last week, Nike, I believe the week before, as well as some other heavy hitters. But, fools, if you have any questions related to the companies we're talking about or earnings-ish related questions, go ahead and get those in the Slido, and we will do our best to answer those.
I'll have to transition away from molecule talk.
We're transitioning away from molecule talk.
As I heard that was the first thing I heard from Brian when I logged in. So
we had a very healthcare centric hour for sure. There might be a couple questions in there I can still answer, but yeah, pivoting to earnings. But I'm curious, Jeremy. I mean, I've been doing this hour a lot, talked about a lot of companies over the last few months. I'm sure you have as well. Sort of looking back now, as we're in a little bit of a lull before things start to pick up again in a couple weeks, are there any really specific companies that have stuck out to you that you were sort of left an imprint on you in this earnings season?
Well, just a couple of companies that come to mind. Maybe last week's reports. Nike. I kind of can't believe that Nike stock is it's a real it almost seems like this tragic story at this point of the stock is at a 7-year low and revenue is falling double digits. I mean, I like the new CEO there. I feel pretty confident in him. I do own a Nike stock, so I'm still betting on a turnaround with them. But it's I think his strategy, which is really sort of geared to maybe correcting some of the mistakes that his predecessor made of sort of, I think, getting away to what the business's core strengths are, I think, as far as its brand and more of a brand focused marketing as opposed to, the kind of Google centric performance marketing that a lot of online brands do, getting back to those wholesale relationships like Foot Locker and other retailers that they've worked with for a long time. So I think he's saying all the right things, but and he's only been there 2 quarters, so I'm trying to be patient at this point. But we'd like to see. I think they said this current quarter is going to be the kind of trough of the comparison. So hopefully the worst or the steepest decline this will be the end of that. So we'll look for the stock climbing out of that, or at least the numbers there. But yeah, it's it's been a tough one for them, certainly.
Yeah, it's interesting because this is one I've talked about a lot over the last week or so since they reported. And it's interesting looking at the business, right? I mean, you think about how their strategy really ramped up to this direct to consumer model in a way that I think really ended up undercutting their growth, because they ended up sacrificing a lot of really long-standing relationships they had with wholesalers, like you mentioned. And that accomplished a couple things. It not only gave the competition an opportunity to sort of step in and forge those types of relationships in a more strong, robust way for themselves, but I think it was also a situation where Nike robbed themselves of potential growth opportunity by trying to really pivot to this, direct to consumer model. And now you're seeing, a completely new strategy, obviously, that Elliott Hill's unveiled. And as you mentioned, that is something that is going to take, I think, significant time to be able to actually implement and then see positive results from. This is not a 1 or 2 quarter sort of transformation. But I do think there's also fair criticism of, issues like Nike has not really done a great job of innovating their core line of products through the years. They have really relied on sales of these legacy products, which are classic, great brands, but not innovating in the way that you've seen a lot of their peers do. And I think over time, that inevitably costs market share. We've seen more recent developments from them, like the announcement that they're partnering with Skims to launch an entirely new line of products, and we haven't seen any kind of an announcement like that from them in a very long time. So that was interesting. Curious to see what those products and what the sort of fruit of that partnership will turn to be. But the thing that Elliott Hill has also said is really focusing on, quote, sport as our North Star, really shifting their strategy back to being around the core values of sport, aiming to inspire, connect with athletes of all levels, having products that are sort of made for athletes, by athletes, in partnership with well-known athletes, and having it be all about sports performance as sort of the underlying, through line for a lot of their products and their product innovation strategy moving forward. I like to think that over the long run, there are a lot of opportunities for this business to come out on the other side of this as a stronger company. I do think it's going to be a bumpy ride, and I still have questions as to whether going back to their roots, as Hill has said, and really focusing again on this sports-centric approach. And obviously working on repairing some of their relationships with wholesalers and other issues and weaknesses in their model the last few years. But it does make me wonder, is that going to be enough? And when do you start to see a turnaround? I think it's several quarters at least.
Yeah, I think I agree with that. They did mention there were some positive signs. And they, like you said, the Skims partnership is interesting. The company said they did get back to growth in running, which I think is, it's always been a big category. I mean, actually the first category they started with. And I think, a lot of investors certainly have seen, growth from, on holdings and, Deckers and the Hoka brand sort of come at the expense of Nike. And I mean, they're still gaining market share. I mean, I think, Nike was up mid-single digits in the quarter, but good to see some growth, getting back to growth in that category. I know that they talked about the Pegasus Premium, which is one of their newer running shoes as well. So yeah, I mean, I think as you said, yeah, I think the strategy of getting back to that, owning that performance, and I think if they can kind of dominate the the sports performance kind of line, that creates a halo effect for the fashion streetwear business, which is I think a model that has worked very well for them over their history. But yeah, I think they need to get back to that.
Yeah. Well, maybe I'll talk a little bit about one company that I kind of was paying closer attention to this earnings season than in past ones, and that was Dutch Bros. Sort of staying in the consumer-centric space. This one reported back in February, and I've talked about it on a few shows. This is an interesting business to me, right? Particularly the way in which, this is a business that's been around for 30 some years at this point, but they have really, remained true to their core model of having these drive-through locations, sort of this design where it's not really where you go and you sit and have the relaxing coffee house experience like you would at a Starbucks per se. It's much more designed to be a convenient on the go, way stop as you are going about your day to get your coffee or other beverage of choice. So they're known for their really efficient, drive-through operations that allows them to really serve customers quickly and minimize costs. A lot of their locations have little to no seating. Again, not really designed to be the place where you maybe sit and have a long, luxurious coffee. But that also has lent itself to a model that saves on overhead costs, is more, capital efficient. And that's worked for the business really well. They previously had a franchising model, but now they really primarily focus on company-owned stores. I don't think that they are franchising new stores. I think there are still some stores in their overall corporate count that are from older agreements. And they have a really strong customer loyalty program that has been key to their ability to really retain customers and drive repeat business. They're actively expanding their network of stores. I think their goal is to have about 4,000 locations within the next 10 to 15 years, which would be a significant uptick from their current store count. Just kind of giving a little bit of color to some of the numbers there. In 2024, they opened 151 new shops. 128 of those were company operated, and that was across 18 states. Total revenue grew 33% year over year to about $1.3 billion. Their system same shop sales increased 5.3%. Company operated shop revenues increased 36% year over year. They also reported that their net income was $66.5 million compared to $10 million in 2023. So more than 6 times their net income a year ago. They're looking to open at least 160 new stores in 2025 alone. They're targeting revenue of around $1.6 billion, which would be a nice bump from the $1.28 billion that they just reported in 2024. It's interesting as well. They said what would this have been? Yesterday, actually, they announced that they're entering the consumer packaged goods market. So they said that they're going to be launching packaged coffee and related products to be sold in retail outlets. This is obviously a model that, these bigger international rivals like Starbucks have been known for a long time. They said, we're going to be launching a line of Dutch Bros packaged coffee and related products to be sold in retail outlets in partnership with Trilliant Food and Nutrition. Trilliant is one of the largest coffee manufacturers of single-serve cup and ready-to-drink coffee in the U.S., has products available in more than 50,000 retail stores across the country. They said this is a significant milestone in the company's growth. They think it'll create a new and exciting way to bring the unique Dutch Bros beverage experience directly to consumers' homes. Again, this is a company that was founded in 1992. They have just shy of 1,000 locations across 18 states. So again, their goal of having 4,000 in the next 10 or more years would be a significant uptick from that current number. This is a business that I have found really interesting. One of the other things that stuck out to me from their recent earnings call was the fact that they said, most of their sales are all about beverages. They really don't have a significant food aspect to their business. And that's something that management really wants to change and innovate moving forward over the next few years. They think that there's a real opportunity for them to tap into, unaddressed spend from consumers who might be going and grabbing their morning coffee and then would also be inclined to grab, some type of a breakfast item. But the other thing that really stuck out to me as well from their earnings call was that they only more recently really launched mobile orders and making that a bigger part of the business. I think mobile orders been around for a while, but they had not really adopted that widely. And they were saying how, a significant number of their stores are now, basically fully integrated and seeing really strong mobile order growth. But it was amazing to me that the company has been around this long and that this is really only a more recent addition to being a growth driver for the business. That was fascinating to me. It was their first in Q4. their first full quarter of mobile order, and they said we're beginning to see the benefits to our business. But again, this is something that you think would be a given for businesses like this nowadays. But as of December 31st, approximately 96% of system and 99% of company operated shops were at mobile order functionality. Their rewards customers placed about 5.4 million mobile order transactions by the end of December. And as of December 31st, approximately 8% of their channel mix was mobile orders, which was an increase quarter over quarter, but still obviously leaves a significant portion of their overall channel mix still unpenetrated. And they said, we observed that customers who use mobile order increase their frequency. Mobile order penetration is more than twice the level of our overall system in some of our newer markets. So a newer line of business for Dutch Bros, that was very surprising to me, but still seems to be something that is doing well, even if they're perhaps a little bit late to the mobile order party. But this selling of packaged Dutch Bros coffee that they announced yesterday, curious what that's going to look like for the business moving forward.
Yeah, I think you made some really good points there. Yeah, Dutch Brothers, and just to talk about the coffee industry more generally, as I was thinking it as you were sharing that. I mean, it's funny that Starbucks has never really had a true rival. I mean, I think you think of maybe McDonald's, and there's Burger King or Wendy's. I mean, maybe Dunkin' was that at one point, but I think that really didn't quite materialize. But Dutch Brothers, I mean, it's a huge market what Dutch Brothers is penetrating or competing in, and I think in some ways they're following a lot of the playbook and the steps that have worked well for Starbucks. I mean, certainly that channel, what they call channel development at Starbucks, with selling. I mean, once if your brand is known, I mean, it's same thing with Dunkin'. Why wouldn't you sell ground coffee in supermarkets and convenience stores and wherever else you can do it, do the K-cups and that sort of thing, and what was the other thing I was going to say? Oh, and then you were right. The mobile ordering. I mean, Starbucks is sort of almost had too much success with the mobile ordering. They've been overwhelmed at their stores. So, I think maybe because Dutch Brothers is a drive-through model, they didn't see quite the same need, or desire to invest in it as Starbucks did. But it's certainly. I mean, I think a coffee shop business model is all about convenience. So, it certainly adds an element of convenience for customers.
Yeah, kind of interesting to look at. Well, maybe before we dive into some questions, I don't know, were there any other companies that you were looking at this earnings season that left an impression?
Well, looking forward to next week as I'm definitely anxious to see or curious to see how Tesla's deliveries that looks like. Obviously a company that's been in the news a lot, but it's funny as investors too. It's often hard to tell what's the signal and what's the noise. So I am curious to see if some the data out of Europe was pretty weak for them, but it's sort of there's been this sort of brand backlash as well. But I don't know if that'll be meaningful in the large scale. So it'll be interesting to see what those numbers look like.
Yeah, it'll be fascinating to watch, I think.
Yeah. Anybody you have your eye on?
I mean, I think right now, as we're in a lull, I'm finding myself really just going back through some of the earnings of companies I report on and follow frequently. I see we had a question I'll get to in a little bit asking about Lululemon versus Ulta. Those are a couple companies I followed pretty closely this earnings season. I'm not sure when they're going to report their full year results, but Elf Beauty is in this next round of earnings one I'm going to be watching pretty closely. So they reported their Q3 results in early February. So I'd expect we'd see their full year results in maybe a month and a half or so. But that's a business that's been interesting. I've talked about it a lot, really beaten down by the market. They have seen some deceleration of growth compared to prior quarters. But this is still a business that, net sales grew more than 30% year over year in Q3. This is a company that's been doing a really great job in terms of profitability, continuing to expand, both within the color cosmetics and prestige as well as mass markets, and doing a really good job of expanding internationally. They had kind of famously had some bad response to the stock when they announced that they were slightly decelerating their outlook for their fiscal 2025 from 28 to 30% year over year growth to 27 to 28% year over year in net sales. It's certainly a deceleration from some of the 70+% growth rates I think some investors have gotten used to in recent years. But this is also a business that is much more mature than it was a few years ago, and is broadly expanding into some really key international markets, including here in Europe and Italy, where I am, in Germany, the UK, Mexico is another area that they've recently been launching into, Australia as well. And they have a really extensive network of retail partners. And unlike Ulta Beauty, they do not own and operate, their own stores. And so I think that has given them a bit of an advantage. Historically speaking, the beauty space has been somewhat resilient in times of economic unrest, if you will. There was this term that was famously coined, I think, during the Great Recession by I believe it was the chairman at the time of Estee Lauder, called the lipstick index, and this idea where even in periods of economic difficulty, these sort of small dollar value beauty oriented purchases that make consumers feel better, we still see people spending money on those things. Obviously, this is a different market and environment than it was at that point in time. So we will have to see how the trajectory of consumer spending impacts this business. But I still think over the long term, this is one that in what is a fairly volatile consumer spending landscape, I still think this is a company that wins in the long run.
Yeah, I mean, I think it's funny that it's sort of too bad. I think Elf has gotten a bit of a negative reputation among some investors because of what we've seen happen with the stock, which is sort of skyrocketing and then coming down as that growth has decelerated. And we've seen similar stories like that play out in the consumer goods space. It reminds me of Celsius Holdings in a number of ways, but still. Cosmetics is a mature market, so it's even if they're able to grow, like you said, 27%. I mean that's still a very impressive growth rate, and it seems like they've done a lot of things right. I do, yeah, as you mentioned as well. I do think it's interesting that technically, right, beauty products are considered consumer staples, so they do tend to be maybe more resilient in a downturn than you might think. So, maybe another reason to can take a look at a stock like that.
Yeah. We've had some questions coming in. If you want to look through those, Jeremy, there's one question I wanted to hit that came in a couple hours ago about a healthcare business. This is a space that I widely follow and report on. So I wanted to take this one. Indie Pharma D said 2 hours ago, do you have any thoughts on DHR, which is the ticker for Danaher Corporation? So for anyone that's not familiar with this business, they are a global science and technology company. They design, manufacture, market products and services for the life sciences, diagnostics, and biotech companies. Life sciences businesses, these provide tools and technologies that enable scientific research and development. They sell instruments, reagents, and consumables, for example, that are used in labs and clinical research facilities. Their diagnostic business really focuses on offering solutions in a wide range of healthcare settings, from local clinics to major hospitals. So they sell, testing instruments, for example, for medical diagnostics, life science research, and industrial testing. They have various medical diagnostic solutions, life science research tools. They also manufacture and market professional microscopes. They provide reagents and mass spectrometry instruments for areas like genomics, proteomics, and metabolomics. They offer a range of genomic consumables as well for DNA and RNA analysis. They even have various filtration and flow cytometry technologies that are used in areas like biopharmaceutical manufacturing and research. So they make money from sort of a wide range of sources. As I mentioned, they have a pretty extensive portfolio, but broadly speaking, falls into equipment, instruments, reagents, consumables, and software that's used in research diagnostics by various healthcare organizations. And they have been dealing with some headwinds recently, which has been reflected in somewhat decelerated growth. The stock itself has also struggled a bit. Shares are down about 18% over the trailing 12-month period. And there's been a few factors there. They had missed some earnings expectations in recent financial results. Their diagnostic segment, which, as I mentioned, is a really key business line for Najarro, underperformed. Revenue in that business also declined single digits year over year recently, but operating profits fell about 19%. They've also been facing some challenges in their higher growth international markets like China, which has contributed to some of the declines that the company's seen in its life sciences and biotech divisions. And then there's also the reality that demand for some of its life sciences products is influenced by biopharma budgets and academic research and development budgets. And that has also been challenged in the last few years. And that is also a reality that could impact the business now. So there's been, some different factors going on with the business in terms of how they're doing, financially. When they reported their results for their fiscal 2024, net earnings were about $3.9 billion on revenue of about $24 billion. Revenue was flat year over year. Operating cash flow was about $6.7 billion for the 12-month period. Now in Q4, their revenue increased about 2% year over year. They also brought in operating cash flow of about $2 billion in the final 3 months of the year. So, I think that this is still a solid business over the long run. I think that some of the challenges they're facing right now could be short-term in nature, but again, understanding that the shifts in some of their key international markets like China, as well as the trajectory of funding and spend by some of their life sciences and biopharma clients is something upon which, Najarro's business is pretty reliant. We've seen some comments from management that they have, overall pretty resilient order trends in bioprocessing. They've been witnessing market share growth in areas like molecular diagnostics. They're still a leader in selling scientific instruments and consumables in the life sciences and diagnostics industries. This is obviously a company they've been around for decades. I still think there's a potential for rebound and growth for this business over the long run, but some of the headwinds I mentioned, at least for the near term, I think will probably continue to impact the business, even though broadly speaking, they are remaining profitable and they are delivering pretty solid operating cash flows.
Yeah, thanks for that rundown there. I can take a question that just came in from Cyber Mikey, and I guess that's why I did bring up Tesla. So he said, I reduced my position in Tesla from 4% to 3.5%. I still believe in it and plan to hold for 5+ years, but it is a bit risky for my 20-year retirement plan. Yeah, I mean, I think, I'll maybe answer that in two parts. I mean, I think, if you're a retiree, you have a shorter investing horizon, I think, there's a portfolio strategy, or, you can offset a growth stock like Tesla, I think, with safer investments. So I don't, I'm not going to speculate as to what the rest of your portfolio is, but I think there's some balancing there that you can determine for yourself what's appropriate. And then as far as Tesla, I will say that I mean it feels about as risky as it's been, and really it's always, I guess it's been pretty risky stock for a long time, and it has been certainly it's done well, and I think Tesla and Elon Musk have a long history of proving the doubters wrong. Though it does, I mean, it almost feels like I don't know what isn't a risk for the company at this point when the financials have been really pretty weak. Flat growth in the auto business last year. Of course, the political attention on Musk hasn't been great for the brand. Seems like the European sales, according to registrations, were down about 42% in January and February. The Cybertruck, the National Highway Transportation Safety Association just issued a recall for pretty much every Cybertruck on the road. And then, I think at this point, and Musk has really set it up like this, where the company and the valuation is tied to if it can kind of pull off this robo-taxi network that he's been hyping for really years now, and it does seem like it's pretty close to kicking off. It's supposed to start in Austin, Texas, this June. So certainly something if you're a shareholder, something you want to watch. And I can I think it's certainly that's an opportunity for the company, and he said it'll make Tesla the most valuable company in the world, and Kathy Wood I think said this week, who's runs the ARK Invest growth stock fund manager, said she gave a price target on Tesla of $2,600. So in the next 5 years, so a 10 bagger go over that time. So I think there's a lot of upside potential if that works out, and then there's a lot of downside potential, downside risk if it doesn't work out. So yeah, I mean that's at least that's how I'm thinking about Tesla these days.
There was a question that had come in from Ed about Wolfspeed, ticker Wolf, WLF. Ed said, I don't follow the stock, but I see it lost 52% of its value today. I've heard contributors talk about it in the past. Any comment? This is one I don't follow as closely, but I know a little bit. And so I was looking into what was happening with the stock today. Actually, they announced a new CEO. That was the biggest development today after their CEO last year was fired, and a longtime company leader had been serving in an interim capacity in that position. But there was also some updates with regards to funding. And those are two things that while the announcement of a new permanent CEO would seem to be positive news, the market seems to have responded quite negatively. And more of that may be related to some of the funding updates they gave, which I'll mention in a minute. But basically, for anyone that doesn't know this business, Wolfspeed is a leading developer and manufacturer of wide band gap semiconductors. They particularly focus on silicon carbide and gallium nitride materials and devices for power and radio frequency applications. They are a pioneer in this space. And that the other thing that is, I think, important to note as well is they've been facing some major challenges in the last few years. As a leading manufacturer of silicon carbide and other semiconductor components, they've been seeing a slowdown in demand from their automotive customers that has significantly impacted profitability, very high costs, including factory startup costs, underutilization costs that have really strained their financial position. They've dealt with production issues at one of the largest production plants for silicon carbide wafers, which is basically what its chips are built on. And that had really stifled manufacturing at its chip plant in New York. The company has made a range of cost-cutting measures in recent times, including closing a semiconductor fabrication plant in North Carolina. They laid off a significant portion of their workforce. And again, their plant in New York had been operating at only 25% utilization, a key plant for them because of tech issues and delays with manufacturing devices. The other thing as well that's worth noting is Wolfspeed is very reliant on federal funding, particularly from the CHIPS and Science Act. And they had secured a non-binding preliminary memorandum of terms, what is known as a PMT, for up to 750 million to support a new silicon carbide wafer manufacturing facility in North Carolina. And today there were comments from the outgoing interim executive chairman that raised some concerns that they could lose out on millions in federal money from the CHIPS and Science Act. There were comments, I'm trying to find the exact quote, if there is one. According to, let's see, Axios, Thomas Werner told reporters the company is being managed so as to be not overly reliant on CHIPS funds or incentives. So last October, Wolfspeed had signed a preliminary agreement with the Department of Commerce to receive up to $750 million in direct funding from the CHIPS program. And then it also expected to get $1 billion in tax refunds under the Advanced Manufacturing Tax Credit. That's also a part of CHIPS law. And the company has been planning to use the money along with $750 million from that consortium of investment funds that I mentioned as part of the expansion of its operations in North Carolina and New York. Werner, who again was outgoing as executive chairman, added that Wolfspeed anticipates a final decision on the CHIPS grant by late summer. Although they believe that legislation might change. Thomas Werner has been serving as the interim executive chairman since the firing of former Wolfspeed CEO Greg Lowe in November. And prior to that was when Wolfspeed had been dealing with this longer term restructuring plan that it initiated, including, facility closures, consolidation. The new CEO is a former executive at Micron Technology, Robert Furla. He will take over the CEO position on May 1st, and Thomas Werner will return as chairman of the board following that transition. But despite the announcement of a new permanent CEO, and again, someone who has, very experienced, has worked at companies like Micron Technology, that seems to be one of the bits of news that really impacted the stock. As I mentioned, they manufacture silicon carbide and gallium nitride materials for a lot of different applications, but including electric vehicles. They had said as well that they received about 192 million in cash tax refunds, and those are part of an expected 1 billion total in Section 48D cash tax refunds. But it would seem that as I'm looking at this news, in addition to the woes the company has been struggling with for a period of months now that have impacted the business, the two biggest bits of news, comments from the interim executive chairman that raised some doubts about whether the company might receive the millions in federal money from the CHIPS and Science Act, probably had more of an impact on the stock than the announcement of the new CEO, which again, broadly speaking, seems to be a good choice. By all accounts, from what I can see, there were certainly no definitive comments that they will not receive that federal money, but more that there are concerns about the finalization of that total, and that they would most likely have more information on that, later this summer. So that is something that could obviously impact the business, which is already dealing with significant debt. And was heavily reliant on that money to support their new manufacturing capabilities, something that had already been significantly strained by the undercapacity of their New York plant. So yeah, those are the key updates of what seems to be moving the stock today.
Yeah, definitely not a good sign if if you're having funding problems. I do wonder if that's maybe related to the macro environment, because it ties in a bit to this next question I was going to get to. Let It Ride here says CoreWeave just opened at $39 and has been trading around that price. How do you value a brand new IPO? Yeah, I mean, the IPO market has been pretty dead last couple of years, which is sort of strange for a bull market. But yeah, I think CoreWeave is one of the more exciting IPOs to come on the market lately. So and it's really a pure play AI stock, which we haven't really seen too many of those either. But generative AI focused cloud infrastructure platform. So they count NVIDIA and OpenAI as two of their sort of more, better known, higher profile investors. And the company is, this is sort of just incredible growth. They went from 16 million. They sort of did more than 100x, more than 100 times their sales from 2022 to 2024. So they went from 16 million in sales to 1.9 billion. They are pretty solidly profitable on a GAAP operating income basis, 17% operating margin. Their bottom line net loss, they did report a loss due to the loss on fair value adjustments. So I'm going to suspect that that's related to equity investments or something like that they hold. So how you value an IPO? IPOs do tend to be volatile. So I think it's funny, and usually they move a lot on their opening day, which did not happen with CoreWeave. I know it's from what I read the IPO is a bit undersubscribed, or lower interest than the company had expected, which also maybe ties into that issue with Wolfspeed, or maybe the macro, the market level sense about tech sector these days. But I think a stock like CoreWeave, if you have operating profits, certainly, and I didn't get the chance to see the cash flow, but I think a profitable company is generally much easier to value than an unprofitable company. And it looks like they're trading at about 7 times trailing sales. I don't know. I haven't seen if they have put out any guidance for this year, because they're coming off a year of 737% revenue growth. So pretty outstanding. I think at that valuation, if any kind of growth that we've seen from them continues, I would say that's pretty attractive. I'd be curious to see where the stock settles after a few days, because I think it went. The data I'm looking at, right? It looks like it opened at $39 and closed at $40. So it did gain about 2.5% on the day, but pretty stable, I'd say. But yeah, I think in general, a company like if an IPOs, a lot of times we see unprofitable tech stocks and that sort of thing go public. But I think a company like this, I would just look at those, the usual numbers that you'd use for to value any other stock.
Yeah, I think they still had a pretty steep net loss under GAAP last year. The other thing that stuck out to me about this one is, their revenue is really heavily concentrated among a few key companies. 2 companies make up more than 70% of their revenue, but I think Microsoft accounts for about 62% of their total net sales as of 2024. And Microsoft is also a rival in a certain way. So it's an interesting business, but I'm curious to see how this is going to shake out. But it is the largest tech IPO we've seen since 2021, despite its somewhat scaled back performance. They had previously been planning to offer shares at a higher premium than the 40 they ended up settling on. So it's interesting to see the response, and I do think some of that's a function of the environment we're in. Let's see. Oh, Cyber Mikey had commented on some prior discussions. I have a position in VLTO, a spinoff of Danaher, great company. Veralto Corp. Yeah, I don't know that one. I'll have to look into that. And then Cyber Mikey had also said, from molecules to athleisure and vanity. Yes, a wide range of discussion points on the show. This was another question also from Cyber Mikey. If you had to pick one, Lululemon versus Ulta. I've talked about both of these a lot in detail. I think Ulta is a turnaround story. Ultimately, I think that over the long term, I'm hopeful of where the business is going to go under new leadership. Ulta is a company that I think has been struggling due to a range of factors. There's obviously heightened competition in the space in which Ulta operates. They are, one of the largest, I think, if not the largest beauty retailer in the U.S. But they have longstanding partnerships, with other major retailers to sell their products or have their stores located adjacent to them. But they have that very, kind of older beauty model of the brick and mortar stores, very capital intensive. And while businesses like Sephora have somewhat similar, Sephora is a major international brand, and they're continuing to grow really strategically, but in a successful way. e.l.f. is obviously, as we talked about earlier, they don't really own and operate their own stores. That's sort of the newer iteration, I think, of what the next generation of the big beauty brand looks like. I think Ulta has really struggled to innovate in a time of really changing consumer spending patterns and habits, and the way that people shop for beauty is different than it was 10 or 15 years ago. And I think that all of these elements, increased competition, changing, shopping habits, and changing habits, broadly speaking, within the beauty industry, have impacted Ulta's business. They are still profitable. They had a very, very sort of slow year of growth in their most recent fiscal year. Their revenue was down slightly, or at best flat on a year-over-year basis, although comparable sales were up slightly, I think by a little bit less than 1%. And they are still profitable, but this is a business with an uphill battle ahead. I said before, I think this is something where new management could really breathe new life into the business, but there's a real road ahead. Lululemon, I think, is a great example of a athleisure giant that is continuing to do really well in what is a competitive and highly fragmented space. Something Lululemon is really in the midst of, and actually at the tail end of, is their Power of 3x2 growth strategy that they announced a few years ago, which was essentially about expanding their international revenue, their menswear line and business, as well as extending revenue to $12.5 billion by the year 2026, which would be double its revenue in 2021. And they look well on their way to achieving that goal. And their international expansion, I think, is broadly speaking doing very well. I saw there was some mixed reactions to the stock after they reported yesterday. They did beat on what analysts had been projecting, but like a lot of management of some of these companies that we've seen in this earnings season, management cited inflation and that economic concerns are weighing on spending. I think that's something that is fairly inevitable, and is also something that is not just going to impact businesses like Lululemon, but obviously, investors hate uncertainty. And I think that some investors are shying away from some of these businesses that are seen as being more, reliant on discretionary spending. But I still think over the long run, this is a pretty resilient business. And I do think that it's a company that does well. I think that Lululemon has shown that they are able to expand very successfully while also remaining profitable and growing their cash position and doing so in a very strategic and profitable way. Kind of just looking at some of their top results again in 2024, which again, these results just came out yesterday. Net revenue grew about 10% year over year. America's net revenue increased 4%. International net revenue increased 34%. Let's see. And then excluding net revenue from the 53rd week of 2024, net revenue still increased 8% year over year. They also reported, operating margin was up 150 basis points. Their income from operations increased 17% year over year to $2.5 billion. They added 56 net new company-operated stores during the year, including 14 company-operated stores from the acquisition of the Mexico operations. And then another thing that's worth noting as well, the pace of growth they're seeing outside North America, which is their most mature market, is really stunning. Part of their longer term growth strategy has also been really focusing on expanding in China and in Europe. China mainland revenue increased 46% at the end of last year, and now accounts for 12% of total revenue. And then the rest of the world net revenue, which is basically everywhere that's either not North America or China, in which Lululemon has a presence, that revenue increased 30% year over year, and now accounts for 11% of total net revenue. So for me, not only does the company seem to be well on their way of achieving the goals they set out to reach by 2026, but they're doing a really good job of expanding. They've grown from being really known for women's wear and athletic wear and footwear to they have children's lines, they have products for men, they have this sort of burgeoning international presence. They are launching location country specific e-commerce stores as well as brick and mortar stores, and they are seeing really impressive growth internationally. Of these two businesses, Lululemon is definitely the one I think I'm more intrigued by right now. I think that both of these companies are very much impacted by shifts in consumer spending. I think that Lululemon is, broadly speaking, more resilient. I think there's much more versatility for its products, and I think the company has proven that it's in a much greater position of financial and business strength compared to a company like Ulta. But I think it's important to recognize, looking at these businesses, over the next 5-10 years, I think that Ulta probably gets back to solid growth. Over the next 5-10 years, I think Lululemon becomes an even better, more superior business than it is now. In the short term, though, even with a company that I think has been as intentional and successful with its growth story as Lululemon, I still think you're looking at a situation where if consumer spending continues to slow or change or shift, there will be some impact. I think that, broadly speaking, goes back to the guidance that we got from management, which is still solid growth. It's decelerated from where it was a few years ago, but this is a much more mature business now. And the macro environment does impact retail businesses. That is just an inevitability, I think, if anyone, for anyone investing in this space. But yeah, Lululemon is definitely one of these two that I probably find more compelling at this moment in time.
Yeah, I think I agree with you there. I mean, I took a look at Lululemon's earnings report as well, and very, very strong growth numbers in the fourth quarter, and it seems like the guidance kind of shook investors there with the 15% sell-off. But this is I think maybe one of the more surprising growth stories of over the last 10 years or so. When you go back to they had that I remember they had that pant recall a long time ago, and it sort of seemed like that early kind of young growth stage company was over, and they're I think the athleisure business too that they basically created has become commodified a bit, but they've continued to find new ways to grow. They've maintained that higher end price point, and I think I don't know if this will be true this time, but I know in past sort of economic slowdowns they've still performed well or better than you'd expect, because they do have a higher end customer that might be more insulated from some economic downturn kind of thing. So yeah, I mean I continue to be impressed by Lululemon. I'll take we'll stay in the apparel sector. I'll take this question from Kent 3 hours ago. And sorry, but I don't know if that my technical problems disrupted you at all, but apologize for that as well.
No, I just kept gabbing.
Yeah, you did, yeah. But yeah, Kent says, how attractive does Deckers look at current levels? And I was going to mention with Lululemon and Deckers too. I mean, the apparel sector, most apparel retailers have not done well in the last few years. It's discretionary spending has been pretty weak. So I think the companies that we talked about Nike at the top of the show, which is certainly had a couple ugly years. The companies that have done well are doing well in a challenging market. So I think they definitely deserve credit for that. And Deckers is one of those that it kind of continue. Yeah, I mean, I think to answer your question, I mean, I do think the valuation has pretty attractive. It continues to be one of those, maybe it sort of fits into that Elf, beauty bucket that, you were talking about Elf before as a company that, maybe their growth, I don't know if it's slowed exactly, but it's maybe not quite as fast as it's been at its pace recently, but still very strong. They have a pretty, I'd say, strong track record of success with both UGG and Hoka, and I think UGG might still be the larger of those two brands. Maybe I guess this is a winter quarter I'm looking at, so but UGG's very seasonal. But the growth in those two brands, which makes up pretty much the whole business. I mean, Hoka's up 24%, UGG's up 16%. Overall revenue of the company up 17% in that holiday quarter, which is the fiscal third quarter at Deckers. So I mean, in footwear, which is another fairly mature category, I'd say that's pretty stellar growth. And I think like Lululemon too. Both of these companies trading at a price to earnings ratio around 20. So I think the market has really soured on some of these consumer discretionary growth stock. I mean, Deckers down. Wow, I did not realize this, but down about 50% now from that I think that earnings report back at the end of January. So pretty steep decline. But I mean, I'd say personally, I think that's probably overdone. But maybe it just reflects that broader macroeconomic concern that has driven the broader sell-off.
There was a question I wanted to hit really quick. Okay, where did it go? Let It Ride was saying 4 hours ago. Any thoughts on the short report for Kyndryl? I know we have just a few minutes left in the hour, but I wanted to hit this one. For anyone that's not familiar, Kyndryl was a spinoff, or is a spinoff of IBM. They manage the IT infrastructure of various businesses, whether it's from IBM or another vendor. They, they help companies transform their legacy operations by moving IT services to cloud hyperscalers like Amazon, Google, and Microsoft. But they are primarily known for their managed infrastructure services. And helping designing, building, managing, and modernizing enterprise IT infrastructure for business partners. They've been in a bit of a transition phase where they are working on winding down older, more unprofitable contracts that they had inherited as part of the spinoff. These lower margin contracts, which means in the short term there is a hit to revenue and margins, but in the long term, I think that really primes them for better and more sustained growth. So there's a few companies that have been asked about in recent days regarding short reports, but there was a short report that came out from short seller Gothic City Research yesterday. The report alleged that Kyndryl has manipulated some of their metrics. Kyndryl issued a response rejecting the report, calling the claims inaccurate and deliberately misleading. Shares of Kyndryl nosedived about, I think, 10% yesterday in response. But Kyndryl said the short seller report issued this morning in relation to Kyndryl contains claims, and again, I'm directly quoting, that are inaccurate and deliberately misleading. They said Kyndryl rejects in the strongest possible terms the conclusions reached within the report, which was clearly designed to manipulate the company's stock for the short seller's benefit. They said, we believe that our accounting and disclosures are correct, accurate, and in accordance with all applicable reporting requirements. The other thing as well, there was, for example, kind of public responses from firms like JP Morgan. They dismissed the report's claim that Kyndryl faces an additional $1 billion to $2 billion in incremental costs from IBM. They called that estimate exaggerated. The brokerage said the report does not dent, quote, its overweight rating, maintaining their $45 price target, pointing to Kyndryl's strong visibility into near-term revenue trends. So this is sort of a tale of something that we see from time to time. Short sellers who will indeed benefit if shares of a company like this tank. will, release allegations. Sometimes we see a very robust and strong response from companies. We certainly did in this case from Kyndryl. There were also numerous brokerages that reiterated, their stance on the stock. Take that as you will. But worth noting, we don't always have such clear, responses. There was a comment from Bank of America saying, Kyndryl could improve their transparency, but investors already understood some of the issues raised in the short report. So that is sort of what is happening there. I always tend to take these types of reports with a grain of salt. I appreciate how quickly Kyndryl responded to this one. I think it's something where we're broadly seeing a response that is negative in the market, is probably benefiting the maker of that report. There's not really a lot of evidence that we've seen provided to underscore the allegations contained in that report. Kyndryl's response was pretty, fast and robust and to the point. So I think this is something that the market will probably digest and move on from eventually. So I think it's always important to pay attention to these things, but understand that these are also somewhat normal occurrences within the state of the market. We tend to see a lot of reports from short sellers on really well-known companies from time to time, often with similar allegations. Some of them may, in fact, over the long run and life cycle of a business, turn out to be founded, but there's nothing we're seeing, at least regarding from this report, that would indicate that to be the case.
Yeah, it seems like maybe we've been seeing more short reports lately with just the kind of high valuation in the market or something like that. I know Apple Oven has been gotten attacked by like three different short sellers in the last month. So I don't know if there's any fire there, but it seems like more often than not, usually there's the allegations are either exaggerated or unfounded. But I think it's always good to look into that.
Yeah. I think we're at the end of the hour here.
Yeah. Thanks for
looks like
joining
Toby
me here.
Coming in.
Toby's coming on.
Hey, Toby, how's it going?
Good. How are you guys doing?
Good.
Good.
Well, I'm gonna bow out for an hour, and then I'll be back in 1 hour with Brian.
All right.
All right. Thanks,
See you
gentlemen.
later. All right, Toby, fresh off vacation, back with them, back with some new insights. Pretty good. How's it going?
Good. So we're just talking about the news of the week, right? Doing a little roundup about what's going on. And...
Exactly. I got a little slide I'll share with the audience here. Nice to do a little news summary, I think. At the end of the week. Tell our graphics team has been working hard at this one all week. So
nice. Our graphics team, does that mean you?
Exactly.
Nice. Love it.
Yeah. So right. So I think you could see that, right?
Oh, indeed.
Yeah, so I got the well, this isn't exact because I did it a little bit before the market closed, and it seemed like stocks might have gone down a little more than that. But stocks were definitely down for the week. 1.5% or so for the S&P 500, even worse for the Nasdaq, which tends to be a little more volatile due to that tech exposure. The major, I think, it was definitely a macro-driven week. We saw stocks jump. Monday, when it seemed like worries about tariffs were cooling off. Wednesday, Trump announces this 25% it should be tariff there on car imports and imports of some car parts. We also have reciprocal tariffs coming next week, so we'll see how that plays out. But yeah, that drove a sell off on Wednesday, and then today we had the PCE inflation report, personal consumption expenditures, which is the one that the Fed tracks. That seems like the CPI gets more attention in the market, but this is the Fed's preferred inflation measure. So year over year, PCE was up 2.5%, core up 2.8%. I put this chart up here too. You can see that. The Fed really wants to get inflation down to 2%. That's their goal, and I think it's you look at the PCE line, and it was pretty close to that back in September, and you'll remember that's when the Fed started lowering interest rates. It kicked it off with a 50 basis point rate cut, but we've seen, I think, two decisions in a row, or two no rate change decisions, and basically at this stage, both the core PCE and the overall PCE is pretty much at the same level they were a year ago. So not really making much progress on fighting inflation. Consumer confidence also continuing to go down. I think the overall number from the conference board had a 4-year low, and then sort of future expectations, they call it, was at a 12-year low. So it seems like consumers are feeling nervous about the direction of the economy. Talked about we just talked about Lululemon on the last hour, but yeah, we had or slow season for earnings, but a couple some full stocks that get attention there: Chewy, Lululemon, and Cintas, and then CoreWeave had an IPO today. Sort of exciting news in the IPO market. I know, Toby, you wanted to talk about that one. We could kick it off there.
Yeah, let's talk about CoreWeave a little bit. This was pretty heavily anticipated. Do you know much about this business, Jeremy?
I've been looking into it a little bit. Yeah, it's definitely intriguing, I think. Pretty unbelievable numbers as well.
Yeah, it's a cloud computing company. They do AI infrastructure stuff. NVIDIA was an investor in CoreWeave. I think still is. I think they're still in a little bit. NVIDIA is an investor.
OpenAI as well.
Yeah, exactly. Right. So there's a lot of excitement about this company coming public, right? And it came public today. Started trading today. The anticipated range that they were given a couple of weeks ago, $47 to $55 a share, right, was what they were thinking they were going to price the IPO at. At the high end, that would have been about a $32 billion market cap for the business. Now they come public today, Jeremy. The IPO price at $40 a share, right, which is a lot less than the low end of that initial range we were given. It's about a $23 billion market cap on that. The stock traded down today, actually, which you don't normally see, like what you want to see, or what the underwriters hope to see is a pop on the day, right? You price it and you pop over that, right? And that IPO price is just a theoretical price that people get who buy in, who are allocated shares, and you sell it for a profit and you move on with your life. Everything's happy, right? It actually dipped below $40 a share a little bit, dropped a little bit. It did recover to that. I think it closed around 40 today. But that's not great. One, a drop below the range, well below the range. Two, falling even below that when trading started. So not a great showing for the CoreWeave IPO right now. A couple of things here, right? One concern, I think, if you looked at the S1, you would have noted that Microsoft accounted for a ton of the revenue, right? Like 2/3 of 2024 revenue was Microsoft. I mean, it is what it is, right? But it's a red flag, right? You don't want to have that amount of customer concentration. If one company, one customer has that, like 2/3 of your revenue, they basically dictate to you what you're going to do and when you're going to do it, right? Because they could just say, we're done, and then there goes your company, right? I don't know many companies that could survive a 2/3 revenue cut and be okay, right? So that's a little bit of a concern, I think. But I don't think that alone would have done what we saw today, right? Because that was disclosed. Everyone theoretically knew that while we were talking about this range, right? And then we come in below that. What does it mean for the IPO market? I don't know if it means anything. I don't want to read too much into it, Jeremy, because it's only one company. And I think there's certainly the possibility that what we saw with CoreWeave, the reaction, the tepid response was company specific, but it's not great for the IPO market overall, right? It makes you wonder if you're going to see a lot of companies rush to come public. they sold fewer shares than planned too, right? So not only did they underprice the IPO, they didn't sell as many shares, so that's an issue. And if you saw the CEO today, who's getting an interview, someone was asking like, why did you price where you did? Why did you price for the range? And they said, well, that's the quote. I think the quote he used there was that was where the buying interest was, right? In other words, we priced where we did because ain't nobody buying at the higher price, right? Nobody was interested at that higher price, and they had to keep ratcheting it down until they got to a point where they could get enough interest to at least take this thing public, right? So that's not great. For all things considered, for the business, you know, I don't know. I mean, it's an interesting business. I think the company's fine, but we also may be seeing some hesitation over the AI market too here. I think what we're seeing is a more reflection of concerns about the sustainability of growth in AI, at least AI infrastructure, than it is about IPO in general. That's my guess from this. And I don't mean to imply at all that I think the AI is going to crash, right? None at all. But I think what we're seeing now is maybe some expectation that the capex in that market won't be as heavy as what people were anticipating, at least for as long as people were anticipating. And there's less willingness to bid up some of these infrastructure providers to higher levels because of concerns over what the next year, 2, 3, 4 years looks like in terms of their growth, in terms of their margins, all that stuff. So, yeah, there we are. I don't know. I don't know if you have any thoughts on this beyond that, but.
Yeah, I mean, I'm interpreting the weakness as more of a reflection on, you know, where the market is right now and where market sentiment is, rather than a reflection on CoreWeave's business or the expectations around that. I mean, I think, you know, my hunch is that if they had gone public, you know, 3 or 4 months ago, or, you know, before these sort of market headwinds crept in, you know, I think they would have done better. We've seen these sort of AI concerns about AI infrastructure growth, you know, come and go. I mean, the last round of earnings reports, you know, from the big tech and the big cloud hyperscalers, you know, they were all pretty bullish on their spending, or, you know, their capex spending this year. But I mean, I do understand the long-term concerns. And then, you know, and we've seen pressure on that AI sector. You know, I mean, Nvidia is down, Taiwan Semi is down. I mean, it seems like most chip stocks, or, you know, certainly with the AI connection as well, are down 20 to 30%. So, you know, CoreWeave, yeah, I mean, it is right. I mean, there's a lot of risks there, and certainly, you know, it's really, you know, there aren't really a lot of pure play AI stocks in the market, and this is a company that's built a, you know, sort of a specifically Gen AI cloud-based, you know, or cloud infrastructure platform. So, you know, I mean, I guess if that, you know, if it's a good stock, you know, if you're looking for direct exposure to that, then I guess, you know, it's a good company to own. But, you know, I mean, it doesn't seem to bode well for the IPO market. I mean, the IPO market has been so slow too for, you know, we've been in this bull market for a couple of years now, and it's kind of amazing that we really haven't gotten more new issues. But it doesn't seem to bode well.
This is actually the largest IPO, the largest tech IPO since 2021 in U.S. markets. So it's been a while since we've had something this big. So it's still, there was hope, I think, that we'd see a big pickup this year. Maybe we will. It's still early. But I don't know that many people are going to be rushing to market right away given the response we saw today. From this IPO. So.
Yeah, I wonder if we'll see a change in the startup market too. I mean, you know, investors have just been throwing billions at you know, so many of these AI startups. I mean, you know, of course, I mean, OpenAI is valued at over 100 billion, but, you know, everybody from Anthropic to Mistral, or, you know, seems like, you know, you got a few engineers from Google or Microsoft, and you can raise at least for a moment there, you can raise a lot of money pretty fast to start a Gen AI company. So maybe that'll change too, at some point.
Yeah, I guess the other big piece of news, if you look at macro news, right, is the inflation number that we saw come out today. What is it? 2.8% in February.
Yeah.
Right.
Yeah. For February. Yeah. Good point. Yeah.
We're lagging here.
Yeah.
So I think so. So take that knowing that it's a February number, right, and notice that a lot of concerns, I think, over consumer spending and the economy and whatnot have materialized in March, which is not reflected in the number we've seen. But as of the end of February, and spending was still strong enough to push inflation above higher than expected. Now, 2%, 2.8% is fine, right? I like that number. I say that's about where you want to be. I see nothing wrong with that, right? But I think we should. My assumption now is that March is going to come in a little bit lower, given the spending concerns we're seeing right now. Maybe not, but that would be my guess. My guess is that the March number, because that shows a pretty strong economy. I think that core inflation in February, spending was actually ticked up a little bit, right? I don't think we're going to see that in March. We shall see. But my guess is that might be a high point for the next couple of months in terms of spending, in terms of inflation. Something to keep an eye on for sure. But if you're wondering why that inflation number seemed stronger, given kind of the vibes going on right now, it's again because just remember it was for February, and that's why it hasn't reflected all the angst of the marketplace has seen these past couple of weeks with the stock market falling.
Yeah, it's hard to know when the impact of if the impact of some of the earlier tariffs will show up, or you're right, if consumer spending is going down or that sort of thing. I mean, I think as investors too, one of the reasons we watch this is we want to know what's going to happen with interest rates. So I think based on I know the Fed last week said they expected to do 2 more rate cuts, or 50 basis points of rate cuts for the rest of the year, but I don't know. It seems like inflation isn't really going the right way for now, at least. If that's what they want.
Another piece of data on that, right, is University of Michigan does a monthly survey of consumer sentiment. That they put this out every month. They do a survey. Their index. I mean, it's unless you know this detail, the numbers don't really mean much to you. It came in at 57 is the headline index of the survey. Now whatever, like we ignore that number. The point here is that it's the lowest level since 2022, right? So we've seen the lowest, according to this one survey, the lowest level of, and this is in March again, not the February where the inflation numbers came for, but the lowest consumer sentiment here, consumer expectations in like 3 years, like since 2022. And it's down substantially from February, right? The number was at 64.7 in February, so 57. Just compare the relative numbers there, and you can see the sharp decline we've had in the past month. So that's also maybe a signal that people are getting a little more worried about what's happening and what's going on in the marketplace. Now, what does this all mean for our investing, Jeremy, right? I think if you're looking at here, sitting at the end of the week, and you're saying, oh, great, we got stronger inflation, which isn't necessarily great, but I think still a fine number. Weaker consumer sentiment, market crashing. We're at 5 or 6 weeks where we've ended in the red. I think the S&P 500 now. Last week, the week I was gone, was the one. Steadily declining market, consumer sentiment going down. These things seem to track a little bit, not 100%, but they move in this relatively similarly. Inflation is no one knows what's going on with tariffs back and forth. Hard to plan, at least from a business standpoint. What do we do with this? What do you do with this, Jeremy?
It's definitely tough. I mean, it's there's a lot of uncertainty out there. I mean, I think as an investor and looking at a longer term time horizon, I mean, I try to buy opportunistically when I see stocks trading at a discount, but I think the more the more I see, it seems like there are a lot of consumer stocks out there that are down 50% or so, some popular growth stocks. So I see that as an opportunity, but it also maybe makes me nervous because it does feel like the market's sending a signal there, and I think you could certainly argue that some valuations were inflated to begin with, but it's definitely feels like a change in the winds, so to speak.
Yeah, I mean, I suspect there are going to be deals to be found, right, in the market going forward, especially if this if this downturn persists a little bit. And again, where are we at? Like we're how far down are we from the high right now?
Like the S&P is about 10%, I think.
Yeah, so 10%. This is a once a year thing, right? So
yeah,
the market scenario right now should actually not concern us at all. It is not outside the ordinary.
No.
It's what one would expect. Whether it continues to go down more, we'll see. But another 10%, 20% down from the high could easily happen, and that would be not, also not out of the ordinary. That would be a fairly regular occurrence for the market. So I think now the tariff uncertainty is a thing that's not normal, right? I think in what's happening right now. I mean, maybe that's part of the cause. I think that uncertainty there that's kind of driving some of the decline we're seeing. But if you're a long-term investor, my friend, and you're sitting here looking at a 10% drop in the market, maybe you put a little bit of cash to work if you've got some, but you also should, I think, be approaching this from a standpoint of this is business as usual in the market. And, if Fool 24 continues indefinitely in the years to come, you should expect us to be talking about a 10% drop in the market about once a year, a little bit less than once a year. It's not like clockwork, right? It's not like every 11 months, right? It's like that's the average. But if you got me and Jeremy and others on here talking about a 10% drop in the market and we do that once a year, that's not unusual. It shouldn't be unusual. We should expect that. So I'm not honestly seeing anything in the marketplace right now with stocks, with the economy, that makes me think I need to change my overall approach, right? I mean, I'm still investing like I would normally do. Is that probably the right approach to take here, the right way to look at it?
Yeah, I mean, I think I think what we do here, the Motley Fools, we want to buy good long-term companies that, and if you can get them at a lower price than you could a couple months ago, then that's great. And I mean, I think some of these stocks that have pulled back, they could fall further. I mean, part of the fear and concern in the market, I think, is that, well, okay, so the S&P is down 10%, is it going to go down another 10%, or is it going to go down further? And, that could happen. But I think, and there's a question related to this that I wanted to get to. But, there are going to be a lot of good companies and good stocks that, come out of this cycle and are going to go back up. I don't doubt that. So, volatility does, equal opportunity a lot of times in the stock market.
Shall we hit some questions?
Yeah. The one I was looking at there. This is from Brandon O. What's your favorite stock that seemed overvalued in the past, but with the recent downturn seems to be at a better valuation? And I think there are really quite a few of these. We were just talking about Deckers in the last hour, which is it's now down. That one's down now 50% from its peak. But the one I was going to talk about, and I did purchase a little bit of it a couple of weeks ago, was Cava, the restaurant chain, which is also down close to 50%. And this is a consumer. It's still expensive, and this is a consumer discretionary. Restaurants are discretionary spending, and it's a stock that could certainly go down further. They've showed off very strong growth. So I mean, I think if their growth slows, the stock's probably going to take a hit. But I think I think this company has a lot in common with where Chipotle was, maybe 10 or 15 years ago. Everything. I think everything they've done. So they've done very well so far. The business seems to be firing on all cylinders. Good growth, good profitability. They have a long runway of expansion ahead. It's a fast casual Mediterranean chain, so I think they're got somewhat of a unique niche there. Have about 300 locations so far, so they're targeting 1,000 by 2032. But I think over the long term, it's you could imagine them having several thousand stores. And we'll see prices go up, and profits go up over time. So I think I think this is kind of a typical stock that you expect, and certainly with the valuation too, you'd expect it to fall in a correction, or in the sort of volatile environment we're seeing. But I think it's also the kind of business that we might see a slowdown in growth. Maybe comparable sales will be flattish or something like that. But I think, if we do have something like a recession, say, coming up, I think in a few years the business will be fine. I mean, I don't, people are going to continue to eat at restaurants. People like their food. They'll keep going back there. The people who cut back their spending are going to come back, or your business lunches, that kind of thing, vacation travel. So I think it's a good example of the kind of stock that is trading at a discount to its previous level. Could fall further, but I think to me it sort of feels like the lower it goes, well, that's the better deal it is.
I want to hit this question from Ed. Ed asked about 4 hours ago. Today, who do you have more confidence in, consumer-related businesses or corporate-related businesses? And I think what Ed means by this is businesses that sell to consumers versus business that are primarily a B2B operation, right? In terms of the revenue set up there. I don't. So I'm going to take this a little bit differently, Ed. I don't think I have more or less confidence as a whole in either category. What I do think though is that B2B businesses focused on the corporate market tend to be a little less volatile in their spending, I think, in various economic cycles than consumer spending related businesses. Is the consumer focused businesses tend to be more up and down, I think, with your economic cycles. And I think that's because it's a lot easier for consumers to pull back on spending, right? Like it's very easy, Jeremy, just to not take a vacation this year, right? You can just say, I'm just not going. And then that's it, right? It's very easy to go from eating out 3 nights a week to 2 nights a week, right? It takes very little effort at all. Just go grocery shopping a little bit more and, whatever. So consumer spending habits can change very, very quickly, especially on the discretionary side. You can suddenly, like if you're looking at a phone and you say, I would like a new cell phone. Do you have to have one today or can you wait 6 months, right? Well, it depends on how fat your wallet is, right? Like those are there. You can put off these decisions. You can trade down. You can shift from shopping at a more luxury clothing store to slightly more mid-market if you want. There are a lot of things you can do that don't impact your lifestyle too much and are very, very easy for you as a consumer to do, right? On the business side, they tend to have longer term CapEx plans. And, let's take Disney for an example. If Disney is thinking about expanding one of their theme parks, as they are doing in California, right? There's a major expansion underway there. They can't just stop that because there's a downturn in consumer spending and traffic at the parks might go down a little bit, right? This is a multi-year plan between the design phase, the implementation phase, execution, building, all that. It takes some doing, right? Arguably, if they saw consumer spend, like if they saw a tick down in attendance at the parks, they might ramp up the plan there, saying, "Oh, well, we're going to inconvenience less people right now. Let's try to get this done before the inevitable rebound in traffic comes," right? Or let's get it done fast and give people a reason to think about coming back sooner than they might have otherwise, right? But they're not going to stop it. They're not going to just like turn that off until the economy rebounds, because they have to have that in place. Similar to airlines, right? Your order book for new airplanes is years down, is years deep, right? You don't just delay, like you have some flexibility, right? You could push things out a year or two, maybe. But you have to plan, like, I'm going to need new planes 5 years from now, 10 years from now. So I need to get that in the order book, right? And get that going. And so from that standpoint, from a B2B standpoint, especially with your bigger CapEx projects, these are multi-year things that are sort of tied to the consumer cycle, with their own customers, but they just have to happen, right? And businesses can borrow to do that. They can build up cash over time to do that, however, what have you, right? But you see less volatility, I think, in their spending because they're longer term plans. I think that's a long answer to your question, Ed, but I see it more of a less volatile, more volatile market rather than a more confidence, less confidence thing, if that makes sense.
Yeah, I like this question. Yeah, I mean, I think it's kind of depends on the individual industry. Or, as you said, something like vacations or going out to eat. It's easy to cut back in spending. And I think a business example of that is advertising. We saw like in 2022, the big digital advertising companies, Alphabet and Facebook kind of, their growth was, I think, was flat at one point or pretty close. So I wonder if we'll see that, maybe not in the first quarter, but maybe we'll see something like that sometime this year. You saw those airlines cut guidance, earlier as well. So maybe you might think of those kind of companies as the canary in the coal mine, or the canaries.
Yeah.
I'll take another question. Luella said 4 hours ago, I've heard you say folks lose money by not being in the market during the X best days of the year. Don't you have to sell on these days to reap that gain? So this is, I think there's maybe variations on this kind of measurement, but basically, one reason you don't want to try to time the market is that if you miss the best days of the days when the S&P 500 goes up the most, you're not going to have a positive return or a good return. And there's so really benefiting from the stock market means you got to be in during those days. One stat I see here: if you miss the market's 10 best days over the past 30 years, your returns would have been cut in half. Missing the best 30 days would have reduced your returns by an astonishing 83%. So, those, which, I mean, in a 30-year span, 10 best days, we saw some kind of crazy off the charts days back in 2020 for a bit. But, when you think of, think of that, it adds up. So and then the second part of your question there, but yeah, so that's, it's, you really don't want to try to time the market and, pull out for a couple weeks and then get back in, or, despite the volatility we're having. And then I think you mean, don't you have to sell on those gains to sell on those days to reap that gain? If you're talking about booked earnings, I guess you have to sell at some point to use that money. But I think that the general point that you probably have heard some of us say on here is that you don't want to miss out on those big gains, because that will really crush your returns over the long term.
Yeah, I think part of the idea there, right, is if as you said, if you sell if you sell on the downward trend, right, and say I'll get back in, right, the risk there is you're not going to get back in at the bottom, right? And then you get back in when the market is going up after that big day. And so if you miss it, you miss it, and you can't ever get that back, right? Whereas if you don't have to sell, then like eventually you sell, but if you're in the market, you have that gain, which you can then do with as you wish at whatever point in time you wish, right? But you don't want to miss the if your practice is to sell as the market is going down and then buy again when you sense a recovery, well, you're going to miss that upswing, right? That's the big risk, and so you don't want to do that. Even worse, Jeremy, is when some people you sell and then the market goes up and you're like, oh, I missed the recovery, so I'm going to wait until it goes back down again to buy, and then it keeps going up and 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 up, right? You definitely don't want to do that, right? I think it's the worst possible thing to do.
And the early rebounds tend to be pretty strong too. So those are, I would imagine, some of those big days happen, pretty early in the recovery. So it's easier to not play those mind games about selling on the downturn and that sort of thing, like you said.
All right.
Not seeing a lot of comments here.
What else you want to say? Oh, so there's a question from Besties here, which is, do you follow TBBB? What do you think of it? TBBB is the ticker symbol for BBB Foods, which is a Mexican grocery store. The actual name is, I think, Tiendas 3B, right? It's a chain of grocery stores in Mexico, like affordable type grocery stores. Came public in the U.S., so came public last February, Jeremy, and a lot of growth since COVID, since 2020. From 2021 to 2022, they had a compound annual growth rate of 34.4%, right? So pretty phenomenal, right? In terms of the revenue, we're talking about growing by numbers. So they come public in February on the New York Stock Exchange. Pretty strong since then. I haven't looked at this too closely, Besties. It is one that's on my list to look into a little more. It's I think the market cap's around $3 billion right now, so it's a pretty small cap at the moment. But it's a very interesting company, doing quite well with their expansion plans. Continuing to grow. Their stick here is like low pricing, quality products. Sort of like maybe I don't know. I have never been to one. Not being a Mexico resident. I think it's like a Trader Joe, Aldi type experience, right? It kind of like that's what they're going for, and they're really focused on expansion right now. So it is an interesting one to look at. I would like to look at it more, Bessie. So I'm going to try to do that, and if once I have, we can talk more about it. But it's certainly an intriguing company if you want an international flavor to your portfolio, and this. International consumer, right? We're talking groceries, so that's kind of an interesting way to get at it. But one concern I have is I'm not super familiar with the Mexican grocery market, so I wonder if I'm, I hesitate to judge them just on the numbers we're seeing because I don't know necessarily how to put that into great context. In what they're doing, so I want to take a little more time to explore that and kind of get a sense of where they fit and what the growth opportunity might look like.
Yeah, I wasn't familiar with this one, but that does sound like an interesting company there. You don't see too many of those kind of international stocks like that are sort of a straightforward business like that. I remember it's Price Smart. Wasn't that was a Latin American retailer that were they supposed to be the Costco of Latin America or something? I don't know. I'll grab another one. Jags asks, is PayPal a slow moving in price action? Is it good at multiples in current markets? Yeah, PayPal's, it's a bit of a rough story over there. I mean, I think the issue with PayPal right now, and to maybe return to a theme of the last hour. So PayPal's looks like stock's down about a third from its peak. And this is sort of maybe it's fintech, but it's been a bit of a slow grower for a while. And I think at some point, I don't know if PayPal maybe deserves to be valued more like a bank than a disruptive payment platform. Especially as it matures. Revenue in the fourth quarter was up 4%. They've diversified their business, and I think the new CEO has made some good moves. But I think my concern too right now is if we are seeing the slowing consumer spending and macroeconomic pressure and that sort of thing, I don't think that's going to be good for the fintech sector. PayPal looks like their price to earnings ratio I'm seeing is 16, which I think is good if you think of this company as still a growth story. But we haven't really seen that in a while from them. So I think it's sort of gradually re-rating. The market's re-rating it as a sort of a slower growth company that's something more like a traditional bank, which tend to trade in PE ratios of around 10 to 12 or something. So and I think if we have, as long as we have this kind of macro cloud hanging around, I don't know. I don't really expect the stock to suddenly break out of its of that weakness.
Yeah, let's see here. All right, so just looking back here at some of these older questions. Do you follow Trex, Jeremy?
I do. I haven't looked at them too closely, but yeah, I know a bit about that
There's
company.
a question from Maginder about a day ago, asking us for comments on Trex. So we can make a comment. We can make a comment on Trex here, right? I like the company as a general matter, right? I think it's a good one. I'm pretty sure I didn't put it in. Like, I bought this house about a year and a half ago. I think the deck on the back balcony is Trex. It certainly feels like it. I can't say for 100% sure, but I'm pretty sure it is. I did have a Trex deck at my house back in Virginia that we put in. It was a nice one. It was quite nice. Do you have Trex material at all?
I don't. No, I don't have a Trex. Yeah. It's really falling apart patio.
Oh yeah.
So
hey,
maybe I could use one.
There, yeah, throw a deck out there. It's a nice summer project for you. But it's durable stuff. They make, for anyone who's not familiar with them, they make composite decking material out of recycled materials, right? They use the part of it is the those grocery store bags, right? It's part of what goes into that. A lot of different colors, a lot of different varieties, a lot of different new technologies they got going on now with that. They have a new, I think it's been a while since I looked at their newer products, but they have a newer one out now that it keeps cooler in the sun, which is nice. You don't burn your feet, right, when you're going outside. But at any rate, what's the stock done in the past year or so? It's down a little bit. Let's see here. Yeah, it's down a decent amount, actually. It looks like, Jeremy, it's down like 40, I want to say 40% or so over the past year. up slightly over the past 5 years, right? So we had a big peak. We saw a big peak in the stock price. They did really well coming out of COVID.
Yeah.
People were saying, what do you want? If you're stuck at home, what are you going to do? You look out in your backyard and say, you know what I could use is a new deck, right? And so a lot of this was happening, right, as we're coming to COVID. So you see this big run up, right? And then you kind of get a decline in 2022 when we had that initial, which everyone forgets about, right? Remember the 2022 crash? But they're going to rise and fall. I think they're a consumer-driven company in some part, right? Because they have two main parts of their business, right? It's the residential market, the consumer market, the renovation market, right? I want to put a new deck at my house, wherever, right? And then there is the new construction element too, a new construction business they have. Clearly, if the housing market is depressed as it is right now, that's going to impact them to some degree, right? A stronger housing market with more turnover, they tend to see a little more business because people buy a new house and they think let me redo my yard after I bought my house, right? So there you get some of that business that's kind of weak right now. But they are expanding. They have it's open now, the new plant in Arkansas, I think, the new manufacturing facility.
Right. Yeah. That sounds familiar. Yeah.
Yeah. So that's opened up, which is kind of which they did to meet demand. So I like the company. This is one I want to look at a little more closely right now too. It looks kind of compelling to me, quite honestly. It's a well-run business. They've done well historically, and I think it seems like the market might be giving us a good price, right?
Yeah, I mean, Trex feels like one of these where I like the business a lot. I mean, it seems like, very, well-run company. They're constantly expanding and, innovating, adding new products. Financial performance has been generally good. They're very profitable. But I think the issue, as you said with the stock is they're beholden to the housing market, and you'd like to see faster growth. Sales were up 5% last year, and they're targeting 5 to 7% revenue growth in 2025. So I think the whole housing sector, or the housing related product sector is kind of in that bucket together. But who knows when the housing market will turn around at this point. But I think so. I think Trex would do well in a friendlier housing environment. But yeah, I think it seems like one you can be patient with, and I think it's a very good business.
Yeah, I also don't think you necessarily want to wait until the clear recovery in the housing market to.
Yeah,
right?
Yeah, sure.
I think you take what pricing you get, understanding that it may be longer than we expect. But as you said, if you don't own any, right, or you're looking at this company, I think it's one that you could buy, knowing that the housing market is tied to it. So you might have to wait through some of that, right? Before you see some strong growth from the business. But it is a nice company.
Yeah, I noticed that. Yeah, I don't know if you saw this earlier in the week, but AZEK, which I think is one of their closest competitors, or maybe their closest, was acquired for $8.8 billion by James Hardie. So
who acquired them?
James Hardie, but an Australian company, not one I was familiar with.
What are they? That's interesting. I missed that. What is James Hardie Industry? Oh, is that the maker of Hardie Plank? Right.
What's that?
Hardie Plank. Have you heard of Hardie Plank?
Maybe. No, I don't. I don't know that one. It's possible. It looks like fiber cement.
It's
probably them.
Right. All right. Interesting. Cool. Yeah. So and Trex is what? What's their market cap?
$6 billion. Yeah, well, that's not.
So $6 billion, and really, and a competitor for $8 billion? Huh.
Yeah, that's a good point.
Okay,
yeah.
now I'm suddenly a lot more interested in this than I was 5 minutes ago.
Right. Yeah. I agree with you.
All right. Thank you. Okay. Let me putting this on my, excuse me, fools, putting this on my watch list to take a look at a bit more here. Thank you for the question, because I feel like they're still the market leader, right? Aren't they? I think they are.
Yeah, I mean that. Yeah, that's how I think of
So
them still.
8 billion. Yeah, okay, that's compelling now.
Yeah.
All right.
Yeah, and
thank
I
you.
know.
That's a good one here.
Yeah,
So Counselor Rob, Toby, and Jeremy, what stocks look attractive that have dipped? Well, there you go, Counselor Rob. Given someone else's opinion of a competitor and what they're worth, Trex is kind of looking a bit attractive to me at $6 billion here. Another one, I know you answered a question like this similar or earlier, Jeremy, but Old Dominion is actually looking kind of attractive to me right now.
Okay.
It's one of those, I think, well-run companies that normally gets a premium for being kind of in the best in their business, and it's looking pretty good, I think. Right now, I'm not totally convinced yet, but it's a well-run. I like the bit. It is a very, very well-run business, and price has come down a little bit, so that's interesting to me. The trade desk is the other one, Jeremy. I know there's some difference of opinions on this one, and it kind of depends on what you foresee for the future. Whether they're going to struggle against competition or whatnot, but it's I think the price looks quite nice in my opinion at the moment.
Yeah, that is one that's come down a lot. Yeah, I mean, I think that's historically. I mean, I know they missed their the revenue guidance last quarter, which maybe for a less expensive stock wouldn't be such a crime, but they did get hit pretty hard for that. And then the broader headwinds, and certainly advertising, as I was mentioning before, is I think more exposed than other industries. Though Trade Desk did very well in 2022 in that era. So certainly compared to a lot of other ad tech companies, and even those the large digital advertising platforms. So I maybe less worried about them in that context. But yeah, I mean, I know management on that call was sort of said it's not competition or anything like that. They were just sort of made maybe a couple small internal sort of errors or things didn't quite pan out the way they expected. So yeah, I mean, that feels like one, give it certainly another quarter and see, could bounce back, and it could be in line with where they should be. A good anecdote about Old Dominion too. XPO, close competitor of theirs, or another less than LTL company. XPO, I think, hired their COO or someone like that. Or made an executive there, its COO, and the XPO stock went up double digits, which I don't think I've ever seen anything like that. So that's how respected Old Dominion is in that industry.
They really are quite respected, I think, and I think they're very much considered to be kind of the they set the standard for how to do business in that industry.
Yeah, very strong profit margins there too. Councilor Rob
nice
approved of that. Looks like Matt was late in joining us. We did talk about CoreWeave.
Yeah, the CoreWeave thing. We talked about at the beginning of the hour, Matt. I mean, it's I think just to kind of sum up our initial reaction from Jeremy and I were like, the business looks interesting of CoreWeave. But there's, I think what you take away from the IPO is a lot of hesitation on the market right now. And, whether that is hesitation over the AI market and continue spinning there, maybe some of that. IPOs generally, maybe some of that is overall market sentiment, and no one really wants to be throwing money at a new company right now. Probably some of that going on too. What was like a 2% drop today in the S&P 500, Jeremy?
Yeah, that's true. Yeah, so
that's not a great day to come public. It's not a great. I mean, again, we're down 5 out of 6 of the last 6 weeks. It's just not. It's not great.
Yeah,
It's not great.
Yeah, the
I
general
almost
environment.
I wonder, Jeremy. I kind of really do wonder why they didn't just say, let's wait a couple months on this. Maybe they just thought that would have even been a worse sign, a worse signal to the market, or maybe they really just they need the money to grow and they feel like this is the best way to do it right now.
Yeah, it seems like the IPO came together pretty fast for them from when
it did
when it was first announced.
You're looking at what at the high end of that initial range they gave. So they said 47 to 55, opened at 50, or they priced at 50, priced at 40 rather today. So you're looking at like it. Let me do math in my head now, like a 25-30%, somewhere in that range, drop from the high end of that initial range.
Yeah, that is rough.
That's, I don't know, that's a lot of money to leave on the table potentially. I mean, no guarantee at 55, but I don't know.
Pretty unusual too. I think, at least. I mean, compared to earlier IPO periods.
What's going to be, Tim Jungles? What's going to be the catalyst to turn the market around? I don't know, Tim. That's a good question. It's one we can perhaps speculate about over the next 5 minutes here, Jeremy. What's going to turn this thing around? I would have said tariffs would be the thing that would send it down.
Yeah, really, right. Yeah, I mean the geopolitical situation. Yeah. Go ahead.
No, yeah, I think you're right on that. I think you're going to have to see some kind of stabilization in the geopolitical environment, right? Like whether that means we settle out at some tariff levels and take trade wars off the table. Because as long as the market is concerned about more increasing, changing tariffs, I think you're going to see some hesitation on behalf of a lot of companies to really kind of push forward too heavily. So I think you need stabilization, right? With that, I don't think it has to be, oh, oops, we're just going to reverse everything and go back to where we're in December. I don't think that has to happen. I think you have to have confidence in the way forward, whatever that might be. Take the uncertainty off the table, and then you see some the business will be able to adapt to that. So I think that's maybe one thing that needs to happen. Beyond that, I don't know, Jeremy. These things just kind of, you can sometimes look back, Tim, and you can see a reason for the fall, and then why do things turn around? Often that's less clear. It tends to be more of the market just got the drop out of its system, and here we go again. That's kind of what it is. Expectations get reset again at the low end, things get a little bit better, and you see a recovery. That can happen slowly, as we saw in the great financial crisis. It took a couple years. It can happen quickly, as we saw in COVID. Took a couple of weeks from the bottom, right? For everyone to be suddenly, oh, woo, this is fun. Let's drive the market up to heights unseen. It's hard to know. It's hard to know ahead of time. That's why I think what we generally like to say to people is just, stay invested, have your cash on hand, and or do what you do, keep investing as you can, keep enough cash, whatever that means for you, so that you don't have to sell for the next couple of years if things don't turn around quickly. But you certainly want to be invested in a market like this, I think, Jeremy, because what's probably going to happen, if history's any guide, is things are going to turn around, and then we'll look back and say, oh, hasn't this been a nice 5 weeks? I'm glad I've been invested, right? And you don't want to miss that part. Now, I think we all would have loved to miss the last 5 or 6 weeks, but you don't want to miss the flip side of that for sure, right? So I don't know, not to be done about it until we do see that turnaround.
Yeah, I mean, I think the thing too to remember, I mean, the tariffs and the trade war is getting a lot of attention. But we just came off of 2 years where I think the S&P 500 was up combined more than 50%, which that I think that's only happened one or two other times in the last generation. I mean, the dot-com era was the big one there. So valuations were already frothy, and when I think that happens, it doesn't take much for to make the market feel jittery. One of the sort of dynamics that has been interesting to me in recent months. I was looking at an ETF that was only stocks outside the U.S., so primarily Europe, but outside, also Asia, some other countries, and it was up more than 10%, doing very well year to date, outperforming the S&P 500. Historically, this ETF had not done well. Last 10 years was up like 30%. So not you didn't want to be invested outside the U.S. for the last decade, but and I remember too, after the election, that was the European stocks were down. So it seems like investors are flipping that dynamic and looking for growth. And part of the attractiveness too is a lot of those stocks are cheaper than U.S. stocks. So I think that's part of what's driving that. So I think the markets, investors are always looking for better returns, one place or another. But I think I agree with Toby, eventually, between valuation and sentiment and sort of, where the news and, earnings reports are, you find a bottom at some point and then, suddenly, you get those good 5 or 6 weeks or, things are back up. So it's, I don't know if hard to anticipate a single catalyst. I don't think, anybody thought, trade war would do what it's done so far. So whatever.
All right. Well, that's it for us, Jeremy. We are at 6 o'clock here, or 6 o'clock over yonder on the East Coast, 3 here on the West. We had fun with you guys. Thanks for your questions. We appreciate them. Always good to spend some time with you, Jeremy, and with our members.
Definitely.
Of course, here. And we do now have Rachel and Brian going to jump in to the show now and take over for the next hour. So good to see you guys, and take it away.
All right.
Thanks, Toby. Thanks, Jeremy.
Thanks, guys.
Well, hey, Brian, it's been a while.
I know it's been like an hour or 2 hours. I guess it was 2 hours.
It's been like two whole hours. Yeah. Back for Ask Us Anything hour. Fools, if you have any questions that you're just itching to ask either Brian or myself, go ahead and get those in the Slido. There might be some questions in the queue as well that we can work through from prior hours. And I know, Brian, both you and myself brought some recent news and stories of interest that we might want to talk about as well and share our thoughts on. Maybe one I'll start with as we're waiting for questions to come in, and then I'll shoot it over to you, Brian, if there's anything in particular you're looking at that you want to talk about. But there have been a lot of comments today on the CoreWeave IPO, and there was someone that had noted that of all the days to pick when the inflation report came out, and I did want to hit a few of those numbers. We saw some key inflation figures that were published just today, this morning, and had not had a chance to get to them in any of the prior shows. So figured that would be interesting to read those. But the core personal consumption expenditures price index, which is a key Fed inflation measure, showed a 0.4% increase in February. That put the 12-month inflation rate at 2.8%. And both of those figures were higher than what had been expected. Now, consumer spending accelerated 0.4% for the month. That was below the 0.5% forecast. And that also came as personal income posted a 0.8% increase. And that was against the estimate for 0.4%. So we're seeing some interesting patterns here. We've got a 0.4% increase in core personal consumption expenditures, which is the biggest monthly gain since January 2024. Again, that puts the 12-month inflation rate at 2.8%. And then economists surveyed by the Dow Jones had been looking for respective numbers of 0.3 and 2.7%. Now, it's worth noting that core inflation excludes volatile food and energy prices. It's generally considered a better indicator of longer-term inflation trends for those reasons. Now, in the all items measure, the price index rose 0.3% on the month and 2.5% from a year ago. Both of those figures were in line with forecasts. And again, we're seeing that consumer spending accelerated 0.4% for the month, so a slight increase, but still slightly below the 0.5% increase in consumer spending that had been expected. That also comes in a time where personal income posted a 0.8% rise against the estimate for 0.4%. There were some comments as well, from different strategists and analysts following the release of these readings. There was a chief economic strategist at Morgan Stanley Wealth Management that says it looks like a wait and see Fed still has more waiting to do. Said that today's higher than expected inflation reading wasn't exceptionally hot, but it isn't going to speed up the Fed's timeline, in their opinion, for cutting interest rates, especially given the uncertainty surrounding tariffs. Good prices increased 0.2%, which was led by recreational goods and vehicles, which increased 0.5%. Now, gasoline offset some of the increase, with that category falling 0.8%. Services prices were up 0.4%. Households are also growing more cautious with their money. That's a pattern that we've also seen a lot of management of different companies allude to in this earnings season. The personal savings rate increased to 4.6%, and that was the highest since June 2024. Now, we know that rates were cut a full percentage point in 2024. The central bank so far in 2025 has been on hold. There's been some comments from officials expressing concern over the effect that increased import duties, tariffs will have on prices. So there's a lot to watch here, but basically consumer wages are up, but spending and core inflation is also up. And then we're seeing different measures across different areas of spending that are increasing at varying rates. The only real measure that seemed to actually have any kind of a decline was gasoline prices, with that category seeing prices fall about 0.8%. So it's an interesting time. I always like to hit these numbers when they do come out because, well, it certainly doesn't influence investing decisions per se, and it doesn't make me change a thesis about a company or own or follow or perhaps would want to own in the future. I do think it's important to understand how these numbers impact a lot of the businesses that we follow and just broadly feed into the landscape in which a lot of companies are operating right now.
Yeah. I mean, I think in the healthcare where I invest in mostly, I'm not sure that the inflation really matters that much. I mean, people are going to have to spend on healthcare for the most part, no matter how their other things are affected. And healthcare hasn't exactly the inflation in healthcare hasn't exactly been in line with the inflation in general. It's generally been higher, at least, for the last, let's say 5 years, probably 10 years, if you look out that far. So I think that generally speaking, I'm not sure that it matters that much for healthcare investors, but certainly for other industries, it matters a lot, especially, like restaurants and that sort of thing. I think are probably the biggest companies that get hit for when inflation happens. Especially anything that's discretionary is going to have effect, even if they're not actually having their prices increase. If other prices are increasing, then there's less money available for the consumer to go ahead and spend on other things. And then, as you pointed out, the savings rate is increasing, so that results in even less spending in terms of discretionary spending. And so, the only place really in the healthcare sector where you see that is in like aesthetics, which tend to be a cash business, and patients are paying out of pocket, and it's definitely not something that everybody, it's not a necessity. But again, the people who are paying for that tend to be a little bit less price conscious. So it can be easier for them to weather the storm than other places where there's discretionary and it's more people with less discretionary income to begin with.
Yeah. Well, and it's also interesting too, because of course some of these readings we're getting as we're also seeing a lot of different news about the state of tariffs, something that could potentially impact a space that obviously we both cover. One of the things I've gotten a lot of questions on has been these potential, pharma tariffs that have been talked about but not formally announced. We've been seeing news how different pharmaceutical firms across Europe, for example, are, rushing to prepare for the potential fallout of U.S. import duties, with some forming so-called, tariff task forces. There's been discussions of tariffs on various pharma goods that could be imposed. And there's obviously been some concerns about how that might infringe on rules set by the World Trade Organization, in which the U.S. is still a member of, under the WTO's 1994 Pharma Agreement. Most pharmaceutical products and the substances used to produce them are exempt from tariffs, which binds them at duty-free levels. So there's been some interesting stories we've seen come out about the ways in which different companies are anticipating to have a response if indeed, on April 2nd or around that time, we get more clarity in terms of any, potential tariffs that would impact that space. That's obviously something where I think some companies are better positioned than others. We've seen announcements from companies like Johnson & Johnson and Eli Lilly that are talking about the different expansions they're making in terms of U.S. manufacturing. Pfizer's another company where management was recently commenting on their ability to pivot, so to speak, to focus a lot of the flow of their manufacturing domestically if need be. But it's certainly a situation where some of the European pharma companies would be among the hardest hit. And the U.S. consumes a significant amount of pharmaceutical products in any given year. And many of those products are related to, global imports, sort of the flow of the supply chain in the healthcare industry these days. So I'm curious if you have, any thoughts on that. It's obviously something that it would impact a lot of the companies we talk about in one way or the other. Yeah, and I think Novo Nordisk, I think, was another company that was talking about it. They have a plant in the U.S. and they bought a contract manufacturer, and they got a plant out of that one that's in the U.S. I think for investors it becomes really difficult, right? Because you don't know exactly where every one of these little drugs are made, right? And and the drugs that have the highest impact on the company's top and bottom line are going to be the ones that you should be most focused on. So, there may be that they have manufacturing in a lot of manufacturing in the US, but if the top drug that they own, which is, 40-50% of total sales, is made outside the US, then that could potentially, come under threat from a tariff. And we don't, it's really hard. It's not like those things get put in 10Ks generally speaking. Right. So you have to then go to the conference calls and try to find it there if an analyst asks, because the company isn't necessarily going to disclose it. And so I think it becomes really difficult. The other thing is this is not something that pharma can pivot quickly on, because the FDA requires every time you make a change to your manufacturing process, you have to go then get a new FDA approval for that manufacturing process. It's not as rigorous as the initial approval for a drug, because that requires all the clinical things, but you do have to be able to prove that making this change doesn't change the underlying substance. So that can be, something as simple as like changing the vial you want to put the drug in. If you change that, you then have to get an FDA approval. I've heard stories of people who have been consultants or whatever, postdocs that in manufacturing areas that have created an improved way for the company to get a better yield on their drug, maybe 10% greater yield. So that would reduce the cost of goods. But because the cost of goods are so low
And because there's a requirement for the FDA to get a new approval when you make a change, the cost to go through the FDA process is more expensive than the cost to than the savings of that 10% yield is, because the cost of goods are fairly low, right? So there's a lot of these examples where, you know, it doesn't really make sense to change the options for the FDA. And now we're saying like, well, maybe you want to because of the tariffs. But again, the tariffs are going to be on the cost of goods, not on the sale price. So if you're importing a drug that has a 90% cost of goods, you know, or 90% gross margin, 10% cost of goods, then the tariff is going to be on that 10%. So if it's a 25% tariff, it's going to be on that 10%, which is only 2.5% of the total cost, right? So it's not as simple as just oh, well, we should move everything to the US because there's tariffs on the drugs. There's a lot of moving factors here, including the FDA getting a new FDA approval for manufacturing it someplace else, and getting the and whether, you know, how much of the percentage, how much is the tariff and how much is of the percentage of the total cost of the drug is the tariff. So
yeah, you know, there was an interesting survey that had come out this week that was operated by the trade group, the Biotechnology Innovation Organization, or BIO for short. And it was essentially a survey of everyone from, you know, emerging drug makers, emerging biotechs, all the way up to larger commercial companies with about $1 billion or more in annual revenue. So sort of a wide swath of businesses. And it was one of the first surveys I've seen that's really reflected kind of industry-wide response to the news we're seeing, which is obviously still developing in terms of how tariffs could impact you know, the trajectory of drug discovery, innovation, development, manufacturing. You know, nearly 90% of U.S. biotech companies, according to this survey, rely on some, at least, imported materials for at least half of their FDA-approved products. One of the things that was interesting in this survey by this trade organization was that 94% of companies polled said they expect tariffs on the EU to drive up manufacturing costs. And 82% of respondents that figure that tariffs on Canada will increase production costs, compared to 70% of respondents on China tariffs and 56% on India tariffs. You know, manufacturing was the most consistent concern that was cited in the survey. Biotechs that responded also flagged concerns about how some of these tariffs could impact, of course, things like raw material sourcing, research and development, regulatory filings, and then partnerships with contractors like CROs or CDMOs. The other thing as well was that 50% of the companies polled said that they expect proposed tariffs on the EU will force them to search for new research and manufacturing partners. Around half of the respondents also noted that potential European duties could necessitate reworking or delaying regulatory filings overseas. And kind of related to something you mentioned, there was the question of how much time companies expect it will take them to tweak their supply chains. 44% of respondents said the process is likely to take more than 2 years. 36% said they expect those changes to take between 1 and 2 years. 21% said they think they could get that work done in less than 12 months. And then, of course, as I mentioned, you know, you've got companies like Eli Lilly that said we're going to invest $27 billion to kick off construction on 4 new production facilities in the U.S. Johnson & Johnson's planning to spend $55 billion in the U.S. over the next 4 years. But I thought that was an interesting survey that actually provided, you know, anonymously, right? We don't know the companies that responded, but it does provide some insight into what the inner workings of the industry are like right now and how that could impact some of these businesses, at least in the near term.
yeah, I mean, I think the 1 year time frame is probably people who are importing drugs and then they can, you know, import them from other places versus changing whole manufacturing processes, because those are definitely 1 year plus time frame. So I mean, I've got to think that that's the only way you can get out of, you know, get something that quickly done by the through the FDA is that you are just changing a product input product versus a process. So the difference between changing an input product and changing a process is substantially different, because the FDA has to be able to adjust. You may just, if your supplier ends up shutting down, you got to be able to get your supplies from someplace else. So that they make that process fairly quickly, and you just have to prove that the two inputs are the same and equivalent, and then you're good to go. Versus changing the process, you have to do the whole process in the new way, and then compare the end product to the old product, and you have to oftentimes do stability assays to confirm that they have the same stability over a year or two. So that requires not only you change the manufacturing process, and then you have to confirm that the drug is the same coming in the output, plus you have to confirm that it has the same stability, which can obviously take quite a while, depending on what the shelf life of the drug is.
Yeah. So let's see. We've talked about the new inflation report, tariffs and healthcare. What are some things?
I guess if we want to stick with the government,
yeah,
we'll stick with that theme for at least one more segment. We can talk about the NIH grants that are being cut. So this doesn't hurt that this many biotechs directly, certainly not very many public biotech companies directly, because very few public biotech companies are getting NIH grants. There are some early stage biotechs that are mostly private biotechs. There are some NIH grants that are possible that sort of bridge the gap between academia and getting started, way before you'd even be starting a clinical trial. But the NIH grants are hurting academia quite a bit, and most, maybe not all, certainly not all, but I would imagine more than 50% of ideas come either directly or indirectly from academia. So either the academic professor has, or their postdoc has decided, this is a potential target, and we're going to go find a drug for it, and we're going to spin out a company, and the university is going to get a portion of the equity in that company, and so we're going to spin it out, and it's become a new company. We're going to get venture capital funding, or that lab is just not interested in the business side of science, but they go and publish that this new protein is involved in this disease, and here's the evidence that we have of that, and then somebody goes and so this is sort of the indirect route. Somebody reads that paper and says, "Oh, that makes sense. We should go after that target." I just talked to I interviewed a company that was announcing a Series A, Boston-based company that announced a Series A venture capital funding of 50 or 60 million or something like that this week, and they did exactly that. They read a paper by some other company, some other group. This group happened to be in Russia, so obviously the NIH funding is probably not affecting that particular group. But there's if it had been an American company, then it probably would have been NIH funded, most likely, because that's where a majority of U.S. academic funding comes from. And then they read that this protein's involved in this thing, and then they developed an antibody, and they've got the antibody and it's ready to go into clinical trials next year. And they got funding because the venture capital saw that it was important. And so without that NIH funding, in 2, 3, 4 years down the line, we're not going to have those novel ideas that are either getting spun out of academia or are getting published, and then companies are being formed around that idea. And so the NIH grants so far since the inauguration are down about $3 billion, and about 60%. That's about 60% decline over the same time frame from the year before. So, well, I don't think it's really going to hurt the biotech industry right now, and maybe it's not even going to hurt any companies that are currently public companies that are already developing drugs, assuming they're already in clinical trials, they're certainly not going to be affected by this. But the new formation of companies and how many IPOs we get in, let's say, 5 years is probably going to be affected by this, unless we get a change in the administration's view of how much NIH funding there should be. Now, I'll be honest, some of the NIH funding cuts are probably reasonable, and there's probably some people who are getting NIH funding that don't actually deserve it and they're not bettering science and society. But I think that in my opinion, the NIH should be the government should be funding these sort of things, because it advances science and makes us all potentially healthier, and gives us the drugs that we wouldn't normally get. I think that if you look at studies, probably 8 out of 10 drugs can be traced back to some sort of funding from the government, either mostly indirect, so where they've made a discovery based on a government funded drug, and then a government funded government grant results in a discovery that down the line eventually results in a drug that gets approved and helps society live longer and something like that. So I think it's a big issue it'll be a big issue for investors in a few years. How long this is going to last, how deep the cuts are going to be is probably a big issue. But
yeah, the other thing that's interesting is I've been watching to see if we have any kind of movement in that 15% cap or 15% cap on indirect cost reimbursements for research grants that kind of faced immediate pushback, and I believe is still temporarily under a temporary block from a preliminary injunction that was issued by a judge at the end of February. But essentially, there was this situation in February where the NIH announced a 15% cap on indirect cost reimbursement for research grants, replacing the previously negotiated rates, which obviously could negatively impact research institutions and their ability to conduct research. And these indirect costs, cover things like utilities, library resources, and other infrastructure that's needed to support research, not necessarily directly tied to a specific project, but still flows ultimately into the trajectory and completion of those projects. And, there were numerous lawsuits that were filed after that, arguing that the cap was a violation of federal law and also congressional direction. And I believe, as of at least the last news I saw about it, there was an order from a judge that had temporarily halted the NIH from implementing that cap on indirect cost reimbursements. And, we'll see if there's any further updates on that. But then more broadly speaking, the changes in funding, as you mentioned, these are things that play a crucial role, especially in supporting early stage biotech companies. That's a significant advantage for a lot of these startups that may not be able to attract private investment. It, supports really basic research that eventually supports clinical trials and later product development of many of the drugs and the revolutionary therapies and vaccines that are commercialized today. You think about how things like CRISPR and mRNA and CAR T therapies eventually, can be traced back to government-funded science. So I think that is very much the case, that this is not something that you're going to see per se an impact from, in the next few quarters, unless you're maybe a really small biotech operation that had a notable research grant, that was cut or something like that. I think where you really start to see it is several years down the line, or even a decade down the line, if indeed some of these cuts persist. The pace of innovation will slow eventually, and at some point that will be felt. A lot of the therapies and drugs that are, promising latter stages of clinical development today were first identified a decade or more ago. So it's a very long and drawn out process within the healthcare field. But eventually, those impacts will be felt, unless, something changes and there's shifts. But it's certainly a situation, I think, where, a weakened research pipeline can lead to a slowdown in the development of new drugs and therapies, and that can delay or prevent advancements in treating diseases. So I think something I've said a lot of times is these big pharma companies, they'll adjust, they'll work around some of these things as needed. There's been interviews I've seen where there's been discussions about how some of these bigger pharmaceutical companies might just directly ink agreements with research institutions. But these smaller enterprises that are so reliant on funding, maybe they get swallowed up by larger healthcare enterprises that have the capital and resources to fund some of this research themselves. But I think it's going to be a very dynamic environment for the foreseeable future and have a lot of long-term ripple effects.
Yeah, I was at a conference last Friday at UC San Diego, and there was a networking thing before that, and I just happened to be I ended up in a group that included the dean of biology, of biological sciences at UCSD, and she was saying that they had a new building that they had already laid the electrical for, like the ground, the electrical that's coming into the building, not the whole. They hadn't even started building the building yet, and they just basically stopped developing the building. Like they just they cut off all the development, or put on hold at least all the development, because when the NIH because they fund so much of their existence and their infrastructure with that that overage from the NIH, where they take the university takes a percentage of the NIH grant, and so that they didn't have that funding, they couldn't build this building basically. And then the other thing, completely unrelated, but to the funding, is I think you need to watch out for your picks and shovel companies. So the picks and shovels that are selling to biotechs, so let's say clinical research organizations that are running clinical trials, those probably aren't going to be affected in the next few quarters. But companies like Illumina or Thermo Fisher or Twist Biosciences, those people are selling to biotech companies. Again, those sales probably aren't going to be affected at all, but they're also selling to researchers. And if researchers don't have grant money, they're not going to be spending it on the products that those companies sell or services that they sell. And therefore they may be hurt, in the next few quarters, depending on how deep these cuts are and where, how much of the cuts are to, let's say, molecular biology versus fish and wildlife, right? I mean, fish and wildlife is probably not going to be, grants that are cut in fish and wildlife are probably not going to affect the sales of Illumina's. Maybe they're Illumina sequencing, but probably not 10x genomics, spatial expression thing. So I think it depends on the company, and it depends on where the grants are getting cut from. And I don't think we know that quite yet, but I think that could definitely be some issues for first quarter sales as we get into earnings in a few weeks from now.
Yeah. Well, that was a fun discussion on tariffs.
Yeah, we started off real happy notes there.
We're a happy half hour. Yeah, pharma tariffs. Ed was saying, what companies are at risk? I mean, this is something I think we've been talking about a lot, but some of these bigger pharma companies like Eli Lilly and Pfizer and Johnson & Johnson have talked about the ways in which they are funneling billions towards US-based manufacturing. That's obviously not an overnight switch. Obviously, these are companies that already have significant US manufacturing, but also have global supply chains that they rely on. But with so much capital on hand, I think it's those kinds of companies that are, well poised to adjust. Although, for all the reasons you mentioned, Brian, that's obviously a series of steps involved. But I think we will see this impact all players if, in fact, these tariffs do take form. But most notably, some of the smaller players that, are much more reliant on imports and are less able to adjust their supply chains due to either, the nature of the business or the fact that they are a much smaller enterprise. So I think it's unclear. I think there's a lot we don't know at this point, as you highlight, because we are hearing about some of these tariffs. We haven't actually seen real numbers take effect. And we obviously had some on a completely different industry, sort of surprise auto tariffs that were announced early a couple days ago. But we've already seen, due to the wave of tariffs announced over the last month and a half, that sometimes there will be exemptions and changes within the few days immediately following those pronouncements. So it's very difficult to say with exact certainty what that will look like. We have some emerging comments from management of some of these businesses in terms of how they are working to sort of right size their manufacturing capabilities, but it's still very early stages at this point.
The other place to look in healthcare is medical devices, because I think a lot of medical device companies have moved manufacturing to Mexico because it was cheaper, and because there was an expectation of free trade with the free trade agreement between Mexico, U.S., and Canada. There was a lot of movement of those manufacturing to Mexico, and who knows how that's going to look. The other place to think for pharma is in Ireland, because Ireland has had attracted a lot of pharmaceutical companies to set up shop there by lowering their tax rates. And so it's not a simple, we should move to the US to avoid tariffs, because there's also, if you move to the US, you lose those tax benefits that you have in Ireland. So it's, there's a lot of calculations going on behind the scenes, and that is really difficult for investors to be able to figure out. There's no way that
we don't have that much insight.
Even major analysts at big firms are probably not making any educated guesses that are better than you or I can in terms of figuring out exactly what the potential impacts could be on these tariffs, because the companies haven't even figured it out yet. And as you point out, things change. So you can figure out, do all the calculations in the world and be 100% correct and still end up being wrong in the end, because the tariff changes, the tax rate changes, who knows what else. So I think that it's, I don't know. I feel like it's one of those where you just throw up your hands and you don't really worry about it as much, because you can't really do anything about it. And, there's certainly areas where it's more challenging, if we're going across industries, right? Obviously, like a tourism industry, no tariffs there. So that's probably a lot, that if you're looking to avoid tariffs, that's the place to go. But I'm not sure that is necessarily the right idea in terms of getting your best returns for your investments. So,
yeah, I think that's right. One other story I was watching that I thought was interesting was about Eli Lilly's Alzheimer's drug, Kisunla, which, they famously waited a very long time to actually garner approval for that in the US due to a range of concerns. The FDA had initially rejected Eli Lilly's request for accelerated approval of this drug in 2023. They had at the time cited some concerns about, the limited number of patients in the trial who had been on the drug for a year or more. And then the FDA had extended their review of Kisunla, calling for an advisory committee meeting to discuss the drug's safety and efficacy. And there were sort of concerns that had stemmed from potential for brain swelling, which was detected in a higher percentage of patients on Kisunla compared to another Alzheimer's drug called Leqembi. Those concerns had led to a delay. The drug's approval originally was expected, late at that point, but then it was delayed twice. And then eventually it was approved in July of 2024. It's approved now in the US for individuals with early symptomatic Alzheimer's disease who have confirmed amyloid plaques in the brain. It is broadly expected to be a blockbuster for the business. But something that I noticed today was there was news that came out that Kisunla got a thumbs down from EU regulators over safety concerns. So previously, Kisunla also did not garner regulatory approval from England's drug reimbursement body. And then just today, it was reported that the European Medicines Agency's Committee for Medicinal Products for Human Use, or CHMP for short, recommended against a marketing authorization for the drug's use in early symptomatic Alzheimer's disease. Their contention was that the benefits of the treatment were not large enough to outweigh the risk of potentially fatal events, such as swelling and bleeding of the brain, which is a side effect known as amyloid-related imaging abnormalities. Lilly has said they will seek a reexamination of the decision. So maybe we see, a longer and prolonged review period that eventually leads to approval and follows a similar trajectory for what we saw in the U.S. But it's also worth noting that Leqembi had eventually won regulatory approval from the CHMP, even though it was a restricted patient population. So there has been a rather cautious approach to approval of these types of medicines previously. Obviously, in the U.S., both Kisunla and Leqembi are FDA approved. They do have the black box warning label for the risks that I mentioned. This was interesting. Eli Lilly is a company I follow really closely. I know you follow this one as well. I'm curious to hear your thoughts on this, and if you think that this is something notable for the company.
Yeah, and just to be clear, if people aren't knowledgeable about the way the FDA works versus the way the EMA works, right? So the FDA has advisory committees that make decisions, and then the FDA will listens to their advisory committee, but ultimately makes their own decision. And sometimes they agree with the FDA or with the advisory committee, and sometimes they don't. And so you get some insight into how the FDA is thinking based on the committee meeting, because the FDA is involved in the committee meeting. But ultimately, it's the FDA's decision. So this body, this EMA body, has committee in its name, but it is not the same kind of committee. This is literally like the final decision of whether the EMA approves something or not. So CHMP is what makes the decision, and it's a committee because the EU has multiple countries, so that's why it's a committee, because it's you have the lead regulator that's from one country and other regulators from other countries that are on this committee. But ultimately, they make a recommendation to approve it or not. And if they make a recommendation to approve it, that's an approval basically, because the last step is just for the EU chancellor or something. I can't some sort of like head body to just rubber stamp it basically. That's the technical approval date, but the CHMP is the one that makes the decision or doesn't make the decision. So this is essentially a rejection from the EMA, even though it has its committee in its name. So with that said, I don't think that's really all that surprising to me. The EU is generally been a little bit more cautious than the US. The US has generally been, they generally will, especially most recently, they've been very, if it doesn't seem like if it's a bad enough disease, we'll let almost anything go through, because let's say the Duchenne's muscular dystrophy drug, right? That one was sort of the opposite. It didn't really have any side effects, but also the efficacy didn't seem that great, and they let that one through. Where they also, will let through drugs where they're life-threatening drugs and their patient's going to die anyway, then they'll let things through on side effects that the EU may not actually let through. So I'm not sure that I'm super surprised about this. I think that I wouldn't have been hugely surprised if they went ahead and proved it, especially since Biogen and Eisai's drug got approved, and it's sort of the same mechanism of action. Although there does seem to be a little bit of this brain swelling issue, this urea, that is a little bit stronger in Eli Lilly's drug than in the other drugs. But I sort of think that brain swelling is somewhat can be caused because the drug actually works better. So the brain swelling seems to come because you have these amyloid plaques, and then if you remove the amyloid plaques, then you end up with this vacuum that results in inflammation and brain swelling. And so there seemed to be maybe a little bit better efficacy on Eli Lilly's drug, as well as a little bit worse side effects and I think those may go hand in hand. And so I think that it's sort of surprising to me that I guess it's sort of surprising to me that the EMA didn't let it through, but also given their history, it's maybe not as surprising. I mean, I would have liked them to approve it for people in the EU to be able to get this drug if they choose to get it. But I'm rooting for Eli Lilly, obviously, even though I'm not a shareholder. But I would expect, it doesn't. I mean, I guess it doesn't really surprise me given that EMA's cautiousness on side effect profiles in general.
Yeah, I think that's right. And the other thing as well is, Eli Lilly said, this decision obviously means that Europeans living with early symptomatic Alzheimer's disease and their loved ones who urgently need treatment options will keep waiting, and they do plan to seek re-examination. And this also might be a scenario where, just like we saw for different reasons, sort of a prolonged process and delays as it pertained to garnering approval in the US. It just may be a more prolonged process to get the final, stamp of approval, from the CHMP. It's interesting because Leqembi, which is, obviously made by a rival, these are both FDA approved anti-amyloid therapies for Alzheimer's disease. Kisunla is dosed less frequently than Leqembi. But both of them are, this mechanism of action that targets and removes the amyloid plaques from the brain, and both are administered intravenously, and both have a risk of developing ARIA, amyloid-related imaging abnormalities. So it's an interesting story to watch. I mean, as someone that reports on and follows Eli Lilly very closely, I'm not worried about how it bodes for the business over the long run. I think this is still a fantastic business in my estimation, and I do think this is something they'll overcome. But it was something that caught my attention, particularly as Kisunla is, I think, one of multiple newer drugs for the business that they are looking at as a key source of future growth outside of their, GLP-1 dominancy.
Yeah, I think the other thing to note is that the clinical trials were run a little bit differently. So Eli Lilly's clinical trial, the patients actually stopped using the drug after their amyloid levels went down, where in the Biogen Eisai drug, they took the drug for the entire time. So maybe there's an opportunity for Eli Lilly to work with the regulators in trying to figure out ways to make it. I mean, obviously, I don't think they're worried about the efficacy. It's not the best efficacy in the world, but there's no other real options for patients except for these two drugs in terms of helping the Alzheimer's disease patients. It only slows it down, and it only slows it down a little bit, but it certainly seems to slow it down compared to placebo in both of the individual clinical trials. And so the question is, can you make it safer by, I don't know, doing some sort of testing, more frequent testing or something like that, so that you're less likely to, maybe the rate at which the plaques are going away, if it's going away too quickly, if when we think that that's the cause of the ARIA, then maybe we, slow down the dosing, and that can maybe lower the level of ARIA, the rate of ARIA, and so therefore the ability, then the side effect and the issues associated with ARIA. And so therefore you can potentially make it safer, and maybe it gets approved eventually under that sort of realm, I guess.
Yeah. The other kind of big news about Eli Lilly this week was that they are soon going to release really important data on the weight loss pill that they're developing. That management has said that they plan to release initial results from several late-stage clinical trials on their experimental once-daily obesity pill, or forgliprone. I never know how to pronounce these things, right? The name is so long, but it's one of those things that, this is bringing Eli Lilly one step closer to becoming, the new needle-free alternative for weight loss and diabetes, that the pill could help, broaden access for patients in the US and internationally. It could obviously alleviate some of the supply constraints that have been an issue, for the injection options on the market. But the company said that they're going to release data from 5 studies in patients with type 2 diabetes and 2 trials in people with obesity at 2025. We've already had some comments from analysts. They say we think the pill will be as effective, safe, and tolerable as Novo Nordisk's, semaglutide. There was a comment from one medical director that this could join a growing toolbox of medications and be a real game changer. And it would be the first, oral version of a GLP-1 that could obviously help Eli Lilly capture an even greater share of the market for that class of drugs. And they're currently several years ahead of other drug makers that are developing pills, even the likes of Pfizer. Obviously, Roche is another company working on one. Viking Therapeutics, famously, is another company working on one. And this is a multi-billion-dollar and growing addressable market. Eli Lilly's pill that they're working on, it operates in a similar function to Wegovy, Ozempic. It targets the gut hormone GLP-1 to suppress appetite, regulate blood sugar, but it's not a peptide medication, unlike Wegovy or Ozempic. So it's absorbed more easily in the body. It doesn't carry some of the dietary restrictions that some of these other products do. In January, the CEO of Eli Lilly had said that the pill could receive U.S. regulatory approval as soon as early 2026. So that's worth noting. And the company raked in about $45 billion in revenue in 2024 alone. A huge measure of that came from their portfolio of GLP-1 drugs. So there are a lot of different patients who could, potentially benefit from this, including those who have found success with injections, but maybe don't want to take those injections, would prefer a different treatment regimen. And they've had, multiple ongoing trials and studies in different cohorts of patients, as I noted. There's obviously also, questions about what would pricing look like? How would insurance coverage work? But this is another really interesting candidate that I'm watching in Eli Lilly's pipeline, because it's very curious to me to see how this space is evolving. And of course, Eli Lilly is one of the most notable players.
Yeah, a couple things. While it's not a peptide, it is a awfully large molecule. So I don't know exactly. I don't think they've disclosed exactly how much it's going to cost to manufacture this thing. But obviously, manufacturing of peptides has been a challenge because they're amino acid group that has side chains off of them, right? But that means the molecule is fairly large because it's designed. The pocket that it fits in on the protein is fairly large. So that means you need if you're going to design a small molecule to fit in that pocket, it's got to be fairly large, and that creates a lot of manufacturing challenges, even though it's manufactured through chemical synthesis versus getting manufactured other ways. I think the end result maybe not the manufacturing may not be that great. It may not be that much of a benefit. And then the question is taking it orally once a day better than injecting it once a week? And Novo Nordisk had its conference its annual conference this week, and I read a comment that from one of their executives that said, it's a small needle and they're injected with an auto injector once a week, and so maybe people will be okay, be just as okay with that as taking it daily, taking a pill daily. I think it sort of depends on the person, right? It depends on how comfortable you are with needles and sticking yourself with the needle. It's not quite the same as injecting yourself like you would if you were, getting a shot at the doctor's office, a vaccine, but it's easier than that, but it's still, you still have to inject yourself and you have to be comfortable with it. But the other thing to think about is that I've heard some people say that the side effects are tied to the peak concentration in the body. So if you're taking a daily drug, that means every day you're reaching your peak concentration, right? Because you take it every day, and that's where you hit your peak, and then it gets degraded over the day, and then you hit your peak the next morning when you take, so you're taking it in the morning. Every morning you're hitting your peak. So if the peak is what's causing the the side effect profile, then now you're getting that side effect profile every day versus with a once weekly injection, you're getting that side effect profile once a week. So even though it's injected, you might only feel bad 1 day a week versus feeling bad 7 days a week with an oral medication. We'll have to wait and see what the phase 3 data looks like. But that, that's another potential issue with the oral medications. And there's also once monthly injected drugs that are coming out, that are in late stage clinical or going into late stage clinical testing. So those could be maybe the sweet spot, especially if that really is true, that the peak concentration is the issue. Then you're only maybe getting the side effect profile, feeling nauseous and that sort of thing once a month, which would be even more ideal. So
yeah, it's interesting because there's numerous analysts that have said they expect the pill to be as effective or maybe just slightly less than the injectable semaglutide, which is obviously the active ingredient in Ozempic. There was a February note from one JP Morgan analyst that said for patients that are taking this for obesity, that would imply weight loss of around 13 to 15%, which is about in line or slightly below the 15% average weight loss in phase 3 trials that Wegovy demonstrated. But what's interesting is that in the phase 2 trial of Eli Lilly's orforglipron, they examined different doses of the pill. The highest dose was 45 milligrams, but the company is giving doses of only up to 36 milligrams in phase 3 trials. Overweight or obese patients who took 36 milligrams of the pill once a day lost 13.5% of their body weight on average after 36 weeks in the phase 2 trial. And that compared with an average of 2.3% weight loss for people who received the placebo. And then, those measures among diabetes patients could come in between 6 to 8%, based on, some comments we had subsequently. So it's interesting to look at as well. The other thing that's worth noting is it's going to, as you were talking about, really depend on how patients tolerate the pill. I mean, the rate, for example, of, GI side effects in the trial will be a key focus in phase 3. There are some analysts that have been, looking at these results and saying, the bar for this candidate is nausea rates of less than 25%. They expect orforglipron to cause slightly worse rates of GI side effects in patients with obesity, and that could lead to a tolerability that's worse than Zepbound, but closer to Wegovy, which is obviously made by rival Novo Nordisk. And this, wouldn't just bode well. Obviously, positive data on the pill and a potential approval would bode very well for Eli Lilly, but it would also be really good news for other companies developing oral GLP-1s, because that creates an added wing within the market. And there's all of these other companies I mentioned, like Pfizer, Roche, Viking Therapeutics. Merck is also working on one as well. Amgen has an obesity pipeline, including oral and injectable drugs. So it's a highly dynamic space. And at the same time, if there's disappointing data in that trial, you could see how that could negatively impact perception, whether that is real or actually in practice of some of those other drugs.
Yeah. Well, I'll wrap it up and then we can talk about For the Bees question in the last 4 minutes. I think that I'm under the opinion that weight loss is not going to be the major factor in the end of who wins the race, this ultimate competition of all these different obesity drugs. And then it's going to be side effect profiles, because if your difference between 15 and 20% weight loss is the difference is you take it a few weeks long, assuming there's no plateau, which we haven't seen a plateau in any of the in the current offerings and the data that we've seen so far. If you don't see a plateau, then you're literally just looking for longer. You're just having to take it longer, and you'll eventually reach the same weight loss. So if that's the case, then I'm not sure you really need to worry about the weight loss so much as needing to worry about the tolerability. If the tolerability is good enough, then people will be willing to take it longer and willing to have their weight loss be slower, because eventually they'll be able to hit their target weight one way or the other. All right, so we got 3 minutes left. The For the Bees says, whoever figures out dementia treatments that work, especially Alzheimer's and vascular, will help so much suffering and change the world. Seems like a real solution is elusive. Yeah, and I think the downside of this, in terms of this is an investing show, right? So I mean, yes, we're cheering on every, as patient and potential patients, we're cheering on every dementia treatment, and it runs in my family, so I'm double cheering it on. But the downside is that it's really hard, and there's been hundreds of. I think at one point I saw a report that said there were over 100 clinical trials that had failed in dementia. And so do you want to invest in it? I mean, yes, the potential upside is very, very large. I mean, as probably, I would guess equally as large as obesity in terms of a potential upside, potential market for dementia, especially as the baby boomers age, right? But do you want to invest in a company developing an Alzheimer's disease, given the history of Alzheimer's disease drugs that either they get approved and they just barely work, and their sales, might be blockbusters, but they're certainly not mega blockbusters, and getting to that 30-40 billion dollar range that there's potential for them to, the potential market for the drug? Or do you just want to sit on the sidelines and not get hurt because so many are going to fail in the future? So
yeah, and I think that's, when you look at businesses like this, this isn't for me a reason to invest in a company like Eli Lilly per se, but I think that the company has a wide range of really exciting growth factors in their approved portfolio, as well as their pipeline for the business over the long run. And then this happens to be one sort of, piece of the pie, if you will, that could be a growth driver for the business, but doesn't necessarily change, the investment thesis.
Right. Yeah. I mean, I would definitely rather invest, if I'm going to invest in a company like that, I would invest in a large pharmaceutical company that also has a Alzheimer's disease drug, compared to like something like Casassava that we saw fail. Their clinical trial failed. And, it wasn't a huge surprise given their mess, their phase 2 data was. But that's sort of one and done. You're either a winner and you're, a $20-50 billion company, or you loser and you do, and you look at the potential upside and the potential downside, and the worst I'm going to do is lose all my money, and the most I'm going to do is 10x 20x my money, right? So you look at that sort of that potential investment, and you think, well, this is a no-brainer, I'm going to invest in it because the upside is so much better than the downside. But the reality is you're still more likely to lose all your money than you are to gain that 10x, and so the investment doesn't necessarily make sense, even though I wasn't rooting against Casassava. So
yeah. Well, and with that, we've bled over into the beginning of your next hour. I know Toby, I think, is joining you for the next hour of Fool 24. Brian, it was fun to do another healthcare related hour.
Yeah.
All right. Thanks,
all right.
guys.
I will see you tomorrow, Sunday, I think.
Yeah, Sunday. We'll be back.
All right.
Fool on, guys.
Hey, Toby.
Hey, Brian.
How's it going?
I'm doing well.
We're here for bold predictions.
Bold predictions. Yeah, I did my first one yesterday, and I had a lot of fun. So I'm back today to do some more.
Yeah, this is my fourth one, and I got one tomorrow too. So
nice.
Yeah. So I don't know. Do you want to lead it off with the first one? Because I've been talking for a while, so I could use a
sure. Let me give you a break. I will lead off with mine. I'll mix them up a little bit here. I got two healthcare related ones and one non-healthcare related one. So let me go with the one that I think might be the easiest one here. We'll start with Moderna, a company that I owned, and I think you own, or do you not own?
I do own it. Yeah, I bought my first shares a month ago. So,
so my prediction, my bold prediction on Moderna is that the market cap triples in the next 5 years. I'm looking for a winner, Brian, and I think it's going to happen. I think, and there's a few reasons for this, right? I think, you and I have talked about Moderna before. And as you've noted, they have a quite a nice pipeline, right? A lot of stuff in trials ready to come to market. I feel like one of those, maybe more than one, is going to hit a decent amount. And I think Moderna kind of got ahead of itself, like it became a COVID rock star, right? When this company was created, COVID wasn't really a thing, right? Moderna did not come on the scene with the goal of coming up with a COVID vaccine. That kind of like happened. The technology worked. They were in the right place at the right time. But I think they kind of got sidetracked because they were like, it was kind of like all COVID all the time. Let's kind of pump this thing out. And I think now we're back to basics. We're back to the original plan here. And I like what I see. I'm hopeful. And part of this might be me just wanting my stock to go up. But that's what I'm going with. A triple in the next 5 years.
All right. So you've got a $12 billion market cap currently, just slightly over 12 billion as it closed today. So that would be a $36 billion market cap. And then let's say we want a 8 price to sales ratio. So you're factoring in a little over 4 billion in sales over the next 5 years. So we got maybe 2, maybe from what's on the market right now. Their current guidance is for 1.5 to 2.5 billion in 2025. So let's call it the middle, which is 2. So that means you got to get another 2 billion in sales if you want to, a little over 2 billion in sales if you want an 8. If you assume it's gonna justify an 8 price to sales ratio, which seems reasonable to me if they've doubled their sales in the last 5 years. We're 5 years from now, they've doubled their sales in the last 5 years. I think an 8 price to sales ratio seems reasonable. I mean, any thoughts on my sort of back of the math envelope in my head?
Right. No, I think that's right. I think you've got it right. So all I'm really needing to do here is get a double in revenue over 5 years, which admittedly requires. I think that requires something in the pipeline to be relatively big, right? I don't think
another RSV vaccine is going to get you to $2 billion.
I'm not like crossing my fingers and hoping for another global pandemic with a respiratory virus either, right? I don't think that's the path to success. So I think it's one of these cancer treatments that's in but they have in phase 3 now. That's what's going to have to. I think that's what's going to have to happen, because what I'm also not really expecting here is something that we don't know about yet, for them to announce they're trialing this and for that to kind of get through all the stages. And
that's not going to happen in 5 years either.
Yeah, right.
Yeah.
So we're not.
I mean, it's got to be something in phase 3, because it's got to be something that can get the clinical trials done. You can get the clinical trials done and get it on the market, which is going to take another year. So it's a year to run the clinical trial, a year to get FDA approval, and then that gives you 3 more years to get to $2 billion, which I don't know is doable, but that's a pretty big blockbuster launch. And so I don't know. So I guess that's the downside. We're taking the poll's open. We're taking questions too. So if you've got any questions for Toby, go ahead and put them about Moderna. Go ahead and put those in the chat, in the Q&A, but also hit the poll and go ahead and vote for the poll in the next 2 minutes. So I don't know. I mean, I think the other thing is maybe you don't even have to get to 4. Maybe you don't have to double. Maybe you get $1 billion, $1.5 billion, and then that's enough to get a higher price to sales multiple than what it is now. And then the other thing is, they also have a lot of cash right now, right? So if they launch another drug, then they're going to potentially lower their cash spend, and so then the market cap is not only people doing the valuation is not only what the sales are, but it's also the cash, right? So it's there's the intrinsic value, or there's the the EV, and then there's the actual market cap, and the market cap is the EV, what the valuation actually is, plus the cash, because if somebody voted them, then they would potentially get it. So we're about 2 minutes away from needing a firm decision. You got any last minute things you want to try to convince me of? Because I'm sort of on the fence here.
Yeah, you sound like you're on the fence, right? I can see you trying to talk yourself into this by saying, "No, maybe I don't need 2 million. Maybe I don't need 2 million.
Maybe a little bit less and a higher. I mean, that's the way it looks, right? I mean, it's either got to be. I mean, every billion you put into sales is less price, is a lower price to sales ratio you can have to just and still get to the valuation there. So
yeah. So that I mean, there's a couple ways you can get there, but I think they all come down to one of the pipelines, at least one of the drugs and pipelines, got to hit pretty big, enough so that either you get to that 2 billion in sales, or even a little bit more, or it gets people excited enough that they say, "Oh, hey, this is a little bit. This is gonna. I can bid this up a little bit, right?" So, but it's all the key on something in the pipeline's got to be a success. So it hinges on that. I'm a yay. I think it can happen. What say you, Brian?
All right, I voted yes too.
Nice.
And 86% of people voted with you and me and said yes. There was 14% said they needed more information, and actually nobody was. I didn't talk anybody out of it, so we're 0% disagreed with you. Nice.
I love it. Well, we need some optimism with the market this week. So here we go. Let's hope for a big boost in the next 5 years, my friends.
All right. Eli Lilly is so I'm doing all big pharma. I decided to go all big pharma for this one. So we're starting off with Eli Lilly, and I'm going to say that their dividend yield will reach at least 2% by the end of 2027, and then just to be clear, I'm using the most recent dividend times 4 as the denominator in the numerator, whichever one's the one on top for the yield. So
the final dividend in 2024, you're going to annualize that, and that's going to be 2%.
Exactly.
I got you.
And the way I'm trying to write it was any time between now and the end of 2027. It will reach 2% at any point. And then you're using the most recent dividend times 4 to calculate the dividend yield, which is the way most places, if you just look at on the website, so on whatever website. So if you look at Yahoo Finance right now, the dividend changed in February, but it shows the dividend in February times 4 as the yield. So that's the way you would normally predict it. So the yield right now is only 0.73%. So we've got to more than double the dividend yield, and the dividend has changes each February, as I said, and it's gone up basically 15% every year. So in 2025 it was up 15.4%, in 2024 it was up 15%, and in 2023 it was up 15.3%. So if we get 2 more raises of 15% and we go from $6 that it's at right now annualized, that would be $7.94. And if it doesn't change the valuation right now, if the Eli Lilly's stock price is the same, that's still only a yield of 0.97%. So I've got to go ways to go, and things have to change. But the payout ratio right now is only 44% because they've been able to generate so much cash from their obesity drugs, right? And so there's been 2 factors for why the dividend yield is so low, right? One is that they've increased their free cash flow substantially, and the second one is that their price has gone up, or they haven't increased their dividend that much, and their price has gone up. But that's resulted in a very low payout ratio. Back in the 3rd and 4th quarter of 2023, it was around 78% payout ratio. So if you just look at the most recent free cash flow, the trailing 12-month free cash flow, so it'd be basically all of 2024, that was $405 14 million. And then if you use 78% as the, if you look at 78% of that, you get to 323 million. And then if you use the market cap currently at 738 billion, that would get you to a 4%, 4.38% yield. So if they went and used their current free cash flow and up the dividend so that they were paying out 78% of what they're paying out right now, we could get ourselves up to 4.38%, which obviously is higher than the 2%. Now, all of that is determined by what the stock price of Eli Lilly's shares are. So ironically, if Eli Lilly's shares go down, that helps my prediction.
There's an easy way to get to 2%. Like, let's cut the stock price in half, right? And somehow keep that dividend.
Right.
You would win if that happens, right? You'd be proven correct, but I don't think anybody who's a shareholder would be happy in that scenario.
No.
So here's the thing I'm worried about, Brian. My concern is that if we increase our dividend raise by more than 15%, right? So let's say we don't do 15%, let's do 20. I just say we're going to use more of this cash to pay a higher dividend, right?
Right. I think that has to happen.
That has to happen.
That's my prediction.
My concern with respect to your prediction is if they do that, the stock price goes up, right? Because everyone gets, ooh, look, more money. And then the stock price gets bid up. And so we don't get to the 2% because everyone gets super excited about more cash, right? So that's the nuance here. That's why I'm struggling here, because even if I buy into your idea that they're going to use this cash to pay out more of a dividend in the future, and it's a reasonable case to make. I don't know that I trust investors not to get super excited about that, right? And therefore keep the yield low. Or you see where I'm going?
Right. No, I understand. I understand exactly what you're saying. I mean, I think the thing is that, certainly it's traded at higher than, it was a 6% dividend yield a few years ago. Obviously, it wasn't growing as fast back then. Mm-hmm. So investors were demanding a higher dividend yield to justify the current the growth rate, and so the growth rate is higher, so they don't need the yield as much. So that's an argument that they may not actually, they may not require the, I don't know, they might not require the yield because the
So what we essentially need, we need a scenario where people understand, like they use this cash flow to pay out a higher dividend, but the stock doesn't rise accordingly, which requires some skepticism on sustainability by the market.
Right. So I think if we get some slowdown, that's actually mostly my hypothesis. Is
we get
some slowdown of the growth, not the decline in obesity drug, but a slowdown in the growth of obesity drugs, combined with an increase in the use of the free cash flow because they don't know what else to do with their free cash flow. I think that combination of the two might would get us to 2%.
Perhaps an increase in dividend to appease investors who might be concerned about a slowdown in the obesity market. All right, I can go with that. I think that might be right. I'm going to say I agree with you on this because I agree. I do. I think that's right. We'll see if it works out. But you have me convinced now. I think this combination of factors could get us to where we need to be. And heck, we could also inflate our way there, right? I mean, if inflation goes through the roof, then suddenly a 4 or 5% yield might be table stakes for some of these companies to get people come. I hope we don't do it that way either. But I see a few different paths. Not all of them. I hope yours is the one we take to get there, because that's the one that actually is promising versus the inflation and or the massive stock price cut. All right. So based on our poll so far, Brian, 60% agree with you, 40% disagree with you. So we have some skepticism here. We'll see how it goes.
I mean,
We'll
it's
keep
supposed to
track
be
of this.
bold. It's supposed to be bold. So if everybody's
Yeah.
agreeing with you, then
Well,
you're
right.
not-
If everyone
you're
agrees,
definitely not
that-
a bold enough.
That tells me that there's maybe not bold enough if we
Yeah.
get universal agreement on everything. All right. So we will go on. Shall I do my next one here?
Yeah, let's go ahead and we're on pace or ahead of time. So there's a couple of questions that are not necessarily related to what we're talking about, and we can try to get to those at the end if we have
we can
time.
get to him in there if we have time here. All right. So I'm going to go with my next healthcare related prediction here. Bold prediction. CVS Healthcare sells or spins off at least one part of its business by the end of the year. And I think the boldness there comes from the timing of that prediction.
Definitely.
By the end, December 31. I'm going to hedge a little bit. An announcement of a spinoff
Yes, right.
or a sale by December 31 of this year. Because these things take some time, Brian. You can't just wave your hands and spin off a whole division overnight, right?
Yeah, I think you definitely have to go with announcements if you're gonna.
We'll go with
that
announcement.
short time frame.
Announce it, and I think there's a couple ways this could go, right? So we did hear talk a little bit ago from management saying they were taking a strategic review of their business to look at a potential breakup, right? Strategic options. The last earnings call, I heard a lot less of that. In fact, I didn't really hear any of that, right?
They got a new CEO.
Yeah, right.
So that I think that was the reason why there was less talk of it.
I think that might be right. So, but I think it's still on the table, right? And I could see CVS has over the last few years, right? They've been making a concerted effort to become a integrated healthcare company, is what they want to be, right? They've got an insurance. They're a big insurer, right? Aetna, right? Aetna's the one. I can't keep the name straight with CVS. They have a pharmacy benefits manager within that. They have the Minute Clinics, which you may have gone to, co-located many of them, I believe, with CVS drugstores. They do have that legacy drugstore operation as well. They've got long-term care operation from an acquisition that came. They've got a few of those type of things, but they're trying to become a large healthcare provider, right? Not just this chain of drugstores. As you get bigger, though, I think they're starting to see maybe this doesn't necessarily all fit together nicely the way we might want it to. Maybe it's not ideal. So I could see them spinning off a part of this. I could really honestly see them separating the drugstore chain out and keeping the healthcare business. Caveat there, you'd sign a long-term deal to continue to co-locate the Minute Clinics, I think, is what they would probably structure that way. But I could see that happening. The other piece of this is we've also heard some commentary from the Justice Department about investigating the pharmacy benefits managers, and maybe they shouldn't be part of big health insurers and all that sort of stuff. So there may be some government-driven force breakup, potentially. Or maybe they might do something to get ahead of that if they really think it's happening. We're in March. I'm not sure I expect a government force thing by the end of the year. I think that maybe be expecting the government to move more quickly than they typically do. These things, again, this would require a lawsuit. This would require some, this would take time. But I think you're going to see a breakup or a spinoff of some sort before the end of the year as they get with the new CEO, right? Getting a better handle on what this business is and what he wants it to look like in the next 5 years. And some divestiture, I think, is going to be part of that.
All right. So do you think it's more likely that they spin off the insurance company with the PBM, or do you think it's more likely that they spin off the PBM separately because, of the potential thoughts that the government might, being proactive, I guess, and thinking that way, right? So one way would be the PBM stays with the insurance company, and the other way, the PBM is by itself.
That's a really good question. I think it's more likely that they end up separate, and I'm not quite sure which route that goes. I could see a very strong case for having the PBM with the retail pharmacy chain. I think that would be an interesting combination. In which case, you might see them keep it, but then would they keep the insurance company and spin off the pharmacies, the retail chain and the PB? I'm not sure. I don't know. I think it's more likely they spin off the PBM, and maybe they do it with the pharmacy chain, maybe they don't. But I feel like the PBM is if you had to tell me which part of this business is least likely to be part of the whole, I think it's probably the PBM.
And of course, they bought the PBM before they bought the insurance company.
Yeah.
The PBM, a lot of PBM thing is just doing a pharmacy is being a mail order pharmacy. I mean, there's more to it than that, but a lot of a PBM's business is literally just, cranking out the mail order pharmacy part of the, saving of, that's part of their saving money, selling points to their customers is that they'll be able to sell the drugs for cheaper because they're doing it through a mail order process instead of the other things.
And I think that's why it kind of makes sense for me from saying that I think it makes sense to keep it with the pharmacy, whatever they end up doing with that, the retail chain. So I guess let me put it this way. I expect the PBM and the insurance business to be separate.
Okay.
And
the fifth has a question for you. How does the cost plus drugs approach of avoiding pharmacy benefit managers entirely going to how is that going to impact CVS's business as that becomes more popular for drugs? And then, do you think that drives them one way or the other? Does the existence of cost plus drugs and potentially their expansion of their offerings change the likelihood or not likelihood of CVS staying as a unit over the next year or less than a year?
I think it might marginally increase the likelihood of some sort of breakup. I don't think. I'm not sure that like cost plus drug specifically by itself is the catalyst, right? But I think it's a symptom of the larger problem. It's a symptom of concerns over, hey, this stuff is too expensive and we need to get a handle on it, and the current system isn't working. And current system isn't working. Broad approach there often gets translated into big pharma is too big insurance is too big. We need to make it smaller, i.e., breakup. So I think that motivation that brought this onto the scene is going to help drive some sort of breakup. But I mean, I think it could still be good for CVS long term, even if they keep the PBM or maybe get rid of the insurance company, for instance. They just have to find innovative ways, right? Innovative ways to compete. They have to become a low cost provider. They have to become the efficient provider there. They have to be the ones that's cutting better deals with insurance companies, right? To say, look, this is what we can offer you. This is much, much better. They're just going to have to, I think, have a little bit of a different approach to what they've been doing. But I think the fifth, your question is just another indication that I'm not sure I see the status quo persisting that much longer. I feel like there's going to be some change, whether it ends up being good or bad for consumers, who knows? But there's a lot. I think there's a lot of built-up desire for something to happen, and I think you're going to see that reflected with respect to CVS in some kind of divestiture or breakup.
All right, get your votes in. We'll leave the poll open for maybe another 30 seconds. I'll give my thing, and then we can. There's a question on Moderna that we can hit right before I move on. So I voted against you mostly because of the timing and because I was sort of surprised. So I did a deep dive on CVS right after the new CEO came in, and I was surprised at how much he was talking about synergies between the different groups. And so the fact that he was talking about all these synergies makes me think that he got brought in maybe to not break it up. And the old CEO was she was a lot more interested in breaking it up, and the new CEO is not as that the board decided that probably wasn't the best move, at least not in the near future. And so I think eventually maybe the PBM gets removed because of government oversight, but I don't necessarily think that the government is not going to drive that in the next 9 months, as you pointed out. So I voted against you, but the majority of people were in favor. It looks like we're still getting a few more votes, so I will not give out the results quite yet, but we're pretty close. Why don't we can take this Moderna, since people are still voting. Why don't we take this Moderna question, and then I will close the poll and announce the results that right then. So we had a question 17 minutes ago. Setting aside Moderna's stock, how successful do you think it will be in terms of its products? Would it be in line with Toby's prediction, i.e. a triple? So I guess that the question is the late stage clinical products are in the next 5 years. Those are going to be the only ones on the market, right? The phase 2 things in phase 2 right now, probably if they're on the market, they're going to have just arrived on the market in 5 years, and so therefore won't be hitting a major amount of the sales. So the question is, of the phase 3 products, I guess, what do we think is what's the likelihood of success? And I think the phase 2 data for the cancer product looked really good. So I think that's a huge upside. I guess the other thing that I guess we didn't talk about is I think it's a partnership with Merck. So I'm not sure what percentage the breakdown is, but that could also affect the valuation. Your valuation prediction is that but it could also benefit the company because they've got Merck, which is a major oncology player, helping them get into a new indication that they're not currently in, and so that that could help. But the phase 2 data looked really strong. So the way this works is they take the tumor and they figure out what proteins are expressed on the outside of the patient's individual tumor, and then they create an mRNA expressing a series of mRNAs that express those antigens, those proteins that are on the outside, parts of those proteins that are on the outside of those tumors, and then they put them in the patient, and then those proteins get expressed. The immune system recognizes them as foreign and says, "Oh, now we need to go attack everything that expresses that," just like you would expect it to express something, to attack something like a bacteria or a virus, and then it goes and attacks the tumor. And then you add in Merck's checkpoint inhibitor, which stops the checkpoint that tells the immune system, "Hey, don't attack me." The tumor says, "Hey, don't attack me. I'm you." Same reason, don't attack all the other healthy parts of your body that uses the same mechanism of action. And then you cut that signal off, and now it's more likely to attack. So now it's primed to attack, and it doesn't get the signal, "Don't attack." And so that should help. Toby, you have anything to add on whether you think that what the success, likely success is going to be? I think it's probably going to be the drugs that are going to the cancer drug is what is going to drive sales in the next 5 years, rather than vaccines.
Yeah, that's what I was basing my prediction on in large part there. I think that's where the optimism is right now for Moderna.
All right, we got a couple of comments and maybe a question. I haven't read them all on CVS, and then we'll get to the result. So Jeff M says, "Thank Buddha for Mark Cuban, someone who cares and is doing something." So Mark Cuban, if you don't know, is the backbone behind Cost Plus Drugs. And then the fifth says, "Well, clearly pharmacy benefit managers are doing the opposite of what they're intended to do, make drugs cheaper for the insured, and cost transparency will be contagious." So that, I don't know whether that means it's more likely to be spun out or not, but I think that's generally true. I think they do some things that are that are benefit the insured companies, but also I tend to agree with you with that. Any comments there? We got one more. So then my Jeff M says my Eliquis at CVS is 120. At Express Scripts, it's $50. I hope CVS gets with the program or goes bankrupt. Yeah. So isn't Express Scripts a pharmacy benefit manager? So I'm not sure that argues that pharmacy benefit managers don't work. I think that that sort of counteracts the other comment that pharmacy benefit managers don't necessarily work. I think Express Scripts is part of that's probably that they're not paying overhead retail, and part of it is probably has to do with benefits that the Express Script is giving to your insurance company, would be my guess. All right, so we can close down the poll, and it looks like 75% of people agreed with you, Toby, that CVS will spin off at least one of their things, and most people were not voting for me. So I'll go on to my second one. We're halfway through the predictions here. My prediction is that Pfizer will have a total compounded annual growth rate of at least 12% over the next 5 years. So the dividend currently sits at 6.88%. So that will get us halfway there. That's where I sort of came up with the 12%. I was going to do it based on the S&P 500, but I feel like if the S&P 500 goes on a run, Pfizer isn't going to necessarily benefit from that run. And so that's the reason why I picked 12% versus the S&P 500. And of course, the total returns include not only the dividends, but reinvesting the dividends. So right now, the valuation is pretty low. So, if we get a couple of years of dividends